So guys, if your attempt is in January 26 and you are wondering what questions to solve, how much time allocation you should do to question answer, let me simplify those things for you. I have come up with super 100 very special hand-picked questions for CA Final DT Jan 26 attempts. Now, what are these questions all about? Every question that have been a part of amendment list, every question that have certain trickier points, every question in which you might do something wrong, and every question in which I did something wrong when I was a student. I have compiled every question in this PDF. It appears 100, but there are 141 questions in this PDF, and we will solve each of them one by one. So, hello everybody, welcome to this very special video where we are going to solve super 100 questions for CA Final DT Jan 26 attempt, and that too in exclusive English. First thing you have to do is do like the video and subscribe to the channel if you have not done it now. And if you have subscribed, do share it with one of your friends because it take real efforts to come up and speak English for entire this long. And if you really like, do comment down your experience, what what suggestions you have, what experience you have on this video. Let's start with question number one. Now, what question number one is all about? It is about basic tax rates, normal tax rates, alternate tax rates like 115 BAB, BAA, and special tax rate. This is all about that. Now, first question: the statement of profit and loss of Manav Limited engaged in manufacturing activities for the year ended 31st March 2025 exhibits a net profit of 180 lakh rupees after debiting and crediting the following items. Now, this question is being asked for company. This is the first question that you are going to see in exam. Always, whenever you see this type of question, you have to check the required portion. Write down the net profit and check out the required portion, what they are actually asking you. You are required to just compute the total income. Tax liability of Manav for assessment year 25-26. Manav Limited has opted to pay tax under 115 BAA. Now, required portion is to be checked very carefully because this is what you have to actually do. Let's see the adjustments. Interest of 24 lakh relating to previous year 24-25 was settled by issuing 8% debentures, 10 rupees, 100 rupees each in August 2025. See, we are already aware these adjustments have already been debited and credited to P&L. That means this interest has already been debited to P&L. Should this be debited? Should this be allowed expenditure? We have studied this thing that whenever you have any outstanding interest and you convert that interest into debt, you convert that interest into new loan, it does not amount to payment. So this should be absolutely disallowed. This should be absolutely disallowed, therefore added back. Now, income tax assessment for assessment year 22-23 was completed in September 2023. Okay, last to last year it was completed. Tax demand to 580, which includes surcharge, which includes education. This entire sum has been paid, and paid sum has been debited to P&L. Now, since it is disallowed, any kind of income tax paid is disallowed, so it has to be added back. 580, 10123. This has to be added back. Done, sir. Provision for gratuity. Array, we are already aware that no gratuity provisions are allowed. No gratuity provisions are allowed. We are never allowed any gratuity provisions in debiting of in debit of P&L. No provisions are allowed. Only gratuity paid is allowed. Listen to next point. Expenditure incurred towards foreign travel of the directors of 6.5 lakh to explore opening of a branch in foreign country to market its product of the said. Oh, see, if I have a business in India, for example, of garments, and I want to expand my business to USA, for that matter, my directors went to USA and they spent some money there. Will this be allowed expenditure? Right answer is it should be allowed expenditure because it is expansion of existing business. If this would have been a new business, new line of business, then expenditure would have been disallowed. But since it is existing business, it should be allowed now. So this is allowed expenditure, and this has to be ignored. Remember, ignored. And with ignore, I got to know if you have not subscribed channel and if you are ignoring the channel, I'm saying na Matarani will not. I mean, there will be something wrong happening with you. I'm saying now, you will be about to score AIR 1 and you will be just missing by 1 marks and scoring AIR 2. Now, point number E, paid 82,000 to purchase the raw material for making payment in cash to supplier in a single day. See, if you are making payment to somebody in cash, it is always disallowed if it exceeds 10,000 rupees. So this has to be added. Anyway, it has to be added. Paid 11 lakh to ST of Japan for online digital advertisement. That it does not have any PE, no equalization levy, no TDS has to be no TDS deducted. See, paying for advertisement, equalization levy attracts. If you did not deduct equalization levy, it will be 100% disallowed in current year. Entire 11 lakh has to be added back. Incurred 4.6 lakh on activities relating to corporate social responsibilities. Whatever social responsibilities, whatever CSR expenditure you do, it is absolutely disallowed under section 37. It is your personal expenditure. You do not get any deduction of that. Okay, sir, done. Sold a vacant land to its wholly owned subsidiary and long-term capital gain is 18 lakh has been credited. See, first of all, whenever you have capital gain, that has to be excluded from PGBP. First of all, it has to be excluded. It should go to capital gain head. And since you are already you are selling it to your wholly owned subsidiary now. If you sell any asset to wholly owned subsidiary, it is an exempt transfer. No tax is applicable on this. So no tax will apply. Tax will not apply on this transaction. Very simple adjustment. Now, pay 2.2 lakh to university as donation for research in scientific research under section 35. Out of this, 1.2 lakh is paid via net banking facility and balance via cash. See, you are donating to somebody who is into scientific research. Is this allowed expenditure? Ideally, it is allowed expenditure. Because in under section 35, it is explicitly mentioned that if you donate to somebody who is into scientific research, it is an allowed expenditure. Done, sir. But this provision is not applicable to person opting 115 BAA. Therefore, if you are an entity opting for 115 BAA and donating somebody, it is disallowed expenditure. If you remember, this was disallowed expenditure. Therefore, entire 2.2 lakh has to be added back. This is not allowed. Now, interim dividend distributed of 65 lakhs. See, if you have distributed dividend, it's okay to distribute, but this should never be debited to P&L because this dividend is not allowed expenditure. No, so this has to be added back. This has to be added back. Okay, sir. Contributed 3 lakh towards employees pension fund notified by the government 15% of the aggregate salary and earners allowance. Now, you have contributed 300 lakh, which amounts to 15%. How much is allowed, sir? 14% is allowed. That means 1% excess you have contributed, which implies 20 lakh excess you have contributed. So 20 lakh will be added back. Perfect, sir. Depreciation of 36 lakh. So depreciation of 36 lakh would be allowed to us. This is going to reduce. 36 lakh is the income of the dividend received from Singapore company where we have 28% shareholding. See, whatever dividend income you receive now, that has to be excluded first. This will go to IFOS. This will go to IFOS 36 lakh. Remember, we have received dividend, we have paid dividend. We have received dividend, we have paid dividend. Whenever you see this line, received the dividend and paid dividend, now there is a section that will come into picture, that is 80M. Now you have received dividend of 36 lakh. You have somewhere it is somewhere mentioned that you have paid also dividend. Now what was the amount of payment you have made? What was the amount of dividend you have paid? Yes, 65 lakh is the amount of dividend that you have paid. So lower of 2 has to be allowed to you. That means 80M 36 lakh you would get as deduction. Now, paid 6 lakh rupees as donation to recognized political party via cross check. See, whenever you pay via cross check, it is ideally allowed, but it is only allowed under old tax regime. And that too under 80 GGB you are allowed. Whenever you pay any donation to political party, it is disallowed. While computing PGBP, it is always disallowed. Whatever regime you operate is always disallowed. While calculating deduction, you get deduction under old regime, but under 115 BAA, you don't get any deduction. So for that matter, it has to be always added back. Now, normal depreciation is 62 lakh. That we'll reduce. Out of that, oops, so sorry. This depreciation, the 36 lakh that is mentioned, it is the expense that we have mentioned. So this has to be added back. Normal depreciation 62 lakh we have to reduce. Additional depreciation we don't have to do anything. Brought forward unabsorbed depreciation, out of that normal is 14 lakhs. If you have any unabsorbed depreciation, that unabsorbed depreciation can be reduced simply. Actually, gratuity paid is 105 lakh. See, whenever gratuity payment is, sometimes what they do is they add back the provision and reduce the amount of actually gratuity paid. But sometimes what they do, they net off the transaction. Whatever they have provisioned minus whatever they have paid, they disallow in net. That means 75 lakh. It might happen that they have written net off. It might happen. Done, sir. We are done with all the adjustments. Let me see whether we have done all the adjustments correctly or not. Let me check it for you. 118 lakh, 1 crore 80 lakh rupees is the 24 lakh is to be added, 5.8 and 75 lakh. 24, 5.8, 75 lakh. Wow, sir. 82,000, 11 lakh, 460. 82,000, 11 lakh, 460. Okay, sir. Things seems correct. 220, 65, 20. 220, 65, 20. 36, 6. 36, 6. Every addition that we have to do, we have done. Now, some things have to be reduced. 18 lakh to be reduced. 36 lakh to be reduced. 62 lakh to be reduced. 18 lakh, 36 lakh, 62 lakh. Somewhere or the other, you would see that 14 lakh is also reduced. Dividend 36 lakh, but you got deduction of ATM, that is 36 lakh. Your total income would turn out to be 30042. The same thing we have done. 14 lakh is also reduced. Capital gain is nil. IFOS is also nil. So your total income would turn absolutely correct if you don't do any calculation mistake. Whatever total income you arrive at, it would be taxed at the rate of 22% plus 10% surcharge plus 4% education cess. This is the amount of tax that would be levied to you. Since we do not have any other income other than 22% income, entire income would be taxed at 22%, 4% surcharge, and this would give you proper tax liability. Very simple question. Very, very, very simple question. See, it might happen that you might do certain things wrong. It's absolutely okay. We learn with mistakes. Whatever mistakes you do, just mark them down. Just watch those mistakes portion at least a day before exam. So it will help you a lot. If somebody is watching this, do comment down the timestamp at which we have talked about this so that other people are also aware about this point. Come to question number 2. Yeah. ABC Limited is a manufacturing company engaged in manufacturing of leather products since 1st April 2022. Now, first of all, whenever you see manufacturing term, now you must recall additional depreciation. And whenever you see leather products, now one thing must come to your mind, that is 80JJAA. Now, what is 80JJAA? 80JJAA is additional deduction that you get on new employees that you hire. Now, for that matter, one thing is important. Leather manufacturing entity, even in this business, you can employ employees for 150 days only. Normally, you are required to employ for 240 days at least to get 80JJAA. But in leather manufacturing, you are allowed even 150 days also. In state of Tamil Nadu, as per profit and loss for year ended 31st March 2025, company showed net profit of 1 crore 20 lakh after debiting and getting the following items: 1.2 crore. The opening and closing stock of 55 lakh and 54 lakh. Opening stock was overvalued by 10% and closing stock was undervalued by 10%. Very important adjustment. Do mark it as a star as of now. Now, what the adjustment is? This is P&L. This is opening stock. This is closing stock. Now, provision says opening stock is overvalued. Opening stock is overvalued. Opening stock is overvalued by 10%. That means, can I say that ideally opening stock was 100, but they have overvalued it. That means this is valued at 110%. That means 55 is 110. And ideally it should be 100. That means opening stock ideally should be 50, but we have increased it by 5 lakh rupees. We have increased it by 5 lakh rupees. We have increased it by 5 lakh rupees. What ideally we should do, since we have increased our opening stock, we have increased our expenditure, so we should add this 5 lakh. We should add back this 5 lakh. Yes, sir, done, sir. Similarly, closing stock is undervalued. Ideally, closing stock should be 100, but we have reduced the closing stock in visibility. So, ideally, this 54 lakh is 90%. It should be 100%. That means it should be ideally 60 lakh rupees. Closing stock should be 60. We had shown it at 54. Should be 60, but we have shown it at 54. That means we have reduced our closing stock by 6 lakh rupees. Ideally, this should also be added up. So 6 lakh also to be added up. Ultimately, 11 lakh is to be added up to make this adjustment. Done, sir. ABC Limited paid 10 lakh to foreign currency as sales commission during the year without deducting TDS to Mr. John, a citizen of USA, a non-resident, for procuring orders outside India. Now, what this point is about? Indian company is paying commission to John. John stays in USA. He does not come to India, therefore he is non-resident. What he is doing, he is procuring order in USA for this company. John is procuring orders for this company in USA. Now, is he doing any business in India? No. Does he have any business connection in India? No. Is he earning any royalty fees? No. Is he earning any technical fees? No. He is not earning any income which is taxable in India. This commission is not taxable in India. You can check out the entire section 9. You would not find a single point which taxes such income. Therefore, this is non-taxable income for Mr. John. And since it is not taxable income, you are not supposed to deduct TDS. Therefore, even if this assessee has not deducted TDS, it is allowed expenditure. It is allowed 100%, and therefore we have to ignore this point. Done, sir. 45,000 paid in cash to Mr. Raj, employees of the company at the time of retirement. See, if you make payment to somebody at the time of retirement, na 50,000 in cash is allowed. So therefore, they have made correct amount. So it is also to be ignored. Now, profit on sale of 2,000 shares of Messrs VKL Limited, a listed company, 3,50,000 rupees. Okay. These shares were sold on 7/4/2024 for 250 per share. The highest price of VKL quoted on the stock exchange as on 31st Jan 2018 was 175. These shares were acquired at 75 rupees. Okay, STT was paid both the time. Done, sir. Now, what adjustment has to undergo? Listen. First of all, whatever the profit that we have mentioned in P&L, that has to be removed first. Whenever you have any profit on account of cash shares, that has to be removed from PGBP. It should explicitly go to capital gain. 3.5 lakh should go to capital gain. But actually, it would not go to capital gain. While computing capital gain, there is a different, we have different provisions now. How capital gain would be actually arrived? See, we are selling shares at 250. So 250 the sales value. How much would be cost of acquisition? Cost of acquisition, actual cost of acquisition was actual cost of acquisition is 75. Sales value is 250 and FMV is 175. Now, how much actual cost you would arrive? Lower of 2, 175. Higher of 2, that means 175. 75 rupees per share every company is having on 2,000 shares. That means 1.5 lakh. That means 75 into 2,000. 1.5 lakh is the actual amount of capital gain that this entity is having. So this 3.5 lakh is irrelevant. 1.5 lakh is actual capital gain. Now, when you are going to tax this, now remember, you would get a deduction of 1.25 lakh exemption. And on remaining 25,000, you would be taxed at the rate of 10%. Why is a 10%? Simple reason being because this entity is selling the shares before 23rd July 2024. If you are selling before 23rd July 2024, you would get tax rate of 10%. After that, it was increased to 12.5%. So this is the amount of capital gain that you would see. No. STCG derived from transfer of the capital asset on which no depreciation is allowable under Income Tax Act. Okay. Whenever you have short-term capital gain on non-depreciable asset, that means like gold, on land, if you have any kind of short-term capital gain, now this has to be excluded, and this would again go to capital gain, and this would be not taxable at the rate of 22% because see, depreciable assets are taxed at 15% under 115 BAB. But these assets which are non-depreciable like land, like gold, these are taxable at 22% only. Let me make you sure, take you through. Total income and taxable is to be computed as per 115 BAB in this question. 115 BAB is to be taken, therefore, this STCG others would be taxed at 22%. Now, profit of 7.2 lakh on sale of lot on domestic company, entire shares are being held. Oh, ho, 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 ho. See, whatever profit you have, first of all, remove that profit and take that profit long-term capital gain under section 112. 1 lakh, what was the amount? 7,20,000 rupees. Now, since this 7,20,000 rupees is on account of sale to a 100% subsidiary, therefore it should not be taxed now. If you have any capital gain on sale of asset to your subsidiary only, 100% subsidiary, it should not be taxed. So it is exempt. Therefore, it would be exempt. Perfect, sir. Credits to statement of profit and loss include 50,000 rupees as dividend on 6 April. Okay, whatever dividends you have, remove that dividend and take that dividend to IFOS. Done, sir. 20,000 paid for expenses in connection with inauguration of new branch opened for expansion of the business. Now, whenever you pay any branch inauguration expenses, now it is allowed expense. Inauguration expenses are allowed. Therefore, this has to be ignored. 20,000 paid as penalty to government on failure to perform any contract within the stipulated time. Delay was 4 months and we have to pay 5,000 per month. So 5,000 per month into 4, that amounts to 20,000 rupees. See, if you pay any penalty now, on account of violation of any contract, it is allowed expenditure. But if you pay penalty on account of violation of any law, it is disallowed. So if we are delaying the contract, it is allowed expenditure. We have to ignore this point. We have to absolutely ignore this point. An amount of 5 lakh was paid to manager of the company as voluntary retirement scheme. Now, if you pay 5 lakh rupees as VRS scheme, understand. If you pay any sum under VRS scheme, it should be allowed or disallowed. Should be allowed or disallowed. If you pay any money to somebody into VRS scheme, Should this be allowed? Should this not be allowed? See, it should be allowed, but only 1/5. That means if you have paid 5 lakh, out of that 5 lakh, 1/5 should be only allowed. That means 1 lakh should be allowed, but we have debited entire 5 lakh. So 4 lakh has to be added back. Okay, done, sir. 75,000 was paid by remittance on deposit made by non-residents on goods manufactured by the company. The said payment were outside without TDS. So if we are making payment to somebody outside India, and we were supposed to deduct a TDS on that component. Yes, we were supposed to deduct TDS on that component, and we did not deduct TDS. How much disallowance it would attract? So 100%. Of course, 100% disallowance would attract now. So in that case, what would happen? Entire 75,000 would be added back. Done, sir. Done, done. Now, during previous year 24-25, the company has employed 56 employees. All these employees contribute to recognized provident fund. Now, listen, this point is very important. Huh? We have 56 employees. Yes, sir. Out of these 56, 39 employees were joining on 1st June. That means they were employed for at least 10 months. Done, sir. On a salary of 15,000 per month. Perfect. 14 employees joined on 1st July. 14 employees were joining on 1st July. That means they were employed for 9 months. They were employed at a salary of 45,700. Done, sir. 3 employees were joined on 1st May. That means they were employed for 5 months and their salary was 22,000 per month. If we do total, we would get 56. 6 employees. Perfect. Now, on what employees we would get deduction? Now, on what employees we would get deduction? Important point is we would get deduction on all those employees on which salaries up to 25,000. And those employees who participate in RPF and who those salaries have been paid in account paycheck demand of electronic clearing system. So therefore, on these 14 employees, we would never get any deduction. Whereas another point mentioned, provision says the salaries of 9 employees who joined on 1st June were settled by bearer check. The audit is done before you did. Now, listen what this point says. Out of this 39 employees, 30 employees are such, sorry, 9 employees are such on which we have paid salary in cash. Now, if we pay salary in cash, it would not be given as deduction. It would not be given as deduction. Therefore, only on 30 employees we would get deduction. How much deduction we would get? 30 into 10 into 15,000, 3 into 5 into 22,000 into 30%. We would get deduction of 14,49,000. Now we have two doubts here. First of all, why did we get deduction of these three employees? First of all, I told you in the initial only, in leather business, we are allowed to employ employees for 5 months only. We are allowed to employ for 150 days. So in 5 months, we do have 150 days. So it is allowed. First thing. Second thing. This is the amount of deduction that we would get under 80JJAA. Sir, but what about the salary that we have paid in cash? Will this be disallowed under calculation? Now, salary of 9 employees for 10 months into 15,000. Should this be disallowed under PGBP? Should this be disallowed? 13,50,000 should this be added back? Now, here we have dual interpretation of ICI. First of all, in one question, ICI, what does ICI does treat it as disallowed. ICI adds it back and computes the PGBP. In one question, ICI adds it back and computes PGBP. In other question, what ICI says, ICI explicitly says that whatever the information given is, whatever the information that has been given to you is after considering this impact. This additional information is only for the purpose of 80JJAA. These two assumptions ICI take in two different questions. In this question, they have taken one assumption. In another question, I will give you the another assumption. In both the assumptions are correct. If you add it back and compute the total income, it would be correct in your answer. If you don't add it back, if you assume that ICI has given this as just for 80JJAA, it would also be correct. Whatever you do, just give a note. I'll tell you what. I'll again refer this point to you when I will be telling you the other question in which different treatment has been done by ICI. Let me take you to the answer. We are done with all the adjustments. Now, our question starts with 1 crore 20 lakh rupees of income. We have done the same thing. What additions we have done? 5 lakh, 6 lakh, 11 lakh, 11 lakh adjustment, 4 lakh adjustment, 75,000 adjustment. Now, 11 lakh adjustment, 4 lakh adjustment, 75,000 adjustment. 1350 is to be added back. Now, in this case, now they have added back. 1350 they have added back, but in other question you would see that they have not added back. They would say that additional information is only for the purpose of 80JJAA. For that matter, it should not be added back. This is what they say. Now, 350 to be reduced, 75 to be reduced, 720 to be reduced. First of all, 1350 to be added back, 350 to be reduced, 75, 720 to be reduced, 50 to be reduced, 150 to be taxed, 75 to be taxed, 50 to be reduced, all the adjustments of PGBP done. So 150 to be taxed, 150 to be taxed, that I have already told you, 75 to be taxed. This would give you the entire answer. Now, one thing I have done here, one mistake I have done here is, what they have done is, they have mentioned dividend credit to P&L account is 50,000 rupees. Now, we have taken off 50,000 rupees from PGBP and we have taxed it as 50,000 rupees under IFOS. Now, word mentioned here is received. So ideally it should be grossed up. As of now, ICAI never grosses up. This question is old question, maybe from last year attempt. I have converted them, but in recent judgments, in recent examples of exam in September 25 attempt or in RTPs, ICAI have never grossed up in case of PGBP. Whenever word received is mentioned in PGBP, you don't have to gross up. Therefore, ICAI has never grossed up, so we would not gross up. Whatever mentioned here is, you can ignore this point, just write down 50,000 and your answer would change accordingly. Done, sir. 80 double JAA matches. Similarly, 75,000 is taxed at 22%. 55,000 dividend is taxed at the 22%. Business income is taxed at 15%, and long-term capital gain over and above this is taxed at 10%. This would give you entire answer, and this would give you net tax payable. Now, here one point is also mentioned, that alternatively we could assume that 9 employees that were employed and by making payment in cash, now this impact of these payments is already impacted in PGBP, so we can even answer by not adding up. Whatever the assumptions we took now, whether it should be added back or not added back, both the assumptions are valid. In the other question, I would show you ICAI is not added back. They assume that whatever the information is only for the purpose of 80 JAA only. Done, sir? Yes, sir. Question number 3. Mr. Amit, a resident Indian, invested in virtual digital asset as cryptocurrencies and non-fungible tokens. Now, on 15th April 2024, he purchased 1 Bitcoin. Purchased 60 lakh rupees of Bitcoin, take 1 BTC. His friend Sushil gifted him NFT. He transferred it not, okay, underlying asset, FMV of this 5 lakh. See, now, Amit received a gift. Whenever you receive a gift of 5 lakh rupees as virtual digital asset, it is income. It is income under 56(2)(10). This 5 lakh would be taxable in the hands of Amit as IFOS. Perfect. Sushil had bought them for 4.5 lakh. So Sushil gifted. So Sushil bought for 4.5 lakh, gifted to Amit for 5 lakh. Done, sir. Amit also buys NFT of 10 lakh rupees on this. Amit also bought NFT of 10 lakh rupees. Done, sir. Due to some financial condition, he sold half of the Bitcoin. Now, out of the 60 lakh of Bitcoin, half Bitcoin, which costed rupees 30, he sold half a Bitcoin for 28 lakh rupees. So sales value was 28 lakh. He sold for half lakh or 30 lakh. That means, sales value was 20 lakh, 28 lakh. Cost of acquisition was 30 lakh. That means 2 lakh was the loss on BTC. Virtual digital asset loss. Answer. Whatever the NFT he received from friend, he sold it for 1.5 lakh. Oh my god. This BTC that he received from his friend, he sold this at rupees 6.5 lakh. So 6.5 lakh is the sales value, 5 lakh is the cost of acquisition. So 1.5 lakh is the gain on VDA. Perfect, sir. Important point here is, whenever you sell any cryptocurrencies or any virtual digital asset, you are not allowed any expenditure of transfer. Transfer expenses are not allowed. In addition to that, you are not allowed to set off any losses as well. Not even losses from virtual digital assets are allowed to be set off. So in this case also, virtual digital assets are not to be allowed to be set off. Incurred expenditure, these expenditures are not allowed. He has other income of 6.5 lakh. Done, sir. That means other income is 6.5 lakh. If we do the total of these, 5 plus 1.6 is 7. 7 plus 6.5. Am I doing it correctly? 5 plus 6.5. Wait a second. Just give me a second. 7 lakh plus 6.5 lakh. Sorry, 6.5 lakh plus 6.5 lakh it is. Yes, so 13 lakh is the income. 13 lakh is the income of Mr. Amit. Let's check. 13 lakh is the income. Done, sir. Out of this 13 lakh, 1.5 lakh would be taxed at the rate of 30%, and remaining 11.5 lakh would be taxed at the rate of slab rate. Now, In this case only, whatever the income tax we would arrive at, we would get a deduction. Now, what this question is asking, listen, compute the tax payable. It is not asking just the tax liability, it is asking us tax payable. Whatever tax we would arrive at, it would be incomplete if we don't deduct a TDS. Now, since selling cryptocurrencies, he's selling cryptocurrencies, there would be a TDS element involved under 194S. How much he's selling? He's selling cryptocurrencies of, first of all, he's selling of 28 lakh rupees, and second, he's selling at 6.5 lakh rupees. So he's totally selling at 34.5 lakh cryptocurrencies he's selling. And of this, 1% would be deducted as TDS. Therefore, 34,500 is the TDS amount that would be deducted in his hands. The same answer you would see and the same taxable you would arrive at. Simple question, but beautifully crafted. Small mistake can lead to a wrong answer, and a wrong answer would mean 0 marks. Literally, sometimes examiner can be so rude that he can give you 0 marks for a wrong answer. So if you like the video, do comment down your experience. Do subscribe to the channel if you have not subscribed to the channel yet. Come on to question number 4. Very, very beautifully crafted questions from capital gain. If you are able to solve these questions only now, believe me, your entire capital gain would be done. You can rely on these question answers to the fullest. You don't need to solve any other question. Got it, sir. Incomes from capital gain. Now, following are the details of income provided by Mr. Singh, the assessee for the financial year 30 up to 31st March 2025. Now, what the incomes are? Rental income from the property at Bangalore is 3 lakh rupees. Standard rent is 2.5 lakh and fair rent is 2.8 lakh. Sir, we are not aware about standard rent, fair rent. We are not about actual rent. What the actual rent is? See, first of all, the thing is always actual tax. If it is higher, it has to be taxed. Common sense says only this thing, that whatever the actual rent is, if actual rent is higher, it would be only taxed. So actual rent is to be taxed. This is the first thing that you must be aware. If you are not able to apply the basic logic, then one thing you need to learn. First thing is, whatever the municipal rent is and whatever the fair rent is, you have to take higher of two. Whatever the figure turns out to be, have to compare with compared with standard rent, lower of two has to be taken. This turns out to be expected rent. This is expected rent. Expected rent has to be compared with actual rent, and whatever the higher is has to be taken. Now, whatever the higher turns out to be, it is called gross annual value. You have to reduce municipal taxes from this, and this would give you net annual value. On this net annual value, you have to reduce two things. First of all is 30% of interest. So 30% of standard deduction. Okay, 30% of NAV has to be reduced as standard deduction. Of this, you have to reduce interest expenditure, and this would give you income from house property. And this is the standard format as per CA intermediate. This is you have to follow to get the correct answer. Now, what the income is 3 lakh rupees. So we would take 3 lakh rupees as actual rent. Done, sir. This is the gross annual value. You have paid municipal taxes and water taxes. See, whenever you pay municipal taxes, you get deduction. If you pay municipal taxes of prior years in today, you would get deduction today only. Therefore, entire municipal taxes has to be reduced. 1.85 lakh has to be reduced. This would give us NAV of 1.15 lakh. Now, of this, we get 30% standard deduction, 34,500. Of this, we would get interest. How much interest? 1.5 lakh we have paid. So this would we would get as deduction. This would give us loss. How much loss? 69,500 is the loss amount that we are getting from house property. In addition to that, we have arrears on rent. Arrears on rent. See, rent was receivable because of some disputes in previous year, but we received that rent in current year. Why, sir? Because some disputes can arise at any point of time. Disputes can arise. So for that matter, what happened? 30,000, whatever the arrears were, have been received today. So we get deduction of 30% on that. So ultimately, 70% would be taxed. 21,000 would be your rental income. So net loss on house property would be 48,500. This is the net loss on house property. Done, sir. In addition to that, we have certain additional informations with respect to Chennai property. Now, actual capital gain is coming. Mr. Singh's father had acquired a residential house property in April 2006 at 1.25 lakh and thereafter gifted this property to the SSC. On the same year, it was gifted. Father acquired the property, same year gifted to his son. The property so gifted was sold by Mr. Singh on 10th June. The consideration was received 25 lakh rupees. Oh my god. Now, Understand this. Full value of consideration on the property is 25 lakh rupees. Cost of acquisition was 1.25 lakh rupees. Done, sir. Stamp duty charges paid by the purchaser at the time of registration is 13% as per guidelines is 3,90,000 rupees. Now this tells you something important. See, Mr. Singh is selling, somebody is buying now. If somebody is buying, he is paying stamp duty charges. How much stamp duty charges he is paying? 3,20,000 rupees. And how much percentage it is? It is 13%. That means stamp duty value turns out to be 30 lakh. Stamp duty value is 30 lakh rupees. Can you see something? Sale value is 25 lakh rupees and stamp duty value is 30 lakh rupees. That means there is something wrong happening. There is something wrong happening. If you remember section 50C, section 50C clearly states that if stamp duty value exceeds 110% of consideration, in that case, stamp duty value is to be taken as consideration. Wow. Has he incurred any transfer expenditure? No, sir, he has not incurred any transfer expenditure. What would be the cost of acquisition? 1.25 lakh. But sir, since transfer has taken before 23rd July, indexation would also be given. If you can see, transfer has taken place on 10th June. That means indexation would also take place. So we have to divide it by CII of 122, multiply by CII of 363. 122 into 363. 1,25,000 divided by 122 into 363. This would turn out to be 371,926. Now, how much capital gain would arise? This would be the final figure. 26 lakh 28,073. This is the amount of capital gain that would arise. Will this be sufficient? Sir, it would not be sufficient. It would not be sufficient. Now, why it would not be sufficient? Let me tell you. We have two more points. On 2nd Jan 2020, SSC bought two adjacent flats in the same buildings and made necessary modifications to make it one unit. Investments in separate sale deeds 8 lakh and 7 lakh respectively. Now, SSC bought two houses. If you buy two houses, do you get deduction? See, once in a lifetime, up to 2 crore of capital gain, you can buy two houses. But since in this case, sir, two houses are bought separately and modifications are done and made it one house, in that case, Anand Baspa case law would come into picture and therefore it would be considered as one house only. So whatever purchase price you have incurred for both the houses, it would be one house only. So you would get exemption under 54 for 15 lakh rupees. So please don't use this accent. Please don't use. I will use this accent unless you subscribe to the channel. I will continue using this. I will continue using this accent. Now, 10/10/2024. 10 lakh were invested into bonds of NHAI and allotment was made on first Feb. Now, house was sold on 10 June 2024. Bonds were bought on 10/10/2024. That means within 4 months, bonds were bought. Bonds were issued on 1st June. That means after nearly 8 months, bonds were issued. We may get exemption in 54EC. Sir, ideally, provision says you have to buy the bonds. Buy the bonds imply you have made the payment of the bond. Whether allotment is done, that is not in your hands. No? So ideally, you would get exemption of 10 lakh rupees on this 54EC. So can 54 and 54EC go simultaneously? Yes, they can. They can go simultaneously. Whatever the capital gain turns out to be, let's find out. 25 lakh is the reduction. So our capital gain turns out to be 128,073. It is the amount of capital gain taxable. Is this the correct answer? I would again say no. Why? Why it is not correct answer? Because we have to check which regime Mr. Singh is opting. Compute the taxable income of Mr. Singh assuming he opts out of default tax regime. Since he opts out of default tax regime, remember, under old tax regime, losses from house property can be set off against the capital gain income. So this has to be reduced. 48,500 has to be reduced. Minus 48,500. This would give us 79,573 rupees. This is the amount of income that is taxable in the hands of Mr. Singh. 570, or of course I should say 74. Oh dear God. Oh dear God. Did you get this question? Did you get this question? Sir, beautifully drafted question. Not only includes house property, it also includes some income of capital gain, multiple exemptions, and at the end of the day, set of provisions as well. Answer. Question number 5. So with this space, will we be able to complete the question answers today only? See, you are watching this video as recorded one. You can see the duration. You can see the last question. It is absolutely done. You can see all the questions are done in this duration. Now, determine the capital gain or losses on account of transfer of listed equity shares. Both, okay. In both the cases, we are selling the listed equity shares, equity-oriented mutual funds for assessment year. Wherever the STT is required, we have paid that STT during previous year 24-25. What the questions is, we have two parts. First of all is Prashun. Long breath. Come on to this question. Mr. Prashun purchased 300 shares. Now, cost of acquisition is, sorry, shares are 300 at the cost of 400. Now, cost of acquisition is fixed. Sold all the shares for 1200. That means sales value is fixed. Now, whenever you have capital gain, full value of consideration is to be taken. Full value of consideration is 1200. Cost of acquisition is to be taken. Cost of acquisition is taken at the in this case, cost of acquisition actual cost 400. Then FMV or sales value. Sales value is 1200. See, if shares are listed on 31st Jan 2018, you have to take the highest trading price. So it would be 700. Lower of 2 would be 700 and higher of 2 would be 700. That means capital gain turns out to be 500 rupees per share. And how many shares are there? 300 shares are there. So all in all, 1,50,000 rupees is the capital gain amount happening. On what date shares are being sold? Shares are being sold on 31st May. That means 1.5 lakh would be exemption. 1.25 lakh would be exemption. That means 25,000 the capital gain would be taxed at the rate of 10%, 2,500 plus 4%. It would mean 2,600 would be actual tax payable by the SSC. Simple question it is? Yes, it is simple question. Now let's come to next question. Mr. Raj purchased 200 equity units. 200 shares of equity oriented funds A and B. Now fund A and fund B. Number of units 200 each at a cost of 550. Now cost of this both the units are 550. Done, sir. Units were not listed at the time of purchase. Fund A was also not listed, B was also not listed. Subsequently, Fund A was listed on 1st Jan 2018 and Fund B was listed on 1st of Feb. Remember these dates. These dates are going to help you a lot. On National Stock Exchange, Raj sold all the units on 3rd April 2024 at 900 each. So sales value for both of them is 900 each. So capital gain would be same. It depends. Details relating to quoted price on National Stock Exchange NAV as given below. You have to calculate the capital gain now. Fund A. How much would be full value of consideration? Sir, full value of consideration is very simple. 900 is the sales price. How much would be cost of acquisition? See, actual purchase price is nothing but 550. FMV we have to find out sales value is 900. 900. Okay. Now, what would be FMV? If we have any mutual funds which is listed on 31st Jan 2018, you have to check the highest trading price. Is this listed on 31st Jan? Yes, it is listed because it was listed on 1st Jan only. So up to 31st Jan, it would be still listed. Highest trading price would be taken. That would be 750. 750 would be FMB. Higher of 2 would be taken. Sorry, lower of 2 would be taken. 750. And higher of 2 would be taken. That is 750. So capital gain turns out to be 150 on 200 units, which would turn out to be 330,000 rupees. Fund A. Let's talk about Fund B. Full value of consideration again 900. Cost of acquisition. Actual cost is 550. FMV or sales value. Sales value is 900. Whether this mutual fund is listed on 31st Jan 2018. Sir, it is not listed because it got listed later on. If mutual fund is not listed on 31st Jan 2018, what do? You take the NAV as on 31st Jan. So NAV would be 950. And in this case, you would take lower of 2, it would mean 900. Higher of 2 would mean 900. In this case, you would have no profit, no loss. No profit and no loss, which would combine give you profit of 30,000 rupees. And ultimately, this 30,000 rupees is within the limit of 1.25 lakh. Therefore, ultimately, no tax would be applicable in this case. Question is simple. Question is easy. Question is just a concept builder. But this concept is important. This concept is really important if you are not aware. Done, sir? Beautiful question. Beautiful, beautiful, beautiful question. Beautiful question. Mr. Sanjoy. Mr. Sanjoy is a resident Indian, age 55. I want you all to mark at least triple star. This is a very beautiful question. He has an impressive investment portfolio in various mutual funds. He redeemed his entire mutual fund investment portfolio and bought a villa of 2 crore rupees and spent the rest of life therein. Mutual fund portfolio is given below. Now, what the point is? He's selling mutual fund to buy a villa, selling mutual funds to buy villa, selling mutual funds to buy villa, sale of mutual funds to buy the property. Can you remember one section coming into picture, that is 54F? Yes, sir, 54F is coming into picture. Important point it is, important point. Now, what four mutual funds are? Let's see mutual fund later on. First of all, we see the notes. Fund 1 and 2 have stated 30% of their proceeds are equity shares of domestic company. 1 and 2 have only 30% in equity shares of domestic company. Can I say these are debt-oriented mutual funds? Can I say debt-oriented mutual funds? Yes, sir, debt-oriented mutual funds. If you remember, we had a section called 50AA. 50AA was a section in which we have specified mutual funds. Specified mutual funds imply any mutual fund which has less than 35% invested in equity shares of domestic company. In addition to that, such mutual funds are issued on or after 1st April 2023. Now, which of these two is debt? 50AA, the mutual fund ABC, that is second mutual fund, it is issued on 4th May 2024. Therefore, it is called 50AA mutual fund. This is 50AA, and first one is simple debt oriented mutual fund. What the additional point is, Fund 3 and 4 have invested 70% of their equity proceeds in equity shares of domestic companies. So Fund 3 and 4 are equity oriented mutual funds only. See, taxation would change in case of different types of funds. The investment pattern of the funds remain unchanged over the years. STT have been paid wherever required. You are required to compute the capital gain taxable in the hands of Sanjay. It seems very simple question, but it has multiple points to be tested. Listen to this point. First of all, we have debt oriented mutual funds. What is the period of holding of debt oriented mutual funds? The debt oriented mutual funds are to be checked for two different stages. If it is sold before 23rd July, then 3 years to be checked. If it is sold after 23rd July, it has to be checked for 2 years. In this case, it is sold before 23rd July. That means you have to check for 3 years. Is this held for 3 years? Yes, it is held for 3 years. You can see 2021 bought and sold on 2024. It is held for 3 years. Therefore, it is long term. Therefore, whatever capital gain would turn out to be long-term capital gain. And since it is sold before 23rd July, you get indexation benefit as well. You get indexation benefit as well. That means 120 invested and 140 redeemed. That means 120 divided by CII of year of acquisition. That means 2021 22. 317 into 363. Your actual cost, index cost of acquisition would be 137.413. And your capital gain would turn out to be 2.58668. This would be long-term capital gain under 112. Done, sir. Second one is 50AA. No. We are always aware that 50AA securities are always short-term. Irrespective of the period of holding, you will always have short-term capital gain. So whatever the difference is, 4 lakh would be short-term capital gain. And that too, regular short-term capital gain, slab rate wala. Done, sir. Third one is equity oriented mutual fund. For equity oriented mutual fund, period of holding is 1 year. You should hold units for at least 1 year. Now, in this case, in 2023, you bought, 2024, you sold, December and July. That means less than 1 year you have held. That means this is short term. Whatever the capital gain of 3 lakh you earn, this is short term capital gain under 111A. Done, sir. SBA Growth Fund, you bought in 2022, you sold in 2024. This would be more than 2 years. You held them for more than 2 years. That means whatever capital gain you earn, that would be long-term capital gain under 112A. This is simple. How much capital gain he has arised, how much capital gain he has earned, it turns out to be 19.5868. Yes, 5868 is the capital gain that this assessee has earned. Now, he would get an exemption on 54F. Would get an exemption. Now, on which capital gains he would get exemption? See, on the short-term capital gain, he would not get exemption. On short-term capital gain, he would not get exemption. He would get exemption on this long-term capital gain. And on this long-term capital gain, he would get this exemption. Now, how much exemption he would get? See, one manner is this. One thing is this. Out of 140 and 240, out of this 260 lakh proceeds, He has invested 200 lakh rupees. Therefore, corresponding capital gain should be exempt. 12.5868 should be exempt. This is one way of doing. 12.5868 into 200 divided by 260. This is one way of doing. This would give you 9.6822 amount of exempt capital gain. This is ideally incorrect. Taking the average of two, taking the total of two, take total of two investment, and taking the total of aggregate of the capital gain, this would be wrong method. What ideally should be done is you should do individually. See, out assessee has 2 crore rupees. Assessee has 140 crore of capital gain from this fund and 120 crore of capital gain from this fund. Ideally, you should use the money from which you have earned more capital gain. Ideally, we have 10 lakh rupees of capital gain here now. So can't we use 120 entirely from this and exempt this fully and use remaining balance from this? Use 60 lakh rupees from remaining 140? Can't we do this thing? Can't we do use remaining out of this 140 we should be using 60? So in total we are am I doing it correctly? 150 I should be using 80. I should be using this 80 from this fund. Yes. Yes. See, 120 I have been using from this fund and 80 I have been using from this fund. So out of this 10 lakh rupees, entire 10 lakh would be exempt. And out of this 2.5868, only 80 out of 140 would be exempt. 2.5868, only 80 out of 140 would be exempt. That means 1.4782 would be exempt in total. Now if you see your exemption is more, ideally as a chartered accountant you should practice more exemption. Therefore the first method is wrong. You have to do individually. Whatever more exemption you can get now, you should claim that exemption. In total, how much it turns out to be? Plus 10 lakh minus plus 19.5868. This turns out to be 8 lakh 10,600 for 860 rupees is the amount of exemption. It is the amount of taxable capital gain. 860 rupees. Same that we discussed now is discussed here. 80 out of 80 out of 140 is the amount of exemption here. Entire 10 lakh has been exempted here. This is the amount of exemption you would get. This is the amount of capital gain that would be given to you. Important question, very important question to be discussed. See, exemption has to be logically appropriated and every asset has to be taken care of differently. Now, come on to question number 7. Beautiful question. Beautiful question. Mr. Robert, a non-resident and German citizen, is employed in German company. See, we have a Robert. He is non-resident, non-citizen. Company has P in India. Now we have a foreign company which has P in India. And accordingly, Robert income is charged to tax in India. Okay, so Robert is receiving this income from APE, therefore it should be taxed in India. Robert visited during previous year 22-25, so 24-25 for official days. He stayed for 185 days, 85 days, and salary for that period is 28 lakh rupees. See, if P is paying the salary to the person for coming to India or for providing services in India, it should be taxed in India. So 28 lakh is taxed in India in the hands of Robert as salary. Done, sir. 28 lakh is salary. Robert held, now listen to these things. Huh? Robert held 1200 shares in Nala Peer Private Limited Indian company since 2017. Robert has shares in Nala Peer. Now, shares are 2000. Let's do important stuff. Huh? These shares were acquired for 15. Acquired for 15, that means cost of acquisition is 15. And for acquiring 50,000 USD were sent to India in 1st April 2011. See, money was sent on November 1st. But acquisition was made. Acha, he sold the shares on 26 June 2023 for 43 rupees. It is 2024. 43 rupees he sold the shares. 43 rupees he sold the shares. That means sales value is 43 rupees now. Important point is how much capital gain would it turn out to be? Sir, whenever a foreign company or non-resident invests in unlisted shares of Indian company, They get a benefit. If you remember, they get a benefit. What benefit they get? Sir, whatever capital gain is being calculated is calculated in foreign currency. How much capital gain? Let me tell you. See, 43 shares he is selling, and he has sorry, sales value is 43 rupees for 2000 shares. How much capital gain turns out to be? 43 into 2000, 86,000 is the capital gain. What, sorry, 86,000 is the sales value. See, whatever sales values is to be converted into foreign currency with an exchange rate of average rate on the date of sale. Now, on the date of sale, we have average rate of 74 or 76. Average rate turns out to be 75. So this has to be converted with 75. Your average rate would turn out to be, sorry, he has 1200 shares. Now he has 1200 shares. Not 2000, but 1200 shares. So 43 into 1200. 51,600 divided by 75. So $688 is the sales value. Cost of acquisition would be 15 into 12,000. 1200, sorry. 18,000 is the cost of acquisition. Now, in this cost of acquisition, you have to convert this cost of acquisition with the average rate on the date of acquisition. Date of acquisition is 28th November, and average rate on that day is 60. So you have to convert this with 60. This turns out to be $300. So the capital gain turns out to be 388. This is very simple logic. $388 is the capital gain. Now, since dollar is not taxable in India, and you have to convert this into rupees also. Now, provision says whenever this has to be converted, this has to be converted with the buying rate on the date of sale. Buying rate on the date of sale. Now, what is the buying rate? Buying rate is this column, and on the date of sale is this. So 74 is to be used for conversion. 74 we would multiply. This would turn out to be 28,712 rupees. This is the capital gain taxable in India. Can you tell how much rate would be applicable on this? Can you all tell me how much rate would be applicable on this? Sir, ideally rate should be 10%, because non-resident foreign company had to pay only 10% as taxes in India on unlisted shares. If you remember, this was the benefit given to non-resident foreign companies. Therefore, 10% would be applicable. Apart from that, Robert holds 2,000 shares in Aribits GmbH, a German company which had acquired 145 rupees. AG follows April to March financial year. It sold all the shares of 615 to David, another non-resident. The relevant information as on 31st March 2025 is okay. 2024 is okay. Immovable property is 15 crore. Sorry, total assets are 15 crore. Immovable property worldwide is 12 crore rupees. Aribits has property in India up to 8 crore rupees. Oh my god. Now what this says, Robert has shares in company called Aribits. Robert has shares in this company. He sold these assets to David. Now what this information is about this company, this Aribits has total assets of 15 crore, out of the 8 crore assets located in India. That means, can I say majority of the assets are located in India? Majority of the assets are located in India. Can I say that? Can I say that majority of the assets are located in India? Yes, sir, you can say majority of the assets. Yeah, I should say substantial value of assets are derived from the assets located in India. But if you remember, there was second condition as well, that at least 10 crore worth should be Indian assets. Indian assets should be worth 10 crore. So in this case, 10 crore is not the worth of Indian assets. Therefore, Aribits is not the company where where values derived from Indian assets. Transfer of this Aribits would not be taxable in India because it is not deriving substantial value from assets located in India. Very important point. Very important point. Therefore, whatever the sales as Robert is doing, it is not taxable in India. Dividend received from Aribits of 11 lakh, 1 lakh 12,000. See, this foreign company is paying to Robert. Should this dividend be taxed in India? Right answer is no, it should not be taxed in India. But remember, this dividend is received in India. So if it is received in India, it is Indian income, therefore it should be taxed. Oh my God, sir. Oh my God. What a testability. What a testability. See, dividend received from a foreign company is ideally not taxed in India. Non-resident receiving dividend from foreign company, why should it be taxed in India? But the fact is, dividend is received in India, so it is Indian income. If it is received in India, it is an Indian income, so it should be ideally taxed. Totaling all will give us the answer, required answer. Achha, let's see what the question is asking first of all. You are required to compute the total income of the robot, ignoring the provisions of DTAA. Assume robot opts out of default tax regime. See, if he opts out of default tax regime now, then 50,000 would be the standard deduction he would get on salary. And we are only required to compute the total income, not the taxes. How much it turns out to be 28 lakh minus 50,000 plus 28,712 plus 111. So why your accent changes with time? Array, what should I say? I have no answer to this. 2889712. Ideally, this should be answer 2889712 It turns out same answer. Okay. I have no answer to your question. Why my accent changes? I enjoy speaking different accents. Sometimes it might turn out to be Spanish. Sometimes it turn out to be the French. Sometimes it turns out to be the other accent. Sometimes I even say Tamil accent as well. If somebody is from South India, you can correct my Tamil accent as well. So my accent changes with the time. I enjoy changing the accent. I enjoy speaking. So for that matter, accent would change. Question number 7, please ji come on to this question. A very, very beautiful question. A very beautiful question. Now, what this question says, Mr. Prem is a partner in two firms, X and Company, and has four partners, including Prem, and profit and losses are equal. Prem resigned on 1st April 2024, and on the sad date, the capital balance of each of the partner is 32 lakh. See, this case is the classic example of 45-4, where there is happening a reconstitution, and reconstitution 9b is applicable and 45-4 is also applicable, and partners receives the assets. Therefore reconstitution is happening, and classic example of 9b and 45-4. Now, in order to settle the dues of Mr. Prem, the firm revalues the land for the first time since purchases. Valuer also valued the self-generated goodwill 70 lakh rupees. The firm has following capital assets now. We have Pune land, which was acquired for 15 lakh rupees, is revalued at 50 lakh rupees. That means 35 lakh is the revaluation. Nagpur land acquired at 29.4, revalued at 45, which turns out to be 19.6 lakh of revaluation. Mumbai land 88 lakh acquired, valued at 250, that means 162 lakh is revalued. Goodwill, zero value it is revalued at 70 lakh rupees now. X and Company gave 15 lakh money, and Nagpur land settles dues. Discuss the tax treatment in the hands of the X and Company. Let me brief out the answer case for you. First of all, X and Company has four partners, 1, 2, 3, and Prem. Each of them hold 25%, and Prem has outstanding capital of 32 lakh rupees. He resigned. And at the time of resignation, he is given two things. First of all, Nagpur property. Nagpur property is worth 45 lakh rupees. Plus, he has been given 15 lakh of cash. That means 60 lakh worth nearly he has been given with. First of all, first thing provision asks us to do is assume that this land was sold to an outsider. How much capital gain firm would have arrived? If this Nagpur land were sold to an outsider, 45 lakh would have been full value of consideration. Cost of acquisition would have been 25.4 lakh rupees. But since this firm is giving this property on 1st April 2024, capital gain would be calculated on that day only. And on that day, if capital gain is calculated, it would be indexed. So it would be indexed by 254 into 363. See, indexation rate has not been given in this point, but it will be given to you in exam. So 36.3 would be cost of indexation, cost of acquisition. Capital gain turn out to be 4 lakh 45 lakh minus 36 lakh 30,000. 8 lakh 70,000 would be capital gain in the hands of the firm. It would be taxed at the rate of 20% plus 4%. So this would be the amount of capital gain taxed in the hands of the firm. So tax would be 189.60. And if you see, the answer would remain the same. This is section 9b. Section 9b clearly states that if you are giving any land, if you are giving any property, if you are giving any asset to a partner, assume it to be sold to an outsider, then whatever the capital gain arising in the hands of the firm, that has to be paid. Therefore, this has to be paid. Now, second step, what questions asks us to do? Assume this land was sold to an outsider, then how much capital would have been of the partner? How much capital would have been of the partner? Let me take you through. Understand this. Mr. Prem had a capital of 32 lakh. If this land would have been sold to an outsider, then this 45 lakh rupees of land minus 25.4 lakh of rupees of cost of acquisition. That means 19.6 lakh would have been the profit of each partner. For the total partners, that means 19.6 lakh would have been book profit of each total partners. That means 4.9 lakh would have been addition to the capital. Minus how much taxes were required? 180,460. This is the amount of taxes that total firm has to pay, and since taxes are paid by the personal accounts, therefore 45,000. Just a second. 45 to 40 is the amount of taxes that each partner is required to pay. Now, how much capital of each partner would be? 32 lakh plus 4.9 lakh minus 0.45240. This would be 36 lakh 44,760 is the amount of capital of each partner if this land was sold to an outsider. If this land were sold to an outsider, this would have been the capital of each partner. Profits would have been as per books of accounts, taxes would have been reduced as per the income tax. This would have been capital of each partner if this were sold to an outsider. Now, instead of paying 36 lakh 44,760, you have paid 60 lakh to the partners. Now, therefore, how much amount it turns out to be? 23 lakh 55,240 is the extra amount that you are paying to partner. That means that there is some special benefit you have got from the partner, and that should be taxed in your hands. Some special benefits you have got from the partner, therefore it should be taxed in your hands. Now, since this has to be portioned, you don't need to understand the apportioned area. This is the only thing that you need to understand. Apportionment would be done and answer would be arrived. We have discussed this in detail in the power batch only. The same example we have discussed. If you want to refer this case more now, I would recommend you power batch, English power batch, lecture number 4. In lecture number 4, we have no, not lecture number 4, it was lecture number 3. Because lecture number 3, we have discussed this point in the depth. In entire depth, we have discussed this point. If you want to refer that, you can refer that case as well. Where we have discussed this entire example in entire English, you can refer that example. I don't want to get into depth of this example because it would take much time. Otherwise, this is a very simple question. Whatever the capital gain is arrived, that would be apportioned in the different hands. See, 35 lakh is the different 35 lakh is the appreciation in the Pune property, 162 lakh is the appreciation in the Nagpur property, Mumbai property, and 70 lakh is the appreciation in goodwill. So in this 35 is to 162 is to 1 into 70 ratio, this capital gain would be apportioned into different assets. Now, what would this appropriation mean? Whenever you would be selling these lands, for example, if you are selling this Pune land, what would happen? If you are selling this Pune land, what would happen? Whatever the apportionment has been, this will be reduced from this Pune land. Got it, Ji? Got it, sir. Got it. Come on to next question. Next question, Mr. Monan. Mr. Monan. Mr. Monan is a who remained in country X, returned to India permanently in 1st Feb 2024. Now, draw the timeline. 1st April 2024 is the previous year commencement. He came to India on 1st Feb 2024. He has a house property in country X, okay, from which he earned and received rental income 30,000 USD and 34,000 USD in 2 years. Okay. In this year, previous year 24, 20, 23, 24, he had 30,000 USD. And in this year, he had 34,000 USD. Done. In the bank account in country 8. He is eligible for basic exemption limit of 18,200 on the balance income. He paid taxes on 20% rupees. Okay, the tax was paid. Okay, done, sir. X for both years on 5th April or 10th April respectively from his bank account in India. Done, sir. His business income in India is 12,50,000. Now, Manan has business income of 12,50,000 rupees. He has a land in Indore which was transferred on he transferred land situated in Indore on 23rd December 2024 to Sarthak for 80 lakh rupees. Now 80 lakh rupees he sold, and this land was acquired for 30 lakh rupees. Cost of inflation index, see, we are transferring the land after 23rd July, so no indexation would be given. So capital gain would be nearly 50 lakh rupees. Exchange rates have been given. Compute the tax liability in the hands of Manan for assessment. Assume he opts for default tax regime. Now, my point here is, what should we do of this rental income? What should we do of this rental income? He has earned rental income of $30,000. Now we shall take that rental income first. Then what shall we do? We shall take the rental income. Then we shall add that income to our taxes. We would arrive at average rate of tax. Then we would tax the doubly tax income. We would arrive the relief. How difficult it would turn out to be. You know how difficult it would be. First of all, answer one question. Answer one question. Whether he is resident for this year or non-resident. Whether he is resident or non-resident. Sir, for the entire year he has been to India, that means he is resident. Whether he is resident, ordinary resident or resident, not ordinary resident, answer this. Sir, last year only he came to India on 1st Feb. He did not come to India before that. That means out of the 7 years, he did not fulfill the 730 days condition. Out of the 10 years, he was never resident. Therefore, he is resident, not ordinary resident. And for resident, not ordinary resident, any foreign income is not taxable in India. So whatever the rental income is now, is just jumla. Understand jumla? It's just a jumla. It has no relevance. It has no relevance. Similarly, the exchange rates that you have given na, has also no relevance. Similarly, double tax income, double taxation has no relevance. Entire question is just revolving around the liar what should I say? Whatever. Total income of Mr. Manan turns out to be 62,50,000. Now, how much tax would be applicable? Now, this is important point. On this business income, we would be taxed at the rate of slab. This is very simple. Up to 3 lakh, no tax, 3 lakh to 7 lakh, 5%, 7 lakh to 10 lakh, 10%, 10 lakh to 12, 10 lakh, 12 lakh, 30%. This we are aware. Of this 50 lakh, how much tax it would be? See, here we have a special point. We have to be governed under section 112. Now, 112 exclusively says if you are a resident individual or HUF, and you sell any immovable property after 23rd July, and that was acquired before 23rd July, and you have long-term capital gain, your tax would be calculated with lower of 20% with indexation or 12.5% without indexation. Your tax would be calculated. In this case, how figure would change? See, if I would take without indexation, so 50 lakh into 12.5%, this is the first thing that we do. 625, 6 lakh 25,000 is the tax rate. Tax. Now, if I do the other thing, 80 lakh minus 30 lakh indexed. 30 lakh index. What should we do if we index it? Divide by 331 multiplied by 363. Divide by 331 multiplied by 363. 32 lakh 90,000 030. This is the amount of cost of acquisition, index cost of acquisition. Our capital gain would turn out to be 47 lakh 09,969. And this would be taxed at 20%, which would be 9,41,993. See, of course, 9 lakh is not applicable now, so we would be taxed at this rate only 625. 625 would be the tax rate, and on this slab rate would be applicable. If you see the answer, you would see 625, 941, not relevant. You would be taxed at 625 only, and on other income, you would be taxed at the rate of slab only. Entire income would be heavy, would have surcharge because income exceeds 50 lakh rupees, and we would add education cess, this would give us the tax liability. Simple question it is, very simple question, but question which has too much of misinformation, which can confuse you a lot. Answer. Come on to question number 10. Very beautifully crafted. Sir, it has been 1.5 hours and you have just done the 10th question. Arey Papa, why are you in hurry? We have 10 hours. We have 10 hours. We'll complete the entire questions. Don't need to worry about it at all. Done, sir. Salsa Limited has two units. One unit is engaged in manufacturing of textile, and the other one is into manufacturing of chemicals. As a restructuring drive, it sold the chemical unit. Important point is, sir, it sold the chemical unit as going concern in slum sale for 242. See, whenever you have slum sale, you need three things. First of all is FMB1, FMB2, and net worth. Higher of two would amount to sales consideration, yeah, full value of consideration, and net worth would amount to cost of acquisition. Now, FMB2 has been given to you, that is 242. Whatever money you receive is FMB2, but whatever assets are gone is FMB1. So you have been given with FMB2. On first, October 2024. The balance sheet of Salsi Limited on 1st October is given below, and chemical unit has been given. So first of all, first thing that you do whenever you solve this slum sale na, is to strike down the data that is not relevant. We are only concerned with chemical unit now. So whatever information that has been given for textile unit now, remove that. Whatever information that has been given for textile unit, cut that down. Because it would only confuse you, nothing else. No additional benefit it would give you other than to confuse you. No additional information it would give you. Because sometimes you might take the wrong figure while calculating. So it is always beneficial to cut the figures down. Now, you have been given information. See what informations you have. You have land at chemical unit, which was 70 lakh rupees. You have building chemical unit, 70 lakh rupees. You have machinery, you have investments, you have inventory, you have licenses, you have trade creditors, you have share capital, multiple things you have. Now, chemical unit was established in 2020 and you are selling it in 2024. That means it will be long-term capital gain. Land or chemical unit is revalued at 20 lakh rupees. Oh, land of chemical unit is revaluation reserve of 20 lakh rupees. The land was purchased for 50 lakh rupees and 70 lakh it appears. Stamp duty value 62 lakhs. Oh, see, 70 lakh is the book value. It was acquired for 50 lakh rupees, but it has been revalued by 20 lakh rupees. And this revaluation figure is appearing in revaluation surplus also. Wow, sir, wow. And stamp duty value of this land is 72 lakh rupees. Okay, sir, done. Building and machinery have been shown at the written down value. The stamp duty value of the building is 72 lakh rupees. Okay. So this building is at WDV only. And stamp duty value of this building is 72 lakh rupees. Okay, sorry. Building of this, the value of this land is 62 lakh. SDV of this land is 62 lakh. Now, what the third point is, licenses and franchises were acquired on 1st June 2023, and these were shown at the original purchase price. See, licenses, this is the cost of acquisition. See, we need WTV also. These licenses are to be recorded at WTV. These are acquired on 1st June 2023. So for 2023, so 23-24, 25% depreciation would be attracted. 23 lakh into 25%, which would mean 575 to be reduced. That means their cost, their WTV would be 17 lakh 25,000. This is the WTV of these licenses. So these WTV would be on 1st April 2024. But slum sale is happening on 1st October. Don't we need to calculate this WTV for 6 months also? Don't we need to depreciation? Don't we need to reduce the depreciation? No. The income tax act, whatever the WTV is on 1st April, we take that only. We do not take the WTV as on the date of the slum sale. Unless it is amalgamation, unless it is demerger, unless it is any other case of conversion or succession, we do not calculate depreciation till date. It is a slum sale that is happening. So in that case, we will calculate WTV up to 1st April only. This is the WTV. Done, sir. We calculated WTV as well. Equity shares were acquired on 1st April 2022 at 42 rupees. See, this is the cost of acquisition. If we take the FMV of these, would be 42 lakh rupees. None, sir. We have incorporated all the information. You are required to compute the taxable capital gain in the hands of Celsi. We have to compute the taxable capital gain. That's the only thing we need to do. Now, how do we compute the capital gain? For that matter, we need to compute the FMV1 and net worth. Let's take FMV1. How FMV1 is computed? Let me tell you. We need A plus B plus C plus D minus L. Take the liabilities first. Liabilities is 47 lakh to reduce that liability. What does D imply? D imply immovable property. How much immovable property this SSC has? Take that immovable property at stamp duty value. Stamp duty value is to be checked now. What is the stamp duty value of the immovable property? Sir, we have land as immovable property, take 62 lakh. We have building as immovable property as 72 lakh. So 62 lakh plus 72 lakh would give us immovable property. We have shares. C implies shares. Shares are to be taken at FMV. We have FMV of the shares, 42 lakh. Done, sir. We have any jewelry? No, sir. We have any painting? No, sir. So B is blank. We have other assets. Whatever the other assets are to be taken at book value. Now, how other assets to be taken at book value? Understand this. We have machinery. We have machinery at book value. We have inventories at book value, and we have licenses at book value. All the three things that we have marked will be added. 52 lakh plus 60 lakh plus 23 lakh. 52 lakh plus 63 lakh plus 23 lakh. 1.38 would be 8. 138 lakh would be 8. Now, if we add all the green ones and reduce the red ones, we would arrive at FMV1. How much FMV1 is arrived? 138 plus 42 plus 62 plus 72 minus 47. This would give us FMV1 of 267 lakh. FMV2 is given to us 242 lakh. Higher of 2 would be 267 lakh only. This is the FMV1 that we arrive. FMV2 is calculated as, see, take the book value of, sorry, take the WDV of depreciable assets and book value of other assets minus liability. Now, for that matter, now what I am doing is, let me do some simple mathematics here. I am first of all removing this highlighted portion. Now, try understanding this. Whether land is a depreciable asset or not, no sir, land is not depreciable asset. So land should be taken at book value. What is book value? 70 lakh. Sir, we have to always remove the revaluation portion. So land would be taken at cost of 50 lakh rupees. Done, sir. Whether building is at depreciable, whether building is a depreciable asset or not, yes, it is depreciable asset. Should be taken at WDV, yes, 70 lakh is WDV. Whether machinery is depreciable, yes, it is depreciable, and whatever the value written is WDV only, so we would take that. Whether investments are depreciable, no, sir. So whatever the book value is, we have to take. Inventories, book value you have to take, it is not depreciable. Whatever the licenses are, these are depreciable, we would take this. And liabilities would turn out to be 47 lakh as appearing. Whatever the things that have been marked in blue has to be added. Whatever things that have been marked in red has to be removed. 50 plus 70 plus 52 plus 35 plus 60 plus 17.25 minus 47 lakh. This would give you 237.25. And this would give you entire taxable capital gain 29.75 lakh is the amount of capital gain taxable. If we check the answer, did I do some mistake? Did I do some mistake? Just give me a second. 23 plus 60 plus 42 plus 52 plus 72 plus 62 minus 47. Okay, it is 264 only. I have done some mistake here. So it should be 26.75 only. Now what mistake I have done? Let's find out now. Other assets turn out to be 160, 138 plus 42 plus 62 plus 72. 3 plus 60 plus. It should be 135. 135 it should be. Small mistake. Okay, that's allowed. That's allowed. Okay. Then, sir, this is the amount of capital gain taxable. Now, sir, one question is arising. Do we need to follow this format? See, FMV wise, this A plus B plus C plus D minus L has to be followed. But while considering the FMV2, do you need to follow? Sorry, FMV2 would be given to you. Whether do you need to follow this net for net worth? For net worth, you don't need to follow. You can directly add the sums that have been given in the question. You don't need to separate the depreciable and non-depreciable asset. But for FMV, you need to depreciate. You need to separate A plus B plus C plus D minus L. For net worth, you don't need to do that. Now, done with this capital gain? No, sir. We are not still. We are still not done. We have one question L extra to solve. Now we have question number 11. Mr. Shivansh purchased 11,000 equity shares of ABC acquired from 2007 at a premium of 40 rupees per share. Okay. On 7th 10 2024, company proposed buyback of 1,000 shares at a price of 550. See, Shivansh had 11,000 shares whose cost of acquisition was 10 plus 40, that is 50. Now, out of this 10,000, 1,000 were bought back. Now, whenever buyback happens after 1st April 2000, 1st October 2024, whatever money you receive on account of buyback is nothing but your deemed dividend under 222F. How much money he is receiving? 1,000 shares multiplied by buyback price of 550. That means 5,50,000 is the deemed dividend. 5,50,000 is the deemed dividend. It is the deemed dividend in the hands of Mr. Shivansh. Simple point, no bakwas. Simple point, it is deemed dividend. In addition to that, whatever the cost of acquisition is, 50 rupees is the cost of acquisition for 1,000 rupees. This would be 50,000 would be short-term capital, long-term capital loss in the hands of Mr. Shivansh. Done, sir. This is the entire taxation of buyback. Now, out of this 11,000, 1,000 have been bought back. Now, Shivansh is left with 10,000 shares. Done, sir. ABC distributed assets to the shareholder on the liquidation. Shivansh received 100 rupees per share in cash and plot in consideration of 10,000. See, out of this 10,000 shares that he had, company liquidated itself and gave 100 rupees per share in cash and a plot to Shivansh. The book value and the fair market value is 45 lakh and 60 lakh rupees on the date. Outstanding share capital is 10 lakh rupees. The accumulated profits over 80 lakh rupees. Cost of inflation index has been given to us. Now we have to calculate. Shivansh has not opted for 115 BAC. Now compute the income chargeable in the following hands. Now we want buyback taxation and we want liquidation taxation. See, in buyback, what would happen? 550 would be taxed as deemed dividend. 50,000 would be allowed as cost of acquisition. This is a simple thing. You would see the same thing. You would see the same thing happening in our hands. Liquidation. How much liquidation is being charged to tax? Understand this thing very carefully. See, liquidation, we have two things happening. We have 222C as well. We have capital gain as well. In capital gain, how do we calculate full value of concession? How much assets this Shivansh is receiving? He is receiving cash, 100 rupees for 10,000 shares. That means 10 lakh he is receiving as cash. I can see this. This is happening. Yes, 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 yes. Out of 10,000 shares, he receives 100 rupees per share. If I can mark that point for you, 100 rupees per share is receiving, plus he is receiving a plot as well, whose market value, see, whenever we receive any plot, the market value is only taxed. So he is receiving a plot of 60 lakh rupees. So in total, he is getting 70 lakh rupees. Now listen, whatever money you receive on account of liquidation, remember, some portion would go to deemed dividend. How much portion? The amount to the extent of accumulated profits would go to deemed dividend. Now, how much accumulated profits do we have? See, company has an accumulated profits of 80 lakh rupees. Out of this 80 lakh rupees, Shivansh, see, out of this 80 lakh rupees, total capital, total share capital is 10 lakh rupees. And out of this 10 lakh of share capital, 1 lakh is held by Shivansh. That means out of this 80 lakh rupees of total reserves, 8 lakh pertain to Shivansh. Therefore, 8 lakh has to be reduced from capital gain and 8 lakh would go to 222C. 8 lakh would go to 222C. This would give us 62 lakh rupees as full value of consideration. How much Shivansh has invested to acquire these shares? See, 10,000 shares into 50 rupees was cost of acquisition. That means 5 lakh. Therefore, 57 lakh would be the amount of long-term capital gain happening in the hands of Shivansh. And 8 lakh would go to deemed dividend under 222C. This is the basic fundamental of the entire. Now, if we ask now, your answer, your total income would turn out to be 550 plus 8 lakh plus 57 lakh minus 50,000. This is the entire total income would turn out to be, but it is not asking total income. It is asking us just the taxation of IFOS, and it is just asking the taxation of this liquidation. That's it. They are asking buyback and liquidation. You don't have to answer any other thing. They are just asking you, they do two taxations, and that will give you the proper answer to your question. Clear to this point? Clear to this point, everybody? Well, we come on to IFOS. Come on to question number 12. What question number 12 says? Mr. Hari, a property dealer, sold building in course of business to his friends Mr. Rajesh, who is dealer in automobile part for rupees 90 lakh rupees. Done, sir. Simple point. Hari is a property dealer. Remember, property dealer is important word here. Sold the property to Mr. Rajesh. Now, here Rajesh is a automotive dealer. Now, property is being sold at rupees 90 lakh. Done. Simple point. On 1st April 2024, when stamp duty value was 150 lakh. Now, date of sale is 1st April, 1st Jan 2024, where stamp duty value is 150 lakh. That means on the date of sale, SDV is 1 lakh 50,000, 150 lakh rupees. The agreement was, however, entered on 1st September 2023 when stamp duty value was 140C. This SDV is SDV as on the date of registration. But on the date of agreement, SDV was 140 lakh rupees. Agreement was 1/9/2023. Noted. Hari had received a down payment of 15 lakh rupees through a cross check from Mr. Rajesh on the date of agreement. See, the date on which agreement took place, Hari received a down payment via cross check. Whenever you receive any money via cross check, it does not amount to any payment. Therefore, SDV on the date of registration would only be considered. Therefore, SDV would be 150 lakhs. Now, Hari is a seller who sells property at 90 lakh rupees, but stamp duty value is 150 lakh rupees. Can you remember one section? There was a section called 43C, which puts down restrictions on the property dealers that they cannot sell below SDV. That means SDV cannot exceed 110% of consideration. This was the condition under 43CA. If SDV is lesser than 110% of consideration, if SDV exceeds 110% of consideration, then SDV shall be considered as PGBP. In this case, for Hari, 150 lakh would be PGBP and cost of acquisition for Hari would be given in the question. Assume Hari purchase the property for 75 lakh rupees. 75 lakh would be cost of acquisition. Therefore, 75 lakh would be PGBP for Mr. Hari. And similarly for Mr. Rajesh, since he acquired the property whose stamp duty value was 150 lakh rupees, he acquired for 790 lakh rupees. He has got a benefit of 60 lakh rupees. This would be taxed under 56. So basic principles are these. Done, sir. Would your answer change if Hari is a share broker instead of property dealer? Or whether my answer would change? First of all, if Hari is not a property dealer, he is a share broker. How my answer would change? Let me tell you. First of all, whenever there happens to be a sale, 43CA would not be attracted here, 50C would be attracted. Will my full value of concession change? No, it will not change. Whether my cost of acquisition change? It will not change. Whether head of income would change? Yes, PGBP would not be taxed, here capital gain would be taxed, and since he held it for less than 24 months, it is short-term capital gain. For buyer, it is not going to change at all. For seller, earlier it was PGBP, right now it would become capital gain, but for seller it would change, but for buyer it would not change at all. If you check the answer, you would find the same pointers. That means 75 lakh is considered as business income. In second case, 75 lakh being the difference is short-term capital gain. But for buyer, earlier also it was taxed under 56(2)(10). Right now there is no change in treatment. Answer would remain same. Again, it would be taxed under 56(2)(10) only. Now, answer, very simple question it was. Okay. Come on to question number 13. What this question number 13 says. Beautiful question with regards to how sentence framing should be done, how legal context has to be understood. Very beautiful example of a question. Manju Menon is an SSC from Coimbatore, has 20% shareholding in private limited company called Aurelia Exports Private Limited. Now, company has immovable property in Coimbatore. It was let out to the said company on the monthly rent. The SSC permitted the company to provide the property as collateral security to ABC Bank in order to enable the said company to obtain the loan from the said bank. Consequently, the property was mortgaged to the bank in 2013. At that time, board passed a resolution authorizing the SSC to obtain from the company an interest-free loan advance up to 20 lakh rupees as and when required for making available the said property as collateral to the bank for the said facility enjoyed by the company. In June 2024, Menon asked for advance rent. He received 15 lakh rupees from the company as advance rent in June 2024, which was to be adjusted against the rent payable by the company as the said by the SSC by the said company. After such adjustment, for the year ended 31st March 2025, the amount of advance rent stood reduced to 8 lakh rupees. The accumulated profits as on the opening balance was 10 lakh rupees. Assessing officer, during the course of assessment order, sought to treat the said amount of 8 lakh rupees as deemed dividend under 222E for the income of the Income Tax Act. Okay, done. Can the advance given by Manju Menon by the company shall be deemed dividend under 222E or not? What the question is, let me tell you. First of all, this is Manju Menon. He holds 20% in Aurelia Exports Private Limited. Now, Manju Menon has a land or property, I should say. This property is given on rent to AEPL, Aurelia Exports, on rental basis. And Manju Menon receives monthly rental. And up to this point, it is very easy. Now, Manju Menon has also given an authority that Aurelia can mortgage this property to bank and obtain loan. Now just imagine, I have given my property to a company and I have given also the power to the company that it can mortgage out this property and take loan whenever required. Now what if this company defaults? My property would be defaulted, my property would be gone. Manju Menon has given the property to AEPL, and if AEPL did not pay the money, a property of Manju Menon would be gone. So he wants certain certification, he wants certain safety. For that matter, Board of Director passed the resolution that Manju Menon can take 20 lakh rupees of interest-free loan whenever he requires. Whenever he requires, he can take 20 lakh rupees of loan. Now, he did not take loan because he was aware that if he took loan, it would be considered as deemed dividend. He was aware. Now, what he did not take the loan. He took an advance of 15 lakh rupees. Of course, his property was given to the company and he would be receiving every month advance. He took advance rent. He took advance rent of 15 lakh rupees, and every month's rent was to be adjusted from this advance rent. Every month rent was adjusted. So every month after adjustment up to 31st March 2025, the remaining advance rent left with Manju Menon was 8 lakh rupees. Now he was left with 8 lakh of advance rent. And accumulated profits was 10 lakh rupees. Assessing officer treated this 8 lakh rupees as advance or deemed dividend. He treated this advance as deemed dividend. Now, entire cases, I have given my property and that property can be mortgaged as well to bank. So I have certain things at stake now. In return, I am getting an advance of entire year, and after adjusting still all those advances, I am still left with 8 lakh rupees of advance with me. Now, should this be treated as deemed dividend? First of all, it should not be treated, because ultimately I have given my assets. I am about to provide services. I am about to provide rental services now. So ultimately I have got advance against services. See, by default, whenever any money in the form of loan or advance is given to a shareholder holding more than 10%, it is deemed dividend. But there are certain exceptions to that. If the shareholder provides any services, if it is an ordinary course of business, if it is of trade nature, it is not deemed dividend. Therefore, it is not deemed dividend. This advance is not a gratuitous advance. It is not given out of will. This is given out of the land given. Na? Therefore, this is not deemed dividend. The same was said in case of Pradeep Kumar Malhotra, in case of Calcutta High Court. Same answer you would see. Nothing extra given in this question. Done, sir? Done, 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 done. Yes, sir. Absolutely done, 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 done. Now come on to question number 14. Beautiful question from PGBP. We have too many questions from PGBP. Let's try to go and solve it in one go. Question number 14. Sheetal Limited is a listed company located in Mumbai. Sir, we have not understood the taxation of listed companies. How can you ask? Arey Baba, let's solve it now. It is engaged in multiple activities at different locations. Books of accounts are maintained by each of the units separately. It has multiple units and each unit maintains separate books. The head office maintains books relating to common transaction. All the transactions are consolidated and return is filed at Mumbai. Done. The following information is unit-wise information for the year ended 31st March 2025. Now, chemical manufacturing unit at Jaipur. Company has reported net profit of 300 lakh in the books of accounts. Now, profit is 300 lakh. Let's note it down. It entered into an agreement to use know-how owned by the renowned scientist. The amount of royalty paid during the year was 40 lakh rupees. 40 lakh has been royalty paid. The tax deducted at source on the amount paid up to November is to November 2024 and omitted to deduct tax on the remaining 10 lakh. Oh my god, out of this 40 lakh, 30 lakh royalty has been deducted. TDS has been deducted. On remaining 10 lakh, TDS has not been deducted. So if TDS has not been deducted, ideally it should be 30% disallowed. If you are making payment to somebody for the purpose of royalty and you did not deduct TDS, then 30% of the expenditure should be disallowed. Therefore, 3 lakh should be added back. Done, sir. Done, sir. The payee admitted that royalty is fully income paid tax in up to the due date. Okay. The other person to whom payment has been made, he filed his return of income. He paid the taxes, whatever the cases, he paid the taxes. Therefore, it should be allowed to the Sheetal Limited in next year, not in current year. Now, company paid 89 lakh 60,000 rupees, being 60% of the basic salary plus dearness allowance to NPS scheme. Oh my god, 89 lakh 60,000. Now, this amount 16%. Ideally, we should only pay 14%. So 2% we have paid in extra. Therefore, 89 lakh 60,000 divided by, that means 11.2 lakh has to be added back. 11.2 lakh has been paid extra. It shouldn't have been paid, so it has to be added back now. Furniture manufacturing unit in Pune. Company has a manufacturing unit in Pune. It reports a net profit of 90 lakh rupees now. So this, it is clear. 300 plus 3, that is 314.2 lakh is the profit of this unit. Pune's manufacturing unit turns out to be 90 lakh rupees. Done. Listen, it bought a trademark from Mr. Yellow for 25 lakh rupees on 1st June 2024 and charged expenditure in the books of accounts. 25 lakh has been charged as expenditure for buying trademark. Remember, whenever you buy a trademark, now it is not considered as kind of cost. It is not an expenditure. It is a cost of asset. It is a capital expenditure. Therefore, 25 lakh has to be added back, and 25% on this would be charged to P&L because depreciation is allowed. So 25% of 25 lakh would turn out to be 6.25 lakh would be reduced as depreciation. Listen, unit paid 3 lakh as interest on loan from a loan taken from non-resident. Tax was deducted in March, only remitted in May. So you paid interest to non-resident, deducted in March, paid up to RY. It is allowed expenditure. This has to be ignored. Company paid 7 lakh, being the amount of income tax payable by the employees on non-monetary perquisite. Remember, whenever you pay any kind of tax on non-monetary perquisites for employees, it is disallowed expenditure. It is always added back. It is disallowed. This would give you the profit of furniture manufacturing unit in Pune. Now, third business, fertilizer manufacturing unit in Narmada. Company established a fertilizer producing unit in Narmada, Gujarat, which became operational in July 2024. It has acquired a land of 1 crore and put up a building of 2.5 crore and installed a new plant and machinery for 3 crore rupees. The net profit as per books of accounts is 220 after debiting the depreciation of 25 lakh on building and 45 lakh of machinery. Now listen. First of all, net profit is 220 lakh rupees. First thing we need to understand, this fertilizer producing unit is a specified business under 35 AD. Whenever you have specified fertilizer business, no depreciation is allowed, rather entire cost of acquisition is allowed as deduction. So whatever depreciation that we have debited, that has to be added back. Depreciation of 25 lakh and 45 lakh has to be added. 25 lakh plus 45 lakh is to be added. Whereas if you buy a building of 2.5 crore, then 2.5 crore would be allowed as deduction. 250 lakh will be allowed as deduction. And new plant and machinery of 300 lakh would be reduced. Done, sir, it would be reduced. This would entirely give you profit of the unit, and this would be entirely separate because it is 35 AD. Loss cannot be set off from other heads. Then we have next business of warehousing facility of edible oils at Delhi. Now remember, warehousing business, is it specified? Warehousing for agriculture produce is specified. Warehousing for sugar is specified, but warehousing for edible oil, it is not specified business. It has established a warehousing facility for for storage of edible oil on 1st August 2024. It made investments of 2 crore of land, 3 crore of building, 5 crore of plant and machinery. Net profit is 70 lakh rupees without charging depreciation. Now, if you are not given depreciation, you would get depreciation. Building of 3 crore would give you 10% depreciation, which would mean 30 lakh is depreciation. Plant and machinery of 5 crore, which would mean 15% of depreciation. That means 75 lakh is depreciation. So, all in all, is the 35 lakh is the loss amount from this unit. 35 lakh is the loss amount. No. We have individually got profits of every unit. Now we will club the profits of every entity. This profit has to be clubbed. This profit has to be clubbed with this profit. Separate this fertilizer unit has to be taken separately, and fourth unit, this has to be taken off. This loss has to be adjusted. Now additional information. Company mobilized the capital during the previous year by public issue. The application money was kept at bank for pending allotment. The interest income for this side is 30,20,000 has been credited to general reserve. Now this company came up with IPO. Whenever company comes up with IPO, it receives application money, and till the time allotment is made, such money is kept at a separate bank account. Now, once allotment is finalized, remaining non-allotted money has to be returned back. Now, for this 2 or 3 days, this company earned 3,20,000 rupees of interest on this pending allotment money. Now, whether this should be taxable, ideally it should not be taxable. Why? Because ultimately it is a type of capital income. Why it is capital income? Let me tell you. Now, since IPO money, if you remember, whenever you raise money via an IPO, it is a disallowed expenditure. If expenditure is disallowed, shouldn't the income be also be not taxed? Right answer is yes, it should not be taxed. If any expenditure is disallowed, income should not be taxed. And since it is already not covered, this should be ignored. What I am saying, sir, understand this. We are having 4 different units and we are clubbing all of them. So we do not have any consolidated P&L. We do not have any consolidated P&L. We are making consolidated P&L. Therefore, this adjustment has not been taken place anywhere, no? So it will not be even taking place. Company declared interim dividend of 10% on the share capital being 40 lakh rupees. 40 lakh is the dividend distributed, and 27% shareholding from it received a 56 lakh rupees as dividend in February. Both dividend receipt and paid were credited to consolidated P&L. Now listen. Dividend received and paid had been debited to consolidated P&L. Do we have consolidated P&L? We have individual P&L of every unit, and this is consolidated. Now from individual we are going towards consolidated. Now so we have to adjust these things. We have not adjusted. Dividend received has to be adjusted somewhere. Yes, it has to be adjusted. Dividend received would go to IFOS. IFOS would be 56 lakh. Now we would get a deduction of 80M, that is 56 lakh, or 40 lakh, whichever is lower. 80M we would get, that is 40 lakh rupees. This is the amount of deduction we would get. Turnover of the company is 390 lakh, that means tax rate would be 25%. Company has MAT rate of 20 lakh rupees. The book profit is given below. Okay, no issue. Book profit we will take 15% plus 2%, sorry, plus the 7% plus 4%. This would give us tax as per MAT. Let me take you through the answers. So compute the tax total income of the company and optimum tax liability. See, total income has to be computed. Optimum tax liability, that means tax as per normal regime, and tax as per 115 BAA is also to be considered. In addition to that, every case we have to answer MAT as well. Now let me take you through the answers. 300 lakh plus 300 lakh plus 3 lakh plus 1120. 300 lakh, 3 lakh plus 1120. Everything is correct in unit 1. Unit 2 is 90 lakh plus 25 lakh plus 7 lakh minus 6.25. 90 lakh plus 7 lakh plus 25 lakh minus 6.25 lakh. Now third unit, 220 plus 70 minus 290. 220 plus 70 minus 290. Sorry, 590 it is. No, it is 590. It is 5, sorry, 290, it is 5, it is 550. 550, both of them adding to would turn out to be 550. 260 would be lost. We would not be allowed this loss because this is a specified business loss. Edible business 70 plus 70 minus 105. 70 minus 105 would mean 35 lakh of loss. So every information that is given, we have incorporated that. Now, apart from that, we would have 56 lakh of IFOS income and 40 lakh as ATM. This would give us total income of 4 crore to 10 lakh rupees. Now, this income would be taxed at rupees of 25% plus 4%, so plus 7% surcharge plus 4% education cess. This would be the total tax rate that is applicable to this company. This would give us tax liability, but we are not, we just don't have to restrict ourselves to tax liability. We have to proceed forward and calculate MAT and 115 BAA as well. Here, how MAT would be arrived? We already understood 520 into 15%, so add 7% surcharge and 4% education cess. This would give us the MAT liability. No need to worry about it. Actual tax liability is more than MAT, so MAT is not required to pay it. Now, oh, of course, we do have a credit, so we can use MAT credit as well. How do we compute the profit of 115 BAA? Remember, under 115 BAA, no special benefit is allowed. To be honest, no special benefit is allowed. Only thing that you would get is this deduction of entire plant and machinery would not be given to you. Rather, just depreciation would be given to you. Just depreciation would be given to you. Only difference this would change. If you see, all the profits remain same. All the profits, like for chemical unit, profit remains same. For furniture unit, profit remains same. For warehousing, profit remains same. But for fertilizer unit, profit would change because here you will not be allowed cost of acquisition as deduction. Here would only be allowed as depreciation. Dividend would remain same and ATM would remain same. This would give you tax liability. Of course, this would be higher. Of course, this would be higher. Therefore, it is not required to opt for 115 BAA. Normally, this is just a formality to be done. Of course, if you have 3580, your normal tax liability under old regime would be lower. Therefore, you would only go for old regime only. But since it is given in our case, we have to solve it. We have to solve it, and this would give you marks. Done, sir. Yes, sir. Of course. Of course, we are done with this. Come on to question number 15. Beautiful, beautiful question. Gomti Private Limited is a closely held company. Now, why this closely held company is given, we'll discuss. Is in the business of growing rubber. Whenever any company is into business of growing rubber, remember, 65% of the total income is exempt income and 35% is only taxable. The profit and loss account for the year ended 31st March 2025 of the company shows a net profit of 37.65 crore after debiting the depreciation of 30 lakh rupees, 30 crore rupees. Now, 37.65 crore is the net profit. Of course, add depreciation 30 crore to it, and you would be given depreciation as per Income Tax Act is 28 lakh rupees. That means you would get depreciation of 28 crore reduction. That means your profit would turn out to be nearly 39.65 crore for the purpose of 33 AB. If you remember tea coffee rubber business, you are allowed 33 AB, 40% of the profit or the amount that has been deposited to NABARD, you get a deduction of that. Sir, got your point. The company has provided the following information. Now, company has deposited 30 crore in NABARD. Oh, ho. 30 crore deposited or 20 or 40% of this profit, 39.65 into 40%. 15.5, 15.86. So, of course, we would get 15.86. That means 23.79 is the income. Normally, 23.79 is the income. Now, company has a loss. We would wait for loss. We would wait for loss later on. The company has accumulated balance of 200 crore in the special reserves with NABARD on 1st April 2024. It withdrew 40 lakh rupees and utilized the same for the following purpose. Now, it withdrew 40 lakh rupees. Sorry, 40 crore rupees. Now, it purchased a new sprinkler machine for the use of its operations for 10 crore rupees. Whenever you buy a sprinkler, it is for your business purposes only. It is for factory purposes only. So it is an allowed expenditure. For growing rubber, you require sprinkler. It is allowed expenditure. That is valid. 10 crore is valid. Perfectly valid. Now, you purchase an office appliance for the corporate office at the Chennai. Remember, whenever you buy a corporate appliance or office appliance, it is disallowed. It is misutilized. You cannot use this money for buying office appliance. This would be treated as your income. This is misutilized amount. 10 crore would be added as income. Purchase a computer and accessories for 5 crore. See, computer and accessories, it is assumed that it is used for factories. We have to assume it that computers have been bought for the factory purposes. Therefore, it is allowed expenditure. It is absolutely allowed. Now, what the next expenditure is? Construction of godown at a cost of 1 crore in the factory estates. If godown construction is taking place in the factory premises only, it is absolutely allowed, no issue whatsoever. And repairs to machinery, if you have machines in factory, then you can even expense it out for repairs purposes. Now, these are valid expenses. Done. My issue here is, understand this, my issue here is, it had withdrew 40 crore rupees. Out of this, how much it has spent? Can you do the total of the highlighted ones? 10 crore, 10 crore, 5 crore, 1 crore, 35 lakh. If you can do the totaling of this, you would get the figure. That means 10 plus 10 plus 5 plus 1 plus 0.35. That means 26.6535 crore they have used. Out of 40 crore, they have used this much amount. If you do the difference, that means 13.65 crore is the amount that they have not been able to utilize in previous year. And I told you, if SSC is not able to utilize the amount within the prescribed time limit, within the previous year, it is taxable. Now, in this case, 13.65 would be taxed in the hands of the company. On 31st March 2025, the company had sold a machinery which was purchased on 10th May 2016 for 10 crore. Now, whenever machinery is purchased, it should be held for at least 8 years from the end of the financial year. Now, if this financial year ends on 31st March 2017, add 8 years to that, that means this machinery should be held till 31st March 2025. And just look at this, they sold the machinery on the same date. On the same date it had sold the machinery. Therefore, this machinery had to be taxed again. This would give us the total income. 23.79 plus 10 plus 13.65 plus 10. This would give you 57.44 crore would be total income. As I had already told you, out of this 65 is exempt and only 35% is taxable. That means 20.104 crore is taxable only in the hands of this Gomti Limited. No. Sir, we had losses also. If you can see, you have losses also. Company had brought forward loss of 26 crore pertaining to assessment year 21-22. Mr. A, who continuously held 60% of the shares voting power since incorporation of the company, had sold the entire holding on 1st August 2024. Now, this loss of 26 crore, will this be allowed? Right answer is no, it will not be allowed. Why it will not be allowed? Listen, understand this carefully. If you have any losses, whenever you have any losses and you want to set off these losses in some other year, remember, at least 50% of the shareholding has to be same. If you have losses in 2021 and there were four shareholders who held 100%, now at least these four should hold 51% of the shareholding. At least 51% of the shares are to be held by the same person. Now, since Mr. A, who held more than 60%, has sold his shareholding, therefore more than 61% has been changed. Therefore, this loss cannot be set off. Section 79 warrants this point. Therefore, this loss cannot be set off against any head of income. Remember, this cannot be set off. Therefore, no set off is allowed. Your answer would be this much only. If you check it, the answer, your answer would be this much only. You would see that loss is not allowed as per section 79. Done, sir? Done, sir? Any issue in this point? No, sir. No, sir. No, sir. Well, no issue whatsoever. No issue whatsoever, sir. We are very much clear. Come on to question number 26. Anna. Anna, come on to this question. A very beautiful question. This. The net profit of a Dilip Industries Limited engaged in the manufacturing of iron and steel in Belampalli, notified backward area of Andhra. The debit and credit of the following amount of the statement of profit and loss is a 1,000 lakh G. 1,000 lakh is the amount of a profit and a loss. Okay, sir, noted down. 1,000 lakh of net profit noted down, sir. Depreciation has to be added back, sir. Always added back. Done, sir. Now, company has paid 50 lakh rupees to a scientific research notified by the central government. Now, this scientific research expenditure, whether it has to be allowed or disallowed, it depends on one thing. It depends whether a company is paying under 115 BA or not. Company, you are required to compute total income of the company. Ignore MAT and 115 BA. Therefore, this is allowed expenditure. This is allowed expenditure. We have to ignore this 115 BAA provisions. Now, company has provided interest of 8% of 350 lakh rupees being the amount on borrowed fund from NBFCs on 1st May 2025. Purchase of the machinery, the interest outstanding on 31st. Understand, Anna, this point. On 1st May 2024, this company borrowed the sum for buying a machinery. 31st March 2025, it is unpaid. It paid interest on 1st October 2025. Now, for any company, ROI due date is 31st October. It has not paid the interest, therefore, entire interest would be disallowed. How much interest would be for the year? 350 lakh into 8% into 11 by 12. This would be the amount of interest. 25.67 lakh. Done, sir. Salary of 100 lakh to foreign technicians for installation of machinery at the factory premises was without deduction of TDS. If you pay any salary for installation of machinery, it is always added to cost. It has to be added to cost first of all, and of course, if you are not paid, did not deducted TDS, then too it would be disallowed. So it would be disallowed under both the sections. It would be disallowed under both the sections. General expense include 35 lakh towards bringing the drinking water towards the factory. See, if you are bringing water, bringing drinking water, it is your normal expenditure only now. It is business expenditure. It is legal expenditure. It is revenue expenditure. So of course it would be allowed. Therefore, we have to ignore this point. Donation of 10 lakh towards a political party. Whenever you do any donation, it has to be added back. You get a deduction. Under 80 GGB, you get a deduction of 10 lakh piece. That's it. Now, company incurred 25 lakh rupees towards purchase of the coal smelting furnace, for which expenditure invoice is not available. However, there are indirect evidences that you have bought the goods, online payment, and etc. Auditors have given adverse remark in the audit report regarding the same. Now, what the case is? If I have purchased the goods and I don't have any invoice for that, I have purchased and I don't have any invoices. Should this be allowed expenditure or disallowed expenditure? See, ideally, if I have purchased it, I don't have invoice, but I have indirect evidences. It should be allowed. Now the question is, auditor has given an adverse remark. Will this disallow the expenditure? Right answer is no. It should not disallow the expenditure. Auditor remarks are only his opinion based on which tax authorities would make a judgment. Auditor remarks are not final. Auditor remarks are only the expressions based on which tax authorities would take the judgment. Here it does not actually, it is not the final opinion as to whether expenditure would be allowed or disallowed. Expenditure would be allowed or disallowed only based on Income Tax Act only, not because of auditor's judgment. So if we have actually incurred the expenditure, it would be allowed to us. Now, very important point, very important point, very important point. Listen to this point very carefully. The company has made a sale of 20 lakh rupees to Messrs. A Limited, a company in sole proprietorship concern on 10/10/23. Now, sale has been made on 20 lakh rupees now. Out of this, on 1st Feb 2024, 10 lakh has been written off as bad debt. That means last year only 10 lakh has been written off as bad debt. Last year only 10 lakh has been written off as bad debt. Only written off. Last year only it has been written off. Okay. Due to demise of the sole proprietor, the company could collect only 7 lakh towards the final settlement as on 1st March 2025. The amount recovered was shown as bad debt recovered and credited to profit and loss. Oh, ho, 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 ho. I'm understanding this point. Sale was 20 lakh rupees, bad debt was 10 lakh rupees. That means the recoverable amount is 10 lakh rupees. Out of this recovered amount is 7 lakh. So out of 10 lakh recoverable, we could only recover 7 lakh rupees. So what should be the ideal case scenario? Ideally, 3 lakh is extra bad debt. 3 lakh is extra bad debt. Yes. So ideally, it should be allowed to us. 3 lakh rupees of bad debt should be allowed to us. Yes, sir, it should be allowed. This is the ideal case scenario. But what this useless accountant has done? This useless accountant has credited this 7 lakh to P&L. It has again taxed this 7 lakh to P&L. Now, if I receive any money on account of sale, should this be again taxed? No, sir. When we are doing the entry of sale, already taxation is done on that. But if I am recovering the bad debt, it is already taxed now. See, 10 lakh was recoverable and I received a 7 lakh. So it is already taxed now. This recovery should not be credited to P&L, but this accountant has credited this. So this should be reversed and therefore 7 lakh has to be reduced again. Done, sir. This is about bad debt. Important pointer about depreciation. Very important pointer with respect to depreciation. Come on to additional information with respect to bad debt. Depreciation. Very important question. Very important adjustment with respect to depreciation. Understand this. Written down value of the assets as on 1st April 2024 was as follows. Factory building was 1200 lakh rupees. Whether factory buildings are depreciated at 10%? Yes. Can I say 120 lakh is the depreciation? Done, sir. Computers are depreciated at 40% rupees opening value. That means 20 lakh is the depreciation on computers. Office appliances are plant and machinery depreciated at 15% value. That means depreciation would be 4.5 lakh. Then tractors for the movements of raw materials 20 lakh rupees. It would be depreciated at 15%. That means 3.5 lakh. 3 lakh is the depreciation. Plant and machinery 800 lakh are depreciated at 15% only. Therefore, depreciation would be 120 lakh. Done? Simple. This was easy. Sir, it was easy. Now, factory building of 300 lakh rupees was purchased, put to use on 1st November 2024. 300 lakh was purchased and it was put to use for less than 180 days. That means 5% would be depreciation now. Therefore, how much depreciation would turn out to be? Sir, 15 lakh. 15 lakh. I'm marking it. Marking. Originally, building was acquired for opening depreciation on building would be 120 and depreciation on the newly bought building would be 15. Computers put to use on 1st May 2024. That means 25 lakh of the computer would be depreciated at 40%. This would mean that 10 lakh would be depreciation on computers. Now, opening computers were depreciated at 20 lakh rupees. New computers would be depreciated at 10 lakh rupees. That means this is the amount of depreciation on computers. Do we have any office appliances? No, sir. Office appliances, there is no addition. So depreciation on office appliances remains same, 4.5 lakh. Now, we have tractors. 15 lakh were acquired and put to use on 1st August and 10 lakh were put to use on 1st Jan. Let me listen. 15 lakh will get 15% depreciation and 10 lakh would get 7.5% depreciation. This would mean that 2.25 lakh and 0.75 lakh. This would be the amount of depreciation on the new tractors we have bought. Now, how much amount of depreciation on these tractors would be 3 lakh and 2.75 and 75. This would be amount of depreciation on tractors. This is the total that we have done. Okay. Plant and machinery. Listen to this carefully. Plant and machinery of 500 lakh rupees installed and put to use on 1st Feb 2025. Listen to this point very carefully. Bought plant and machinery is 500 lakh rupees. Remember, there was an expenditure of salaries. If you see, 100 lakh is the amount of foreign technician salary we have paid. It was disallowed. Why? Because it has to be added to cost. Sir, we have not deducted TDS. Will it be added to cost? Of course, it will be added. There is no such provision as to if we do not deduct TDS and it would not be added to cost. It is always added to cost. It is irrelevant that whether we deduct TDS or not, it will be added to cost of asset. So 100 lakh has to be added. In addition to that, if you remember, we had taken a loan on machinery. On 1st May 2024, we took a loan, and this loan was paid on 1/1/2025. This was paid on very late. Very late it was paid. Remember, there is a point which says machinery is put to use on 1st Feb. That means this machinery is put to use on 1st Feb 2024 5 now. That means for this period, whatever the interest we have paid, that will be added to cost of asset. That means 350 lakh was the loan amount, 8% is the interest amount, and this will be 9/12. This will be added to cost of the asset. Very important point. If you want triple star this point, this is very important. That has to be understood carefully. 21 lakh is to be added. That means if you see, 621 is the amount of machinery on which we would get depreciation of 7.5%. 621 is the cost of machinery on which we would get deduction of depreciation of 7.5%. 621 into 7.5. How much depreciation would it turn out to be? Is equals to 646.575. This is the amount of depreciation. And on total machinery, we would get depreciation of, if you can see carefully, 120 is the opening value and 46.576 is the depreciation that we would get on machinery. Are we done with this? Let's see another point. Expenditure incurred towards ISO certification of 10 lakh rupees. It is included in the PP. See, whenever you spend any money on ISO certification, it is a normal expenditure. It is never capitalized. Therefore, it would be reduced. 10 lakh we would get as deduction. We would get deduction of 10 lakh rupees as our expenditure. It is a normal expenditure. It is not a capital asset. Done, sir. A recognition granted to scientific research engaged in scientific research was subsequently withdrawn by the government. See, if we donated somebody who is into scientific research and later on its status of a scientific research has been revoked, what would happen, sir? Nothing would happen. Ultimately, if at the time of giving donation it was available as scientific research, it was known as scientific research, we would get deduction of the same. If at the time of giving it was available. Done, sir. Now, on this machineries, on this addition, last important thing that has to be taken care of is the additional depreciation. We are done with depreciation. By adding the same colored ones, you would get normal depreciation on each asset. We want to calculate the additional depreciation. How much additional depreciation would be added? Do we get additional depreciation on factory? No, sir. No additional depreciation is given. Computers, normally no. Tractors, sir, we get the additional depreciation on tractors, and how much it would be. By understanding this, I am writing this in blue. 15 lakh would get 20% depreciation, additional depreciation, which would mean 3 lakh rupees. And 10 lakh of addition would give you 10% of additional depreciation, which would mean 1 lakh of additional depreciation. And this plant and machinery of 621 lakh would yield you 10% of additional depreciation, which would mean 62.1 lakh of additional depreciation. That means you would also have to add this additional depreciation of 3 figures. Now, whatever the figures that I have highlighted one by one, just add them down and let's see how much depreciation turns out to be. 120 plus 20 plus 4.5 plus 3 plus 120 plus 15 plus 10 plus 3 plus 1 plus 2.25 plus 0.75 plus 46.575 plus 62.1. This would give you total depreciation of 408.175, or I can simply say 408.18 is the amount of depreciation. Very beautiful adjustment. If somebody is watching till this far, do mention down the timestamp of this adjustment. Also, if you have not subscribed, do subscribe to the channel now. You are not subscribing to the channel also. Very bad person you are. No, 1000 lakh is the net profit. We have got the same. 350 to be added, 250, 25.67 and 100 to be added. 350, 25.67 plus 100 to be added. 10 lakh to be added, 3 lakh and 7 lakh to be reduced, and 10 lakh to be reduced. 10 lakh to be added, 3 lakh, 7 lakh to be reduced, 10 lakh to be reduced. Depreciation, how much depreciation totally turns out to be 408.18. 408.18. Oh my god, sir, how can you get the exact answer at first go and 10 lakhs deduction? Why will we not get the exact answer? Just tell me one thing, why will we not get the answer? Are we doing something very suspicious thing? No, we are just sticking to the basics. That's it. Now, question number 11. Sorry, question number 17. Messrs MPK Pharma Limited, a company resident of India in which public is not substantially interested. Okay. Is engaged in the manufacturing of pharmaceutical products. The statement of profit and loss for the year ended 31st March 2025 shows a net profit of 50 lakh 75,000 after debiting and crediting the following items. Now, profit is 50 lakh 75,000. Done, sir. One-time license fees has been paid to the foreign company for obtaining license fees. See, if you have taken license fees, it is nothing but a depreciable expenditure. So one-time license fee has to be added back, and 3 lakh amount of depreciation is to be reduced. Now, what happens is now they do some contradictory treatment in license fees. Sometimes they take it as entire expenditure. Sometimes they treat it as depreciable assets. Whatever treatment you do, just mention the note here. Whatever the treatment you do, both the treatments are correct. Whatever the treatment they do, they give an alternative treatment in the notes. So both the treatments are correct. Now, convertible debentures were issued by the company on which expenditure on the issue and collection was 350. See, whenever you issue any debentures, whether that expenditure is allowed or not, sir, it is absolutely allowed. Issue on shares, it is not allowed, but issue on debentures, it is allowed. Even though these debentures would be converted into shares, even though it would be allowed, so it is allowed expenditure, it would be ignored by us. Done, sir. Company paid 225 to the share brokers for the transaction in relation to equity shares listed in stock exchange and 120 for the transaction in relation to MCDX. TDS have not been deducted. Now listen, as a company who is into who is a company who is into manufacturing pharmaceutical products. Remember, manufacturing and pharmacy, both the things are to be understood carefully. Why would be trading in shares if we are doing manufacturing business? We don't have to do any trading related to shares now. So it is not our business expenditure. Therefore, 225 has to be added back. But trading in MCDX would be okay because we require raw materials. So trading would be done in MCDX. So it is a regular expenditure. So in regular expenditure, if you did not deduct TDS on this 120, 30% would be disallowed. That means 36,000 would be added back in this case. Now, it had contributed 15% of basic salary NPS referred under section 80 CCD towards salary paid to the employee Gaurav, whose basic salary is 6 lakh rupees and earners allowances 30% of the basic salary and 50% is to be considered as retirement benefit. Oh wow, sir. Oh wow. Now, how much we have contributed, it is important. We have contributed 15% of the basic salary. Now, what is the basic salary? Basic salary is 6 lakh rupees. 6 lakh into 15%, which means we have contributed 90,000 rupees. See, I'm just telling you in brief. I'm telling you in brief. Whenever we would add something to it and calculate 14% of that, always it is going to be higher now, because adding 6 lakh and adding 6 lakh added something and take 14% and take 15% of 6 lakh, it would mean that of course 14% would be higher would be. So whenever whatever expenditure we have incurred is correct, 15% of basic salary or 14% of basic salary plus dearness allowance in terms of retirement benefit, of course this would be higher now. So we have only paid the required amount. We have only paid the required amount. Therefore, whatever NPS contribution we have made is correct. It is valid in law. Therefore, it has to be ignored. Now, if you did not understand the last portion, let me take you through. Now, what this point says, see, 6 lakh, 30% of this is the dearness allowance. That means 1 lakh 80,000 is the retirement benefit. Of this, 50% contributes to retirement benefit. That means 6 lakh 90,000 would be the salary for the purpose of retirement benefit. On this, 14% is allowed. On this 14% is allowed. That means 96,600 is allowed. We have paid 90,000 rupees. So it is allowed now. Whatever we have paid is valid. 7 lakh have been incurred for providing freebies to the doctors. Always add back. Always add back. Expenditure of 520 towards feasibility study for examining proposal for technological advancement of the existing business. The project is abandoned. See, if you do any feasibility study report for existing business, whatever technological advancement you want to do in existing business, it is allowed expenditure. It has to be ignored. Now, depreciation on the basis of useful life has been charged. Whatever depreciation you have charged, add back. Employees Provident Fund for the March month 520 has been remitted on May, and in 260 for the employers. Oh, 220 260 is the employer's contribution. This is late. Even though it is late, if it is paid up to ROI, it is allowed. But employees' contribution cannot be late by date. It is late, so it should be disallowed. Therefore, 260 is to be added back. Swachh Bharat Kosh, 2 lakh is to be added. Whenever you donate any money to Swachh Bharat Kosh, you get deduction under 80G. You get deduction under 80G. And since it is related to Bharat, then it would mean 100% only you would get, 100% under 80G you would get. Industrial concession, power concession you got from central government. See, whenever you get any concession from power, central government, state government, it is PGBP only, so it is already taxed, so it has to be ignored. Interest and borrowing costs amounting to 6,85,000, 5,65,000, though not meeting the criteria for revenue recognition as a component of cost, is included in the opening and closing stock respectively. Oh dear God. Oh dear God. See, opening cost was something and closing stock was something. Whatever the opening cost was, we have added 6,85,000 to opening cost as interest expenditure, and we have added 5,65,000 rupees as interest cost rupees to our closing stock. See, this should not be added now. So whatever expenditure extra we have claimed, we would add back, and whatever income that we have increased, that has to be reduced. So net expenditure would be adding 1,20,000 rupees in net. That would give the entire benefit. That would nullify the entire impact. The profit for setting up the warehouse from the rural area before claiming the deduction under 3580 was 10 lakh rupees. Warehouse commences its operation now. Whatever the profits we have from here, we will transfer this to separate business account. Whatever the profits we have, whatever the profits we arrive at from 3580, we have to calculate it separately. Answer. Company has following additional information. Company collected 14 lakh from GST from its customer before the due date. Consequently, an appeal was filed. Honorable High Court gave 5 lakh rupees to the company and it returned 2 lakh rupees from whom GST is collected. Now listen. You collected from customer 14 lakh of GST, you paid it to department. Now there is an appeal which made you refund of 5 lakh rupees. You got a refund of 5 lakh rupees. Now this 5 lakh has to be transferred to customers. Now you only transferred 3 lakh rupees. Therefore 2 lakh is kept with you. It is your deemed PGBP. So 2 lakh is to be taxed in your hands. Now, company has brought forward loss of 13 lakh rupees relating to assessment 21-22. Mr. X, who continuously held 55% of the voting power, has sold his shares. Therefore, this will not be allowed. Not allowed, not allowed, not allowed, not allowed. This would not be allowed. Done, sir. Depreciation allowable as per income tax rule 14 lakh 50,000 rupees. It would be allowed. So we have to reduce this thing. Company has invested 35 lakh in construction of warehouse in the additional life. This includes 20 lakh of land. So 35 lakh construction you have incurred. Out of this, 15 lakh is towards building and 20 lakh towards land. Deduction for land is not allowed. Therefore, 3580, 15 lakh we would reduce. 5 lakh would be loss from 3580. Answer. You are required to compute the total income. Got it. Let's do the solution now. 50 lakh 75,000 is the question. Done, sir. 12 lakh 225 and 36. 12 lakh 225 and 36. Done, sir. 3B 7 lakh to be added. 13 lakh depreciation, 260 to be added. Now 7 lakh to be added, freebies, 260 to be added, and 13 lakh to be added. Swachh Bharat Kosh 2 lakh to be added, borrowing cost to be 120 to be added. Swachh Bharat Kosh 2 lakh to be added, borrowing cost 120 to be added. Wow, sir, every adjustment is correct till now. One adjustment would be wrong, I'll tell you now. 10 lakh to be removed from here, 1450 to be removed, depreciation, okay. 1450 to be removed, 10 lakh to be removed, and 10 lakh would be taxed separately. We would get a deduction. Now, every adjustment seems to be matching one. One adjustment is different. I'll also tell you that. See, GST refund amount 2 lakh is to be added. We did the same thing. Loss is not allowed. 5 lakh is the loss of 3580. You get a deduction of 80G. Now, what the point is, let me tell you. 2 lakh we adjusted, that's correct. 10 lakh 80, 2 lakh 80G we got. Only difference you would see is the depreciation. As I said now, as I simply said, sometimes they do not even consider it as an expenditure. It takes, they do not even consider depreciation for that. Now, what this point is, what they say is, see, they assume two things. They assume two things. Now, whenever you are given with depreciation of 14.5 lakh, first assumption is either this 2.5 lakh is already adjusted, sorry, either this 3 lakh is already adjusted from this or it is not adjusted. We can take two things now. In this 14.5 lakh, this above 3 lakh depreciation is already adjusted or not? Sir, I have assumed that it is not adjusted, therefore I reduce this 3 lakh rupees. They have not just assumed this key, the 3 lakh is adjusted, they are given a note. Let me tell you now. Let me tell you the answer. Where it was, where did it go, where did it go, where did it go? Yes. One time license fees. Okay, now it is not here, it is in depreciation head. No, depreciation. As per depreciation, it is included. Okay, now, it is assumed that it is considered that it includes depreciation of franchise. That means 14.5 lakh, it assumes that 14.5 lakh depreciation of franchise is already included. But if it is assumed does not include, then 17.5 lakh would be answer and your answer would change accordingly. Therefore, it has given an alternate solution as well, that in case you do not assume to be included one, you can separately take this 3 lakh rupees. Your answer would change by 3 lakh rupees. So your answer by 3 lakh would change. That's the entire solution. See, normally whatever assumption you take now, you have to note it down in the notes column. They take both the assumptions. In that case, both the answers would be corrected in this sense. Come on to question number 18. What does question number 18 says? Messrs Cure Limited, an Indian company, is engaged in manufacturing of pharmaceutical products since 2020. Net profit of statement of profit and loss for the year ended 31st March 2025 was 95 lakh 45,000 after debiting and crediting the following items. 95 lakh 45,000. Paid 6 lakh rupees an expense for public issue of shares. Oh. Public issue could not materialize because of non-clearancy. Whenever you pay any expenses relating to IPO, it is to be added back. Goods purchase of 5 lakh rupees from Messrs Sunny Traders, a micro enterprise, was delivered on 25th of Feb 2025. Payment terms were 25 days. The date of delivery as per the contract with the Sunny Traders, the payment was actually made on 29th May. However, no interest was charged. Whether it would be disallowed, sir, it would be disallowed. You have agreed to pay in 25 days and you are delaying then 25 days, then it should be disallowed in current year, but it should be allowed in the year of payment now. So we have made payment on time in the previous year 25 20 24 25 only we have made the payment now. So this should be allowed expenditure. See, ideally it should be disallowed in the current year, but it should be allowed in the year of payment. We made payment in the same year only, so it should be allowed only. Now, expense of 725 lakh providing the freebies to the medical practitioners added. Depreciation of 1250 on the basis of useful life of the assets, always add back. One time license fee of 10 lakh paid to foreign company for obtaining license. See, one time license fees again to be added, and we would reduce depreciation of 2.5 lakh. See, they not sometimes they assume that normal depreciation includes this 2.5. Sometimes they don't. We would take a consistent view that we have to reduce the depreciation. We always have to reduce the depreciation. Now, profit from setting up the warehouse in rural areas before claiming 3580 17.4 lakh. So 17 lakh is to be reduced, and 17 lakh would go to section 3580. Warehouse commenced its operation on 24th November 2024. Power subsidy was received. Okay, done. It is done. But whenever power subsidy is given, it is already considered your part of income. Therefore, it is PGBP. Therefore, it has to be ignored. Company earned 480 of the profits on the sale of 3,000 shares of ABCC. Whenever you have a profit on sale of equity shares, that has to be removed. That would go to capital gain. Now, how it would go to capital gain? Listen. 3,000 shares, listed company. These shares were sold for 260. Now, 260 is the selling value. How much would be cost of acquisition? Highest trading price on the stock exchange is 80. Okay. That means FMV is 180. Purchase price is 100. And sales value is 260. Remember, cost of acquisition would turn out to be 180. That means profit on each share would be 80 rupees on 3000 shares. This would means 2,40,000 rupees is the profit. 2,40,000 is the profit amount. Done, sir. 240 is the profit. Out of this 1.25 lakh, it would get exemption, and remaining 1,15,000 would be taxed at the rate of 12.5%. This is the amount of treatment according to me. PNB waived the loan of 8 lakh rupees as one-time settlement, which includes 6 lakh as principal amount and 2 lakh as interest amount. The loan was taken on this amount for meeting the working capital. Now, this is important. Just understand this carefully. We had taken 8 lakh of loan. 8 lakh or 6 lakh of loan we have taken, on which 2 lakh interest is outstanding. Now, this is loan or this is interest. We have outstanding principal, outstanding interest as well, and both have been waived off. Whenever any loan is waived off, principal component is your PGBP. Whether your interest component also becomes PGBP, so interest component never becomes PGBP. Whenever interest is waived off, it never becomes PGBP. Remember this point very carefully. Interest component never becomes PGBP. Why it is so? Because interest has never been debited to P&L, or even if debited, it is not allowed because of 43B. So therefore, it never becomes PGBP. So ideally, our tax amount should be 6 lakh only. Now, what we are actually studying, understand this thing. Understand this thing very carefully. After debating and creating the following items, that means whatever the waiver 8 lakh rupees we have got, that has already been credited to P&L. Ideally, 6 lakh should be your income. But we have credited 8 lakh rupees as our income. So 8 lakh should not be taxed. No, ideally 6 lakh should be only taxed. So whatever 2 lakh extra that we have taxed, that has to be removed from here. Now, company has furnished the following details. Now here comes the contradiction. Try understanding this. Company has employed 50 new additional employees on for financial year 24-25 on regular basis with effect from 1st April 2024. Now, at the wages of 23,000 per month per employee, the regular employees participate in the recognized fund. Additional employees were paid through account paycheck. Now, if we have 50 employees employed on 1st July, that means for 9 months they have been employed at the rate of 23,000 per month into 30% of the salary. This is the amount of salary every employee would get. That means 31.05 lakh is the amount of deduction you would get on 80 double A. The company had invested 40 lakh rupees for the construction of warehouse. Out of this, 25 lakh is for the warehousing of the rural area. Okay. 25 lakh is the land. Now 40 lakh, 25 lakh is land and 15 lakh is the only amount. 15 lakh is the only building amount. So we would get deduction on this 15 lakh only. That means 2 lakh is the profit of 35 AD. Done, sir. Got this point. Depreciation as per income tax load without considering the above adjustments. See, 920 is the above adjustments, and this also to be taken. 2.5 lakh is to be taken. 2.5 lakh is to be taken. Remember, the company's turnover for 2023 is 395. That means 25% tax rate would apply. 99.5 is the book profit. That means 15% MAT plus 4% education cess would apply. Compute the total income and optimum tax liability and give reasons of each of the items. Let's see. Let's see each of the answers. 95, 45, 6 lakh to be added and 725 to be added. 95, 25, 6 lakh, 725 to be added. 1250 to be added, 10 lakh to be added. 1250, 10 lakh to be added. Wow, sir. 17 lakh to be reduced, 480 to be reduced, 2 lakh to be reduced. 17 lakh to be reduced, 480 to be reduced, 2 lakh to be reduced. Wow, sir. Depreciation 1170. We have existing depreciation of 920. Added to it 2,50,000. That would mean 1170 only. 1170 is the depreciation. Got it, sir. After that, we have 2 lakh rupees of 3580, 240 as the capital gain income, and 31.05 is the 80 double Z as we have already calculated. Whatever the 112 income is would be taxed at 12.5% over to 1.25 lakh. That means this would be the amount of capital gain. Apart from that, remaining income would be taxed at 25% since the turnover is less than 400 crore. This would give us tax liability. In this case, how much would be 115 JB as we have already discussed. 115 BAA, only 35 AD adjustment would take place. Apart from that, everything remains same. As per 115 BAA, 20 lakh 33,000 would be tax liability. This is a simple point. You don't need to look at it too much. Clear, everybody? Pretty clear up to this point. Come on to question number 19. Let's see what question 19 says. Beautiful question. Orient Pharmaceutical Private Limited is an Indian company engaged in business of manufacturing and providing access to affordable and innovative medicines and healthcare solutions. Okay. Manufacturing word always has to be interpreted with additional depreciation. Done, sir. The company is incorporated in 2009. Company shows a net profit of 95 lakh per as per statement of profit and loss for year ended 31st March 2025. Done. Net profit has been arrived at by debiting and crediting the following items. Okay. Depreciation as per Companies Act claimed in statement of profit and loss is 11.90. First of all, write down the net profit. Then you have to add the depreciation 11.9 lakh. Done, sir. The amount of employee benefit expenses 13 lakh rupees as the bonus paid to employees in the previous 24-25 company, and its employee union had a dispute. In order to avoid the late payment of the bonus, company formed a trust and transferred the amount of bonus payable to the employees to the trust. The dispute was settled in the August and trust paid the amount to the employees on August 2025. See, whenever you have to pay any bonus to employees and you did not pay the bonus to employees, rather you gave this money to a trust. Whether this would amount to an allowed expenditure, right answer is no, it would not. Basic thing has to be checked is whether trust has paid this bonus to the employees or not, whether before ROI or not. In this case, trust has paid, therefore it would be allowed expenditure and therefore it has to be ignored. Done, sir. Amount paid by the company as regularization fees. Whenever you pay any regularization fees, it is disallowed expenditure. Amount of 45,000 paid as late fees to the government for failure to perform contract within stipulated time. Delay is 5 months and 9,000 rupees is the per month fees. See, whenever you pay any penalty for delay in work or for any non-compliance of any contract, it is allowed expenditure. Therefore, it has to be ignored. Okay. Company earned 7,50,000 on the sale of plot to Sudhakar Private Limited domestic company. Entire shares have been held by the SSC company. This was acquired. Okay, sir. First of all, remove the 7.5 lakh. This is a capital gain. This is a capital gain. 7.5 lakh is the capital gain amount, and that to exempt capital gain because the person to whom you are selling is the entity where you hold the entire shares. The company earned a profit of 4.5 lakh on the sale of equity shares. Oh. Sale of equity shares 4.5 lakh. First of all, this has to be removed. 4.5 lakh capital gain has to be removed from PGBP. It will be taxed in capital gain head, and that too under 112. Let's see how much. 2,500 shares listed. These shares were sold at 280. Okay, sales value is 280. Highest trading price was 175. So FMV will be 175. The shares were acquired for 100. Sales value was 280. So higher of two. Sorry, higher of two. Sorry, lower of sales and FMV, that would mean 175, and higher of two, that means 175 would be actual cost of acquisition, which implies 105 is the profit on 2,500 shares. How much profit it turns out to be? 105 into 2,500, which implies 2,62,500. 262,500 is the profit under 112A. This is the amount of profit under 112A. Answer. How much it would be taxed? See, this would not be entirely taxed. Whenever you are going to tax it, you are going to get a benefit of 1.25 lakh. In addition to that, now what would happen? What is the date of sale? Date of sale is November, so it would be taxed at 12.5%. Done, sir. Very simple point. It is not difficult at all. Bank guarantee was furnished for disputed tax liability. See, whenever you have any tax liability outstanding, and instead of paying the tax liability, you submitted a bank guarantee. Does that amount to payment? Right answer is no. Unless you actually make the payment, any submitting of bank guarantee does not amount to payment, therefore it has to be added back. Company debited an interest expense of 7.5 lakh, which the company remitted to USA, a company in the USA, taken loan 3 years ago. TDS deducted under such section in March and deposited in July. Of course, it is allowed now. Whenever you pay any interest pertains to the current year. You have deducted TDS in current year only. You have paid the TDS before RY date, so it is absolutely allowed. This is to be ignored. What the next point is, company has contributed 65,000 to electoral trust and same has been debited. Whenever you pay any sum, add back, and you get a deduction under 80 GGB 80 GGB. You get a deduction. Done, sir. Very important adjustment. Understand this. A very important adjustment. Closing stock of 1200 pieces of imported machinery at a landed cost as at the date of the import is 25 rupees per piece. Oh, exchange rate on the date of import is 15.9. Oh, when you acquired, you had 1200 pieces into $25 was the rate, and conversion date on the acquisition rate was 82.88. This is machinery. This is machinery. And this is cost of acquisition. Now, remember what this point says, this machinery is included in closing stock. This machinery is included in closing stock. Remember, that means can I simply say that while purchasing the asset, you recorded this as purchases? And while recording the closing stock, you are recording it as closing stock. Similarly, this closing stock is recorded in balance sheet as well. So you have three implications of this transaction. Your purchases also include such machinery. Your closing stock also includes such machinery, and closing stock appearing in the balance sheet also includes such machinery. Done, sir? Yes, sir. So how do we remove the impact of this from our P&L? It is included in the closing stock. It is included in the purchases. How much impact we are going to do to nullify the impact? Right answer is we don't have to do anything. Whatever the amount of the closing stock is included in the whatever the amount of machinery is included in closing stock is the same amount as in the purchases now. So either we do not add or we do not subtract anything. So there would be no treatment of this. With regards to P&L, there should be no treatment, but with regards to balance sheet, there would be a small treatment. Why? See, listen, understand this carefully. Whenever you have any machinery and it is included in closing stock, this has to be transferred to fixed asset and you get a depreciation on that. If you remember, you get a depreciation on that, and how much depreciation you get? See, on whatever machinery you buy now, machinery has to be recorded at cost on it. In machinery, you do not do fair market valuation, nothing. You don't do any such thing. You always record machinery at cost only. So how much cost turns out to be 1200 into $25 into 82.88. This implies 24.86,400. This is the amount of lakhs. Sorry, this is the amount of rupees. This is the amount of rupees on which depreciation has to be charged. This is the closing stock of the machinery on which depreciation is to be charged. Depreciation charge in the statement of profit and loss is 11.5 lakh, which includes the depreciation calculated on the following assets. Oh my god. Oh my god. Oh my god. Now, whatever you have charged, how much you have charged? 11.9 lakh. Okay, we have charged. Done, sir. How much should be actually allowed? Let's understand. It includes the depreciation of 95,000 rupees in respect of firefighting equipments installed in the office premises of the SSC during the year. There was no incidence of fire. See, if you have any firefighting equipments and they are not put to use, you still get depreciation on that. Why? Because it is allowed on ready to use basis. So it is correct. This is correct. The new machinery was installed and put to use on 1st September for 1st May 2024, valuing 75 lakh rupees. Oh, okay, okay. Done. See, if you have purchased a machinery of 75 lakh rupees, hmm, 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 hmm. Hmm. Is this the same machinery that we bought? No, sir, it is not the same machinery. Okay. The machinery which was sold to a domestic company on 2016 at WTV was 35 lakh and it was reacquired for 65 lakh rupees. Oh my god. Oh my god. Okay. Done. First of all, understand this thing. See, 11.9 lakh is correct, yeah, whether it is correct depreciation or not. See, this point is correct. Whatever depreciation is on 95,000, it is correct. It is to be included. Depreciation on this should be included. Yes, depreciation on this should be included, but additional depreciation shall also be taken. Additional depreciation on the 75 lakh is also to be taken because it is nothing. It is nothing but a manufacturing company. So on the 75 lakh, 20% additional depreciation would be given. That means 15 lakh rupees of additional depreciation would be allowed to us. Yes. Apart from that, a new machinery which was on sold on this WTV, it was reacquired for this. See, whenever you sold any machinery and you reacquire at a higher price, you sell any machinery and reacquire at a higher price, you do not get depreciation on the higher price. You get depreciation on 35 lakh only. So on 35 lakh, you would be allowed depreciation, but you claim the depreciation on 65 lakh. So whatever the difference 30 lakh is, 30 lakh multiplied by 30 lakh multiplied by 15% is the extra depreciation that you have claimed. 4.5 lakh has to be reduced. Remember, there is no other fixed asset included in the company's accounted for the depreciation except for the three methods. Done, sir. In apart from that, this closing stock is also to be subject to depreciation. This closing stock, which is a machinery which is included in closing stock. Are you getting this? Are you getting this? This closing stock is also subject to the depreciation because it is actually a machinery. So on this 24,86,400, you will get a depreciation of 15%. Plus, you would also get a, see, it is imported machinery. So imported machinery, you also get additional depreciation. So 20% additional depreciation would also be given to this. Therefore, 35% depreciation would also be given. So 870,240 is the amount of depreciation that you get in total. So 11.9 lakh plus 15 lakh minus 4,50,000. Amount of depreciation would be 3110240. This is the amount of depreciation that you should ideally be getting. This is the amount of depreciation. Let's see the answers. 95 lakh. Done, sir. 95 lakh. 11.9, 9.5 and 11 lakh. 11.9, 9.5 lakh and 11 lakh. Then 65,000 reduce 750. 65,000 reduce 750. Reduce 4.5. Almost all the adjustments done. Let's check out the depreciation one. See, 95,000 is valid depreciation. Yes, sir. Oops, just give me a second. Just give me a second. This includes, na. So this includes. Okay, it seems correct. How much depreciation should be ideally calculated? Done, sir. This is 95 lakh. Done. It is correct. Machinery sold. 525 is the difference. Did we arrive at the correct difference? Did we do any calculation mistake? On this 75 lakh, we would get depreciation of 11 point. Okay. My bad. They have not done this. They have not calculated depreciation as per books of accounts. Now see what would happen. What would happen? Listen to this point carefully. Yeah. See, on this 95,000 we would get depreciation. Now, so on this 95,000 we would get entire depreciation. How much depreciation we would get? 15%. 95,000 into 15%. Oops, what am I doing? 95,000 is the depreciation amount. So we would get 95,000 depreciation. New plant and machinery 75,000, we would get depreciation of 15% and we would get additional depreciation of 20% on this. So 75 lakh into 35%. This would mean 26.25 lakh, 26 lakh 25,000. Another machinery was sold. So whatever the depreciation of 30 lakh difference is, difference into 15% that we have claimed extra. Or I should simply say we would get depreciation on 35 lakh only, 35 lakh into 15%. This would be the amount of depreciation. That means 525 is the amount of depreciation. Sir, we would also get depreciation on this amount. That means 24,86,400 into 35%, 15% depreciation, 20% additional depreciation. 870,240. So this is the amount of depreciation. See, actually they have not corrected this 11.5. Rather, they have just disregarded this 11.9 and they have calculated depreciation separately. Now, this amounts to 411,5240. This is the amount of depreciation they have got. I don't think answer would differ. Answer is absolutely same. Answer in capital gain also remains same. ATGGB is also same. So we have got the absolute correct answer. No issue whatsoever. See, only issue is that they have not corrected this 11.5 lakh, 11.9. Rather, they have just corrected the correct depreciation. They have calculated the correct depreciation and it is very simple. We don't need to correct this. We just have to calculate the depreciation separately and that's absolutely fine. I hope you got the point. Done, sir. Absolutely done, sir. Come on to next question. Very important, very beautiful, very simple question actually. But it has too many important pointers. Statement of profit and loss of Tirupati Private Limited domestic company engaged in manufacturing shows a net profit of 107 lakh for the financial year ended 31st March 2025. 107, 1, 2, 3, 4, 5. Credits to P&L. Rent received from vacant land. See, whenever you receive a rent from vacant land, it has to be excluded from here. And it would go to, sir, IFOS. Whenever you have a rent from vacant land, it never goes to house property. It is always IFOS. Understand this point carefully. It always goes to IFOS. It never goes to house property. Land is not a house property. Rent received from a commercial property owned by the company 530. Okay. Whenever you have a house property rent, it has to be excluded from here. And this would go to income from house property. 530 minus 30% in standard deduction you would get. Interest received from income tax refund. Whenever you have income tax refund, that has to be interest has to be removed from here, and it would go to IT refund, interest, and IFOS. Profit from sale of lot. Whatever profit from the sale of lot you have, that has to be removed from here. 8 lakh has to be removed from here, and it would go to capital gain. Apart from the dividend from the wholly owned subsidiary, dividend has to be taken off from here, and it would go to IFOS. Now, items debited to P&L. Depreciation charge to P&L is 11 lakhs 86,000 has to be added back. Donation 85,000 to Swachh Bharat Kosh. 85,000. Whenever you donate to Swachh Bharat Kosh, it would be eligible for 80G. Remember, 80G and entire amount is eligible for deduction. Actual contribution to pension fund. Hashtag that point. We will discuss this point later on because amount of actual salary is not given to us right now. Amount paid to transport of 68,000 via account paycheck and no tax has been deducted. See, whenever you make any payment to transporter and you have to deduct TDS. But remember, there was a point. If there is transporter who is registered under 44A, he pays taxes under 44A, therefore no TDS is required to be deducted. Therefore, no TDS is applicable. And since we have not deducted TDS, it has to be ignored. Now, bonus to employees of 448. However, payment was made in December. Oh. Whatever bonus you are paying to employees, payment was made later on. Oh, that means that has to be added back. This has to be added back. Provision for income tax. Whatever provision for income tax you do, that has to be always added back. It is never allowed expenditure. Contribution of 1 lakh to scientific research. Whenever you contribute to somebody in scientific research, is this allowed expenditure? Sir, for that matter, we have to check whether we are opting which regime. Compute the total income and tax liability as per 115 BAA. Under 115 BAA, it is a disallowed expenditure. You do not get deduction of that. Therefore, it has to be added back. Interest on the borrowed capital. See, whatever interest you pay that is disallowed, this will be reduced from dividend income. So if you have dividend income, you would get section 50M. 20% of this would be reduced. That means 1.2 lakh or 1.5 lakh, whichever is lower. That means 1.2 lakh you get as deduction under 80M. 80M not actually, it is section 57. These are the adjustments. Too many adjustments, huh? Depreciation as per Income Tax Act 1961 is 18 lakh rupees. However, while calculating the depreciation rate for computers have been applied to printers and EPABX, the written down value as on 1st April is given below. See, whenever you have calculated, whatever depreciation you have calculated is absolutely correct, mostly correct. But the rate which was applicable to computers, you have applied that rate to EPABX and printers as well. So for printers, it is a correct. For printers, it is correct, but for EPABX rate applicable is 15%. You charge 14%. Ideally, you should be charging 15%. So 25% depreciation you have charged extra. 25% depreciation you have charged extra. That means 1.25 lakh extra depreciation you have charged. This means out of this 18 lakh rupees, you should be only charging minus 1.25 lakh. That means you should be charging 16.75 lakh of depreciation. 16.75 lakh of depreciation you should be actually charging. Got it, sir. Got it, sir. Got it, sir. Got it. It might happen sometimes. What they do, they net off the depreciation. I'm just highlighting in blue so that I am aware that where I have depreciation mentioned. Sometimes they net off the depreciation. They net off sometimes. Let's see. Additional depreciation on plant and machinery has to be ignored because additional depreciation is not allowed under 115 BAA. Provision for audit fees 1 lakh was made in books of accounts as on 31st March last year without deducting TDS. Such fees is paid in December. After deducting TDS, what it says, last year you paid some audit fees, last year you debited some audit fees. Where you did not deduct TDS in last year. If TDS is not deducted in last year, it was disallowed in last year. 30% was disallowed. It would be allowed in current year. Why? Because we are paying in current year, so it would be allowed in current year. So 30,000 will be allowed in current year. 30% will be allowed in current year. Now, during the financial year 23-24, company made the provision for outstanding bill of 90,000 rupees for the purchase of the raw material, out of which company paid 45,000 in cash. Hey, maaf Mataji. Last year you debited expenditure on outstanding basis, and today you are paying that expenditure in cash. You should be ashamed of yourself. That has to be added back. And what else you should be ashamed of if you have not liked the video and subscribed to the channel? How much I have to say just to make you subscribe the channel? During the year, company had issued 1 lakh equity shares of face value of 10 each at a premium of 90 each. The fair market value. See, you have issued shares at a premium that is not taxable as of now. Plot sale of 58 lakh rupees, company had acquired at 50 lakh rupees. Now listen. Plot that you had sell, the plot you have sold is acquired at 50, sold at 58. That means 8 lakh is the capital gain. Now, which capital gain it is? It was acquired in 2023, sold in 2025. So you have a long-term capital gain. Long-term capital gain, that to 112 wala. It would be taxed at the rate of 12.5%. Sir, ठीक है, got this point. The eligible salary for the purpose of 80 CCD is 10 lakh rupees. We have eligible salary of 10 lakh, 14% we can contribute. That means 1.4 lakh we can contribute towards pension fund. They have contributed 1.9 lakh. That means they have contributed extra 50,000, so it has to be added back. Now, the company declared interim dividend of 10%, 520. See, what the question is, let me tell you. It had earned dividend of 6 lakh, on which 120 is allowed as deduction. That means net dividend it has earned is 480. Now it would get 80M. Received dividend is 480 and paid dividend is 520. So it would get deduction of lower of 2. That means 480 that it would get deduction. That means dividend is 0. Dividend income is 0 at the end of the day. That's it. That's it. What else we need to do? We are done with the question. Of course, every adjustment had something to be done, but yes, it was a good question. 530 minus 30% in the house property, 530 minus 30%, we have done the same thing. 107 plus 85 plus 50. 107 plus 85 plus 50. 448 to be added, 420, 1 lakh. 448, 420, 448, 420, 1 lakh. 1 lakh 50,000 and 45,000. 1 lakh 55,000 and 45,000. Absolutely done. So absolutely correct. 489 to reduce, 30,000 to reduce. 255 to reduce. 489 to reduce, 489 where it is, 489 where it is. Sir, 489. 225 is to be reduced. Just give me a second. What was the figure? Now 489 is the depreciation amount. 30,000 and 255. So 30,000 here is this. 255 is this. How now? What is the depreciation amount? If you do the difference of these two, na? If you do the difference of this two, you would get at 439 only, 489 only. So this is correct. Depreciation is net off. They have done depreciation as net off. So we have got the correct answer only. 530 to be reduced, 48, 8 and 6. 530, 48, 8 and 6. 530, 48, 8 and 6. Oh wow, sir. The adjustment being highlighted seems good, seems happiness. 8 lakh rupees of plot sales, other sources, 255 vacant land, 48,000 IT refund, and 480 is 80M deduction that we get. Now, we get deduction under 80G. Oh, 80G is not allowable. Yes, 80G is not allowable. One thing I forgot. Somebody mentioned this 80G is not allowed under new tax regime, so we would not get deduction of this. Otherwise, every figure that we have done is absolutely correct. This would give you a proper answer, except for one mistake. One mistake is allowed now. Capital gain on this property of 8 lakh would be taxed at 12.5%, and remaining income would be taxed at 22%. 10%, of course, surcharge is to be added, 4% education cess, and this would give you actual final tax liability. Done with this point? Done with this point, sir? Absolutely done with this point. Come on to question number 21. Very beautiful, very important, very powerful question. Kansal Cements Limited is a resident company set up in the year 2010. Is engaged in manufacturing of cements. Its a statement for profit and loss from cement business shows a net profit of 75 lakh rupees after debiting and creating the following items. Done, sir. Now, depreciation is 6 lakh rupees. Always add back. SSC received a dividend of 5 lakh rupees from Arnold, a foreign company. It has incurred expenditure of 1.5 lakh rupees for borrowing. Okay, sir, done. Whatever dividend you have received, add back. Whatever interest expenditure you have debited to P&L, that has to be reduced. Now, where it would go? It would go to IFOS. Dividend would go to IFOS. and you get section 57 deduction of 20%. That means 1.25 lakh has to be reduced. Not actually 1.25 lakh, 1 lakh has to be reduced as ATM. It contributed 5 lakh towards state housing board towards the construction of tenements of the company's workers, which contributed 25% of the cost. And this has been for 25 years of the ownership, but ownership remains with the housing society. I have contributed 5 lakh towards the residential status of the employees, for residential houses of the employees. I have constructed the house with prior approval of State Housing Corporation. Now, I do not get the ownership of this house. So, is this an intangible asset? I do not get the ownership. I just have a right to live there. Is this a deferred revenue expenditure? Sir, it is not a deferred revenue expenditure. It is a normal employee benefit expense. It is a normal benefit expense. I would request you to star mark on this and you have to ignore this point. Because every time when you study, you will have a confusion. You need to understand, you need to learn this because you do not get any enduring benefit. You do not get any ownership. Therefore, you do not get any intangible asset as well. Now, the trade creditor whom 20 lakh rupees was outstanding 10 years ago has settled 15 lakh rupees on 1st March 2025. Based on the compromise, the amount waived has been credited to statement of rough and loss. Ignore this point. See, you got a benefit of 5 lakh rupees and that has already been credited, so ignore that point. Upfront discount, very important point. Understand, most people do wrong thing in this point. Understand, upfront discount paid during the year to the debenture holder is 5 lakh. You gave upfront discount of 5 lakh. Okay, the debentures were issued for a 5 period. Done, sir. So 5 lakh was the discount given to the debenture holders. Then, apart from the half-yearly periodical interest payment, debentures holder plus was per paid one upfront discount amount, 1/5 of the interest pays have been debited to P&L. Oh my God, listen. You have paid 5 lakh of interest upfront. One upfront interest you have paid 5 lakh rupees. How much would be allowed to you? Of course, entire 5 lakh would be allowed to you. But how much you have debited to P&L? You have debited only 1/5. That means 1 lakh only you have debited. So remaining 4 lakh should be allowed to you. It should be allowed to you ideally. So you would get a deduction of 4 lakh on this. Now, this is the additional information. Remember, this is additional information. कहता है, during the previous year 24-25, SSC started a business of developing and building rental housing projects eligible under 80 IBA. The net profit from such houses is 20 lakh rupees. During their SSC also earned an income of 10 lakh rupees from construction of the eligible houses, which is mere work contractor, and the projects were approved in financial 2021. So we have a business of 80 IBA. Now here we have 20 lakh of revenue and 10 lakh of revenue, but this 10 lakh of revenue is only because of works contractor. So we have 30 lakh of business of 80 IBA. We would get deduction only on 20 lakh component. Why, sir? Because works contract is not eligible for 80 IBA. So 10 lakh would be business income, separate business income of this housing project. SSC has purchased a land on 1st April 2010 for 5 lakh rupees, which was compulsorily acquired by the government on 31st March 2018. Oh, okay. The compensation was awarded 10 lakh rupees as received in that year only it was received. The compensation, the company had filed for a lawsuit for additional compensation on the High Court, and High Court awarded additional compensation as on 31st May 2024. Oh, see, you have got additional compensation, so it would go to cap gain, and it would be long-term capital gain, 8 lakh rupees. Would be 8 lakh rupees, and it would be taxed at 20% only because your transfer took place before 23rd July only. Depreciation as per income tax rules is 4.5 lakh, so we would reduce 4.5 lakh of depreciation. Now, SSC had purchased a machinery of 20 lakh rupees on 1st May 2021 and insured it against the fire. Very important point. Fire, flood, earthquake. The insurance company contained a reinstatement clause requiring the insurance company to pay the value of the machinery on the date of the loss. Okay. A fire broke out of the September 2024, causing the total damage to the machinery. The company received 22 lakh rupees from the insurance company on 1st March 2025. Rate of depreciation 15%. Assume the machinery was only asset at the clock. Now understand this point very carefully. Very important point. You acquired machinery on 1st May 2021 for 20 lakh rupees. On 1st March 2025, fire broke and machinery was completely dismantled, and you received 22 lakh rupees. I guess 22 lakh is the insurance sum you received. Now, how much capital gain would be arising in your hands? It's an important point. In first year, how much depreciation? For that, we need to compute the WTV. Now, what is the WTV as on 1st April 2024? We need to have WTV. Then only we can arrive capital gain. For computing WTV, we need to have depreciation of every year. Now, in 1st April 2021, we would have depreciation of 15%. That means 3 lakh depreciation. But one important point that most students fail here is it is a manufacturing company. So the year of inception, the year in which it started its operation, they would also get additional depreciation as well. So in first year only, they would have got additional depreciation of 4 lakh. That means value on 31st March 2022 was nothing but 13 lakh rupees. Depreciation for 22-23 was 15% of 13 lakh. That means 1.95 lakh. That means value as on 31st March 2023 would be 11.05, and depreciation for 23-24 would be into 15% minus is equal to, that means value would be 9.3925. This is the opening value as on 1st April 2024. Opening value as on 1st April 2024, and this has been sold for 22 lakhs. So minus 22, this would mean 12 lakh 60,750 is the amount of cap gain, short-term capital gain. Short-term capital gain of 12,60,750 is the amount of short-term capital gain that this SSC has got. Very beautiful point. And this would be taxed at slab rate only, or mean whatever the rate, 25%, 25%, 30% applicable to it. Compute the total income tax liability for the assessment year. This under the regular provisions by analyzing the relevant provisions. Assume that company has not opted for concessional tax rates. Briefly explain the reason, and tax rate applicable is 30%. 30% is the tax rate. Let's check the answer. 75, 6 lakh, 1.5 lakh. 75 lakh 6 plus 1.5 lakh. Where did 1.5 lakh go? 1.5 lakh is to be added, of course. This. Okay. This dividend has to be reduced and this 1.5 lakh is to be added. Correct. We have done correctly only now. 5 lakh minus 4 lakh minus 5 lakh minus 4 lakh minus. Depreciation 4.5 lakh you would get. Then 35 AD business, sorry, 80 IBA business, 30 lakh income. 30 lakh income. All the adjustments done. One adjustment is from capital gain only. It is in capital gain. Now capital gain 8 lakh is taxable, 1260, 750 is taxable. Other sources 4 lakh is taxable, but you would get ATM. Do we have ATM? ATM, yes. Do we have it? Did we distribute dividend? Just give me a second. Did we distribute dividend as well? Is it somewhere mentioned? Okay, company has distributed dividend now. So ATM would be given. ATM would be given as 4 lakh rupees. ATM would be 4 lakh rupees. Of course, whatever received or paid, whichever is lower, ATM we would get 4 lakh rupees. 80 IVA 20 lakh rupees. See, whatever the works contract portion is, we won't get deduction. 4 lakh is the ATM amount, and this would give us the total income. Total income 30% would be tax amount, but 30% would not be tax amount the entire sum. Remember, on this total income, whatever long-term capital gain, it would be taxed at 20% only. Remaining income would be taxed at 30%. Whatever the income we get, we would add 4% surcharge, and this would be our total income. Good question to practice with. Very good question to practice with. Come on to next question. Question number 22. Krisha, Kinara, and Komal. A good question again to practice. Very good question. Krisha, Kinara, Komal were three partners in a partnership firm, KKK Enterprises. The firm carried on the business of running banquet halls, marriages for and other parties and event purposes on the date of the formation. Done, sir. It is a partnership firm, but it was converted KKK Enterprise. Okay. Till okay, that is formation. That is till 2015-2020. The partners converted into company on 1st April 2020. Earlier it was partnership firm, but on 1st April 2020 they converted themselves into company. They were partnership firm till 2020, and later on they converted into company by the name of KKK Private Limited. They transferred the entire business to the company. All the partners became the shareholders of the company in the same proportion of their capital stood on the books of the firm. No other consideration was paid to the partners. Now, company earned a net profit of 11925,000. 11925,000. This is the amount of benefit they have. This is amount of net profit that they have. During the financial year, the sum of 1,70,000 was paid to a transporter, Milan, for providing transportation services in cash. Amount was paid in cash. Company did not deduct TDS because he had a certificate of no deduction certificate. Okay, TDS was not required to be deducted. 26,000. Whether it is disallowed, no. Up to 35,000 you can pay to a transporter. 37,000, yes, it has to be added. 22,000 allowed, 32,000 allowed. That means 37,000 is to be added as cash payment. Depreciation in books is 13,56,000. It has to be added back. Out of the debtors that were transferred to the company, one debtors, Mr. M LLP, to whom 6 lakh were due since 1920, became bankrupt and nothing could be recovered, and company debited 6 lakh to the statement of profit and loss. See, ultimately, proprietorship concerned had some sales made. Later on, the person to whom sales was made became bankrupt, and as of now, company wants to claim bad debt. Can company claim bad debt on the sales made by the partnership firm? Yes. Whatever the deduction, whatever the sales that this partnership firm has done, company can claim bad debt on that. So therefore, it is allowed expenditure. Dividend received from listed companies, dividend has to be removed from here, and dividend would go to IFOS. Company invested in the shares of listed company through stockbroker. During 24-25, the company paid 1,25,000 to its resident stockbrokers as commission for the purchase of the shares. Okay. Oh. No shares were bought and sold and no TDS was deducted. See, remember, company is into share trading. Company is not into business of share trading, but company is doing share trading. Now remember, company's business is not to do share trading. So whatever brokerage that they paid, whatever the brokerage that they paid is a disallowed expenditure. It's absolutely disallowed. In addition to that, company has not even deducted TDS on that. So it should be. And in addition to that, it would be disallowed. So ultimately, first of all, it is a disallowed expenditure. In addition to that, they have paid in cash, then too it would be disallowed. But still, we would not disallow this. Why? Because we have not even debited this expenditure to P&L now. This information is given in additional information column. So that means that it has not been debited to P&L. Therefore, we would not do no treatment of this. No treatment of this adjustment. Depreciation as per income tax rule is 15.78 lakh rupees. Okay. Machinery HYC that the firm has been used earlier has been transferred to the company at the time of succession. Machinery formed part of 15% block. WDV of the machinery was 12 lakh rupees. On acha, the machinery was discarded. The amount of depreciation of 11 has been included, sir. No issue whatsoever. See, ultimately, you had a machinery, very big machinery, but that machine has been discarded. And this 11, 15 lakh 78,000 includes the machine depreciation on that machinery as well. You discarded machinery and depreciation has been included in this of this discarded machinery, sir. It is allowed. It is irrelevant that whether you have machinery in the block or not. You just need WDV. Machinery has been sold, discarded. You would still get depreciation on the WDV component. Now, very important point, sir. The shareholding pattern in financial year 20 or financial year as on 1st April 2024 were as follows. Now earlier they were equal shareholders. Krisha, Kinara and Komal were having 33% each. But as of now what they have, Krisha has 30%, Kinara has 25% and Komal had 20% only. 25%, and others have taken the 25%. That means 25% have been sold by each of them to others. 25% have been sold, done, sir. During financial year 24-25, Krisha sold 95% of her shareholding to daughter Kirat. That means this 30% have also been sold to somebody else. Can I simply say, whoever the partners who were there at the time of conversion are now holding less than are now holding 50, 45% only. Or I should say, Krisha had 35%. Krisha had 30%. So 95% was sold. That means 28.5% have been sold. What I am saying is actually Risha was holding 30%, 28.5% have been sold to others, 25% was already sold to others. That means less than 50% of the partners are partners right now. The partners who were shareholders in the inception of the company are holding less than 50%. We had a clause, we had a provision that whoever the partners are there in a partnership firm shall continue to hold at least 51% of the profits till the 5 years, till the end of the 5 year from the conversion. More than 50% have been sold to an outsider. In this case, whatever the exemptions that this firm has taken during the time of conversion, it would become taxable in the hands of the company. Important point. Brought forward business loss. Sir, business loss cannot be carried forward because ultimately shareholding has changed a lot. Company held 65% in Aadhaar Hospitalities. The company took loan of 15 lakh rupees and accumulated profits was 31 lakh rupees. Company repaid, it is irrelevant, sir. 15 lakh would go to IFOS. Deemed dividend 15 lakh would go to IFOS. Done, sir. The long-term gains on the asset 55 lakh rupees. See, whatever the long-term capital gains you had at the time of conversion of the partnership firm to entity, this would become taxable, and this would be taxable at the rate of 20%. Why? Because transfer took place in 2020 only now. At 2020, when partnership was converted into company, 55 lakh was the amount of capital gain. But since they violated these conditions of partner conversion, it would be taxable in the hands of the company at 20%. The turnover in previous year 2024 was 390, but 2023 was 400. That means 30% is the tax rate for the company. You are required to compute the total income and tax payable by giving the reasons. What would be beneficial to opt for 115 BAA or not? Whether it would be beneficial or not, let's see. 11 1 1192500 1192500 37,000 1356 37,000 1356 540 to be reduced 1578 to be reduced 540 to be reduced 1578 to be reduced. Brought forward losses ignored. Capital gain 55 lakh would be taxed. IFOS would be taxed. Yes, sir. This would give you total income. Long-term capital gain would be taxed at 20% and other income would be taxed at 30%. Of course, if your total income exceeds more than 1 crore, then in that case, 7% surcharge would be applicable. See, in the entire case, if we do not have any special income now, so how do we arrive at 115 BAA? Total income shall be taken standstill. Capital gain would be still taxed at 20%. Other income would be taxed at 22%. So it is of course beneficial to go for 115 BAA in this case. Therefore, assessee would opt for 115 BAA. Simple question. Simple question it was. Yes, sir, it was very simple question. To be honest, it was not that difficult question, but we must be aware of all these things. If we are not aware of all these things at once, we might do something wrong. Now, this is an important question. This was a part of RTP JAN-26. Therefore, it is important for your exams as well. Nova Motions is engaged in assembly and manufacturing. Whenever you hear the word manufacturing, always additional depreciation should pop up in your brain. Automotives and auto components in Nagpur, Maharashtra. Net profit after debiting and crediting the amounts in the statement of profit and loss is 825 1 2 3 4 5. Depreciation as per Companies Act 2013 is 18 lakh, 11 crore 18 lakh rupees. 1 crore 80 lakh rupees. Okay. Now, contributed 1070 during the financial year to National Reform Party, a political party registered by the way of count paycheck. Oh, you are donating to a political party. Always add back. Whatever the regime is always to be added back. But whether we would get deduction under 80 GGB or not, it depends upon regime it is opting. What it is asking us, total income tax liability of Nova Motion as per normal and concessional, both the things it is asking us to calculate. We'll assume normal regime. Okay, we'll assume normal regime as of now. 80 GGB would be given to us and 10,70,000 rupees would be allowed to us. Long-term cap gain of 618 of non-listed equity shares on which security transaction tax was paid. First of all, this has to be removed, 618. And this would go to long-term capital gain, LTCG, 112A, 618. Loss of 2 lakh on hedging contract for mitigating the loss on the fluctuation of foreign currency payment on imported machinery. Whenever you buy any machinery, whatever the hedging contract is, hedging contract losses are to be adjusted from cost of asset only. It is never allowed expenditure. It has to be added from cost only. Company borrowed fund from two state financial organizations, 75.75 from Andhra Pradesh Financial Corporation and 39.94 from Andhra Pradesh State Financial Corporation. Company accrued 11,56,000 rupees on these loans and did not make the payment. However, as a restructuring drive, company converted these shares into equity shares. Oh my God. You had outstanding interest, you converted them into equity shares. Whether this amounts to payment, right answer is it amounts to payment. Whenever there is outstanding interest, Whenever there is outstanding interest and it is converted to equity shares of the company, it is allowed and therefore it has to be ignored. Frontiers Technologies Limited, I guess it was the case law, Telangana High Court. Company had borrowed 6 crore 74 lakh rupees from the uh, HDFC Bank on 1st June 2024 for the purpose of acquiring the machinery. Interest on such loan is payable at the rate of 10%. The interest pertaining for the year ended 31st March 2025 remained outstanding on the date and subsequently was paid after the due date of ROI. Remember, loan was taken on 1st June and up to 31st March. Whatever the interest is, how much interest would be 6.74 crore into 10%, into how much period it would be 10 out of 12. 674 6 crore 74 lakh into 10% divided by 12 into 10. That means how much interest would be added? Interest amount would be 56 lakh 16,667 is the amount of interest to be added back. On 11 November 2024, the company made a payment of 63 lakh rupees to a scientific research organization which was duly notified. Sir, in old regime it is allowed expenditure. Company sold auto components worth 18.5 crore to Zenith, a sole proprietor on 2022. On 2024, 1st Jan, 11 lakh was written off as bad debt. Now, 18.5 lakh was sold. Out of that, 11 lakh was written as bad debt. That means 7.5 lakh are receivable. 7.5 lakh are receivable as of now. Proprietor passed away in 5th Feb 2025. Company later on recovered 9.8 lakh rupees in full settlement. You were receivable 7.5. You actually received how much? You actually received 9.8. That means how much extra you received? How much extra you received? You received extra 2.3 lakh rupees. Extra you received. That means it should become taxable. It should become taxable. Yes, yes, yes. Yes, sir, it should become taxable. The entire recovered amount was recorded as bad debt recovered, or what they are doing. You were only required to tax 2.3 lakh rupees. You are only required to tax 2.3 lakh rupees. Only required to tax. But this poor accountant, this stupid accountant, instead of 2.5 or 2.3 lakh as taxable, it credited 9.8 lakh to P&L. That means 7.5 lakh extra it had credited to P&L. To nullify that, 7.5 lakh has to be reduced. Listen to this point again if you did not understand. Depreciation calculated on the as per income tax rules amounts to 1 crore 18 lakh 50,000, which includes depreciation and additional depreciation on imported machinery from Japan purchased. Okay. See, whatever the depreciation, additional depreciation is, you don't have to calculate it even. Everything has been given. 118, 50, 1, 2, 3, 4. Whatever the depreciation is, additional depreciation is on everything that has been given to you. Very simple point it has made. Now, purchases not debited to P&L 12 lakh were made on 13 March, which is the micro enterprise. The written agreement payment has to be made within 13 days, but payment was made on 14th April. Purchases 13 March, payment 14th April. That means more than 30 days have taken place. Therefore, this would be disallowed in current year. But sir, it has never been debited to P&L, so it would not be disallowed. It has not been debited to P&L, so it would not be disallowed. Therefore, we have to ignore this point as well. It has not been debited, so why would we disallow? Now, let's calculate the total income. 825, 180, 1070. 180, 1070. 2 lakh to be added, 56, 16 to be added. 2 lakh to be added, 56, 16, 167 to be added. Now, 618 to be reduced, 750 to be reduced, 618 to be reduced, 750 to be reduced, 118, 5000 to be reduced, and capital gain to be taxed at 618. 118 and cap gain to be taxed at 618, or of course you would get 80 GGB of 1070. This would give us the total income. Now, solution is not lying within total income. Whatever the total income we arrive at, on this total income, whatever the cap gain we have, it would be taxed at the rate of 12.5%, and remaining income would be taxed at 30%, plus surcharge of course 7%, plus 4% education cess. This would give us the tax liability as per old regime. This is not even a part of the question. Important part lies in calculating the tax liability under 115 BAA. Now, how would tax liability be arrived? Let me tell you. Let's take GTI for the purpose. 947 86667. This is the GTI. Now, whenever we want to go from old regime to 115 BAA, two adjustments we would do. First adjustment is scientific research expenditure. The 63 lakh of scientific research expenditure is to be added. 63 lakh of scientific research expenditure to be added. Done, sir. We will add that. Where did it go? Yes. 63 lakh is to be added. Sir, we would add that. No issue whatsoever. Anyway, no issue. In addition to that, we would add additional depreciation also, because additional depreciation is also not allowed. Now, how much additional depreciation is we need to calculate for that purpose? How much additional depreciation would it be? Let me make you understand with this example. Understand this. Now, this was the first case. Loss of 2 lakh on hedging contract on mitigating the loss arising on the foreign exchange fluctuations on the imported machinery. Now listen to this point. You bought machinery at 65 lakh rupees. You added hedging loss on this. That means 67 lakh is the cost of machinery. This machinery was put to use on December. Whenever you buy any imported machinery, it is considered as new only. So you would get 10% additional depreciation on this. That means 66.7 lakh is the first additional depreciation that you would get. First additional depreciation that you would get. First thing. Now, in addition to that, now listen to this point very carefully, very carefully. I'm highlighting this for your reference. Company had taken loan of 6 crore 74 lakh rupees from HDFC Bank for the purpose of acquiring a machinery. Interest on loan is payable 10% per annum. Interest pertaining to the period up to 31st March is unpaid, and interest was paid subsequently. Done, sir. Later on, it says a point. Nova Motion installed the machinery purchased from the borrowed fund on 1st Feb 2025. What I'm being to say is, you took a loan to buy machinery of 6 crore 74 lakh. That would be added to cost, of course. That is to be added to cost. I'm highlighting this. This has to be added to cost because this is the cost of the machinery. On this, on this 10% interest is to be charged, and whatever the interest is up to the rate it is put to use, it will be added to cost of asset. If you can see, loan was taken on 1st June and machinery was put to use on 1st Feb. How much months it to be? June, July, August, September, October, November, December, January. 8 months it turns out to be, if I'm not mistaken. 2 months to be removed from starting, 2 months to be removed from later on. That means 8 months it is. 8 by 12. That means 44, 93, 1, 2, 3. Now the figure, it seems like I have done something wrong, but let's do it now. First of all, this will be added to cost and this will also be added to cost. This means 17 lakh 18,093,333. This is the amount of cost that has been added in the block. On this, additional depreciation of 10% would be given. 71 lakh 89,333. This is the amount of additional depreciation we have got. 6.7 lakh plus 71 plus 89. Adding both of them, this is the amount of additional depreciation that has to be added back. 78,59,333. This is the amount of additional depreciation that has to be added back while calculating 115 BAA. Putting it here and making you check the answer whether we have done it correctly or not. 71. Adding both of them would give us the same answer. It would be same answer only. Did you get how do we arrive? This would give you total income. On this income, we have to separate the cap gain income, which would be taxed at 12.5%. Remaining would be taxed at 22%. And the best part is you would get lesser liability in 115 BAA. Under old regime, we had 3 crore 1 lakh 11 lakh. Under new tax regime, we have lesser liability. So new tax regime is more important, and this conclusion is also more important, because other than this, you would not get marks. If you don't write the conclusion correctly, you would get 2 marks less. Now, whatever you have done in the old tax regime, I'm not saying it is wrong at all, but it is only a part of the answer. Unless you solve 115 PAA, you will not get the correct answer and you would not get the marks as well. Therefore, this is a super beautiful question, and it has been given in RTP. I am not making it of my own, or it is not very old question. It has come in RTP, latest RTP. Done, sir? Come on to question number 24. The tax assessment of Raghav was completed with liability determined at 28 lakh rupees. No. Raghav was required to pay 28 lakh rupees. He had a FD of 28 lakh rupees. He had receivable of 27 lakh rupees. Can banks attach this? Yes. Can bank attach this receivable? Yes. He had gifted a land to his son 5 years ago, whose fair market value is 28 lakh rupees. He gifted a diamond necklace to son's wife, and he owns an apartment in Australia. Discuss whether tax department can attach the properties or not. First of all, can they attach the bank account? Yes, they can attach. Can they attach receivable? Yes, they can attach. Can they attach the land that has been given to his son? No. Once land has been given to the son, at the time when he was given the land, or at the time of the assessment started, whether he was if he was major, this land cannot be attached by the department, therefore this cannot be attached. Can they attach the diamond necklace given to the son's wife? Yes. Can they attach any property in Australia? Yes, they can attach. A private limited company has a share capital in the form of equity shares. Now, these shares were held till 2025 by four members A, B, C, D. Now, this question is a good question. Understand this. A, B, C, D held 25, 25, 25, and 25 to 31st March 2022. Company had a profit and loss of this and this. Okay. Assessment year 2020, 21, 22, 22, 23, 23, 24. We have a loss of 9 lakh rupees. No issue. And unabsorbed depreciation. Okay, done. The figures have been accepted by the tax department during previous year ending 31st March 2024. A sold its shares to Y. That means if we check 31st March 2025, what figure turn out to be? Y, B, C, D holding 25, 25. A sold the shares to Y. And on 31st March 2025, if we check now, figure would turn out to be Y, Z, C, D holding 25, 25 each. That means B sold goods shares to Y. So if you carefully analyze, if you check the profits of 24, 25, you can see 75% of the shareholders that were there at the time of loss remains in the company. But if you check 25, 26 now, 24, 25 now, you would see that more than 50% have changed. That means if you have any loss in 21, 22, you can set off that loss in 23, 24, but you cannot set off this loss in 24, 25. Important point, section 79. What basic provision was, if you have incurred loss in a year and if you want to set off in any subsequent year, at least 50% of the shareholding has to be same. In this case, more than 50% has changed. Sorry, at least 51% of the shareholding has to be same. In this case, in previous year 24, 25, shareholding has changed. Therefore, this loss cannot be set off against previous year 25, 24, 25. Now, what the case is? For 24, 23, 24, we have 18 lakh of profit. Before charging depreciation. So 18 lakh of profit minus 9 lakh of depreciation. This would give us 9 lakh of income. This would give us 9 lakh of income. We can simply reduce the losses from this. So in previous year 23, 24 only we are taking deduction of this losses, and later on we would take depreciation. Very simple point. It is not difficult at all. Very simple point it is. See, in previous year 23, 24 we had 75% same shareholders, therefore we can set off the losses. But in 24, 25 we do not have 50%, 51% same shareholders, therefore we cannot set off losses in 24, 25. We can only set off till 23, 24 only. And we did the same thing. Now, 26 question. ABC Private Limited was converted into LLP. Company was converted into LLP. Now, what it says? Business loss. If any of the company has business loss, can this be carried forward to LLP? Yes, it is allowed to LLP for fresh 8 years. Remember, fresh 8 years. Written down value of the assets. Remember, whenever you have any depreciation for a year, during the year, if company has converted into LLP, during the year, whatever the depreciation is has to be apportioned on the number of days. Number of days you have to apportion. If you do, it is simple. It is not difficult at all. Number of days you have to split the depreciation. Now, cost of asset. If you have any of the asset, see, if you have any asset in the company and that has been transferred to LLP, it would always transfer at cost only. It would never be transferred at fair market value. Always at cost. If you have any VRS expenditure, for example, if any of the expenditure has been incurred by the company 2 years back, and deduction for 2 years have been taken by the company, so remaining deduction for 3 years would be taken by LLP. Now remember, for the year of conversion, we do not split the expenses on number of days basis. Do not split the expenses based on number of days. VRS is never split. Only depreciation for the current year is split. Otherwise, VRS unabsorbed depreciation is never split. Now, unadjusted MAT, this would lapse because whenever company is converted into LLP, company is required to comply with MAT, LLP is required to comply with AMT. Therefore, it would lapse. Unabsorbed depreciation would be carried forward to LLP and it would be given to LLP only. This is the same answer. If you see, it is the same answer that you would do. Let's solve question number 28. What this is, Mr. Akash earned a royalty of 288 from a foreign country and a book authorized by him, being a book in the literary nature. The royalty is of 18% of the books. The expenditure incurred by him for earning the royalty is 40,000 rupees, and he remitted to India up to 30th September is 230. The remaining amount was not remitted till 31st March. Compute the amount of royalty to be included in gross total income and amount of deduction that Mr. Akash would be entitled. Understand this point. Earning of royalty is 288. Done, sir. Earning of royalty is this much. And how much expenditure he has incurred to earn that royalty? If you see carefully, you have earned incurred expenditure of 40,000 rupees. That means your net royalty turns out to be 248. Now, how much 80 QQB would be allowed to you? 80 QQB clearly states that whatever royalty you get, now you should get up to 15% only. And question explicitly states that you have got royalty of 18%. So 288 is the gross royalty you are receiving at 18%. It would be only allowed 15%. So how much royalty deduction you would get? How much deduction you would get? You would get deduction of 240 only. 240. Yes. But only out of that 240 you have been able to remit 230 in India. That means lower of 2 you would get deduction 230, and out of this you would also get my deduction of expenditure also, na, because you have taken net royalty na, so deduction of expenditure would be given to you. That means 190 is the only royalty amount that would be allowed. That would be allowed as 80 QQB to you. So net taxable royalty would turn out to be 58,000. I don't think they have given net taxable royalty, but deduction of 80 QQB they have given properly. Now, question number 28, it is a good question. Now, Mike, let me frame that question for you. Now, what this question says, X Limited has two units. X Limited has two units, Unit N and Unit Y. Now, what the business of this is? Unit N is eligible for 80 IA, but it has not opted for 80 IA. Why it has not opted? Because for current year, it has profits of, say, profits of 100 lakh rupees, but it has additional depreciation of 120 lakh rupees. Therefore, no profit was left even to claim 80 IA. 20 lakh was the loss amount. And Unit Y is not eligible for any ATI, it is not eligible for any special deductions. Now, what the case is, it has a profit of 70 lakh rupees. See, one thing we are aware, if we have any profit on account, if we have any loss on account of ATIA business or specified business, we cannot set off this losses from any other businesses. We are aware of this fact. Can we set off this additional depreciation from this ATIA business to the other business? Right answer is, sir, we can set off. Why? Because we are not even claiming ATIA. If we are claiming ATIA and claiming additional depreciation and having a loss, therefore we cannot sell. We cannot set off. But in this case, we are not even claiming ATIA now. Understand this fact. If we are claiming ATIA and claiming additional depreciation and then having this loss, then we are not allowed to set off this loss. Then we are absolutely not allowed to set off this loss. But in this case, we are not even claiming ATIA now. We are only claiming depreciation. So in this case, this loss can be set off. And this was given in case of CIT versus Swarnagiri installations in case of Karnataka High Court. Question number 29, Meenakshi Urban Cooperative Society. A good question to practice. 80 is a good, it is section tested in this question. Now, it is a society engaged in credit facility to the members during previous year 24-25. Society provides credit to the members, money to the members on credit basis, and it charges interest on the members. Now, two aspects to this answer. First thing, always compute the gross total income, then compute ATP different separately. Compute gross total income and then ATP. Gross total income and ATP. Do not confuse between them. First of all, gross total income is to be arrived, then ATP is to be calculated. Now, interest received from the deposit with the cooperative societies, whether it has to be added, yes, it has to be added. It is the business of the society, therefore it has to be added in business income. Interest received from members 260 for the personal purpose, it is also business of the society, therefore it will be business income. Interest from the idle members of the funds, it is also interest, business income, it is also business income. Rent received per month, sir, rent received per month is 36,000 per month into 12 if we do, and 70% would be only tax because renting out is not the business of the society. That means 302,400 is the rental income, and this would go to house property. Agency business. Agency business, it is a kind of business activity only. Expenses of agency business to be reduced and losses from previous year has to be reduced. So whatever things that I'm highlighting in green has to be added back, and whatever the things that I'm highlighting in red have to be reduced. Do this thing and you will arrive at gross total income 547 plus 1185 plus 204 plus 302400 plus 287500 minus 124 minus 98,000. This would give you GTI. GTI would be 2303900. This is the GTI of the society. Now, important aspect here is how do we arrive at the ATP? Understand this point very carefully. I am removing the highlights just for clarification purpose. Understand this now. If you are a cooperative society who earns any interest from cooperative society, it is eligible under ATP. Interest dividend earned from other cooperatives, it is eligible for ATP. That would be allowed to us. Society has business of giving money to the other society members and earning interest from them. So it is also allowed. It is also ATP business. Therefore, these two would be allowed to us. Whether rental income would be allowed to us, the rental income from godown or warehouses is allowed. It is nowhere mentioned that this rental income is from godown. Therefore, we would not get deduction. Whether agency business, we would get deduction. So agency business is normally not allowed as deduction. But if you remember, if any of the society has a business income, it is eligible for ATP. To that mean 50,000 of additional deduction. So how much deduction we would get? Add the portions in blue. That means ATP simply they would get 1936 and ATP2 they have 50,000 standard deduction. Reducing this would give us the total income of the society. 317,900 is the income of the society, and this minus 20,000 multiplied by 30% plus 2,000 plus 3,000. This would give us the total income of the society. 317,900 plus 30,000. This would give us the total income. Add education says this would give the total income of the society. This was all about your PGBP, clubbing, set off, and deductions. Let's start with assessment of various entities, which comprise of MAT, AMT, and other questions as well. Okay, so come on to question answers of assessment of various entities. Now, this chapter has multiple subtopics, like we have MAT, like we have AMT, like many other topics this chapter consists of. Now, right away, starting from question number 30, which is of MAT. Of course, MAT is important topic. Whatever the important questions are there, we will solve them. Question number 30, Mahadev and Sons is a public company whose accounts have been prepared in accordance with the provisions of Schedule 3 of the Companies Act. Simple point it is. The profit and loss statement as on 31st March 2025 shows a net profit of 27 lakh. Okay, sir, note it down. Note it down, note it down. Perfect. The company informs the following debit and credit have been made to P&L account before arriving to the net profit. Done, sir. Agriculture income. Sir, agricultural income is never subject to MAT. Always remove this income while calculating the book profit. Done, sir. Second thing, profit of industrial undertaking covered under 10AA 30 lakh. Whenever there is profit of 10AA, it is never covered under 28 adjustments. If you remember, only 28 adjustments are to be done, and this industrial undertaking is not under 28 adjustments. Therefore, this has to be ignored. Done, sir. Done, done, done. Amount withdrew from reserves created in previous year 23-24. This reserve was not through P&L account. Oh, see, we are aware that whenever we credit any sum to the P&L, whenever we credit any sum to the P&L from the reserves account, it is excluded from MAT. Why it is excluded from MAT? Reason being, earlier whenever you create any reserve, such reserve is created out of P&L. Therefore, whenever you create any reserve, that it is subject to MAT at that time only. So whenever you create it again, it is never subject to MAT. Now, this reserve was never created from P&L. That means this reserve has never been subject to any taxes. Therefore, taxes will be charged right now. In that case, it would be subject to MAT, and therefore we have to ignore this point. LTCC on sale of equity shares, sir, ignore. This is subject to MAT. Whatever gain you earn on listed equity shares, it is subject to MAT. Amount withdrawn from revaluation surplus, we have to hold this for a minute. Expenses relating to 10AA, sir, ignore this point, ignore this point. Current year depreciation, sir, current year depreciation, whatever the current year depreciation is, we have to always add back. Always current year depreciation has to be added back. Interest on ROI not paid up to the rate of ROI, interest not paid to bank. So this is a disallowed expenditure. It is a disallowed expenditure as per PGBP, but not as per MAT. Provision for uncertain liabilities. Uncertain liabilities are always to be added back. Income tax, whenever debited to P&L, it has to be added back. Penalty for infraction of law. Whenever there is a penalty for infraction of law, it is a disallowed expenditure under PGBP, but not under MAT. Under MAT, only 20 adjustments are to be done. Now, depreciation for the current year includes 5 lakh towards revaluation of the assets. Now, what the point is? 12 lakh is the total depreciation we added back. Out of this, actual depreciation is 5 lakh and 7 lakh, and depreciation on revalued components is 5 lakh rupees. That means allowed depreciation should be only 7 lakh. Done, sir. Remember, amount we have withdrawn from revaluation reserve and credited to P&L is 10 lakh rupees. Depreciation on revaluation component is 5 lakh rupees. Whichever is lower has to be reduced. We have understood this point. Whichever is lower, we will reduce. Done, sir. Apart from that, depreciation relating to previous year 23-24 as per books is 13 lakh. Brought forward losses as per books of accounts is 10 lakh rupees. Whichever is lower, we have to take. Whichever is lower, we will take. That means 10 lakh we would reduce as deduction, and this will give us the book profit. Let's do the calculation. Let's do the calculations. Sir, 27 lakh minus 11 lakh plus 12 lakh plus 3 plus 6 minus 7 minus 5 minus 10. All in all, 15 lakh is the book profit. This will be subject to 15% tax plus 4% education cess. This is the amount of book profit that we will arrive at. That's it. Simple question what was. No difficulty at all. Very simple question it is. Question number 31. What this question number 31 says? Question number 31 talks about Zenith Formulations Limited, an Indian company engaged in pharmaceutical formulation. Okay. And Tamil Nadu started the adoption of Ind AS with effect from 1st April 2019. Done, sir. The provisions. The following particulars are furnished for the year ended 31st March 2025. The book profit after adjustments of all the items amounted to rupees 52,26,000 rupees, except for brought forward losses and unabsorbed depreciation. See, in MAT, we have to do 28 adjustments. If you remember, addition side, we had 15 adjustments. Deduction side, we had 13 adjustments. All in all, we have to do 28 adjustments only in MAT. Now, in MAT, important point is, they have already done the 28 adjustment except for losses and depreciation. Every adjustment that is required to be done, they have already done. We only have to do the Ind AS related adjustments. Now, brought forward losses as per books of accounts, how much should it be? Business loss 4.6 lakh and 1.75 lakh. All in all, it turns out to be 6.35 lakh. Unabsorbed depreciation 7.1 lakh. All in all, whichever is lower, we get deduction. That means ideally 6.5 lakh should be allowed as deduction. Business loss of 4.6 and 1.75 have been deducted while computing book profit. That means we have already taken deduction. Business loss would be 0. So 0 would be disallowed. 0 would be reduced. Yes, sir. Done. Particulars of the OCI for the year ended 31st March 2025. OCI income. So deferred gain cash flow hedges, we have income. Deferred cost of hedging, we have a loss. Comprehensive income from discontinued operations, income. Exchange differences, so debit. That what should we do of these things? What adjustment should we do of these things? What adjustments? Sir, we are not aware. I'm not able to recall what to do. My tears are coming. What to do, sir? I don't remember. Nothing. It is other comprehensive income reclassifiable to P&L. It is OCI. It will be reclassified into P&L. Sooner or later, it will be reclassified. We don't have to do anything in this. Sooner or later, it will be reclassified. Other comprehensive income that will not be reclassified to P&L. Will not be reclassified. Now, this is subject to adjustment. Changes in fair value of equity instruments. We have to ignore this expense. This will be taken to P&L. This will be taxed to MAT when it is actual sales. Actual sale of shares will actual sale of equity instruments will render us to charge MAT. Right now, we don't have to charge MAT on this. Deferred cash flow gains. It is income, so MAT will be charged on this. Deferred cost of hedging. It is an expense. It will be deducted. Changes in share of other comprehensive income from associates add back. Remeasurement, it has to be added back. Revaluation surplus, we have to ignore. Revaluation surplus is charged to MAT when it is actually sales. So whatever the additions are, we would charge to MAT 7.25 plus 3.2 plus 4.45 minus 4.1. All in all, 10.08. 10.08 is the additions we have to do. 10.8 is the additions we have to do. Transition amount as on the conversion state is 52.5 lakh. Credit balance, it is a credit balance. Done, sir. Now, it includes capital reserves of 8 lakh, that means capital reserve is to be removed, and adjustment of foreign translation operations. So 4.25 is to 4.5 is to be reduced. So all in all, it turns out to be 40 lakh rupees. 40 lakh is the transition amount. Now, whenever we have transition amount, it is allowed in 5 equal installments. Now, 5 equal installments would be 8 lakh per annum. So 8 lakh would be charged to MAT. But will this be actually allowed to us? See, conversion state is 1st April 2019. That means for the first year that India has got applicable to this entity was 2021. 2021 was the first year of application of India's, and a year prior to that, opening balance sheet is conversion date. So conversion date, if it is 1st April 2019, so India's applicability is 2021. So first year would be 2021, 21, 22, 22, 23, 23, 24, and 24, 25. Therefore, it is 5th year of operations. Therefore, we would get deduction. Therefore, 1/5 would be taxable in the current year. 1/5 will be taxable in a current year. Okay, sir, got it, got it, got it. The National Company Law Tribunal Chennai readmitted the admission of Section 7 of the IBC by the financial creditor against the company. Oh my God, sir! It is under insolvency. That means not just unabsorbed depreciation, but unabsorbed depreciation plus business loss both has to be allowed. In this case, 7.1 lakh would be allowed as deduction. Here, ICI has done something wrong. They had already taken deduction of business loss. They would again give the deduction of business loss. So therefore, addition of both would be given to us. 4.6 plus 1.75 plus 4.9 plus 2.2 all added on, and it will give us the deduction. That means 13.45 lakh is the deduction that they would get. It is an important point, a point worth it understanding. Otherwise, one might do wrong in this point. If you do all the adjustments, you would arrive at the right answer. 52.26 minus 52.26 minus 13.45 plus 10.8 plus 8. 57.61 lakh is the amount of book profit. On this, 15% would be charged plus 4%. All in all, 8,98,716 is the amount of MAT that is this company has to pay. Now, what this point is, assume the income tax as per regular provisions of the Act is 7.2 lakh. So 7.2 lakh is the regular provisions of income tax. If we reduce this 7.2, our actual MAT credit would turn out to be 1.78716. This is the amount of MAT credit allowed to us. Let's see the answer. 1.78720. Oh my God, sir, how it is absolutely matching. Why will it not match? I again ask, why will it not match? Why will it not match, sir? It is going to match, of course. Question number 32. What this question number 32 speaks out. Amold Limited, a company incorporated in UK, has a branch in India. The net profit of the branch as per statement of profit and loss for the year ended 31st March 2025 was 83 lakh rupees. Now we have 83 lakh rupees of net profit. What do we have to compute? Let's understand this now. You are required to compute the book profit as per 115 JB for the Income Tax Act, for the assessment year 25-26, and also total income and tax liability. Oh my God. Oh my God. Oh my God. Done, sir. Book profit we are given with. Now, dividend from Indian company listed. Dividend from Indian company listed, sir. Whether this should be taxed. Now, what is the tax rate at this? What is the tax rate for this dividend, sir? Whenever any foreign company receives any dividend, it is taxed at the rate of 20%. Dividend from Indian company unlisted, again it is taxed at 20%. Now, interest received from MMS of MMS Limited of Pune, from Mumbai, the amount was received by the Indian company MMS in foreign currency as per the loan agreement. See, 194 LC is applicable. 190 in under 194 LC, if you remember, if loan has been taken before 30th June 2023, then interest payable on such loan is taxed at the rate of 5%. So this 7 lakh is taxed at the rate of 5%. Done, sir. Important point, fees for technical services received from BAAR on Kolkata 25 lakh rupees. The agreement was approved from central government. Expenditure for provided or 6 lakh rupees. Oh my God, sir, what to do, what to do, what to do. This is the foreign company. It is receiving fees for technical services of 25 lakh and 6 lakh is the expenditure. Sir, how much should it be taxed? Should it be taxed 20%? Should it be taxed 20%? It should not be taxed 20%, sir. It will be taxed 35%. Why? because it has a branch in India. Foreign company, if it has branch in India, na, so 115A is not applicable. Only 35% tax rate is only applicable. 44DA would apply in this case, and therefore 20% benefit is not given to such foreign company. So therefore 25 lakh minus 6 lakh, that is 19 lakh, on this 35% would apply. Simple point it is. Yes, sir, it is simple point. So while considering the MAT, what should be excluded? This 7 lakh rupees, which is taxed at 5%, has to be excluded. So MAT book profit would turn out to be 76 lakh rupees multiplied by 15% plus 4%. This is the amount of book profit. This is amount of tax as per MAT. 11,85,600. This is the amount of book profit as per MAT. Sorry, tax as per MAT. Now, tax as per income tax laws, how much tax it would turn out to be? See, provision is clearly stating down that total income chargeable to tax as per Income Tax Act is 20 lakh. 20 lakh is the total income. It would be charged to tax at the rate of 35%. Now I am highlighting in blue what are the other incomes and what are the other tax rates. This 18 lakh, 8 lakh dividend would be taxed at 20%. 4 lakh dividend will be taxed at 20%. 7 lakh interest income would be taxed at 5%. And this 19 lakh would be taxed at 35%. 20 lakh would be taxed at 35%. This will give us the tax as per Income Tax Act. Let's calculate. 16,40,000 is the Income Tax Act. Income tax into 1.04. 17,05,600 is the amount of income tax required to be paid. Wow, sir. Wow. Since actual tax liability is more than MAT, so we are not required to pay MAT. Simple point it is. Most of the foreign companies don't require to pay MAT. Now, this is a good question. Question number 33. Very beautiful question. Beautifully drafted question. What this question is about, understand this. ABS is a cooperative society engaged in marketing of agriculture produce grown by the member. Now, members grow something, and this cooperative society markets these products to any of the market. Now, this is a specified business under ATP. That means on this business, whatever the income society earns, it is deductible at the rate of 100%. The profit and gain attributable to such business is 60 lakh rupees. That means entire 60 lakh would be subject to ATP. It had employed 10 employees at the 20,000 salary. So 10 employees at the rate of 20,000 salary. On 1st May, that means for 11 months. How much employee cost they have incurred? 10 into 20,000 into 11 into 30%. That means 6.6 lakh is the 80 double J they would get. And answer, they would get this much amount. Salary is paid by account paycheck. Its books of accounts get audited under section 44AB. It also earns 32 lakh as fixed deposit. You are required to compute the total income tax liability, advise whether it should opt for 115 BAD or not. Let's see what the question is asking. See, we have society whose business income is 60 lakh rupees. Interest income is 32 lakh rupees. Total income GTI is 92 lakh rupees. On this GTI, we would reduce ATP. ATP would amount to 60 lakh rupees only. We would reduce 80 double JAA. That would be 6.6 lakh. That means 25.4 lakh is the total income. And on this total income, we are required to compute the taxes. What is the tax rate for a society? What is the tax rate for the society? If you can help me out, up to 10,000, 10% tax. Or I can simply say 25.4 lakh minus 20K into 30% plus 3,000 into 1.04. This is the figure you have to do. 25 lakh 40,000 minus 20,000 into 30% plus 3,000 into 1.04. 789,360 is the amount of tax cooperative society is required to compute. Sir, since it is a cooperative society and it claims income-based deductions, AMT would also be calculated. How AMT is calculated? We would take the total income, 25.4 lakh. Whenever we take AMT, sir, we have to add all the income-based deductions. Right away from 80IA to RRB, every income-based deduction is to be added back. Now, important point here is, sir, 80P is never added back. While calculating AMT, 80P is never added back. Therefore, 80 double JAA would be added. 6.66 lakh will be added. Therefore, our total income would turn out to be, adjusted total income would turn out to be 32 lakh. And on this, what is the AMT rate? AMT rate 18.5%? No. AMT rate is 15% for society plus 4% education cess. If you would arrive, how much AMT would turn out to be? 499,200 is this is the amount of AMT this society is required to pay. And not just that, we need to calculate 115 BAD. Now, BAD, the business income would be 60 lakh rupees, interest income would be 32 lakh, GTI will be 92 lakh. Now, while computing 115 BAD, we are not allowed a small deduction. We are not allowed a small deduction. Which small deduction we are not allowed? Sir, we are not allowed deduction under 80P. That means 60 lakh we won't get deduction, but 80 double 6.6 lakh we would get deduction. That means our income would turn out to be 92 minus 6.6. This would turn out to be 85.4 lakh will be our income. On this, we would be charged 22% tax, 10% surcharge, 4% education cess under 115 BAD. How much tax turns out to be? 2,149,347. This is the amount of tax as per 115 BAD. Of course, it is not going to opt for 115 BAD. Of course, the society is not going to opt for 115 BAD. Now, the question is not over. Remember, dear friends, question is not over. What would be your answer if ABC Cooperative Society is not a cooperative society, but it's a bank engaged in the business of banking? All the facts remain same. Assume it is not a primary agriculture cooperative bank. That means it is not eligible for ATP. What will happen if it is a bank? Now, how answer would change? Let me tell. For a bank, business income being 60 lakh, interest income being 32 lakh. If it is a bank, then what would happen? Our GTI would be 92 lakh. Now, if it is a bank, it will not be given ATP. Banks are not allowed ATP. But 80 double CAA is still allowed to banks, so they would get it. Bank would get 80 double CAA 6.6 lakh. That means 85.4 lakh would be income, and it would be taxed heavily. 80.4 lakh minus 20K into 30% plus 3,000 into 1.04. This will be the amount of tax that this society has, bank has to pay. 266,1360. Now, if it is a bank, it is also required to pay AMT as well. 60 lakh. Sorry, how much AMT would arrive? Sir, 85.4 lakh is the total income. We have to add 80 double CAA. That means 6.6 lakh is to be added. That means 92 lakh is the adjusted total income. And on this, 15% plus 4% is the AMT required to be paid. AMT is 1435,200. Now this bank is also subject to be taxed under 115 BAD. We have to check whether BAD is beneficial or not. How BAD will be checked? 60 lakh plus 32 lakh is the GTI. Till 92 lakh is the GTI. Whether it would get ATP? No, sir, it would not get ATP. Whether it would get 6.6 lakh of 80 double CAA? Yes, it would get. 85.4. How much tax? 85.4. 22% tax, 10% surcharge, 4% education cess. As good as old regime. So 2149,347. 2149,347. Now, if it is a bank, it is beneficial to go for 115 BAD. So a normal society won't go for 115 BAD. It would go for ATP. It is a bank who is not allowed ATP is beneficial to go for 115 BAD. Beautiful, beautiful question. You will see 6 points and you will get 6 marks for each point. Beautiful question. Another beautiful question in the list has come. Another beautiful question. Very beautiful question. Now, what the question is about, understand this. Question number 34. PRK LLP is limited liability set up in special economic zones on 1st April 2017. I would request you to just focus here. Focus very keenly because now this question might be wrong at multiple places. And even after solving at a certain point, you will feel like you are done with the answer. But there are too many layers to this answer. Humble request to everybody watching, just be careful in this answer. In addition to being careful, do like the video, subscribe to the channel. If you are not subscribed to the channel, Mata Rani will not bless you. Mata Rani is not going to bless you. You do not subscribe to the channel. Now, come on to question. Now, since it is an SZ and incorporated in 2017, now what would happen if it is incorporated in 2017? Then it is nearly 7 to 8 year of operation, maybe 9th years. 50%, whatever the 10AA would be arrived, 50% would be allowed as deduction. Okay. To develop and export SEZ. Unit complied with all the conditions of 10AA. Net profit of each unit of profit and loss is this and this of 65 lakh after debiting rating the following items. Done, sir. So net profit is 65 lakh. Done, sir. Profit and sale of import entitlements. Sir, do we add this? No, sir. It is an allowed expenditure. It is allowed expenditure. It is allowed income. It is taxed, and under section 28, it is absolutely okay. So I'm just highlighting this point. I will use it later on, but right now it is already taxed. Remuneration to working partners. Whatever remuneration you pay now, you have to add back. It is not allowed. Interest of 20 lakh rupees paid at the rate of 16%. So 20 lakh interest is paid 16%. You are only allowed 12%. That means 4% extra you have paid. That means 5 lakh would be added back. Donation to political party will be added back, but sir, you would get a deduction under 80 GGC. That is 3 lakh you would get deduction. Done, sir. Depreciation 17 lakh to be added back, sir. Done. Depreciation added. Now, do we have any depreciation mentioned? Sir, depreciation mentioned in last line, so we would reduce the depreciation. Now, this is actually the book profit that we would arrive for the purpose of depreciation. Do we have any other thing? So payment of remuneration to working partners and interest on capital are authorized by the partnership deed. Brought forward business loss. See, we have some business loss as well, 4 lakh rupees. We have some unabsorbed depreciation of 35 lakhs. So unabsorbed depreciation is reduced. Normally, unabsorbed depreciation is reduced while calculating the book profit for the purpose of remuneration. What I'm saying is, whenever you calculate remuneration based on reducing the depreciation, reducing the unabsorbed depreciation as well. So whatever the book profit is for the purpose of remuneration, we are arriving at that. 65 plus 58 plus 5 plus 3 plus 17 minus 26 minus 35. So we arrive at a book profit of 87 lakh. Now we will get remuneration on this. First 6 lakh, we get 90%, that is 5.4 lakh. And on remaining 81 lakh, we would get 60%. That means 48.6 lakh. Adding both of them would give us 54 lakh of depreciation. 54 lakh of remuneration. Paid remuneration is 58 lakh. Allowed is 54 lakh. So lower of 2 would be given to us. Removing the computation portion, I'm just removing because it is not relevant as of now. Allowed remuneration is 54 lakh rupees. That means our PGBP after remuneration would be 33 lakh rupees. After this, we will reduce the losses. Losses of 4 lakh to be reduced, and then we will arrive at gross total income of 31 lakh. Not 31 lakh, actually 29 lakh. Anybody having any doubt up to this point? I personally don't think that this is the area of issue. This is not the area of issue that one might face issue. It is a simple point. Done, sir. Now, after GTI, we would get two deductions, that is 80 GGC of 3 lakh and 10 AA. Now, how 10 AA is calculated, that is important. Whenever you compute 10 AA, you need three things. First of all is PGBP of the unit multiplied by export turnover divided by the total turnover. These are the three things you require. Now, what is the PGBP of the unit and export turnover? Say export turnover and total turnover is given in this line. Total turnover and export turnover is 45. Now, total turnover and export turnover is 45. Okay, 45. And sales proceed received in convertible foreign exchange up to 30th September 38. Oh my God. So export turnover will be 38 only because received in India is up to 38 only. Total export turnover of 45 includes telecommunication charges of 5 crore. See, whenever you have any telecommunication charges that are never considered a part of total turnover, so 5 has to be reduced. So total turnover is 40 crore only. And sales proceed of 38 crore includes 2 crore of telecommunication charges. That means out of this 38, 2 is telecommunication charges. That means 36 crore is the export turnover. So export turnover is 30 and total turnover is 40. What is PGBP of the unit? Sir, if I am required to tell now PGBP of the unit, will it be 29? Will it be 33? Sir, PGBP is always before set off of unabsorbed losses. Unabsorbed losses before set off is the PGBP. Always. PGBP for the purpose of 10AA is before the losses. But after depreciation. Before the losses, after depreciation. Now, What is the PGBP? Sir, 33 lakh. Sorry, 33 lakh. Yes, sir. 33 lakh. Yes, sir. 33 lakh is the PGBP of the unit. Now, in this case, there is an issue. Not one, but there are two issues. If you remember, for the purpose of 10AA, whatever the profit we arrive on the sale of import entitlements, it is not allowed. Any profit on import entitlements is not eligible for 10AA. So this shall be reduced. This 9 lakh has to be reduced, and this will give us the profit of unit. Profit on sale of import entitlements are not allowed for 10AA. So how much 10AA deductions we would get? So 24 lakh multiplied by 36 crore divided by 40 crore. This would give us 24 into 9%. This implies 21.6 lakh rupees is the deduction we would get. 21.6 lakh is the amount of deduction we would get. Done, sir. Simple point it is. Very simple point. Yes, sir, it is simple. But issue still remains. Why issue still remains? Because, sir, it is 7th year of operation, 8th year of operation, so only 50% would be given to us. Therefore, amount of deduction under 10AA would be 10,80,000. This will give us net total income. Remember, you are not done with this. You are not done up to this. Remember, I am telling again, you are not done up to this point even. 15.2 lakh is the NTI. You are not just required to comply with NTI. You have to calculate taxes. You have to calculate adjusted total income. You have to calculate AMT, and you have to tell the AMT credit as well. Just calculating NTI would give you 3 marks out of 8 marks. After doing too much of hard work in 10AA, too much of hard work in remuneration, you would still not get too much marks. Understand this. You will not get full marks if you do not calculate taxes. So how much taxes? For a LLP, 30% tax rate plus 4% surcharge is the applicable rate. So ultimately 474, 240 is the amount of taxes required to be paid. Now, this LLP has to undergo AMT as well. Now, NTI is nothing but 15.2 lakh rupees. Now, whenever you have any NTI, you just have to add certain things. You have to add 10AA. 10AA is nothing but 10.8. Do we have to add GGC? Sir, 80 GGC is not to be added. Why? Because only income-based deductions are added. So 80 GGC will not be added. Your total income would turn, ATI would turn out to be 26 lakh, and it also carries marks. Now, this ATI has to be taken at 18.5%. Whenever you have ATI, you will be charged 18.5% AMT in this case. Into 1.04, education says, so 5 lakh 240 is the amount of AMT that this cooperative has to pay. Understand? Tax AMT, tax AMT, tax AMT, both the things are to be taken care of. Now, how much credit this entity would get? Minus 4.742440. 26,000 is the amount of credit that this society would get. This society, no, actually, this LLP would get, and this is the right answer. If you do not write the credit now, you will still get 2 marks less than total marks. This question is not just about hard work, it is about too much of dedication. Or I should say, not dedication, but too much of focus it requires. One step and you will get 0 marks. One step wrong and you would get 0 marks because your credit would be wrong. If you grade wrong, you won't get marks. If your AMT is wrong, you won't get marks. If your 10AA is wrong, you won't get marks. Whatever you would get, sir, it would be not be wrong. Even if your remuneration is wrong, now remember, you will not get even a mark for this. When people come in complaining, we didn't get marks, we didn't get marks. Why will somebody give you marks if your even remuneration is not correct? What steps examiner is going to give you marks? So you must remember, these questions are to be done with focus. These are the difficult areas. These are not simple. Understand, these are difficult areas. Got it, sir. Got it, sir. Got it, sir. We got it. We got it. We won't do mistake any. Okay. Now we have tonnage. Now we have to calculate the tonnage. Now we have 4 quarters. I'm not calculating all, but quarter 3 and quarter 2. Quarter 4 and quarter 2 we'll do. Whenever we have tonnage, see, 37,525 is the net tonnage and 100 it is carrying. 37,525. Whenever tonnage we carry, na tonnage is always calculated in nearest 100 basis. 37,500. For first 1,000 ton, how 1,000 tons go? Sir, 70 for every 100 ton. 70 for every 100 ton it is allowed. So how much it turns out to be? 700. For next 1,000 to 9,000, 9,000, sorry, 1,000 to 10,000. How much tonnage applies? Sir, on 9,000, 52, sorry, 53, 53, 53, 53, 53, yes. How much it turns out to be? 9,000 divided by 100 into 53? 4770. Now, on 10,000, 2. 25,000. How much it turns out to be? 15,000 divided by 100 into 42. 6,300, and greater than 25,000 to 37,500, that means 12,500, it would be charged at 29. 12,500 divided by 100 into 29. 3625. This is the daily tonnage income. Whatever I am highlighting, 700, 4770, 6,300 and 3625. 15395. Oh, 15. What am I doing? 15395 multiplied by 100. So this is the tonnage income of the ship for the quarter 4. Similarly, you can calculate for quarter 1, quarter 2, quarter 3 as well. It's very easy question. It is not difficult to be understood. But one point you need to understand: how do we understand this 770, 52, 40, 53, 42, and 20? How do we learn this? Now let me try. Let me try. Okay, 70, 53, 42, 39. Or no, sir, we did not get this. 70, 17, 11, and 13. 17, oh sorry, 70, 17. See, can you recall 70, 17, 70, 17? Do you recall? Do you understand? Are you able to recall this? 70, 17, 70, 17, 70, 17. Clear? It is very clear. 11, 13, 11, 13. I say, can you say 11, 13, 11, 13? Can you say? I know it sounds silly, but it is the thing that will make you learn. Remember. Can you recall 70, 17, 70, 17, 70, 17, 11, 13, 11, 13? Can you say this? Can you say like this? I know it sounds funny, but it is important. Okay. Now, how figures arrive? 70 minus 17 will give you 53. 53 minus 11 would give you 42, and 42 minus 13 would give you 29. This is how you are able to learn. We do this in regular or power batches, so it'll help you a lot. It'll help you a lot. I hope you are able to solve it. I hope you are able to do it. Done, sir. Watch it multiple times. It'll help you solve. It'll help you solve it. Come on to question number 36. How many questions do we have? Willingly or unwillingly, I have given too many questions, I guess. More than required questions I have given. No, sir, nothing is more than required. Everything is required. Now, Mr. Rajesh is a resident unit holder in PQR and Shipra Limited. PQR is Incorporated Investment Fund. PQR is investment fund, and Shipra is nothing but a REIT, a real estate investment trust, that is a business trust. A REIT which holds 100% in GPL. So, REIT holds 100% in GPL. GPL is nothing but a SPV. Done, sir. An Indian company. Rajesh holds 10% in both. Rajesh has 10% in business trust and 10% in investment fund. Done, sir. Both Rajesh and Shipra have been held since 2021. Income from Shipra and Rajesh. So Shipra is nothing but a business trust, and BQR is nothing but investment fund. Done, sir. Dividend income from GPL. Now, now what if this is happening? Shipra's information has been given to us. That means business trust earned dividend income from GPL. We have to calculate income for the purpose of Rajesh. Now, whenever you receive any income of dividend from the business trust, you have to check at SPV whether SPV is paying taxes under 115 BAA or not. This GPL is paying taxes as per 115 BAA or not. Let's see. GPL does not exercise an option for 115 BAA. Done, sir. And Shipra and PQR distribute 90% of the total income to the unit holders after deducting the applicable TDS. Compute the total income and net tax payable. Done, sir. Now, since this GPL is paying taxes at the rate of 30%, 25%, therefore dividend income is exempt in the hands of the unit holder. This is exempt in the hands of the unit holder. Absolutely exempt, sir. Done. Done, sir. Done, sir. Interest income from GPL. Now, 3 crore interest income is there. So, remember, business trust distributed 90% of the interest. That means, all in all, 2.7 crore interest has been distributed, and of this 10% is received by Rajesh. So 27 lakh is the amount of interest income received. Now, whenever a resident unit holder receives interest from business trust, it is taxable in his hand at the rate of slab. Slab rate is only applicable. Slab rate is only applicable. The only thing is this business trust must have deducted TDS at the rate of 10%. So TDS of 2.7 lakh has been deducted. That's the only thing. Otherwise, everything is sorted. Done, sir. Done. Short-term gain on sale of developmental properties, business and developmental properties. Sir, if any business trust earns any developmental properties income, it is taxed in the hands of the business trust at MMR. Whatever income we receive, it is absolutely exempt. It is absolutely exempt in our hands. So it is exempt. It is exempt, sir. Absolutely exempt. Now, we have this Rajesh has business income from PQ. Investment fund has an income of business. Investment fund has a business income. Now, whenever business income is with the investment fund, it is taxable in the hands of investment fund only, and we get exempted. It is exempt in our hands, so it is exempt for us. It is exempt for Mr. Rajesh. Done. Now we have long-term capital losses. See, whatever losses this business trust investment fund has, that will be transferred to Rajesh. So 2.7 lakh is the losses Rajesh would get. LTCL, he would get loss. And interest income, 52 lakh is the interest income. Important point now. Investment fund earn the interest income. Now for investment fund, it is not taxable. It is taxable in the hands of the unit holder. So unit holder received the 10%. Rajesh received 10%. So 5.2 lakh will be interest income from investment fund. And investment fund must have deducted 10% TDS. That means 52,000 interest TDS must have been deducted. Sir, but it is said that 90% have only been distributed by investment fund. There is a point mentioned now. Both the investment fund and business trust have distributed only 90%. So why are you taxing entire 100%? Solution here is, reason here is, whenever investment fund either distributes or not distribute, it is assumed to be taxed in the hands of the unit holder. It is assumed to be taxed. We do not consider whether it has distributed or not. For business trust, distribution is important, but for investment fund, in distribution is not important. If investment fund distributes or not distributes, it is irrelevant. It is taxed in the hands of the unit holder, irrespective of distribution. Therefore, total income turns out to be 32.2 lakh rupees. On this would be taxed in the hands of Rajesh. What is the what net tax payable? Assuming he has opted for 115 BAC. Now, if he has opted for 115 BAC, how much deduction, how much tax he would be charged? 32 lakh 20,000 minus 15 lakh into 30% plus 1 lakh 40,000 into 1.04. So tax amount turns out to be 682,240. This is the amount of tax that would be charged in his hands, minus one thing we have to do. What one thing we have to do? That this is the TDS amount. 2.7 lakh plus C, that means 332 is the amount of TDS we have to reduce, and this will give us the net tax payable. 322 actually. 360, 240 is the amount of tax payable. 322 is the reduce. 630, I guess total is wrong here. Total mention is wrong. 360 is 240 is the right answer. It is the right answer. See, our tax payable is same as 682 to 40. 682 to 40 minus 322, we would get the same answer. Don't worry. Done, sir. Done. Now it comes the firm taxation. So every topic has been covered. Don't worry. Firm taxation is also covered. The net profit of LS and Associates, a partnership firm, shows a profit of 80 lakh rupees after debiting and crediting the following items. So 80 lakh is the net profit. What the question asks? Compute the total income of the firm, giving the reasons of each of the items. So we just need to calculate the total income, not the taxes. Partner interest on partners' capital, see 7 lakh 13,000, 7 lakh 15,000 is the interest paid. It is 13%. 1% would be disallowed. So 55,000 is to be added back. Done, sir. We would add that. Interest on loan taken from one partner. See, 90,000 is the interest you have paid to partner on whatever thing you pay. Now, maximum interest allowed is 12%. Maximum interest that you should pay is 12%. So divided by 15%, multiplied by 3%, 3% because it is extra. So 90,000 divided by 15 into 3 would turn out to be 18,000 is to be added back. Interest from bank deposits made out of surplus fund. Whenever a partnership firm earns any interest from surplus fund, it is taxable under IFOS. So it would go to IFOS. 35,000 would go to IFOS. Depreciation as per books of accounts to be added back 115,650. Building purchase in financial year 21, WDV was 36.45 lakh, was sold at 90 lakh rupees on 10/10/2024. Wow. Wow. The differential amount is credited to P&L. Remember, this was the only asset. Remember, whenever you have a capital gain on short term, whenever you have any capital gain, remember that has to be excluded. Has to be excluded. Always excluded from PGBP. It is never considered part of prior PGBP. Now, how much is included in PGBP? 90 lakh minus 36.45 lakh is included in PGBP. So 90 minus 36.45. All in all, 53.55 lakh is included in PGBP. Now this would go to short-term capital gain. Short-term capital gain, 53.55 lakh would go to short-term capital gain. Done, sir. Now the firm has 4 partners, only 2 are working. Partnership firm did authorize the payment of interest to all the partners at the range of 12 to 16%. It won't be allowed, only 20%, 12% is allowed. And payment of remuneration not debited to P&L to all the partners of 20,000 each. So remuneration allowed is 20,000 to each partner. 4 partners into 12 months, sir. But how much it will be allowed, sir? It will be allowed only to 2 partners. So if we consider now, only 4,80,000 remuneration is allowed remuneration, maximum limit. We will check whether how much as per book profit they are paying. It started for establishment SZ, so this is related to SZ. No, sir, no issue. Out of the amount received from the sale proceeds of the building, 60 lakh have been invested in 5-year bonds, so it is relating to capital gain. Depreciation as per income tax rules is 14,000, excluding the depreciation and ENF. So depreciation allowable is 14,000. Done, sir. WDV on motor vehicle is on 1st April 2020 is this 6,80,000 rupees. It was purchased on 1st Jan 2020. Remember, huh? Whenever you have any motor vehicle purchase from 30th August 2019 to 31st March 2020, depreciation was not 15%, depreciation was given 30%. So in this case, 30% depreciation would be given to us. 680 into 30% depreciation. So 2,04,000 depreciation would be given to us. In addition to that, mobile phone were purchased on 10th October 2024. That means half rate 7.5% would be given to us. 20,000 into 7.5, 1,500 depreciation would be given to us. Done, sir. Done, done. After adjusting all these items, we would arrive at book profit for the purpose of remuneration. 80 lakh plus 55,000 plus 18,000 minus 35,000 plus 115,650 minus 53 lakh 55,000 minus 14,000 minus 204 minus 1,500. So our book profit for the purpose of remuneration 2,579,150 is the book profit for the purpose of remuneration. See, you can see just you can take 60% of that and it would exceed 240. So maximum remuneration allowed would be to 480 only. Whatever we have paid is the allowed. Of course, we cannot get deduction of more than what we have paid. So 480 would be maximum remuneration allowed to us. We would reduce 480. So 2099150 is the amount of book profit we would arrive. On this we will get deduction. Let's check the figures. 2099150 is the book profit we have arrived. This is the book profit. Book profit. Now we would have also capital gain. How much capital gain would be arrived to us? So 53.55 lakh is the amount of capital gain given to us. We have a small point. Out of the proceeds, firm invested 60 lakh rupees in 5-year bonds of NHAI. Sir, is it allowed? Whenever you have any bonds, do we get any deduction exemption on that? Remember, very important point, sir. When did you sell the asset? When did you sell the house? You sold the property on 10/10/2024. 10/10/2024. And you bought bonds on 31st May 2025. No, you bought bonds on 5th April 2025. 5/4/2025 and bonds were issued on 31st May 2025. Now, what my point of discussion is, it is short-term capital gain. Will bonds give you any exemption? Sir, it will give you. We had a case law of VS Dempo Limited, Supreme Court judgment. If capital asset is a long-term capital asset, now short-term capital gain is irrelevant. It will still give you exemption. So exemption is allowed. But the point is, you must pay the money for acquisition of bond till within 6 months. Money should be paid within 6 months. So from 10/10, if we take 6 months now, did he pay? Yes, he paid money. Therefore, exemption would be given to us. Maximum exemption given would be 50 lakh rupees. So 50 lakh has to be reduced from here, and taxable capital gain would be 3,55,000. 3,55,000 would be taxable capital gain. Apart from that, it would have income from other sources of 35,000. Done, sir? Absolutely. Now, how much our GTI would turn out to be? GTI would be 2489 150. This is the amount of GTI. Now we would have 10AA. How 10AA would be arrived? 10AA would be arrived as export profit into PGBP of the unit into export profit, export turnover divided by total turnover. This is the figure we have to put. What figure says? Understand this, huh? It applied for establishment necessity in 2020. Okay. But approval was given in 2020. That means 2021 was the first year of operation, 21, 22 second year, 22, 23 third year, 23, 24 fourth year, 24, 25 is the fifth year of operation. That means 100% export turnover and net profit of the unit was this and this. So how much it would get deduction? Understand this. Total turnover is 120. Export turnover is 40. Out of that 7.5 lakh is the PGBP of the unit. So we would get 250 to 2.5 lakh as deduction. So 2.5 lakh, 2,50,000 is 10AA allowed to us. This would be reduced. But total profit turns out to be 2,239,190. This is actually the total income of the unit. 2,239,150. Fingers crossed. Oh my god. Oh my god. Oh my god. I'm amazed to see the right answer. Very nice, sir. It is easy. It is easy. It is easy. Why are you amazed? It is bound that you will get the right answer. Come on to question number 38. Beta, a real estate investment trust registered under SEBI regulations, holds 65% in H Limited. Now, what the case is? Beta holds 65% in H Limited. H Limited is nothing but SPV. Now, whether SPV is paying taxes, let's see. H has opted to pay tax under 115 BAA. So, SPV is paying taxes under 115 BAA. Now, Beta Limited provides you the following information. Also, there is one information. Arpan is the resident unit holder who holds 70% in the REIT. Now, Beta is the business trust, and Arpan is a person who holds 70%, and he is resident person as well. Done, sir. Okay, done. Now, first of all is interest income from business trust. Interest income from business trust. Remember, whenever any interest income is received for business trust and for unit holder, understand this. For business trust, interest income is always exempt. For unit holder, that is ARPAN, it is taxable at the rate of slab. And how much it would be taxed? Only 70%, since he is receiving 70%, 70% would be only taxed. That means 8.4 crore it would be taxed in the hands of the ARPAN. Dividend income. Whenever business trust distribute any dividend income, it is exempt in the hands of the business trust, but it is taxed in the hands of the unit holder. At what rate it would be taxed? It would be taxed at the rate of slab only. That means 1.4 crore is taxed at the rate of slab. Short-term capital gain on sale of developmental properties. Any short-term capital gain in the hands of business trust is taxed at MMR. And for unit holder, it is exempt. Interest received from investment in unlisted securities. Whenever any business trust earns any third-party income, then it is taxed at MMR in the hands of the business trust, and it is exempt in the hands of the unit holder. Done, sir. Rental income from directly owned premises. If business trust earns any rental income from directly owned premises, it is exempt in business trust, and it is taxed in the hands of the unit holder. Whatever the unit holder hold, it will be taxed. Now, important point here is he acquired the units issue. No issue. He does not have any other income. During the previous year, redistributed 20 crore income to the unit holder. Understand this thing very carefully. Very carefully. Business trust distributed 20 crore. How much it had earned? Business trust had earned how much income? I'm highlighting the portion. Business trust earned 12 crore as interest, 2 crore as dividend, 1.2 crore as short-term capital gain, 12 lakh rupees as interest, 2 crore as rental income. That means if we do the total, 12 plus 2 plus 1.2 plus 0.12 plus 2, all in all 17.32 crore is the amount of income that business trust has actually earned. Business trust had earned only 17.32 crore. Done, sir. If I may ask, 2.68 crore is the extra distribution that this business trust is doing. So this extra distribution is taxed in the hands of the unit holder. Now, since Arpan is the unit holder, now Arpan holds 70%, so 70% would be taxed in the hands of the Arpan. That means 1.876 is tax in the hands of the urban. Now, only problem here is he gets a deduction of cost of acquisition. Whatever the cost of acquisition that he had incurred for acquiring the units will be reduced. So 1.5 crore as it is given in the question will be reduced. Only 37.6 lakh will be taxed in the hands of the urban. This is the amount of calculation. This is 56 to 12. Whatever the excess distribution that this business trust is doing now, in addition to the income it has earned, it is taxable in the hands of the unit holder. It is taxable in the hands of the unit holder. You would see the same answer 37.6, and it is not taxable in the hands of the business trust at all. Done, sir. Done, ji. Simple chapter it was. Very simple, very simple, very simple. It was chill topic. Done, sir. Taxation of charitable trust, political parties. Now, what this topic is all about, understand this. Asma Rani. Asma Rani is a charitable trust that runs a hospital cum rehabilitation center to treat the patients suffering from leprosy. The charitable trust is registered under 12 AB and follows cash system of accounting. Furnishes the following information. The trust follows the cash system of accounting and follows. Okay, no issue. Now, we need two things. We need receipts. We need applications. Only two things we need, and we'll be done with question. Now, gross receipt from hospital is 560, so it is a part of receipt. We would add that. Gross receipt from rehab center, so this is also to be added back. Perfect. Fees not realized from patient. See, it is following the cash system of accounting now, so we don't have to consider this because this has not been realized. Administration expenses for the hospital, that means administration expenses for hospital is nothing but 335. We would note that down. Admin expenses paid for rehab center, that means we would note it down. Admin expenditure for rehab center 138, we would note that down. Now, acquired a building for 150 lakh for expansion of rehab center. Cost of land is 85 lakh. Stamp duty value is 185. Sir, it is irrelevant. Cost, stamp duty value, nothing is relevant. Only price paid is to be taken. Price paid to acquire is this 150. So therefore, application for building would be 150. Done, sir. Grant received from government. So grant would be taken. Government grant would be 7.5 lakh. This will be added to the receipts only. Now, admin expenses includes payment of 12 lakh rupees to resident doctors and contractors on which TDS has not been deducted. So on this 12 lakh, 30% expenditure would be disallowed. 3.6 lakh has to be disallowed. So in this 3.35 minus 3.6 would be taken as application. 3.6 lakh has to be reduced from application. Voluntary contribution including the corpus of 10 lakh is 20,000. See, donation we received 20 lakh. Out of that, 10 lakh is normal. 10 lakh is corpus. Whatever donation of corpus we received is exempt. Always understand is exempt. These contributions are included in gross receipts of the hospital. Oh, that means out of this 560, 20 lakh has to be excluded, and 20 lakh is the donation amount. So donation amount, how it turns out to be 10 lakh is taxable, and corpus 110 lakh is exempt. This is how figures would click. Anonymous donation of 8 lakh rupees. So whenever we receive anonymous donation, some part of it is considered as normal and some part of it is considered as 115 BBC. 115 BBC. Some part of the donation of anonymous is considered as normal and the other part is considered as taxable. Now, how much it is considered normal? Sir, 5%. I'm just removing this figure for now. 5% of normal donation, corpus donation, anonymous donation, government grant, exclude government grant. 5% of normal donation would be 10 lakh, 10 plus corpus donation would be 10 lakh. Anonymous donation is 8 lakh. Government grant we have to ignore. So it implies to 28 lakh into 5%. That means 1.4 lakh is normal and remaining 6.6 lakh is taxable at the rate of 30%. So 1.4 lakh would go above and 6.6 lakh is taxable separately. Amount donated to Kalyan Trust running the similar hospitals in Bihar, it includes corpus donation of 5 lakh. See, we have donated to other trusts, so 11 lakh. Out of that 11 lakh, 5 lakh is towards corpus. So we have actually donated 6 lakh rupees. On this 6 lakh, we would get 85% deduction. So we would get 5.1 lakh of deduction. Trust donation. 5.1 lakh, we would get deduction. Done, sir. Repayment of earlier taken loan. See, whenever we take any loan and we spend that money, it is not allowed. But whenever we repay that, it is allowed as deduction. So we would get deduction today. Trust set apart 15 lakh rupees for acquiring some other future tables and equipment. So 15 lakh we would get 11 to 11 to how much we would get 15 lakh. Okay. Now whatever I'm highlighting in blue has to be added back. Has to be added for the purpose of income portion. 560 is to be added, 220 is to be added, 7.5 lakhs to be added, 10 is to be added, 1.4, and this 20 to be reduced. This will give us the total receipts of the trust. 560 minus 20 plus 220 plus 7.5 plus 10 plus 1.4. This will give us the total receipts of the trust, that is 778.9. Now we would get a 15% standard deduction on this. 116.835, and after reducing the standard deduction we would give 662.065, the total income of the trust. Let's take it down. 662.065 is the total income of the trust. Now we would get the application portion. Just do the totals here. Whatever I'm highlighting in green has to be totaled, and whatever that I'm highlighting in red portion has to be reduced. 335 minus 3.6 plus 138 plus 150 plus 5.1 plus 6.65 plus 15. This will give us 646.15. This is the application. Now, incomes are to be compared with applications. How much it turns out to be? Minus 662.065. 15.915 is the total income of the trust. 15.915 is the total income of the trust. What we are required, total income only and income tax liability. For trust, assuming it has not opted for 115 BAC, we would multiply it with we would arrive income at 15 lakh 91,500. Reduce 10 lakh rupees into 30% into plus 1,12,500 into 1.04. Our tax liability will turn out to be 301,548. This is the amount of tax liability. This is the amount of tax liability. Sorry. In addition to that, of course, we would be taxed at this anonymous donation as well. We have this anonymous donation as well. So 660 into 30% into 1.04. So 205,920 to be added. 507,468. 507,468. This is the amount of tax we arrived at. Point is simple. Of course, the 15 lakh we arrived, that was correct, but we had to add anonymous donation. This will give us the total income. Did we get this point or not? Tell me, did we get this point? Did we arrive at this point properly or not? Yes, sir. Absolutely. Absolutely, we arrived at this point. Come on to question number 40. Now we have 141 questions to solve, and out of that, we have just reached to question number 40. Are we doing right, sir? Yes, of course, we are doing right. Have faith in the process. We will do it on time. Don't worry. The Mahan Charitable Trust is running an orphan and hospital for poor children, registered under Section 12 AB. The details of income and expenditure is given. Now, voluntary donation received during the year is 150 lakh. So 150 lakh would be taken. It includes corpus donation of 10 lakh. So corpus donation is to be excluded. The corpus donation is invested, done, sir. The donation of 20 lakh rupees from Michael, a foreign donor, that is received on the last date. See, whenever you receive any donation from a foreign donor, is it allowed? Of course, it is allowed. No issue whatsoever. But the point here is that it is received on very last date. How can we use any income which is received on last date? We are not in a position to use that now. So for that matter, we have to apply to AO that we would use this in next year under the form 9A, if you remember. Relation 1 to section 11 we have to apply. So 130 lakh is the total income of the trust as of now. This is the receipts. Now we have salaries. This is the application portion. 40 lakh is the salary, done. General expenses are 10 lakh rupees, out of which 90,000 is paid by cross check. So general expenses would be 9.7 lakh. Land belonging to trust in nearby village was purchased for 5 lakhs. So purchase was for 5 lakhs, sold for 10.5 lakhs. So difference is 5.5 lakh. This would go to capital gain. Done, sir. And another land adjacent to that was bought for 12 lakh rupees. So ultimately, cost of new asset minus cost of old asset would be given as application. Cost of new asset is 12 lakh, or cost of old asset was 5 lakh. So 7 lakh would be given to us as application. 7 lakh would be given as application. 5 laptops, 50,000 each were purchased. So laptops were bought. Therefore, 2.5 lakh would be given to us application. Two adjacent rooms of 1500 square foot each. So 1500 square foot each into two rooms. And each room was constructed at a cost of 1200 rupees per square foot. So cost of construction into 2 into 1200. That means 36 lakh would be cost of construction. 36 lakh. Corpus donation was made to other trusts having similar objects, that it would not be allowed as application. Whenever you do any corpus donation to somebody else, it is not allowed as deduction. Compute the taxable income of the Mahansi. We have to gross receipts of 135.5. We get standard deduction of 15%. 115.175. This is the gross receipts we would be getting. Now, we would have some applications 40 plus 9.7 plus 7 plus 2.2, 2.5 plus 36. So 95.2 would be our application. Now this would give us 19.975 is the amount of total income. Now, important point here is support your answers. We don't require to do anything else. This is our answer. But just think of it. Somebody might be thinking, sir, its income is turning out to be taxable one. We have an option. We still have an option that whatever donation that this Michael has given, if you can see this figure carefully, donation of Michael of 20 lakh rupees, we can apply to AO and apply it in next year. Now we can get a deduction in current year. We will not be required to pay any taxes. We can give this declaration to AO and we can use this money next year. We can apply to AO. But why are we not doing that? Provision is not asking us the optimum tax liability. It is asking us only compute the total income. That's it. If it would have asked us to calculate the taxable income or optimum tax liability or tax portion, we would have used this application. Still, if we want to write the answer, now we can write down that out of this 19.975, how much basic exemption limit is 2.5 lakh. Now just remove 2.5 lakh. 17.475 lakh we can declare to AO that we would use it next year. We can furnish form 9A to AO at least 2 months prior to ROI, and we can claim exemption of 11.1 explanation 1 that we would use this money in next year. This is also doable. This we can write down in notes, and the same thing they have done. Same thing they have done. 17.475 lakh they would use it next year. They can file 2 months prior to ROI in from 9A so that they get exemption on this, so that they are not required to pay taxes. So we don't have to do it of our own. If it is given, if it is asked in question, we would do that. Okay, so come on to question number 41. Now what question number 41 says, it is about exit tax. Ramnarayan Trust Foundation was formed on 1st April 2009. It applied for registration under 12AA and got registered and approved from prescribed authority with effect from 1st April 2013. Got it? The trust got exemption from the payment of taxes satisfying the condition laid down. Perfect. Under section 11 to 13 from 1st April 2013, and trust got dissolved on 29 December 2024. The balance sheet of the trust is given below. Now, let me draw the timeline for you all to make you understand what the point is. It started its activity on 1st April 2009. It got registered on 2013 and it got dissolved on 29 December 2024. So this was the period for which this trust was registered. Answer. Now what the point says, it had building, land, it had investments, it had unquoted investment, it had cash, it had bank balance, it had corpus, it had loan, it had multiple things. Now let's see. FMV of land and building is 50 lakh rupees. So whatever the land and building that this trust has, FMV of this land and building is 50 lakh rupees. Oh my god. Land and building of 3 lakh rupees were acquired out of agriculture income. Now understand this point very carefully. Huh? Out of this 12 lakh, you can carefully see 3 lakh has been acquired out of agriculture income. Now we are already aware that if any income, if any of the asset is acquired out of agriculture income, exit tax is not levied on such income. That means, can I say 25% of the entire land and building are from agriculture income? Therefore, on 25% exit tax would not be levied. So only on 75% exit tax would be levied. That means 37.5 lakh is the value of land or building on which exit tax should be levied. If you are clear with this, do like the video. That's it. We have already liked the video twice. See, whenever you want to like the video, like in odd numbers. If you want to like once, if you like the video more, then like it thrice. If you liked it more, like it 5 times. Never like in even numbers, always like in odd numbers now. Market value of quoted shares on the date of dissolution is, oh. So if they have quoted shares market value. So whenever we have market value of quoted shares, we will take the market value of quoted shares only. Done, sir. 50% of the unquoted shares were acquired during previous year 10-11. Done, sir. With respect to Z Limited, the trust had invested in unquoted shares. The following information is available now. The trust has invested in Z Limited. I mean, trust has unquoted shares. Unquoted shares, this trust has that to 150 lakh rupees. Okay. Okay, sir. Now, how much assets this unquoted shares has and this trust has? Now, understand. This trust has equity share capital of 10 lakh rupees. 1 lakh shares of attendees, that means 10 lakh of share capital. Book value of all the assets other than jewelry bullion is 60 lakh rupees. We would take that. Jewelry market value would be taken at 30 lakh rupees. That means all in all, it had 90 lakh assets minus 35 lakh liability would turn out to be 55 lakh. 55 lakh is the total value of the assets. That means entire Z Limited, that is unlisted company, is valued at 55 lakh rupees. Listen, for this 55 lakh, if you understand, entire share capital is 10 lakh rupees, and out of the 10 lakh rupees, this trust has only 1.5 lakh rupees. That means, can I say is 1.5 lakh out of 10 lakh is being held by the trust. How much value turns out to be? Value turns out to be 28 lakh rupees. Sorry, 8 lakh 25,000. Are we clear in this point? That means value of this 1.5 lakh is nothing but 8.25 lakh. This is the value of this. But there is a condition. Provision says half of the unquoted shares were acquired before registration. Since half are acquired before registration, that means they were not subject to exit tax. That means half are not subject to exit tax. So exit tax would be applicable on 4,12,500. This is the amount on which exit tax is applicable. Whatever the value of cash is, we would take as it is. Whatever the value of bank balances, we would take as it is. Done, sir. Now, what else point it says? The trust distributed the assets on dissolution valuing to 8 lakh rupees. See, whenever you distribute any assets, you would get a deduction on that. That is not subject to exit tax. Done, sir. Now, trust has any corpus, you have to ignore. If it has any reserves, you have to ignore. It had any loan taken, so loan has to be reduced. I would mark it as red. We have to reduce this, so we would mark it as red now. Loan taken for the purchase of the unquoted share loan is taken on 2010-11. Now understand this point very carefully. Loan has been taken in previous year 10-11. Loan has been taken in previous year 10-11. Answer. Whether trust was registered in 10-11, sir, trust was not registered. Just tell me one thing. Whenever a trust is not registered, whenever a trust is not registered, and you acquire shares at the time it was not registered, it is not subject to exit tax. Do you agree with me? If trust is not registered and you acquire any shares at that point of time, exit tax is not applicable on those assets. Can I say vice versa thing is also true? If a trust is not registered and you incur any liability, you won't get deduction of that liability either. Because since tax was not applicable on the assets acquired before registration, so how liability deduction would be given? Therefore, no deduction of this liability would be given. My humble submission would be to just add down the orange ones and reduce the red ones, and you would get the answer. 37 lakh 50,000 plus 18 lakh plus 412,500 plus 1 lakh plus 50,000 minus 8 lakh minus 9 lakh. This would give you the right answer, 44 lakh. 12500. This is the amount of accreted income leviable for exit tax. Now, how much tax would be applicable? Sir, exit tax is applicable at the rate of 30% plus 12% plus 4%. Sir, how do we remember this? We always tend to forget what is the value. For that, I have told you a secret hack. I have told you a secret hack. Just say 1, 2, 3, 4. 1, 2, 3, 4. 1, 2, 3, 4. Can you say this? You really get carried away. 1, 2, 3, 4. Can you say 1, 2, 3, 4? 1, 2, 3, 4? Can you say? Can you say 1, 2, 3, 4? 1, 2, 3, 4. Can you say this thing? Yes, sir. We can of course say 1, 2, 3, 4. Now this is only the exit tax. 12% surcharge, 30% tax, 4% education cess. Whenever it comes to exit tax, you just need to know 1, 2, 3, 4. You know 1, 2, 3, 4 now. 12% is surcharge, 30% is tax, 4% is the education cess. So this is the exit tax, 30% tax into 1.12 into 1.04. Exit tax turns out to be 1541,900. This is the amount of exit. 1541,900 is the amount of exit tax applicable. 1541,900. So that's it. Very simple question, Ji. Very simple. Very, very, very simple question, Ji. Very simple. Come on to question number 42. Good question again it is. Now, a charitable trust XYZ is a charitable trust registered under section 12AB derives income from properties held under as 500 lakh. Now, income is 500 lakh. The trust decide to pay 200 lakh to additional trust ABC. Oh, trust wants to donate 200 lakh to another trust. Oh, wow. Can a trust donate to another trust? Of course it can donate. Remember, but such other trust has to be registered, one first thing. Second thing, donation should not be in corpus. And whatever donation you make, you would get 85% deduction. That's it. These are the three conditions to be taken care of. Now, what the question is asking, how much amount paid to charitable trust will be considered as application if it is with the specific, it is not for the specific, not for corpus. Now, if we do not donate for corpus, how much deduction we would get? So 85% application we get if we donate to another trust. 85% we get as application. Therefore, 170 lakh would be allowed to us as application in first answer. What's the second answer now? What if we make payment with a specific direction that amount will be towards corpus? Now, if we give any money towards the corpus, then it is not allowed as application at all. No application at all. We cannot donate to other trust as corpus. If we donate, we won't get application of that. Answer. What would be your answer to the above question? If such point is paid out of the accumulated balance, if yes, then what are the tax implications? What does that mean? See, under 11.2, you are allowed to accumulate your money for a specific future purpose. It can be building construction, it can be any other specific purpose, you can accumulate that money. But one condition attached to this 11.2 was you cannot donate this money to somebody else. You are not allowed to donate this money to somebody else. What if you donate? Then what would happen? If you donate it to somebody else, it is considered as violation and it is taxable in your hands. It is considered as absolute violation and it is considered taxable in your hands. Therefore, if you donate out of accumulation, it is taxable in your hands. Done, sir. How much it would be taxable? It would be taxable under 115 BBI at the rate of 30%. Perfect. Also examine the conditions which ABC Educational Trust required to satisfy for not including the amount received from that as a part of corpus to prevent him from taxation implication. Now, what does it say? See, if I receive any corpus donation, ABC is an entity who receives the corpus donation. Now, what this ABC should do to exempt this corpus? Now, what this ABC should do? They should keep this money in 11.5 safe investment. Safe investments referred under section 11.5, then it would be absolutely exempt. Thus, we need to do this, only this thing. Very good, sir. Very good. Come on to question number 43, sir. 43, G, 43. Examine each of the following independent cases in a charitable trust institution based on the relevant provisions of the Income Tax Act and judicial pronouncement for the assessment year 25-26. Now, AMPL is a electoral trust incorporated on 1st April 2024. Provides the following information for the previous year 24-25. Now, it is an electoral trust incorporated on 1st April 2024 only. And for the same year, information is given. Voluntary contribution received by this electoral trust is 600 lakh rupees. It spent 5 lakh rupees. 5 lakh rupees it is spent. Done, sir. On the management of the affairs, in light of the provisions of 13B and 17C central government, answer the following question. What is the amount of surplus that can be distributed by the political electoral trust to the political parties, assuming all the conditions are satisfied? Would your answer be different if 100 lakh has been received from the person non-citizen of India? Very simple question. Whenever you receive any contribution from an electoral, whenever electoral trust receives, first point is, sir, it has to distribute at least 95% of its current year contribution and last year's contribution. Current year plus last year has to be clubbed and 95% of that has to be distributed. Now, current year we only have, last year we don't have. So 95% of the current year has to be distributed. Done, sir, that we will distribute. How much it turns out to be? 570 lakh has to be distributed minimum. Minimum. This has to be distributed minimum. Now, how much maximum it can distribute? Understand. Electoral trust can keep 5 lakh for operations of its affairs, for working its affairs in first year, and 3 lakh in subsequent years. Now, since it is first year of operation, out of 600 lakh, it can keep 5 lakh rupees. That means 595 lakh it is kept with the trust that is available for distribution. 595 is the amount that electoral trust can distribute. So minimum it can distribute, it has to distribute 570. Maximum it can distribute 575 because it requires money for affairs. So this is the amount that can be distributed. Now, what if any of the amount has been received from a non-citizen of India? If any money is received from non-citizen, remember, I'm not talking about non-resident, I'm talking about non-citizen. Non-citizen gives you any donation, then it is a invalid trust. Any amount would be taxable. It would not get any deduction, any exemption under 13B. Done, sir. Asta Foundation is not-for-profit organization, runs a secondary school and hospital. The trust has receipt of 1.2 crore, school has 4.2 crore, and hospital. Okay, sir. Trust has school receiving 1.2 crore rupees. Hospital receives 4.2 crore. See, understand, whenever you have any of the trust which is registered under 1023C, your gross receipt has to be up to 5 lakh rupees to 5 crore rupees to prevent yourself from getting registration. Up to 5 crore, no registration is required. If it exceeds 5 crore, then registration is mandatorily required. Understand this. Now, adding both of them would give us 5.4 lakh rupees. That means it has more than 5 crore rupees, more than 5 crore rupees of gross receipt. Therefore, it has to mandatorily take registration. It cannot simply claim exemption. Now, Care for All Foundation is claiming exemption under 1023C. 15/11/2024, it gets notified under 1046. See, whenever you are registered under 1023 or 12AB, you have to claim exemption under these sections only. If you claim exemption under any other section under section 10, then these two exemptions you would not get. So this, if this entity wants to claim 1046, it cannot claim 1023. Either of the section they can claim. They cannot take both the benefits simultaneously. Got it, sir. Got it. Yes, sir. Got it. Beautifully, sir. Got it. Beautifully, sir. Got it. Now we have question number 44. Another beautiful question. Classic example of mistake prone area. Examine and discuss each of the following independent cases of charitable trust institution based on the relevant provisions of income tax and judicial pronouncement. Okay, sir. We will answer as relevant provisions of income tax. KRA is a charitable trust registered under 12AB engage in activities of providing old age homes. 12AB plus old age homes. ठीक है. The total receipts of the trust for the financial year 24-25 was 145 lakh. Okay, total receipts was 145 lakh. Done, sir. Receipts of 145 include voluntary contribution from Keshav, a resident of 75. Okay, out of this 145 lakh, 70,000 have been received from Mr. Keshav. During financial year 24-25, out of the total receipt, trust gave unsecured loan of 5 lakh to Keshav. 5 lakh to Keshav. 5 lakh to Keshav. 5 lakh loan. See, he is giving donation and taking 5 lakh of loan. Wow. And that too, point worth noting, dear friends, unsecured loan, chi. At, acha, at a rate of 12%. Okay, at the rate of 12%. 12% is good. Scheduled bank charge 11.5%. See, if Kesha would have taken loan from bank, then this would have been 11.5%. That means trust is charging more. But unsecured, bank would have given a secured loan, trust is giving unsecured. Now, the trust has always applied 85% of the receipts. Discuss the implication in the hands of the trust as per the provision. Now, understand. Whenever trust gives any unsecured loan, or I should say any loan without adequate mortgage, without adequate security, it is assumed that it is violation. It has violated. It has given a benefit to a related party. If it gives any money without any securities, if it gives any loan to any of the specified person without any security, remember, it is absolutely considered as violation. It is by default violation. It shall be violation, and therefore this shall be taxable. This 5 lakh shall be taxable under 115 BBI. Done, sir. Next question. Medicare Foundation, a trust registered under 12AB of Income Tax Act, runs a hospital during financial year 2024. Last year, it is running a hospital. It received voluntary contribution of 95 lakh with a specific direction that it should form part of the corpus now. Thus, invested such amount in the public sector company. Perfect. On 31st March 2025, due to disinvestment of the government, it ceases to be public sector company. Oh my dear God. Now, trust has invested into public sector company. Whether it is a safe investment, yes, it is a safe investment. Now, I have invested, this trust has invested money into public sector company. This is the proper company. Now, what happens? This public sector company ceases to be public sector company because of disinvestment. Now, what would do? Will this be an invalid investment? Right answer is till up to 3 years, it is a valid investment. Sissy has to take this money out and invest somewhere else, which is 11.5 safe investment. Till 3 years, till the 3 years, it is safe investment. After 3 years, it would become invalid. So it is SSC has option to keep this money for 3 years. Now we have third question. Masers Medicare Foundation, a trust registered under 12 AB of the Income Tax Act, which runs a hospital, also paid consultancy fees of 1 lakh rupees to Mr. Suresh, a doctor. Trust did not deduct a TDS. Array, trust did not. How a trust can forget deducting TDS? Any SSC paying any fees on which TDS is applicable has to be deducted. There is no exception as to as your turnover. Turnover limit is only for individual HUF. There is no limit for any other SSC. Trust has to mandatorily deduct a TDS irrespective of its audit requirement. It has to deduct TDS. Therefore, TDS has to be deducted in this case. Therefore, trust has done wrong. Oh wow. JAN-26 RTP. So this is also covered in Superintendent, of course. Examine and discuss each of the independent cases, the following charitable trust under 12 AB as per relevant provisions. Now, Yashoda Green Charitable Trust, having main objects as advancement of general public utility, provide electric scooter to various corporate employees in Gurgaon. The business, with this business, it generate revenue of 45 lakh. It had applied all for general public utility. Total receipts is 9190 lakh. Now, its total receipts is 190 lakh. 20% is allowed as business. That means 38 lakh is allowed as business. Now it has received 45 lakh as business. Therefore, it is invalid. It would not get deduction. It would not get exemption for the current year. Then, Samarth is into vocational trading, teaches sewing, handloom, weaving, handicraft. It operates as clothing shop also. The shop derives 40 lakh of business income and it is already applied for the objects of the trust. Now, remember, whenever you do any of the charitable activities, then you can do business as well. Only thing required is just maintain books of accounts separately. That's it. Only thing you require. Whatever the profits from business are also subject to exemption. That's clear. But if you do any advancement of general public utility, then you have to see business receipt cannot exceed 20% of the total receipt. That's it. Now, in this case, it is a normal educational activity. So, there is no limit of business receipt. Therefore, whatever they are doing is absolutely valid. There is no issue as such. But the only thing they have to do is they have to maintain their books of accounts. They have to separately identify. They have to keep this business separately identifiable. Now, let me take this example for you. There is a Light of Hope, karke, an organization, and there is also another organization called Water for All. Light of Hope and Water for All. There are two organizations. Both are into advancement of general public utility. Both are into advancement of general public utility. Now, both of them are registered. It is assumed in the question that they both of them are registered. They both have same motive, but they operate in different states. Now, to expand their network, to expand their resources, what they did, they merged themselves. Two trust merging themselves, having similar objectives, both of them registered. Will this be a valid merger? Will this be a valid merger? Right? Absolutely valid merger. Absolutely valid merger. There is no issue as such to this there is no issue to the validity of this merger. It is absolutely valid. Come on to question number 46 now. What question number 46 says? A charitable trust engaged in relief to poor registered under 12 AB for the previous year 31st March 2025 derived income of 11.4 lakh, which consists of the following questions, sir. It is September 25 exam question. Wow, wow, sir, wow. That means gross receipts are 11.114.5 lakh. Done, sir. Which consists the following: 110 lakh from properties and interest accrued on FDR was for 4.5 lakh. Done, sir. During financial year, the trust applied a sum of 86 lakh towards charitable purposes, which include 86 lakh have been applied, and it includes three items. Let's see whether they are actually to be included or not. Electricity bill amounting to 80,000 rupees paid on 18th April 2024 pertaining to March 24. Trust follows the mercantile system. Oh, oh. Last year's bill paid in current year. Last year's bill paid in current year. Sir, of course, last year it was disallowed because it is allowed on payment basis only. Trust is allowed expenditure on payment basis only. So last year it was disallowed. It will be allowed in current year. And it is already included 86 lakh. What we would do? We would ignore this point. We would ignore this point. Amount of 472. Amount of 4,72,000 including GST of 70,000 is paid to XYZ to an event management company for fundraising program. Full amount was paid without deducting TDS. Okay, a word to be mentioned without a TDS deduction. Without TDS deduction. Oh my God. Oh my God. Such a bad habit, such a bad person. It is no TDS deducted. Understand this point very carefully now. 4 lakh is the payment to be made and 72,000 is the GST to be added. Now, how much TDS has to be deducted? TDS has to be deducted on this 4 lakh rupees. Whatever the amount is, we have to deduct TDS. We did not deduct it. How much disallowance it would be? Sir, it would attract disallowance of 30%. That means 120 would be disallowed. Now, how much we have actually paid, sir? 472 we have actually paid. And out of that, 120 would be disallowed. That means actual allowed amount should be 352. 352 is actually allowed amount. How much we have actually deducted? We have deducted 472, but we should actually get deduction of only just of 352. That means 120 extra deduction has been taken. 120 has to be reduced from this point. Done, sir. 5 lakh paid to Parivartan, another charitable trust having the same objects as donation other than corpus. Now we have donated to somebody else other than corpus. Remember, whenever we donate to somebody else having same objects, are we allowed to donate? Yes, we are allowed to donate. But can we donate in corpus? No, sir, we cannot donate. Whenever we donate, we get 85% deduction. So in this case, 5 lakh entirely has been taken. Rather, we would get deduction of just 85%, which amounts to 5 lakh into 85% amounts to 425. That means we have got extra exemption of 75,000, reducing these two. 86 lakh reduce 1 lakh 20,000 minus 75,000, we would get entire deduction of 8405. So 114 minus 15%, this would give us 97. We would reduce 8405 and this would give us total income of the trust, and this will be our answer. With that, we are done with trust taxation. As we have done 9 chapters, we have done 9 up to now. Let's continue further. Very important chapter. Tons of question from this chapter. Let's do it one by one. Answer. First of all, TDS, TCS, advance tax and refund. Now, what the question is about? Understand. Very simple questions are there from TDS. Gamma Limited is an Indian company established in previous year 2008. Reports total income of 22 lakh for the previous year ended 31st March 2025. Tax deducted at source by different payers amounting to 1,68,000 and tax paid in country A on doubly tax income amounted to 30,000 rupees, for which TDS relief as per section 90 is given. Okay, during the year, company paid an advance tax of this and this follows. First quarter, 45,000, quarter 2, 90,000 rupees, third quarter, 1 lakh rupees, fourth quarter, 1 lakh 5,000. Company filed return of income for assessment year 2026 on 3rd November. That means it is required to file on 31st October 2025, but it filed on 3rd November. That means this company has delayed return filing. You are required to compute 234A, B, C interest plus 234 FPs. Assume that company has not opted for 158, 115 BBA, BAA, and turnover of gamma is 250. That means 25% tax rate is applicable. Got it, sir. Got it. Let's solve it. Total income is 22 lakh. Tax rate is 25% plus 4% education cess. How much tax turns out to be? 5,72,000 is the amount of tax applicable. Now, on this tax rate, we have already paid, we had TDS is somewhere deducted. How much TDS is deducted? 1,68,000. On this the rate, relief has been deducted. Relief. How much relief? Maybe 30,000 it was? Yes, 30,000 relief. This is the advance tax payable. How much it turns out to be? 3,74,000 is the payable advance tax. And how much is the paid advance tax? Paid advance tax is total of all four. It turns out to be 45,000 plus 90,000 plus 1 lakh plus 105. 340. That means shortfall in advance taxes for 37,000 only. Sorry, this figure I wrote it wrong. It is 374. Done, sir. This is the shortfall in advance. Absolutely. 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 Now, we need to compute 4 or 5 things. First of all, 234C interest. Whenever we compute 234C interest, we need to compute it quarter-wise. In quarter 1, out of the total payable advance tax 374, 1, 2, 3, we have to pay 15%. How much is 15%? 374 into 15%. 56,100. And how much did we actually pay? We actually paid just 45,000. Did we do shortfall? Yes, sir, we did shortfall. That means 11,100 is the shortfall. 1%. 1% for 3 months would be charged to us. But sir, there was condition, if you remember. In quarter 1, we are allowed to pay 12% of advance tax. If we pay up to 12%, we won't be charged any interest. But if we pay even lesser than 12%, now then interest from 15% would be charged to us. Now, what is the amount of 15% that turns out to be? 374 into 12%. 44,880 is the amount of advance tax that should have been paid. And how did we pay? We actually pay 45,000. That means we paid more than 12%. That means no interest for quarter 1 would be charged. No interest for quarter 1 would be charged. Absolutely. Such a beautiful tax planning. Wow. In quarter 2, we have to pay 374 into at least 45% we have to pay. 374 into 45% we have to pay. That means we have to pay 168,300. How much did we actually pay? 45 plus 90, that means 135 did we actually pay. That means we have done shortfall, but in quarter 2 we also have a cushion. We can pay up to 36% as well. How much 36% turns out to be? 374 into 36%, it turns out to be 134,640. Oh my god, we have paid this also. That means 36% we have paid, therefore again no interest would be charged. Again, no interest would be charged. Beautiful, sir. Beautiful. Quarter 3, 374 into 75 at least we have to pay. 374 into 75%. How much it turns out to be? 280,500. And how much did we actually pay? We actually paid total of 3. 135, 235. 2,35,000 we have actually paid. 280,500 minus 235. 45,500 is the shortfall. We have done 1% for 3 months. 1,365 is the amount of quarter 3 interest. Now quarter 4 would turn out to be 374 into 100%. 374. How much did we actually pay? We have mentioned 340. We have already mentioned. That means 37,000 is, sorry, 37,000. No, it is 4 minus 340. 34,000 is the shortfall. 1% would be charged. That means 340 interest would be charged. So quarter 234C interest would be 1,365 plus 340. 1,705. This is the amount of interest that would be charged. This is the amount of interest that would be charged under section 230. How much interest would be charged on 234BC? We have done shortfall from 1st April 2025 till 3rd November 2025. April, May, June, July, August, September, October, November. That means for at least 8 months interest would be charged 3,400 into 8%. This will be 234B. But sir, there was a catch. If you can recall, there was a small itusa catch. If you can recall. Sir, small thing. Small thing. If we pay 90% of the advance tax, then no interest under 234B is applicable. So out of 374, did we pay 90%? Sir, how much 90% turns out to be? 336,600. How much did we actually pay, sir? We pay 340. That means just under 234B would be. Last 234A. 234A is applicable for late in ROI. So 34,000 is the shortfall in taxes that we have not paid up to ROI. 1% would be charged for 1 month. That means 340 would be amount of interest under 234A. Of course, 234C, 234F, we would be charged 5,000 of late fees because our total income exceeds 5 lakh rupees. So we would be charged 5,000 rupees of 234F fees. How much it turns out to be, understand this thing. 234A, 340, 234B will not be levied. 234C, we would be given here somewhere 1705, and 234F at last it is given to us. It was somewhere given 5,000 is 234F. This is the total figure that is applicable. Did you get this point or not? What question number 48 says, listen to this. Discuss whether taxes to be deducted at source under provision of Income Tax Act 1961 in the following cases or not. Now, Messrs. Jiva is a partnership firm that pays a sum of 43,000 as interest on loan borrowed from Indian branch of a foreign bank. Now, what it says? This is a partnership firm which pays interest to a foreign bank, but this foreign bank has an Indian branch. Now, this firm is paying interest to a branch of a foreign bank. Whether this is an Indian, whether on this TDS should be deducted or not. First of all, we need to understand. Whenever we study 194A for interest payment, it always says that TDS is not to be deducted when payment is made to a bank. Whenever we make any payment to a bank, TDS is not required to be deducted. This is the first thing. Second, another important thing is, sir, whether foreign bank is a bank or not, sir, it is considered as bank only. Therefore, no TDS is required to be deducted. Right answer is no TDS. Above firm pays 12,000 rupees as interest on capital to partner A. Whenever you pay any interest to a partner, TDS is not applicable till 31st March 2025. No interest is applicable. A resident of India, and 24,000 as interest paid to partner Mr. B. See, whenever a partnership firm pays interest to a resident partner, no TDS is applicable. But when this partnership firm pays any interest to a non-resident partner, TDS under Section 195 is applicable. That means TDS at the rate in force is applicable. Whatever the applicable rate is, that rate in force is applicable in this case. What if the firm pays any profit to non-resident partner? If partnership firm pays any profit to a non-resident partner. See, one provision we are aware, if any of the income is paid to a non-resident person, it is tax. The TDS is deducted at rate in force. The rate at which this income is taxable in the hands of the non-resident is the rate of TDS we have to deduct. But profit by a partnership firm to a partner is exempt, so no TDS in this case is applicable. This is the answer to question number 48. Now come on to question number 49. Very beautiful question, simple question yet important. Raghav Motors Ludhiana is a dealers in car of Ford and Maruti and also runs a service station. Done, sir. The sale of cars of Raghav Motors for financial year 23-24 is 9.8 crore. The sale of spare parts and spare stations is 60 lakh rupees. Oh wow. Oh wow, 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 wow. Beautiful wala wow. 9.8 crore is the sale of cars and 60 lakh is the sale of service parts. That means 10.4 crore is the sales. That means, can I say this is a eligible seller for 206C1H? This is eligible seller for 1H. 206C1H, it is eligible seller. Yes, sir, it is absolutely eligible seller. Absolutely eligible seller. Now, Messrs. Om Limited, dealing in trading of textile manufacturing, for turnover 5 crore rupees, bought the following cars from Raghav Motors during previous year 24-25 for business purposes. Very simple point. It is also simple, not difficult at all. Now, Raghav is the seller, turnover greater than 10 crore, and Om is buyer, turnover lesser than 10 crore. Now, first car is sold of 37 lakhs. See, whenever a seller sells any car to the buyer, then in that case, 1% TCS is to be collected under subsection 1F. If you remember 206C, 1F TCS has to be collected 1%. Second car, 19 lakh, again 1% TCS is to be collected. Done, sir. Third car, 8 lakh, whether TCS is to be collected, hold on for a minute. And fourth car, exceeding 10 lakh, again 1% TCS is to be collected. So TCS on 3 cases has to be collected. On 3 cases that it has to be collected simply. But what about this third car? Whether TCS to be collected, remember, in this 1F is not applicable. 1F is not applicable. But when 1F is not applicable, can you see one thing? I'm able to see one thing. Seller has turnover more than 10 crore in last year. Sales amount has already reached more than 50 lakh rupees, because 37 lakh plus 19 lakh cars sold, that means more than 50 lakh sales has already been reached. Therefore, on this 8 lakh rupees, 0.1% TCS is to be collected under section 206C1H. Did you get this point? 0.1% is to be collected under section 206C1H. This 8 lakh rupees. Done, sir. Did we get this point? Yes, sir. We got this point. We did get this point. We did get this point. Question number 50. Beautiful point. Beautiful point. Acha, what the question was asking, you are required to compute the TCS applicable. Now we have already told the TCS applicability. The same answer that we discussed is written here as well. Now we have question number 50. Part 1 is simple, but part 2 is beautiful. Beautiful, beautiful. Part 1 is simple. Let's see. Messrs Cash Dash Private Limited is a company in the business of event management throughout India. Withdraws 10 lakh rupees in cash every 7th of the next month. Now, for financial year 24-25 from its current account with Union Bank. Local payments to the payment of the wages or incentives temporary employees engaged by different events. It did not make a single payment exceeding 10,000 rupees to any person. Examine the tedious implications. See, company is withdrawing 10 lakh per month for 12 months. That means 120 lakh this company is withdrawing. 120 lakh this company is withdrawing. And it is making payment for event purposes. Now, it is not making payment in cash. That is the best thing. But whenever you withdraw money from a bank, TDS is applicable. If you remember, TDS is applicable. Which TDS is applicable? TDS under section 194N is applicable. Whenever you withdraw exceeding 1 crore rupees, whatever the amount that you exceed 1 crore rupees, that is 20 lakh rupees, TDS at the rate of 2% is applicable on this transaction. That means 40,000 TDS amount will be deducted of this cash dash limited. If you see the answer, you will see the same answer. 40,000 is the amount of TDS. So this was a kullu pullo question. Kullo pullo question. Very kullo pullo question. Real things, real thing is coming now. Real thing is coming now. Miss TQ Inc., a foreign company, seconded some employees to its collaborators, Messrs Techwell Inc., an Indian company, for working in a turnkey project for setting up a warehouse in setting up a pharmaceutical factory. Okay. These employees work for Techwell throughout the year 24-25. The employees were in receipt of salary from Techwell. Okay. These were also in receipt of special loans directly from Messrs TQ in foreign currency outside India. Messrs Techwell deducted TDS under 192 in the component of the salary paid by without taking into account the special allowance paid abroad by TQ in foreign currency to these employees. For this reason, the revenue authorities treat Techwell as assessee in default under Section 201 for non-deduction of tax at source on special allowance component salary paid by it. Examine whether the treatment by revenue authorities consequent to the levy of interest and penalties is justified. What can I do? What can I do? What can I do? Very simple points. Sir, don't you think that you overreact? This overreaction makes you awake now. That's the only thing. If my overreaction still awakes you, that doesn't let you sleep, then it's okay. Overreaction is justified. Well, what the case is, we have two companies. First of all is TQ and the other one is Techwell. Now this Techwell is setting up a pharmaceutical factory. For that, it requires employees. So experienced employees have come from Techwell, this foreign company, to India. Perfect? Yes, sir. Perfect. Important point here is these employees have stayed in India for more than 1 year, therefore they are resident of India. Whatever the resident, they are resident, OR, RNOR, whatever the case, they are resident. That's it. Done, sir. Now, these employees are paid salary by this Techwell. And Techwell deducted TDS on this salary component as well. Very simple point it is, very simple point. But these employees also get a special allowance from this foreign company. Special allowance. And Techwell did not deduct a TDS on this special allowance component. See, Techwell deducted TDS only on the salary that it has paid. It did not deduct TDS on this special allowance component. Now, what assessing officer did? Assessing officer treated this as assessee in default. Oh my. First of all, whether my four questions are to you. Whether Techwell did is wrong or not. Whether declaration of assessee in default is correct or not. Whether interest is leviable or not, or whether penalty is leviable or not. Four things I want you. First of all, what Techwell did is wrong or not. Whether Techwell was required to deduct a TDS on this special allowance component, right answer is yes, it was required. This special allowance is also a part of salary, and an employer is required to deduct TDS on entire salary of the employees, entire salary. So it is the duty of the employer to deduct a TDS on this special component. So there is some mistake on account of tech bill, some mistake on account of tech bill, some mistake. There is some mistake on account of tech bill. That is the. But whether that mistake can lead to treating assessee as default, that is the second question. Whether that mistake can lead to treat assessee as assessee in default, it is a question worth noting. For that matter, we need to understand how assessee default is treated, how it is declared. Whenever tax is not reached to Government of India, then assessee is treated as assessee default. There is one case now, since these are resident employees now, these employees have to file ROI. And if they consider this income, this special allowance component, they pay taxes now. Therefore, since taxes are reached to government cannot declare this assessee in default. What I am saying is, if I did not deduct TDS, just because I did not deduct TDS, can department declare me as in default? Right answer is no. If other party whose TDS has not been deducted declares his return of income, pays the corresponding taxes, then I cannot be declared. So it is not directly answerable that whether this is assessing default or not. It completely depends whether employees have paid TDS, whether employees have paid taxes or not. So our answer will be conditional that if employees have paid taxes, declared their income, then no assessee in default can be declared. But if they have not paid taxes, then assessee in default has to be declared. It is valid. Third question, whether interest is valid or not. Interest charge is valid because if government has received taxes amount as late, therefore interest is applicable. Whether penalty would be applicable or not. Whether penalty would be applicable or not, very important point. Whether penalty would be applicable or not. The penalty is not. Whenever there is a reasonable cause of failure, now penalty is not applicable. Remember, dear friends, penalty is not applicable whenever there is a reasonable cause of failure. Did we get this point or not? Are Baba, did we get this point or not? Absolutely, sir. Absolutely. Absolutely. Come on to question number 51. In respect of the following independent case scenarios, you are required to discuss the provisions with respect to income tax deducted, collected for the previous year ended 31st March 2025. Mr. Rajat, age 79 is a retired senior individual, maintains savings account, fixed deposit accounts with ABC Bank. He has also provided information. Can I simply say senior citizen age 75 plus interest plus pension, which implies 194 P is applicable? Done, sir. Interest on savings account 75,000, done. Pension 55,000 into 12 months. Let's see, it does not have any other income. It has opted out. That means deduction it would get is 50K. Interest from savings account would be 120. We would add all of them and we would get 80 TTB as a 50,000 rupees. 80 TTB would be given to us. How much our total income is? 7 lakh, 55,000 per month into 12 minus 50,000, 6.1 lakh plus 75,100 plus 1 lakh 20,000 rupees minus 50,000 rupees. So 755 is the amount of total income this assessee has. Now, how much tax it would be charged? See, in this case, since it is a senior citizen, remember, from up to 2.5, up to 3.3 lakh, it is not. This is not taxable. So from 3 lakh to 5 lakh, it would be with 5%, that means 10,000. And 5 lakh to 7.551 lakh, how much it turns out to be? 20%. It turns out to be 51020. Adding both of them, this would be 61020 into 1.04, and this would give us the actual payable taxes. Actually payable taxes, if you see, this is the right answer. This is the absolutely right answer. How much it actually turns out to be, let's calculate it now. 63460, 63460 and 6346030. That is the absolutely right answer. Done, sir. Done. Come on to next question. High and Tall Limited is a real estate development company entered into joint development agreement with John. High Tall and John. John would transfer a plot of 10 acre. John would give a 10-acre land, and in return he would get 6 crore to be paid on the date of agreement, that is 1st June 2024. High and Tall would develop a high-rise apartment complex, and upon completion it would get 6 flats of 1.2 crore. So John would get 6 crore plus 6 flats of 1.2 each. Remember, whenever there is an agreement of joint development, developer has to deduct a TDS under 194 IC only on the money component. TDS is not required to be deducted on the building component or the kind component. Only money component is to be considered. So TDS will be deducted on 6 crore, that is 10%, that is equal to 60 lakh rupees. That's it. Next question. Messrs RN, a domestic company having turnover of 12 crore rupees. For the financial year 23-24, purchased goods of 85 lakh rupees, excluding the purchase return from Varun. Oh, now this is RN. It is a buyer, and it is Varun, who's a seller. Okay. Purchase goods of 85 lakh rupees. Done. Varun. Okay. Furnish the PAN and details of payment as given below. First payment of 30 lakh rupees. Whenever it paid 30 lakh rupees, no TDS is applicable. Second payment of 25 lakh rupees, TDS only on 5 lakh is applicable, that to 0.1%. Third payment of 20 lakh rupees, TDS on entire 20 lakh is applicable, that is 0.1%. Now, on this third payment, out of these purchases, 5 lakh were returned. See, I paid amount and ultimately I deducted TDS on 20 lakh entirely, but later on I returned the goods. That means I have deducted TDS on 20 lakh, but actually purchased goods of just 15 lakh rupees. I have deducted TDS on extra 5 lakh rupees. What would happen of this extra 5 lakh rupees? Whenever I would buy subsequently, I would have to deduct the TDS on lesser amount of 5 lakh. Due to quality issues, it was refunded. Mr. Varun on made the 10 lakh rupees. So on this 10 lakh rupees, we would not deduct entire 10 lakh rupees. We would deduct TDS only on 5 lakh rupees of at the rate of 5%. Assume the turnover of Varun during the financial year was 8 crore rupees. Okay, done, sir. If you check the answer now, you would get the same answer on 30 lakh, no TDS. On 25 lakh, that is 0.1%. 5 lakh, 1.1%. 20 lakh, 0.1%. And last 10 lakh, only on 5 lakh, we would deduct TDS. State government of Telangana grants a lease of coal mines to XYZ on 1st September 2024. Now, state government giving coal mine to XYZ. Whenever a coal mine is given, na, TCS under section 206 C1 is applicable. The coal mine worth 10 crore rupees, that means 2% TCS, that means 20 lakh is the amount of TCS that has to be collected from XYZ. This XYZ sold coal to AB Private Limited for 1 crore rupees. Done, sir. Turnover of AB and XY is 5 and 6 crore. Turnover is 5 crore, turnover is 6 crore. See, both of them don't have to deduct TDS under 194Q and 1H. You remember, there was a section 206C1 which exclusively talks about sale of coal. If you sell any coal, now then you have to collect a TCS at the rate of 1%. So 1% has to be collected by this AB. Entire 1% is to be collected. That means 1 lakh TCS has to be collected. How much? 20 lakh would be collected first and then 1 lakh would be collected secondly. Simple question, sir. Come on to question number 52. Come on to question number 52 now. What this question says. During the previous year 24-25, A purchased a scrap of 55 lakh from B for the purpose of manufacturing. Mr. A furnished a certificate to B that the scrap shall be utilized for manufacturing purpose carried out by the A. So, A is the buyer, purchases scrap from Mr. B. Now, A furnished the certificate to B that scrap shall be used for manufacturing. Now, 55 lakh is the payment and this shall be used for manufacturing purpose. That means the seller will not collect TCS under 1 nor 1H. No TCS would be collected under any sections. Right. Shall not be used for trade or shall not be used for trading purpose, but it shall be used for manufacturing only. We made the payment of 45 lakh rupees. Both the turnover exceeds 10 crore rupees. What are the TDS implication? See, we purchased goods of 55 lakh rupees but paid only 45 lakh rupees. Do we need to deduct TDS? Sir, we need to deduct a TDS because under 194Q there is no limitation of payment. We don't have to make the payment. We have to deduct TDS on payment or accrual, whichever is earlier. So in this case, TDS on 5 lakh has to be deducted. Beautiful, beautiful question. Very beautiful question. I mean, if I can say I love you to a question, then this is a question on which I will say I love you. If question deserves I love you, then this is a question I should say. Beautiful question. Why it is beautiful question? Because a small mistake will make your answer entirely wrong. Why? How? Let me tell you. Mr. P provides technical consultancy to various clients who deduct TDS under 194J. Okay. Mr. P provides technical consultancy. Now, what is technical consultancy? If you remember technical consultancy 194J, It was 10%. 194J technical consultancy was 194J. 194J had only 10% rate now, so technical consultancy would be 10%. Technical consultancy would be 10%. No, tech consultancy is 2% only. If you take 10%, I will tell you how your answer would be wrong. I will tell you, don't worry. Applies to lower. Acha, Mr. P applied for lower deduction certificate. That means it is not satisfied with 2%. It wants TDS to be deducted at a lower rate. Okay. During previous year 24-25, Mr. P was issued lower deduction certificate allowing him to receive the consultancy payment after deducting TDS. Okay. Lower deduction certificate was issued at the rate of 1%. Now Mr. P's TDS can be deducted at just 1% only. P forwarded it to various clients and requested them to deduct TDS at 1%. So P gave this lower deduction certificate to Mr. Q. Now Q was supposed to make 15 lakh of payment and wanted to deduct 2% TDS. But instead of that, he received lower deduction certificate 1%. Now he is dicey. Mr. Q has gone to a chartered accountant where he is seeking the expert advice whether it should deduct TDS at 2% or 1%. Q has come to a chartered accountant. He wants to make payment to Mr. P and it wants to check whether which rate would be applicable. Now, Mr. Q gathered the information that Mr. P is not filing his ITR for assessment in 23-24 and TDS credit 26 years is more than 1 lakh rupees. Oh, that means Mr. P has not filed ROI for AY 23-24 plus TDS is more than 50,000 rupees. That means TDS will be deducted at a higher rate. What is the higher rate? Twice the rate of respective section or 5%, whichever is higher. Answer. Whether this lower deduction would be valid whenever TDS is deducted at a higher rate, lower deduction certificate becomes invalid. What would be your advice? What is the rate of respective section? 2%. That means 4% or 5%. That means higher. Mr. Q has to deduct TDS at the rate of 5%. 5% is the. Just imagine for a second. Just imagine for a single second. If your answer would have been 10%, if you would have taken 10% as consultancy, yes, on consultancy 10%, if you would have taken, then how much you would have deducted? Twice the rate of respective section, that means 20% or 5%. You would have taken 20% and your entire answer would have been wrong. Entire answer. Just because you did not recall technical consultancy rate, your entire answer would be wrong. That is why this question is beautiful. It is testing the core of TD. Core of exceptions, exception. Oh, sir, I'm getting goosebumps. If somebody is watching, now do just drop down the timestamp to this question. Very beautiful question it is. Miss Roshni sold the house in the Delhi to Shalini. So Roshni is the seller, Shalini is the buyer. Whenever you solve TDS, now try writing down the names, write down the designation. It is easier to understand what question is demanding. Always easy to understand. Now, on 1st August 2024, he purchased the house on. Achha, he is the seller, she is the buyer. Now, whatever the purchase prices is not relevant. On the date of agreement is 82 lakh. Sale is done at sale is done at 60 lakh rupees, but stamp duty of this value of this house is 82 lakh rupees. Oh my God! So TDS has to be deducted by Shalini on this 82 lakh rupees. Yes, TDS on stamp duty value is deducted, that to 1% under section. Can you call 194 IA? This is the amount of TDS to be deducted. 82,000 rupees. 82,000 is the answer. Question was beautiful. Come on to question number 53. What this question number 53 says: examine the applicability of provisions relating to the collection of tax at source and compute the amount of tax to be collected in the following cases. Rajesh remitted 5,80,000 rupees towards medical treatment of the son for the education in University of Australia. He also remitted 7,80,000 rupees to University of Australia for the purpose of son's education out of the loan taken from employer ABC, a Indian manufacturing company. Both remittances are being made through authorized dealer if scheme of the RBI. Now, first of all, Rajesh remitted 580. Whenever you make remittance out of liberalized remittance scheme up to 7 lakh, there is no limit as to for what purpose you are remitting. So no TCS. Once this limit is crossed, then you have to check. See, second remittance is made on 780. So out of the 780, 120 goes into 7 lakh limit. So up to 120, no TCS is collected. Now remaining 660 is to be checked. What is the purpose of remittance? Now purposes of remittance is education. So whenever you remit for educational purpose, 5% is applicable. But whenever you remit out of the educational loan referred under ATE, then In that case, 0.5% is applicable. If you remember, if you know, you know. Now, whether loan taken from your employer is loan referred under ATE, right? Whenever you remit out of the loan taken from a bank or a financial institution, then only it is ATE loan. So 0.5% benefit would not be applicable. Flat 5% be applicable. Flat 5% would be applicable. That's the point is, in this case, 5% TDS would be applicable on 6.6 lakh rupees. You would get the same answer, that is, sorry, 5% would be applicable, that is 33,000. Now, Mr. James is an authorized dealer under liberalized remittance scheme of RBI. Three persons of India remitted the following sums through liberalized remittance scheme. Now, Pradeep remitted 650, no TCS because up to 7 lakh, no TCS. Promodes remitted 15 lakh rupees for overseas tours and package program. See, whenever you remit 15 lakh rupees up to 7 lakh, 5% TCS is applicable. Remaining 8 lakh, 20% TCS is applicable. So 35,000 plus 1 lakh 20, 1 lakh 60,000. All in all, 1 lakh 95,000 is the TCS amount under 206 C1G. Pranav, 10 lakh remitted for education loan repayment from the Bank of Germany. Now, Pranav is remitting 10 lakh. Now it is remitting, of course, on first 7 lakh notice is applicable, on remaining 3 lakh it is applicable. Now for what purpose he is remitting? He is remitting for repayment of loan taken for education from Bank of Germany. What is the rate of TCS applicable? See, if loan would have been taken from approved bank or FI, then in that case 0.5%, otherwise 5%. It is not approved, so only 5% is applicable. So 15,000 is the amount of 15,000 is the amount of TCS applicable. Done, sir. Of course, sir, of course. Very important. Good question. Very good question. Question number 54. Examine the TDS applicability in the following cases. Kite and LLP withdrew from its bank account 68 lakh rupees from cash for buying the agriculture produce from the farmers and agriculturists. Being raw material required for machine manufacturing for finished goods, buy it 58 lakh for the purpose of the other activities. It files the return regularly now. Right? Withdrew 68 lakh rupees from bank for making cash payment to agriculturist. You are making payment to agriculturist. You are making payment in cash to agriculturist. Is this disallowed expenditure under 40A3? Sir, it is not disallowed under 40A3. But sir, if you are making payment to agriculturist, whether TDS would be applicable? Of course. During withdrawal, there is no such exemption as to whether you are paying to agriculturist or any other person. TDS is not applicable. There is no such exemption. TDS would be applicable in every sense. In that case, 68 lakh plus 58 lakh would be clubbed. Entirely 1 lakh 26,000 turns out to be on this 100 lakh is not applicable. On 26 lakh, 2% is applicable. All in all, it turns out to be 52. What it turns out to be 260 to 26 lakh now into 2%. So 52,000 is the amount of TDS applicable under 194N. If you check the answer, you would get the same answer. 2% exceeding 1 crore. 1.26 lakh, only TDS is applicable on 26 lakh. That's it. Now, interest of 98,000 on capital gain bonds issued by Power Finance Corporation Limited to Ajay, Mr. Non-resident. Now, this is a beautiful point. Worth confusing. Interest Power Finance Corporation Limited pays interest to Ajay, who is an NR, rupees 98,000. If you remember section 195, 194A, whenever any interest is received, TDS is applicable under 194A. If you remember one of the exception, I have already told you that if interest is paid by a bank, by a Power Finance Corporation on the bonds referred under 54 EC, then no TDS is applicable. If you remember, this was the provision I had already told you. No TDS is applicable when interest is paid on 54 EC bonds of PFCL. Did you remember under 194? I also where I've also told you, and this is specifically 193 because this is a security, so 193 is applicable. One thing, if you can recall, sir, 193 was applicable for resident payers. Sorry, resident pays. If interest recipient is a resident, then only this provision is applicable. Mr. Ajay is a non-resident now, so 193 is not applicable here. 195 would be applicable, so TDS would be absolutely done, sir. Rajkeshari Hotels and Resorts Limited is engaged in business of owning and managing the hotels during previous year. The tips were paid from the credit cards, and these tips were given to employees on regular interval. It did not deduct TDS. Now, what is happening? Employer here, hotel is working. Now, whenever any customer comes, it pays extra in the form of tip. Now, this tip has to be re-remitted to the employees. Here, the employer, here the hotel is just an intermediary. It is not paying anything out of its own pocket. It is just collecting from customers and paying it to employees. It is just acting as an intermediary. There is no employee-employee relationship based on this tip. Therefore, it is not salary. It is not applicable. On this tip, 192 is not applicable. Now, Another good point. Lalit is an individual whose total sales during the business for the year ended 31st March 2024 is 1.5 crore. 1.5 crore is the sales. He entered into a contract with Rajesh for construction of his factory building of 5 lakh rupees, which was credited to his books of accounts on 1st Feb 2025. Oh. So if I have constructed factory building, I have to do TDS under 194C at the rate of 1%. Done, sir. No amount was credited to the books of accounts. Turnover of Lalit in current year is 95. See, current turnover is not relevant. We have to consider the turnover of the last year only. If last year turnover exceeded 1 crore, then in current year we have to do TDS on one or on contracts at the rate of 1% or 2% as the case may be. Here 5 lakh payment is made to Rajesh, therefore 1% TDS is to be deducted. He also pays monthly rent from 1st April to 31st March at 16,000. 16,000 is the monthly rent multiplied by 12. For the office premises of the Hemant, the owner, he also pays 55,000 per month rent to Hemant, 5,500 to be added. What it turns out to be 16,000 into 5,500. 16,000 plus 5,500 into 12. Entire year's rent turns out to be 258, which exceeds 240. Therefore, TDS on entire would be applicable. See, whenever we deduct TDS under 194 INA, we do not demarcate the payment for the purpose for which we are making payment. If we are paying rent either for machinery, either for land, either for any other, either for building, anything we are making paying rent for, now we have to club and consider limit of 240. Now, XY and Company is a partnership firm that sells product R through digital commerce, digital facility by ABC. On 18-28 Feb, ABC credited the books of accounts 490 for the sale of R for the month of Feb. Now, company released the payment of 430 out of the out of the sales made during the Feb. Mr. Raj further purchased product R from the digital facility and paid directly to XYZ on March. Oh my god. Oh my god. Now what the case is? Listen. XY and Company is a firm and it is selling R, product R at ABC. It is an e-commerce operator and there is a person here, there is a buyer. There is a buyer. Okay, there are buyers actually. Now, through this ABC, sales of 490 is done. 490 sales is done in Feb. Out of this 490, 430 has been remitted. 430 has been remitted. 60,000 is withheld with ABC. On what amount ABC should deduct TDS? Sir, on entire sales. Whether remittance is done or not, it does not depends. It has to deduct TDS on entire sales. That means on entire 4.9 lakh, 0.1% TDS is to be deducted under 194O. In addition to that, there is a buyer called Raj who bought goods through via ABC of this R that made payment directly to ABC. Bought goods via ABC but made payment directly to XYZ. Now, whether on this payment ABC is required to the TDS, right answer is yes. On this transaction also, ABC is required to the TDS. If ABC is acting only as an intermediary, it also has to do the TDS on this transaction as well. On this transaction as well. That is the important part on this transaction. That means TDS on entire 550 is to be deducted at the rate of 0.1%. Done, sir, done, sir, done, done, sir. Done, sir, done, sir, done, done, sir. Discuss the relevant provisions of Income Tax Act. Mr. Bhuvan, an individual purchased urban agricultural land on 12th July 2015, which was compulsorily acquired by Maharashtra state government. Compensation was fixed 240 and which was paid in April. So whenever compensation is received on compulsory acquisition, TDS at the rate of 10% is applicable. But only if compensation exceeds 2,50,000 in a financial year. Here 240 is the compensation. Later on, enhanced compensation of 50,000 is received. So if enhanced compensation is received, so TDS would be applicable on 240 plus 50,000. All in all, 2,90,000 is the compensation. 10% would be applicable under 194 LA. 1st October 2024, Aman makes a payment of 9 lakh towards overseas tours and package program to Mr. Robert, who is a seller of OTPP, authorized dealer. Okay, Aman had not filed return of income for 2 years for assessment year 24, 25 and 23, 24. Aman has also TCS collected of 50,000 in both the years. What is, oh my god, oh my, oof. Again an I love you question. It is I love you question. If I am supposed to say I love you to a question, sir, why would you say I love you to a question? Because it is a lovely question. I cannot I cannot proceed without thinking of this question. It's a very good question. Now, what the point is, see, here we have a Robert. He is a overseas tours and package program seller. Now, it is selling a product to Aman. Aman is paying 9 lakh rupees for this package. Now, this Robert is required to collect a TCS. What is the rate of TCS? If you remember, up to 7 lakh rupees, 5%, and on remaining 2 lakh, we have 20%. This is the amount of TCS to be collected. But wait, Aman has not filed ROI in preceding financial year, and TDS deducted for that year exceeds 20,000 rupees. That means TCS applicable is of higher rate. Now, what will be the higher rate? If we have a slab of TCS, then what will be the higher rate? The higher rate per slab shall apply. For this 5 lakh, we would see twice the rate of respective section of 5%. Here on this 5%, we would deduct a TDS to collect at 10%. And on this 20%, 5% or twice the rate of respective section, that is 40%, but subject to maximum of 20%. So on this 20 lakh also 20% would apply. So on this 7 lakh 10%, that is 70,000. On this 2 lakh 20%, that means 4 lakh would apply. That means 4 lakh 70,000. 40,000, that means 1 lakh 10,000 TDS would apply. 1 lakh 10,000 TCS would be applicable. Are you getting this point? Are you getting this point that how TCS is applicable? On this 5%, we would consider different 5 twice the rate of respective section of 5%. And on the remaining portion also, we would check on every slab. This is the important point. This was never asked any before. This was asked in November 24 examination. Wow, sir. Wow. Question number 13. Now, what this question 13 talks about. Another question, good question to be honest. What this question is about. Dream 44 is an online gaming. Wow, Dream 44 is an online gaming platform. As user, Mr. Z is a user in a portal had created 10,000 rupees in his user account on 31st March 2024. That means last year, or I should say, opening balance is 10,000 rupees. Accumulated balance. Okay. Opening balance was 10,000 rupees. He deposited 1 lakh rupees. He played games and won 30 lakh rupees. Okay, 130 lakh rupees. That means his closing balance should be nearly 31 lakh 10,000. Yes. He started. Okay. During year, he also earned referral bonus. See, whenever you earn referral bonus, the referral bonus is normally withdrawable. They assume that it is withdrawable. So referral bonus, it earned 50,000 rupees. So how much it turns out to be? 31 lakh 60,000 rupees is referral bonus including. It is withdrawable. Assume it is withdrawable. Out of this sum, it withdrew 25 lakh also. Oh my god, withdrew 25 lakh. After withdrawal, how much it turns out to be? 6 lakh 60,000 rupees turns out to be the closing balance. On 1st Feb 2025, it kept the balance of 660. 660 is the closing balance on account of this, okay, till the next year. Now, what the case is? What it is asking it is that, of course, it is a question of TDS, so we need to understand the TDS. How TDS is calculated? TDS is calculated at 2 steps. First of all, whenever at the time of withdrawal, and second at the time of closing balance. 2 things TDS is to be considered. First of all, at the time of withdrawal, how much TDS is deducted? Take the aggregate withdrawals minus opening balance minus non-taxable deposits minus we have to do amount on which already TDS has been deducted. So aggregate withdrawals is nothing. Aggregate withdrawals till date is 25 lakh minus opening balance 10k minus non-taxable deposits. See, whatever we have deposited of our own, that is non-taxable deposits. Remember, this with referral bonus is taxable because it is received for free of cost, and we can even withdraw this. So it is non. This is taxable. We have to add, or we have to reduce only non-taxable deposit, and amount on which TDS is deducted. Till now, we don't have any such amount on which TDS has been deducted. So amount turns out to be 23.9 lakh rupees. On this, 30% TDS would be deducted at first. 23 lakh 90,000 into 30%. This is the first TDS. 7.17 lakh is the first TDS amount. Now, second case would be TDS deduction at the year end. This is important. Closing balance plus aggregate withdrawals minus opening balance minus non-taxable deposits till date and minus amount on which TDS is already deducted. This is the formula for which we have to do. Closing balance is 6.6 lakh. Aggregate withdrawals is 25 lakh as the case. 10,000 is the opening balance. Non-taxable deposits at 1 lakh and 23.9 lakh is the amount on which TDS has already been deducted. So reducing this 6.6 lakh plus 25 minus 0.1 minus 1 minus 23.9. This will give us 6.6 lakh on which TDS has to be deducted on closing balance. These are the two figures on which TDS has to be deducted. If you check the answer, you would get the same answer 23.9 and later on 6.6. Did we get this point or not? First is 23.9 and second is 6 point. Simple point it is. Come on to question number 57. Examine in context with the provisions of chapter 17 of the Act and also provide the amount of TDS to be deducted in the following cases. Now, profit commission of 1 lakh to be paid on 18/7/2024 by a reinsurance company to our insurance after the expiry of the term insurance. Now, what this says, see, if for example I went to HDFC, Rahul went to HDFC, that I want a life insurance of 10,000 crore. I want an insurance of 10,000 crore. For that, SDFC was very much worried. SDFC was worried that whether Rahul died, then in that case, it had to pay 10,000. So SDFC was worried. Premium required to be paid was 500 crore, and in return, I was getting a cover of 10,000 crore for 1 year. This was the case. Now, SDFC was worried. What it did, it went to SBI. It also went to, it reinsured itself. What would happen if in case of any in case of any casualty, 10,000 crore would be divided between both of them. 10,000 would be divided between both of them. In addition to this, premium would be distributed between both of them. Now, provision is HDFC is giving 50% of its premium to SBI, whether it would amount to insurance commission under 194D. Whether it would amount to insurance commission under 194D. Right answer is no. No, it would not amount to insurance commission because commission is only paid to an agent. Here they have profit sharing also and loss sharing also. And since it is loss sharing, in case of loss sharing, we do not have any concept of commission. Therefore, 194D is not applicable to this transaction. Amrish is a part-time director who was paid 3 lakh 10,000 rupees. Whenever a part-time director is paid anything, it is subject to TDS under 194J. A whole-time director is deducted TDS under 192, that is salary, but a part-time director TDS under 194J is only applicable. Now, question number 2058. How many questions are there here in TDS? Willingly, unwillingly, we have taken a lot of questions. Oh my god, 60 questions. Examine the applicability of TDS and calculate the amount of TDS in independent cases. Now, UB Click is a non-resident company engaged in the manufacturing of the paints and factories all over the world, including India. The factory in India produces paints as well as in Indian market and withdraw TDS from past 10 years. The turnover of last 3 years was 200 crore, 490 crore and 540 crore. XYZ, okay. It bought raw materials from Color Paints, a domestic company, 1 crore rupees. Okay, the turnover for financial year is 5 crore, 8 crore and 9 crore. In India, it does not have DTAA. Okay, discuss the TDS implication with this. Oh, okay. What the transaction is, let me tell you. UBClick is a company. It had multiple stores and store in India as well. Now its turnover. Just give me a second. If it is the buyer or it is the seller, it is a buyer. It is a buyer. And there is a seller called Color Paints whose turnover is up to 5 crore only. Now it has turnover greater than 10 crore, but other seller has turnover up to 10 crore only. Now it had purchased goods of how much? How much it had purchased? 1 crore. It had purchased goods of 1 crore. 1 crore it had purchased. Now whether this buyer has to deduct TDS under 190 is a kind of non-resident buyer, kind of non-resident. It has a PE in India. Whether it is required to deduct TDS under 194Q, it is irrelevant. Buyer's angle is irrelevant. We have to check a seller has to be resident only. While considering 194Q, we do not have any concept of resident or non-resident payer. We only have to see the person, seller, the person whose TDS is deducted has to be resident. That's the only condition. So whether it is resident, non-resident, they have to deduct TDS under 194Q on amount exceeding 50 lakh rupees. So 50 lakh into 0.1%, that means 5,000 TDS is applicable. Good question. Seal India Private Limited, domestic company engaged in manufacturing and selling of washing powders and bars for the purpose of promoting and selling the boost the sales of its product. It hired agent to whom incentives commission was paid on the basis of percentage of the sales. Okay. During previous year 24-25, Prakash, a resident individual working as an agent for the company, was paid the following commissions and incentives. Remember, commissions are deductible under 194H and incentives are deductible under 194R. Remember, huh? Commission was paid in quarter one. See, whenever you pay commission in quarter one commission is before 30th March, 30th September. Na, so 5% TDS is applicable. So 5% TDS is applicable. Commission in quarter three is after September. That means in case it is 2% is applicable. Other incentives on 160 incentives, we need to see what incentives are there, whether it is 194R or not applicable. The above figures include reimbursement of 1 lakh rupees on booking of an air ticket for the Singapore and its family. See, whenever you get a flight ticket now, it is not business promotion. It is not business promotion expenditure. So it is a kind of perquisite only. So on this 1 lakh rupees, now entire would be 10% under 194R. Of course, 60,000 rupees, it is not mentioned, so it is also perquisite as well. The company also had given 6,000. Now 60,000 extra has been given as laptops. So entire, see 10,000. See, this 60,000 is doubtful. It feels like that this 60,000 laptop is included in this 1 lakh 6,000 only. No, this 60,000 is different and this 60,000 is different. On entire 220, 10% TDS has to be deducted, and that is 22,000 is the TDS deducted under 194R. And on this, 5% and 2% is only applicable. Now, Antique Master is an online gaming auction portal which provides portal, which is an e-auction portal for antique items like coin and artifact. Operates only in India. The owner lists their products on this portal. Buyers place the bids. Portal provides the details to the buyer of the top 3 bids. Seller choose the buyer, intimate to the portal. Portal takes the money and transfers the amount to the seller. See, whenever there is an e-auctioneer portal, normally e-auctioneer portal does not deduct a TDS. E-auctioneer portal does not deduct a TDS of a seller whenever it provides the e-auctioneer services. But sir, e-auctioneer portal should not receive money. Important condition. Now, since the e-auctioneer portal is receiving money, it is a proper e-commerce buyer, e-commerce operator under 194. Therefore, it has to deduct TDS at the rate of 0.1%. After 1st October, it has to deduct TDS of 0.1%. So in this case, 11 lakh sales has been made. So 0.1% TDS has to be deducted. In that case, 1100 rupees is the amount that is to be deducted. Done, sir. Question number 59. Ramesh, a distributor of lottery tickets in Mumbai of the golden lottery ticket, very old lottery, which has turnover of 98 lakh, commission has been 18,000 and 40,000 rupees. 18,000 before September and 40,000 after September. See, golden lottery ticket pays commission to Ramesh. 18,000 before 30th September, that means 5% TDS. And 40,000 after September, that means 2% TDS. This is simple. But sir, this lottery agency has turnover up to 1 crore in last year. Sir, we don't have to check a turnover. Turnover is to be only checked under 6 section 194 HIJACRS. Only only in these 6 or 7 sections we have to check the turnover in preceding financial year. In any other section we don't have to check. If any of the person pays lottery commission, it has to the TDS at whatever turnover they have. So 5% before 30th September, after 30th September 2% TDS is applicable. Now, Smart Switch Private Limited is emerging startup in Bangalore, operates digital in cryptocurrencies. The company had recently gained popularities. Okay. Mr. Adesh, an IT professional, invested 1 lakh rupees and in cryptocurrencies and transferred crypto coins at 347 profit. Now, this is something, a smart platform. It has A buyer called Adesh. It helps in crypto trading. Adesh invested 1 lakh rupees and Adesh earned 3,47,500 rupees. Now, whenever a e-commerce seller, there is an e-commerce portal, it facilitates sales any transaction, it has to deduct 1% TDS under section 194S of the buyer, of the seller. TDS has to be deducted of the seller. Now, whenever Adesh receives this money now, yes, TDS would be deducted. Now, what is the amount of TDS? 1% of the sales consideration. Here, 1 lakh is the cost. 347 is the profit. So, sales consideration would be 447,500 and 1% of that would be considered. Let's see the amount. If you check the carefully, 1% of 447 is considered. That's the correct answer. Last question. Mr. A and Mrs. A jointly purchase a build-up house in Lucknow for 86 lakh. Now, Mr. A and Mrs. A jointly buy 86 lakh rupees house. In addition, they have to pay 4 lakh rupees, plus they have to pay 2.5 lakh extra, plus they have to pay 1.5 lakh extra. Okay, so 86 plus 4 plus 2.5 plus 1.5, all in all they paid 94 lakh rupees for that house. But stamp duty of that house is 75 lakh rupees only. Remember, Mr. A paid half, that is 47 lakh. Mrs. B paid in half. Their personal consideration is less than 50 lakh rupees. Their personal SDV is less than 50 lakh rupees. Both of them is lesser than 50 lakh rupees, whether they are required to deduct TDS under 194 IA or not. Remember, if my consideration is less than 50 lakh and my SDV is less than 50 lakh rupees, I have to deduct the TDS if aggregate consideration exceeds 50 lakh. If more than one buyers buy the property, then we have to club all the consideration to find out the limit of 50 lakh rupees. If all the buyers cumulatively buy property more than 50 lakh rupees, then TDS is applicable in this transaction. Therefore, TDS is applicable on this transaction. Gross salary of Mr. Pankaj, 42 years, is 37.5 lakh. 37.5 lakh is the salary. Let's see the regime. He also implied that he opts to choose default tax regime. That means 75,000 is the deduction that he would get. Remember, 37.5 lakh, 37.50 lakh minus 75,000. Do not make a mistake of just reducing 75,000. Just don't write this as 30 lakh rupees. I have seen answer sheets people writing it as 30 lakh rupees. Remember, 337 lakh 50,000 minus 75,000 implies 36 lakh 75,000. This is the figure. Remember, this is the figure. If I am not doing it wrong, yes, this is the figure. House property loss. Sir, house property loss is not allowed under new tax regime. In respect of self-occupied property, 60,000 is the interest accrued plus 60,000 interest to be taken. 37,635. Done, sir. Now, TDS has been deducted. Okay. Pankaj had a motor vehicle. Sir, see, since he has purchased motor vehicle for personal purpose, so 1% 32,000 TDS would be deducted. And on this FD also, 60,000 FD, nearly 6,000 interest TDS would be deducted. Done, sir. He had no other income. He had furnished the declaration. See, again, he would what we would do, we would take out the taxes, we would reduce the TDS. We would take out the taxes 37, 35. We would take out the taxes, we would deduct the TDS amount, and we would get the total 192 TDS applicable. Urban Bank made an FDR of 100 crore with Union Bank. See, if there is a cooperative society bank, there is Urban Cooperative Society Bank. Who made FDR? Whenever we are a cooperative bank, na, we can make FD. Yes, we can make FD. Whether TDS would be applicable on this interest, see, if any interest is paid up to a bank, if any interest is paid to a bank, no TDS under 194 I is 194 is A is applicable. So 194A not applicable. Okay, done. The said cooperative bank also mentions a current account and withdraw 4 crore in cash. Whenever a cooperative bank withdraws any sum, no TDS is applicable. Cooperative bank withdrawing any sum, no TDS applicable. Cooperative bank earning entry interest, no TDS is applicable. Did we get this point or not? And dear friends, did we get this point fully or not? Sir, we got this point. This is all about your TDS, TCS and advanced tax. Now we shall beautifully, relaxfully start the assessment. Okay. Simple questions up to 61 we are done. We are done more than half. We are only left with small question answers, very theoretical question answers. We'll very fast. Okay. So starting with question number 61, what question number 61 says? Now, this chapter includes the question from income tax authorities, return filing and assessment procedure. Remember, whatever questions are there based on my personal thought that how Much things can be asked. These are based on that. Okay. Of course, new question can be framed from this topic. For that, we need to refer some portion of concepts as well. Some portion, at least judicial update you must be aware of. Question number 61. Rajesh regularly files his return of income electronically while he was trying to upload the return of income for assessment year 2026 on 31st October. It was extremely difficult to do so because of some network problem, and ultimately he became unsuccessful and he could file only late. 1st November, the return contained carry forward of 3.1 crore of losses circumstances was emailed to the competent authority on first mail. Rajesh made a request to CBT for the condonation, discuss whether the CBT can condone this. What would your answer be if there is loss of 2.7 crore? See, whenever there is loss, you for that matter you have to file return on time. If you did not file the return, loss cannot be carried forward. But one thing point to be noting is, if it is genuine cause of delay, if delay is genuine now, so department can condone you. Now for that matter, where you have to go for condonation, you have to go to condonation at different authorities. In that case, the authorities prescribed here is, if up to 1 crore loss is there, you can go to PCCIT and CIT. If loss is 1 crore to 3 crore, then you have to go to CCIT, and if loss exceeds 3 crore, then you have to go to PCCIT. So in this case, Rajesh can go to PCCIT, but if loss is up to 2.7 crore, then it should go to CCIT. That's it, sir. That's the answer. That's the only thing. Question number 62. Business premises of Ram Bharosa Limited and the residence of the two directors at the Delhi were searched under 132 at DDI. The search was conducted on 9/8/2024. The following assets were also seized. Answer. See, premise were Ram Bharose. Ram Bharose is the premise of search, is the area where search was conducted. Papers were found in the drawer of the accountant relating to Sri Krishna. Now, Ram Bharose were searched. There was drawer. Documents were found relating to Sri Krishna Limited, indicating the details of various transactions. However, Ram Bharose did not have any direct connection in the nature with the Sri Krishna Limited in the Mumbai. Oh my God. So documents were found relating to Sri Krishna. Done, sir. Jewelry worth 5 lakh rupees from the bedroom of the director was claimed to be one of the married daughter. So Ram Bharose was under search. Director's premises were also searched. Under the bedroom of the director, 5 lakh rupees jewelry were found, and director claimed that it is his married daughter's jewelry. Answer. Paper recording certain transaction of income expenditure having direct nexus with the business of the company for this period under the search, it was admitted by the director that the transactions were recorded have not been incorporated. So there were some papers found which indicate that some transactions were not recorded in books of accounts. Now, what action did the DDI shall be taking in respect of the seized paper? See, whatever the seized paper are with respect to Shri Krishna Limited, na first thing, whatever the due diligence authority has now with respect to Sri Krishna, that shall be given to, whatever the documents that shall be given to them, that shall be, whatever the documents that have been found with respect to Sri Krishna, that shall be handed over to their respective jurisdictional officer. See, if I found some papers of some other party, for example, I found papers of somebody in my premises, or assessing officer finds some papers in my premises, then such other person is also subject to the assessment. Therefore, their documents are to be handed over to their assessing officer in that jurisdiction. It has to be handed over. So it will be handed over. The authorized officer, TDI not having jurisdiction over Sri Krishna, will hand over the related documents which has jurisdiction over Sri Krishna within 60 days. Done, sir. Now, whether the contention raised by the director with respect to jewelry be acceptable. See, director is saying that whatever jewelry found is not mine. The jewelry is belonging to his minor daughter. Now, whether this contention is valid, right answer is no, it is not valid. Whatever the asset is found during the search, it is assumed that the asset belongs. Answer. Which presumption shall be drawn in respect of paper which indicate the transaction not recorded in books? See, whenever the transactions are not recorded in book and it has been found, then it is assumed that transactions are being done by you. It is a basic presumption in search that whatever the documents that have been found are your documents only. Answer. Presumption in respect of the paper indicating the transaction not recorded have direct in the nexus. Assume that it is your transaction and it has been done by you only. This is the basic presumption. Now, this is a good question. Question number 63 will help you a lot to understand IT authorities better. Understand this. Processing officer with prior approval of CCIT under 133A surveyed the Good Day Cyber Cafe. See, Good Day Cyber Cafe was under survey. Whether approval by CCIT was taken? Yes, approval was taken by CCIT. Done, sir. Which was within the jurisdiction at 1 a.m. at night. 1 a.m. at night, the premise was under survey. on 1st June 2024 for the purpose of obtaining information relevant to the proceedings under Income Tax Act. Cyber cafes open between 12 p.m. to 2 p.m. So business hours are 2 to 2, and in between that, survey has taken place. That means whether survey has been done in business hours, yes, survey has been done in business hours. Listen, on 15 June, assessing officer entered into Bright Light Cyber Cafe, which was within the jurisdiction at 11 p.m. Now we have another entity, Bright Light Cyber Cafe, and here survey did not take place. Survey did not take place. Here 133B power to collect information has been exercised by the AO, and he had entered the premises just to collect information. No survey, but just to collect information they have come. Done, sir. For the purpose of collecting information which may be useful for the purpose of the income tax. Now, cyber cafe is kept open for business every day between 12 to 12. Now, of course, between 12 to 12 it take place. 12 to 12 is the business timing, and they have entered at 11 p.m. That means whether they have entered during business hours, yes, they have entered during business hours. In both the cases, assessing officer impound and retain certain books for 12 days, inclusive holidays. So books of accounts taken for 12 days. Here also books of accounts taken for 12 days. Now, after recording the reasons in writing. So, the assessing officer, however, did not take the prior possession permission from the commissioner for doing so. The owners of the cyber cafes claim that assessing officer cannot enter after sunrise sunset and cannot take away the books of accounts as well. And even this cafe is arguing that why did the assessing officer did not take commission before entering, whether the legal claims are valid or not. First of all, first legal claim with respect to whether they can enter during business hours or not. They have entered after business hours. They have entered after sunrise. Whether this claim is correct or not. Right answer is this claim is absolutely incorrect. During survey under 133A, we have a special provisions that survey can be conducted during business hours. If surveys is happening at a business premise, it can be conducted in business hours. Whether it is conducted in business hours, yes, it is conducted in business hours. Similarly, under 133B also we have similar section, similar provision. If assessing officer wants to come to your premises for the purpose of information collection, they can come any time during business hours. It is not necessary that they come after sunset. They can come any time at the time of business hours. So contention of entering after sunset is invalid. In contention, can they impound books of accounts? First of all, during survey, can they impound? Yes, they have power. Yes, they have power to impound books of accounts. During during this 133B power to collect information, do they have power to impound books? Right answer is no. In this case, they cannot impound books of accounts. Therefore, in this case, books of accounts cannot be impounded. Another thing, third thing, they require prior approval. Sir, in survey, they have already taken prior approval. No another approval is required. In 133B, approval, sorry, in survey, they have taken approval. But under 133 power to collect information, no approval is required. So whatever the assessing officer has done is absolutely correct. In addition to that, would your answer change if assessing officer had surveyed good day for the purpose of TDS? What would your answer be? If this survey would have been a tedious survey, if they would have been a tedious survey, then what your answer would have been? First of all, approval required. Yes, approval required. Whether can they enter into business hours? Sir, no. Here business hours is incorrect. They have to enter after sunrise, before sunset. For the purpose of TCS survey entry restriction, there has to be entry only during the business hours. First thing. At last, one thing is to be said, one thing clearly is to be mentioned is one thing absolutely clear. Then can they maintain, can they impound books of accounts? Yes, they can impound books of accounts for the purpose of TDS collection. So these are the things that have to be taken care of now. I answered. I have entire summary on YouTube relating to this income tax notice. You should refer that to understand it better. What powers are there during survey? What powers are there during power to collect information? And what are the powers of an IT authority at the time of TDS survey? Contrasting every power, I have made a video. Just refer that; it will give you a better idea. Now, question number 64. Question number 64. What does this question number 64 say? Examine whether the following person are required to file ROI or not. Okay. Albert, 31 year turnover 70. If your turnover exceeds 50 or 60 lakh rupees, then you are mandatorily required to file ROI. Yes. Ashish, 42 gross receipt 5 lakh rupees, business turnover 1.5 lakh rupees. In addition to that, 4 lakh interest income. See, total income is 2.5 lakh plus 4 lakh. That means total income is more than basic exemption limit. Therefore, ROI required. Yes, required. A law firm mandatorily ROI required. XYZ partnership firm had incurred expenditure of 95,000 towards consumption. Sir, a company, irrespective of their expenditure, is required to file ROI. Yes, they require ROI. Wallace, who deposited 50 lakh rupees in savings account, he received a gift from Rishi, who is employed in the company. Wallace used the money to buy the asset, buy the house of rupees 30 lakh rupees. For self-residence, the balance money was transferred into FD. Oh, wow. Wow. He did not maintain any account. He did not have any foreign source. He did not offer 150 in BSc. What it says. See, you receive certain money from your son. Whether it is taxable or not, it is absolutely exempt. It is absolutely exempt. It is not counted in GTI. Therefore, ROI for because of this condition is not applicable. But since he has deposited 50 lakh rupees in savings account, therefore he is required to file ROI. He is absolutely required to file ROI. Come on to next question. Question number 65. Assessment of R and Sons HUF was completed under section 143(3) in the income tax with an addition of 7 lakh rupees to the return income. The assessee contend that order of assessment is bad in law as no notice was issued. Assessment was done without issuance of notice. Assessment was done without issuing any notice, without any issuing any scrutiny notice. Even though the assessee has participated in the assessment proceedings, the assessing officer, relying on the section 292BB, contends that assessee has participated in the assessment proceedings. Now he cannot raise any objection on the assessment order. Oh my god. Examine the validity of both and give your opinion in this list. Listen, whether it is correct that small irregularities do not invalidate the assessment proceeding. Yes, sir, it is. If assessee participates, can a wrong notice be correctified? Can a belated notice, a barred notice be valid? Yes, it becomes valid. Barred notice is also valid. Small irregularities are always covered. These are two sections, 292BB. That means if there are some irregularities, if notice is not served properly, if notice is not served on time, even though these irregularities become valid, will make a valid notice. These irregularities will become a valid notice. Issue is notice is not even served. Notice is not even served. Whether it is a valid ground for assessment, sir, it is not a curable defect. It is not a curable defect. See, a wrong notice is allowed. Wrong name in the notice is allowed. A bit delayed notice and assessee cooperating, it is allowed. But a notice not even issued, will this be valid? Sir, it is absolutely bad in law. Notice has not been issued and your assessment is started and you even cooperate now, it is not valid. It is invalid assessment. Question number 66. 66. Mr. Rajneesh, a resident individual, during the course of the assessment proceedings, found guilty for making false entries in the books of accounts to evade taxes. The assessing officer indicate the penalty against him under 271 AD. Penalty is likely to be more than 3 crore rupees. Assessing officer passed the order provisionally to attach the property 2024. Since AO is of the opinion that it is necessary to do so to protect the interest of the revenue, AO also took the prior approval of Principal Commissioner of Income Tax. For passing such order, you are required to answer the following question. Is this action of the assessing officer valid? Is there any monetary limit for the provisional attachment? See, whether assessing officer has done correct or not, yes, he has done correct. Whenever a penalty is likely to be imposed exceeds 2 crore rupees and it is necessary for the interest of the revenue, then he can attach the property. But for that matter, he requires approval of commissioner. At least a commissioner approval should be taken, and then he can attach the properties. For 6 months, he can do the attachment. Assume all the procedure of the assessment attachment have been met. Discuss the validity of the provisional attachment. Can it be valid? See, provisional attachment is valid. Remember how long the provisional attachment will last. Remember, provisional attachment will last later of 2 years from the end of the attachment. I mean, once you attach, 2 years can be maximum limit for which it can be done, can be extended, or 60 days from the completion of the assessment, whichever is later. Till this date, this attachment will going to last is going to last. Third question: is there any option available to Mr. Rajneesh where such provisional attachment can be avoided? And if yes, then tell the relevant cases. Now, I want to vacate this provisional attachment. I actually want to sell this property. Then what can I do? I have to submit a FMB. I have to submit a bank guarantee relating to the fair market value of the property. If I want my property back, if I want my provisional attachment to be vacated, I have to submit a bank guarantee to the assessing officer. An assessing officer is going to invoke that bank guarantee if I do not furnish a fresh bank guarantee within 15 days before the expiry, or if I did not pay the taxes, he's going to invoke that bank guarantee. But bank guarantee is mandatory thing required for the purpose of vacating the provisional attachment. Done, sir. Please answer the following cases in respect of the issues involved provision and analysis. Now, as per latest judgments, the SSC Messrs PQR LLP, a registered LLP, is engaged in the wholesale and retail trade of beverages. SSC debited 5 crore to profit and loss in respect of surcharge of sales tax paid to the central government. Assessment order 1143.3. Income tax assessee has made assessing officer has made 5 crore additions as disallowance of surcharge on sale tax. See, assessee debited 55 crore rupees as an expenditure. What is the expenditure? Surcharge on sale tax. And assessing officer disallowed that. Whether surcharge on sale tax is allowed or not, whether surcharge on sales tax is allowed or not, whether it is allowed or not, that is not even a question. First paragraph is just to mislead you. It is not even a question. Let me take you what question is. Let me take you. The assessee contends that order of the assessment is bad in law as no notice was issued under 143.2. Yes, if no notice has been issued, whatever the disallowance that assessing officer has done is it. No notice has been issued. Now, whatever the disallowance that assessing officer has done is invalid. You were thinking about allowance, disallowance, but it was asking something different question. So therefore, in assessment, it might appear that you don't know the answer. But if you see the required question, you will understand that you already know the answer. Mr. Balji is a resident individual, filed return of income for assessment year 24-25, 30th July 2024. Now he filed the return on time, it seems on time, offered interest income of 25 lakh rupees received from Sanjay Finance Company, Limited, Delhi, deductor. He claimed the TDS, of course. He received the interest, he offered that interest, and he also claimed the credit. TDS credit was not allowed by the department under section 143(1). The application was filed for rectification as it was also rejected because it was not reflected in 26 years. The tax was recovered from the SSC itself. Advised Baljit on the basis of the latest court ruling and department in the form of provisions, tax involved, and the given case. Now, what the provision is, let me tell you. Exactly understand this thing. Baljit received interest after deduction of TDS. This TDS is already deducted. Now, what happened to TDS? Now, the deductor was supposed to pay this TDS to the government, but it did not pay. Deductor did not pay the TDS to the government. Therefore, in our 26 years, it is not reflected. Therefore, while processing the return, department disallowed this credit because it is not reflecting in 26 years. Now, in that case, what happened? This department disallowed, Baljit or the SSC claimed the credit and he was denied credit. Even at the time of rectification, also he was denied the credit. Now, in that case, what would happen? Since he was denied the credit, can he legally claim the credit? Can he legally claim the credit which is not even appearing in 26 years? Yes, he can claim. If TDS has been deducted now, an SSC is a bona fide SSC. He has not done anything wrong. He can claim. He can absolutely claim the credit. Now, the assessing officer, with the prior approval of the Principal Commissioner of the Income Tax, directed Messrs Greenfield Textiles to get its books of accounts audited under 142(2)(a). The Income Tax Act on the complexity of the account. For this purpose, a chartered accountant was nominated by PCCIT. Okay. SSC, however, was willing to produce the books of accounts and extended full cooperation in getting the audit conducted. However, nominated chartered accountant without any reason refused to undertake the audit. Assessing officer treated the matter as non-compliance of the direction under 142(2)(a) SSC and proceeded to complete the assessment proceeding under best judgment basis. In light of the above facts, examine whether the SSC can be held for the failure to comply with the provision of the direction of the Principal Commissioner on account of mistake of chartered accountant, whether the assessing officer in proceeding with best judgment assessment is valid or not. Referring the case, you have to answer. Now, what the case is, understand. SSC was put to audit. Now, I am subject to special audit. I am cooperating with department. I am ready to produce my books of account. The chartered accountant who has been nominated is not even willing to do this. Because of his mistake, his silly mistake, he's not willing to do audit. I am subject to best judgment assessment, whether it is good, valid or not. Sir, if I am supporting my audit and chartered accountant is not doing, is it my fault, sir? It's never your fault. If you are willing to get your books of accounts audited now and chartered accountant is not doing, it is not your fault. Remember, It is not your fault. It is absolutely okay. It is absolutely okay. You will never be subject to any such consequences because you are doing correct. You are doing correct. Therefore, whatever the best judgment assessment has been done is not valid. If you see, it is not valid. Now, answer any two out of the three. Okay, let's answer. In the case of an assessee, assessing officer passed an order under 143.3 on 15/12/2022. Order was passed. CIT passed a revision. Okay, after 2 years. See, now what happens is 15th December 2022, order was passed, and this order was revised. When it was revised, 20 order for revision was passed. That means as a CIT wanted to revise this, so it passed a notice. It issued a notice. Okay, no, it did not issue. It passed the revised order. When did it pass? 23rd March 2025. When can CIT revise? See, whenever the actual order is passed within 2 years from the end of that year. Within 2 years from the end of the year. Let this year end, that means 31st March 2022. At 2023 plus 2, that means 31st March 2025 is the date till which order can be passed. Order is passed within time. Holding the date of the first was erroneous. See, of course, in this revision order, original order was considered erroneous and prejudicial to the interest of the revenue. CIT set aside the order and directed AO for fresh assessment after conducting the necessary inquiries. The order passed was dispatched to the assessee on 28. AO issued notice for special audit for making the fresh assessment. Oh my god. The SSC contended that it has come to the notice of the revision only after he received a notice under 142.1 on 6th May. A copy of the order passed by the CIT under Section 263 was supplied to him on 29th March on request made to the assessing officer after receipt of the notice. Hence, the revision order is beyond the limitation period. Now, what the question is understanding. Understand this. Think of it from assessee's point of view and department's point of view simultaneously. Department wanted to revise, therefore CIT wanted to revise. So it issued an order to AO. That is also it wanted to revise now. What the case was, department passed an order on 26th March. Whether department passed order on time? Yes, they passed order on time. Now, since they wanted to do assessment, it requested CIT requested assessing officer to issue a notice. Now, this notice under 142.1 was issued on May. Notice even though it's delayed. Notice even though it's delayed. But original order for which revision was sought now was passed on time now. This notice was received to the SSC later on. What I'm saying is, department passed the order on time, but it was received to the SSC as late. Whether can this be considered as time barred? Department passed order on 26 March, but it was received to the SSC on May. How did it receive? Because department delayed in issuing 142.1, so therefore SSC received this as late. Can this be considered as a valid order? Sir, in this case, it was considered valid order. Because while passing order under 263, there is no limit as to whether it should be received by the SSC or not. It is order issued by the CIT. So date of issue is important. Date of issue of order is important, not the release. Part 2, what question part 2 says? Messrs. Rama filed its return of income claiming deduction for bad debts. Okay, the return was processed under 143.1. Thereafter, assessing officer noticed that assessee has wrongly claimed the amount of bad debt. Therefore, he issued notice under 154. Okay, so what the case is? Return was filed. It was processed. After processing, 154 was issued after the expiry of the time limit prescribed. So this 154 was issued late. First of all, if there has to be a disallowance to be made, can this be disallowed under 154? First of all, 154 cannot be used for disallowance. Remember, 154 cannot be used for disallowance. It can be only used for mistakes apparent from record. During the pendency of the proceedings initiated by the notice under 154, the assessing officer issued 148. Contention of the Rama is notice is illegal. See, of course, 154 can be issued after 4 years. Up to 4 years it can be issued. And after during the pendency of the proceedings under 154, assessing officer issued 148. Is it valid? Sir, it is not valid. Ideally, it is not valid. Why it is not valid? See, first of all, your time limit for issuing notice under 148 has to be taken from the original order. It shall not be taken from the rectification order, ideally. The first rectification done and taking for 148 due date from one rectification is not valid, therefore it is not allowed. Let me take you to the solution of this point. See, in the present case, 148 was issued during the pendency under 154. Therefore, it is illegal. Facts were given in case of SMEs overseas. Supreme Court. The above is bad in law. Okay. It is bad in law in the absence of any specific order of withdrawal of the proceedings under 150 on the ground same as beyond the limitation period. The proceedings initiated under 154 can be said to be have been pending. During the pendency of the proceedings under 154, it is not permissible to initiate any other proceedings under 148. See, already there were proceedings going on for the same thing now. Then again issuing 148, it doesn't make sense, for it is invalid. Now, what the case is? Next question. AZ Foundation is trust registered under 12AB. Runs an educational institute. The trust, they are paying rent 30 lakh rupees per annum for building occupied by it. But trust did not deduct the TDS. See, ultimately, if trust did not deduct the TDS now, it should deduct actually TDS. It should deduct TDS. Ultimately, trust should deduct TDS. Irrespective of the turnover, if it is making any payment on which TDS is applicable, TDS has to be deducted by the trust. Now, under the relevant provision, ITO issued a notice to the trust, show cause notice, as why it should not be treated as assessing default for the tax deductible and not not be imposed for such default. The income of the trust being exempt, ITO whether is justified or not. See, trust did not deduct TDS, therefore ITO made that trust as assessing default. Whether ITO is correct or trust is correct, see, ideally trust should have deducted. Trust should have deducted, but whether just because not deducting would make it assessing default, ideally it should become. Ideally it should become, because it is the duty of the trust to deduct the TDS, even though it is exempt. There is no other reason as to why it should not deduct. Therefore, it should be considered as assessing default. It should be considered. Now, what the case is? Issue under consideration is whether a trust being an exempt can be treated as assessing default for not deducting TDS. Okay. Analysis does not provide any exemption for trust. In the present case, AZ has not deducted TDS on the rent, therefore it shall be deemed to be assessing default, and therefore it is justified. IT is justified. Same question we have done. If you remember, the same question we have done with respect in TDS topic we have done that the TechWell or TQ, if you remember, we have not deducted TDS. In that case, we had given a point that if the person whom payment has been made files his return of income, furnishes such income in ROI, then this could not be considered as assessing default. But in this case, other party point is not given. Whether other party files his return, whether it pays taxes or not, it is not given. So we would not get into details of that as well. Come on to question number 69. A good question. Appeals and revisions. A petition for stay of demand. Acha, even if you have not liked the video till now and not commented and not subscribed, what should I do? Should I take a bowl and beg for a subscribe? Should I? Am I so bad? Don't I deserve a subscribe? Haven't I contributed even this to your studies? Shouldn't I deserve a subscribe, sir? I deserve. I deserve. Ideally, I should deserve a petition for subscription. I'm not doing. Answer done with overacting. Okay. A petition for stay in demand was filed by XYZ before the Income Tax Appellate Tribunal in respect of disputed demand for which appeal was pending. Done. The Appellate Tribunal granted stay dated 1st Jan 2020. 1st Jan 2025 stay was given. Now, how long stay goes? For 180 days stay goes. For 180 days from the date of the order. Okay. On deposit of 20% of the amount, stay was given. Thereafter, bench was not functioning till 1st Feb 2026. Now, till 1st Feb 2026, bench was not functioning. Now, stay would vacate after 180 days. XYZ would require extension on this stay, and therefore, the disputed matter could not be disposed of. In the meanwhile, in June 2025, the XYZ had made an application for the extension of the stay, and stay was extended up to 31st December. So up to 31st December, it was extended. If you remember, whenever we seek stay of demand to ITAT, stay is allowed only for 180 days, but it can be extended to 65 days. Remember, extension is only valid in for certain circumstances. If delay is not on account of SSC. What would happen after 65 days? Normally, stay is vacated. But if remember, there was a case law of Pepsi Food Limited. In case of Supreme Court, where Supreme Court said even after 365 days, if delay is not because of SSC, SSC is not fault, SSC is not faulty, then stay shall continue. Now, what did it do? After 1 year, on 5th Jan 2026, that means after 1 year, Ideally, stay should continue because ITAT is not working now, so it is not in the control of the SSC. ITAT is not working. Then thereafter, on 1st Jan 2026, the assessing officer attached the bank account of XYZ and recovered almost 15 lakh rupees against the arrear demand of 25 lakh. Oh, attached the bank account. Oh my God. The company requested the assessing officer to refund the amount. The assessing officer, however, rejected the contention of the refund because it said, since stay was vacated, assessing officer is allowed to attach the bank properties. Oh my God. For which order of stay stood vacated automatically. Examine the correctness of the assessing officer. See, even though stay is vacated after 1 year, it is correct that stay is vacated after 1 year, but there is an issue. What issue? Ideally, what should happen is, see, understand this. Because it is not the issue of the SSC now that stay will continue, and this was said by Supreme Court in the case of Pepsi Foods. Therefore, stay shall continue. Whatever the act that High Court or whatever that ITAT has done, the assessing officer has done is invalid. Accordingly, appeal not heard by the bench is not a delay attributable to SSC. Therefore, it is extended beyond the 65 days. Therefore, it should order of stay only if it is, sorry, only order of stay shall vacate only if mistake is only attributable to SSC. It was said in case of Supreme Court in DCIT versus Pepsi Foods Company, Supreme Court judgment. Now, this is also a good question. Actually, this is not the good question, but the good question is yet to come. The Commissioner of Income Tax issued notice to revise the order passed by the assessing officer under 143. So 143 order was passed. Now, as Commissioner wants to revise, CIT wants to revise this order by passing 263. During the pendency of the proceedings with the Commissioner on the basis of the material fact, see, for issuing 263, it issued a notice. Done. After issuing notice, there was a survey taking place at the premise of the SSC. Survey took place, perfect. After the first notice, Commissioner issued a second notice for which contents were different. Examine whether Commissioner can issue the second notice. See, first notice was issued that, for example, 10 AA is to be disallowed. Commissioner wanted to revise the order because as Commissioner thought that 10 AA is to be disallowed, for which it issued first notice. Now what happens? There happened survey at the premise of the SSC. Now what happens? Commissioner thought that in addition to 10 AA, some more things are to be disallowed. Therefore, it issued a second notice. Whether the second notice is valid, already this is at the loss of the SSC. It is a loss to the SSC. Whenever a revision takes place, it is a loss to the SSC. You should inform everything on the first notice itself. If you want to issue multiple notices, it is a detriment to the SSC. Therefore, only first notice is allowed. Multiple notices, second, third notice, even that notices on which content is different, it is not allowed. It is absolutely not allowed. Therefore, it is invalid. Examine the circumstances where appellant is entitled to produce additional evidences, oral or documentary, before the Commissioner of the Appeals, which were not given to assessing officer. Understand? See, ideally, we should submit all the evidences to AO only. But if we went to AO and it did not take the evidences, first thing, we were prevented from submitting the evidences. We gave it to somebody and those people did not give to AO. But third thing, we were about to give the evidences, but AO passed the order before taking the evidences. So AO did not take first thing. We were prevented from giving it to AO. Or third thing, AO passed the order before taking the evidences. In all the three cases, we can submit these additional evidences to Commissioner of Income Tax Appeals. We can submit them to CITA. Now, examine the correctness or otherwise of the following preposition in context of the Income Tax Act. The powers of the Commissioner of the Income Tax to enhance the assessment are plenary and quite wide. Whether can Income Tax Appeals enhance the assessment? Let me tell you what the point is. Assessee, say for example, has an income of 10 lakh. And this was increased to 15 lakh rupees during assessment. For that matter, assessee went to appeal to CIT Appeals. Can CIT Appeals increase this 15 lakh further? Right answer is yes. CIT Appeals can increase the assessment. Can ITT increase the assessment? No, ITT cannot enhance the assessment. CIT can enhance the assessment. At the time of hearing the rectification application, the Income Tax Appellate Tribunal can reappreciate the evidence produced during the proceedings of the appeal hearing. Oh, at the time of a rectification application, Income Tax Appellate reappreciate the evidences produced. No, sir. For the purpose of rectification, now you can only for the purpose of rectification, it cannot reappreciate the evidences now. Once evidences are furnished, they are logged. You cannot take any more evidences for the purpose of rectification. Rectification does not amount to looking at more evidences. It only amounts to correcting the mistakes which are apparent from record. If you know that 2 plus 2 is equal to 4 and you have by mistake done it 2 plus 2 is equal to 5, you don't require any evidences. This is revising your order. If you are reappreciating the evidences, if you are taking more evidences, now in that case, it would amount to revision of the order, and revision is not allowed. Review of the order is not allowed. Only thing allowed is rectification, and rectification that too rectification on the mistakes which are apparent from record. Now, High Court cannot interfere in factual findings of the lower authorities without any valid reasons. It's absolutely correct. Absolutely correct. High Court cannot interfere in the factual findings. What does that mean? See, case whatever the facts are there, facts establishment work is to be done by the lower authorities only. High Court do not involve in itself for fact finding work. Fact finding is to be done by lower authorities only. High Court only involves in the interpretation of law. That's it. Question number 72. Doctrine of precedence would be applicable in the case laws. Oh my god, what is doctrine of precedence? We don't know. In light of the doctrine of precedence, comment the correctness or the otherwise of the following treat. Sir, we are not aware what is doctrine of precedence. The ratio descendi. The rationale of deciding case of a Supreme Court decision is absolutely binding on the lower court tribunal authority. However, lower courts tribunal authorities are not bound by the additional remarks by the Supreme Court. See, Supreme Court gives the order, it is applicable to all the courts of India, correct? Supreme Court sometimes give additional remarks, additional judge comments. Whether they are applicable to courts, yes, they are also binding in nature to these courts, to these lower courts, they are binding. It is incorrect statement. Where there are two irreconcilable decisions of two benches of the similar strength, the Supreme Court decision with more detailed discussion will prevail. If judgment comes which is in the favor of the SSC and same judgment comes in which is in the favor of the department, both are functioning as same benches. I mean, both of them are having same strength. Now, which one would prevail? The one with more detailed one would prevail. It is absolutely incorrect statement. The one which is later shall prevail. The judgment which comes later in the time shall prevail. Lower judgments are bound by the decision of the Supreme Court. The only exception is that principle of incurium, which means without referring to the statutory provision. There are certain provisions, there are certain judgments that Supreme Court gives without referring to statutory provisions. For example, based on some international laws, based on some customs, Supreme Court does give the judgment. Now, these are not to be followed by the lower court. It is absolutely incorrect. Even though some statutory remarks that are being some judgments are being given without statutory remarks, these are to be followed even. These are even to be followed by the lower courts. Now, lower authorities may deviate from the High Court within the scope of the jurisdiction they function only in a situation to keep alive the department where the department has not accepted and has taken the matter to the Supreme Court. No, sir. Whenever High Court is there and High Court has given you the judgment, lower court cannot depart. Lower authorities cannot deviate from the judgment. Since the case has been gone to Supreme Court, it does not mean that you can deviate from the judgment of the High Court. Till the judgment of Supreme Court has not been passed, you cannot deviate from the judgment of the High Court. You cannot. So, of course, this is also wrong. This is a good question because the language given in this question is new to you. Therefore, if you don't practice, there are greater chances that you might not be able to recall, you might not be able to understand actually what the question is asking. Tax planning, avoidance, and GAAR. Now, what the point is? Specify with reason whether the following acts can be considered as tax planning, management, and evasion. Mr. P deposits 1 lakh rupees in PF account so as to reduce the total income from 5 lakh to 590. Whenever money has been deposited legitimately based on ATC deductions, legitimate exemptions, it is always planning. It is always planning. SQL maintains a register for tax deductions. See, tax, it is a kind of management only. It appears it is a kind of management only. An individual taxpayer making taxes saver deposits of 1 lakh in nationalized bank. See, it is a kind of planning only. A partnership firm obtaining declaration from lenders, depositors in Form 15GS for forwarding, it is management, of course, if you are timely complying the law. Now, the company installed air conditioner of 75,000 at the residence of the director as per the terms of the appointment, but treated it as a quality control equipment to claim the depreciation. See, you are using the air conditioner for the residence of the director. but you are treating it, you are wrongly showing it as a business asset, you are showing it as a factory asset to claim higher depreciation. It is invalid now. It is absolutely invalid, of course. But the point is, actually, it is an evasion. Of course, answer is evasion. But how difference it would make if we have given anything to a director? It is entirely expensed out in the P&L now. It is entirely expensed out in the P&L. We have already taken deduction of it entirely. Now, how difference it would make? See, if we have used that, if you have used that air conditioner in our business, we would capitalize it. We would get half a deduction, 40% deduction maximum. We would get certain 15% deduction. What more we can get? But giving it to director, we are entirely debating it to as a P&L as a salary expenditure now. We are entirely debating it as a salary expenditure. So it is something very debatable why this is a evasion, but it is evasion. Just bluntly looking at the provision now, we would understand that there is something evasion happening, something non-compliance of law is happening. Therefore, it is evasion. But ideally, if you see logically now, it is not even evasion. It is a better thing to do. I mean, whatever they are doing is incorrect. Now, why they would charge it to why would they even claim depreciation if they are giving it to the director? So it is a salary expense. Entire deduction you would get. RR issued credit note of 80,000 rupees as a brokerage payable to Ramana, who is the son of the managing director. The purpose is to increase the total income of the Ramana from 670 to 7 lakh, 620 to 7 lakh rupees, and to reduce the income of the company. See, company has certain income. To reduce the income of the company, company issued a credit note to the director's son so that company's income can be reduced, tax can be saved by 25-30%. And since Ramana doesn't have any income, so he would get a benefit of slab plus rebate. So therefore, there has diversion of income happening. Of course, diversion of income is allowed in some cases. Diversion of income is absolutely allowed in some cases, but the fact is, you cannot give this income to somebody who is not even entitled to. He should be qualified enough. You are just giving him credit note without any reason. So therefore, in this case, it is nothing but a evasion happening. Company remitted provident fund within time. It is nothing but a management. Simple question, yes, sir. Now we have some very good questions from GAAR. Tax planning evasion. We have some very good questions. I want you all to cooperate, corporate, whatever you understand. I want you all to cooperate because these questions you are bound to see some question from this topic. Somebody who is good person, who has come from heaven. Just drop a timestamp at this point so that you are in a position. You are in a position to uh, come on to this point clearly. Question number 74. Messrs Global Architect Company Inc. Incorporated in country F1 is engaged in business of providing architectural design all over the world. Now, Global is a F1 based company. F1 is the country name. It receives offer from Lovely Resort Private Limited, an Indian company for designing and development of resorts all over the India. Done, sir. Lovely is an Indian based company. India F1 treaty provides that architectural services are towards the payment of the technical services and company may be taxed in India. So if company provides the services in India, it will be taxed in India. Tax in India. If company is providing services, it is taxed in India. However, if professional fees are provided by the firm and individual, then such services are only taxable if they have fixed base in India or employees come to India for 180 days. That means if company is providing, definitely tax in India. But if firm provides them, firm will only be taxable in India if they have permanent establishment or fixed base in India. That means if firm is providing virtual services, it would not be taxed in India. Wow. It is a limitation of benefit between India and F1. Now, Global Architect form a partnership firm. Now, since it is a company, now it don't want to pay tax in India. What they did, they form a partnership firm where all the directors are the partners. Where all the directors is the only partners and entered via firm and did not pay that. They did not pay taxes in India. Ideally, whether it is a planning, no, sir, it is not a planning. Clearly appears that this is a shell company. This company does not even this partnership firm does not even have a commercial substance. It is just formed for tax evasion purposes or tax avoidance purposes. Whether it is illegal, so it is not illegal. It is not illegal, but it is exploiting the loopholes in the law. It's exploiting the loopholes in the law. Therefore, it is a kind of avoidance happening. And since we do not have any specific rules for that, therefore, general anti-avoidance rule will prevail. Of course, general anti-avoidance rule is only applicable when there is impermissible avoidance agreement. Yes, it is impermissible. Why? Because tax benefit is happening, and this transaction lacks commercial substance. Therefore, GAAR is applicable into this transaction. Now, critically examine the following cases and discuss whether the provisions of GAAR will be applicable or not. Diva is an Indian company between two manufacturing units. Diva has two manufacturing unit, A, which is into SEZ, and B is in non-SEZ. Done, sir. Manufacturing activities are carried out in B. Manufacturing work is done in non-SEZ. Oh my god. While Unit A only does the packaging. So SEZ1 does only the packaging work. The manufacturing of the B. In the books of accounts, it showed that manufacturing is done. See, in books of accounts, all the manufacturing is done in A1. Now, what the cases understand? You have two unit, one is in SEZ, the other one is elsewhere. Now, major work of manufacturing is done in non-SEZ unit. But in books of accounts, they are showing that manufacturing is done in SEZ unit only. It is a clear-cut case of evasion. It is a clear-cut case of evasion. No strings, no doubts attached. It is a clear-cut case of evasion. It is just a evasion, nothing. It is not even avoidance. It is a clear-cut evasion. Tampering books of accounts would never amount to avoidance. It would always mean evasion. Jiva, an Indian company, has two units, C and D. One, C. Jiva has two companies. C is in SZ and D is in non-SZ. Now, it transfers the good manufactured by D to C at a price significantly. Now, there is shift of income from this place to this place. The Actually, this non-SZ is taxed at 30%, but SZ will not be taxed because of 10AA. In that case, it is shifting its income from this 30% to 0%. Therefore, it is a kind of avoidance happening. It is a kind of tax avoidance happening. Now, since we already have specific rules for that now, so therefore SAR would apply, GAAR would not apply. Specific anti-avoidance rule would apply, GAAR would not apply in this case because we do have specific rules now. Thus, now, question number 76. In the following independent circumstances, discuss whether provisions of GAAR would be applicable or not. What the case is? Right Inc., a company incorporated in country M, holds 1200 shares in PS, an Indian company, since 2016. Right is from country M and holds 1600 shares in India. Sorry, not 1600 but 1200 shares as per Indian. Okay, since 2016. On 1st May 2024, PS issued 1200 shares. Now, shares are held in PS Limited. Now, on this 1200 shares, of course, 1200 shares are given as bonus. Provisions is as per the treaty between India and country M, the capital gain are taxable in the country where transferor is the resident. That means capital gain is taxed in the country M only because he is resident in that country only. Tax laws between India and country M exempts the capital gain. It is exempt. Oh my god. Oh my god. Right, sold all the shares of the PS on 1st Jan 2025 and earned a capital gain of 5 crore rupees. Oh my god. What the cases understand this? Just think of it from the person who holds the share. I am person of country M. I invest in India. I get bonus as well. Now, I am not doing anything. I am not doing anything. My government and Indian government has made up an agreement that tax will be charged in my country. And in my country, tax charge is 0%. So is it anywhere my fault? Is it anywhere my fault? So it is not my fault. I'm not doing any avoidance. I'm just properly utilizing my treaty. It is a kind of planning only. It is not any evasion happening. It is not any avoidance happening. But this is not the answer that they would give. Why? Because the shares were acquired before 1st April 2020. They were acquired on 1st April 2016. If you if you're aware a bit, when the anti-avoidance rules came on 1st April 2017, they were applicable. So these transactions have taken place before GAAR coming into picture. And even if GAAR was not applicable on original shares, now it would not be applicable on bonus shares as well. Therefore, GAAR would not even applicable at all. GAAR would not be applicable because this is transaction before GAAR coming into picture. What if this transaction would have occurred after? What if this transaction would have occurred later on? Then whether GAAR would have been applicable? Right answer is in that case, GAAR won't have been applicable either. Why? Because this is not a evasion happening. Na? What's the next question? D Limited is an Indian company, incorporates wholly owned subsidiary company C in country X, which is a low tax jurisdiction with quality equity shares of 1 crore each. Out of the total equity share capital, company gives loans to C. Okay. The Indian company at the rate of 5% and no other activities. Chee, 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 chee. Now, what the case is? D Limited is an Indian company. It incorporated a wholly owned subsidiary in say country, whatever the countries. No, it invested 1 crore rupees to it, and again it itself gave 1 crore rupees as loan to it at 5%. Arey Baba. I am incorporating a subsidiary in some company. I am investing 1 crore as share capital. And I am getting that money again back as a loan. So there is net 5% outflow of interest. Net 5% outflow of the interest. Yes. Whether on this transaction GAAR would apply, sir, first of all, we have specific rules to this. We have specific rules in transfer pricing to this. In addition to that, GAAR would not apply because aggregate benefit to all the parties would be lesser than 3 crore rupees. Therefore, no GAAR would apply in this case. Got it, sir. Now, management. So now what the question is? This question, let me briefly tell you now what the case is. See, if you have an option to buy the assets and claim the depreciation of 30 lakh rupees, or you can even lease out that assets. You can take that assets on lease and claim leased rentals of 36 lakh. You have to decide between the two. You can buy them and claim depreciation, and if you don't want to buy them, you can take those assets on lease. You have two options. Now, what options did you choose? It absolutely depends, of course. Whether it would be considered as tax avoidance, no, it is never considered as avoidance. It is absolutely planning. It is always planning. It is always considered as planning only. Done, sir. Mr. Doval, I mean, not Dhaval, Dhaval, age 45, who is having investment in equity shares in India. Now he has a short term capital gain of 10 lakh rupees. Now he has STCG of 10 lakh. He was holding 1000 shares of SPR, which was purchased for 500. So cost of acquisition was 5 lakh rupees. Market price is 200. As on 31st March, he sold all the shares. That means he sold it for 2 lakh rupees. That means he had a loss of 3 lakh rupees. And then he bought back those shares again on the next day. That means again at 2 lakh rupees, he bought those shares. So he has a loss of 3 lakh rupees. Can the short term capital gain loss be adjusted? Is it evasion or planning? It is a kind of thing. Understand this. If I have some unrealized losses, can I claim those losses? Can I use those losses for my tax planning purposes? Yes, I can do that. It is called tax harvesting. It is legal in India. It is absolutely valid answer. Now, under treaty between India and country X, the capital gain from the sale of the shares of the Red Chili Limited Indian company. See, this is Indian company Red Chilies. It has share capital outside also. Now, what the agreement between India and country X is? If shares of Indian company are sold and value is held less than 10%, then in that case it would be taxed in country X only. But if value held is more than 10%, it would be taxed in India. Now, what this company did, this company created two subsidiaries. One is holding 9.95%, other is also holding 9.95% and transacting between the shares of the Indian company. Whether it would be taxed in India or not, sir, of course it would be taxed. The subsidiaries do not have any commercial substance. They do not have any commercial substance. Understand? Treaty says less than 10% to be held. Now, instead of actually holding less than 10%, you are creating multiple subsidiaries to hold less than 10%. Now, it is absolutely, these subsidiaries do not have any commercial substance. Your benefit of transaction exceeds 3 crore. Therefore, GAAR would be applicable for sure. Now, what this point says, Messrs RS Steels is a company incorporated in India. Its setup has two units, SEZ and non-SEZ unit. Same question. The company has transferred the product from SEZ to at a lower price. That means there is shifting of income. Whenever there is shifting of income, we do have specific domestic transfer pricing rules for that. Therefore, we have specific rules. Therefore, no general rules would apply. But at the end of every answer, you have to mention this down that these two things can coexist. That means SAR and GAR can coexist. This is the point they say. Come on to question number 80, that is DRC. So DRC, we have questions on DRC as well. We will solve that also. Arey sir, why are you overacting? We got that now. Simple question. Let's solve it. Now, Mr. Vijay furnished his return of income on for assessment year 25, declaring total income of 28 lakh. 28 lakh. He received an assessment order where income was increased by 5 lakh. See, whenever your declared income is up to 50 lakh rupees, your enhancement is up to 10 lakh rupees, and that order is not of search, not of any DTAA, not of any survey, then in that case, you can simply go to DRC. He is aggrieved by the said order and want to go to DRC. He informs you that there is no detention, no prosecution, but only penalties levied under 271D. That's the only issue he has. Can Mr. Vijay file the application before DRC? Of course he can file DRC. Of course he can go to DRC. Of course he can go to DRC. Income is up to 50 lakh, no detention, specified order, specified person, of course can go to DRC. If yes, what is the time limit? 30 days. But he has to take off the appeals. Whatever the pending appeals are there, he has to take that off. In addition to that, remember, does he has any option to go somewhere after the order of DRC? He does not. So the DRC order is done, you cannot go to any appeal. Now, what would be your answer if assessment order is based on information received by DTAA? See, if assessment order is based on DTAA, you cannot go to DRC. That's it. Penalties and prosecutions. Now, in penalties and prosecutions, we have single thing, two things to be understood. First of all, mostly they ask underreporting and misreporting. For underreported income, whatever the taxes are applicable, now you have to charge taxes. You have to charge penalty of 50%. For misreporting, you have to charge penalty of 200%. Understand this thing. Remember, whenever you file any return of income and your income is increased at the time of processing of return, it is not subject to any penalty. Any filed return is enhanced during the processing of the return is never subject to penalty. Whenever a process return is increased during scrutiny or during income escaping assessment, then penalty is applicable. Remember, penalty is only applicable when enhances only at the time of scrutiny or best judgment or any income escaping assessment, not during processing of return. Now let's solve it. Now see, we have with us a firm, partnership firm, filed 35 lakh, processed 45 lakh. There is increase of 10 lakh. Whether it is subject to penalty? No, sir. This 45 lakh was increased to 62 lakh. That means there has been 17 lakh increment. On this, 30% tax would be charged. 4% education cess would be charged. Whatever the taxes turn out to be, we would charge 50% penalty on that. Let's calculate. Let's calculate it. 17 lakh into 30% into 1.04 into 50%. All in all, it turned out to be 265 200, sir. If there is increase in income during the reassessment, then what would happen? There is 19 lakh increase. 30% tax into 1.04 surcharge education says whatever it turns out to be plus 50% would be the answer. 19 lakh into 30% into 1.04 plus into 19 lakh into 30% into 1.04 into 50%. It turns out to be 296 400. This is the amount of penalty applicable. 265 200 and 296 400. Same would go for company as well. See, it is a company. Let's check tax rate. Company is a trading company. Turnover is 402 crore, 401 crore. That means 30% tax is applicable. No. 12 lakh was the loss. If there is increase during the time of processing, whether it is penalized, no, it is not penalized. From processing till scrutiny, there is increase of 4 lakh rupees. This 4 lakh would be 30% tax plus 4% surcharge. Whatever the surcharge and tax turns out to be, 50% of that would be penalty. And at the time of second increment, then 8 lakh would be added into 30% plus 4%. This would be added plus 30%, 50% would be penalty amount. Done, sir. Same question. Sunrise Trading Company is a partnership firm. It is into wholesale trading of the electronic goods. Filed the return of income, declaring the income of 40 lakh. Now 40 lakh has been declared. The firm determined 40. Achha, the processing was done by increasing the 2 lakh of income. 42 lakh has been processed. On scrutiny assessment, the income was 58 lakh rupees. That means there has been increase in income of 16 lakh rupees. Now income is 58 lakh rupees by making certain additions. It is not misreporting. So if it is not misreporting, then whatever the taxes are turned out to be 30% plus 4%, 50% of that would be penalty. Now, the assessing officer being satisfied that underreporting initiated penalty proceedings, you are required to compute the penalty amount I had told you. Now, whether Sunrise can file an application for the immunity for the grant of the imposition of the penalty, what are the conditions to be satisfied? Understand. Whenever there is penalty, understand in case of underreporting whether penalty can be waived, yes. But in case of misreporting, can immunity be given? No. Only in case of underreporting you get immunity. Now, how to go to immunity? Whenever there is a reasonable cause of failure, you have to file this application to the assessing officer who is in charge. Tell him the reasons, he will give you the immunity. But remember, you should pay the relevant taxes, you should pay the interest, surcharge, whatever is applicable. File him the application within 30 days. And in addition to that, if you have any pending appeals, you should withdraw that. You should not go to appeals at all. Now, Sunrise can make an application to AO for immunity if it had paid the taxes within the period not preferred an appeal, and within 1 month from the end of the month of the assessment order, he should give the application. Done, sir. Now, come on to question number 83. It is a good question to practice. We have too many things to practice. By willingly or unwillingly, we have given too many questions unnecessarily. Thing is unnecessary. Fearless General Finance Investment Company is a residuary non-banking company, accepts public deposits, issues certificates, and repays the same over the period of time under different schemes run by it. Now, Fearless General Finance Investment Limited is a NBFC. Now, it takes deposits and repays the same. Whenever you take deposit, 269 SS is applicable. Whenever you repay, 269T is applicable. Always understand, during taking deposits or during repaying the deposits, NBFCs are not exempted from these two sections. NBFCs have to comply with these two sections. Always understand. Mr. A, an individual, has deposited 15,000 rupees. Okay, for first 15,000 deposited in May 2021, 48 months. Bear a check, sir. That means done in cash. Whether it would attract penalty? No. 20,000, no penalty. And another 15,000 rupees in cash for purchase of new certificate. Whenever he paid another 15,000 rupees now, then cash payment exceeded 50,000 rupees, 30,000 to 20,000 rupees, then entire 30,000 would be penalized. Entire 30,000 would be penalized because ultimately it has outstanding balance of 20,000 rupees. Therefore, any payment in cash would attract penalty since inception. Therefore, entire 30,000 would be penalized because outstanding balance exceeded 20,000 rupees. Mr. A applied for premature withdrawal. Now he was paid 16,500 via bearer check. Now he has an outstanding balance of 30,000 rupees. He applied for premature withdrawal, and at that time he was given 16,500 via bearer check. Remember, whenever you withdraw money or whenever the NBFCs repay the loan, you have to check the outstanding balance at the time of repayment. At the time of repayment, outstanding balance amounts to rupees more than 20,000. Since outstanding balance is more than 20,000 rupees, na, standing balance is more than 20,000, then this repayment would attract penalty. This repayment would attract the penalty. If you are not clear, na, I have a marathon in which I have told this entire logic how things go. Whenever you repay any sum, it would attract penalty. Whenever you repay any sum, it would attract any penalty if outstanding balance is more than. We don't have to check the amount of repayment. We have to check the outstanding balance on the repayment. Therefore, it would attract the penalty. And remaining payment, it says that 15,500 again is paid in cash. It would not attract the penalty. It would not attract the penalty because ultimately we have paid lesser in cash now. Yeah, outstanding balance is less than 20,000, so it would not attract the penalty. Now, what the case is, under what circumstances assessing officer can go for a provisional attachment? It is very logical question, very practical question that is being asked multiple times. Now, what the case is, understand. If you have committed a default under 271 double AD or any other section where penalty is likely to be imposed exceeds 2 crore rupees. Plus, assessing officer thinks that it is in the interest of the revenue to attach your property. Plus, he has taken prior approval of CIT. He can attach your immovable property, provisionally attach your immovable property for 6 months. Can he get the extension? Yes, 2 years extension is allowed, or 60 days from completion of assessment, whichever is later. He can extend your property. Done, sir. He can attach your property. Done, sir. 6 months or 2 years, 60 days, whichever is later. Can SSC use this property? Yes. Can he sell this property? No. If he wants to sell this property or if he wants to transact in this property, what can he do? He can submit a bank guarantee to assessing officer. What would be the amount of bank guarantee? Bank guarantee has to be the fair market value of the property. What would happen if this bank guarantee is about to expire? Assessing officer is going to invoke this bank guarantee. Or if tax was due on the SSC and SSC did not pay the taxes, the assessing officer is going to invoke this bank guarantee, and then this bank guarantee will be used to pay off the entire liabilities. Come on to question of the tax audit. Now, what the question of tax audit is? See, question is very simple. Questions from tax audit are very simple. Only issue in these questions are how to write the answers, and that is the major area of concern. I will try to explain you how to write the questions. You have to be very serious on how do we attempt questions. Understand this thing, huh? A search was conducted under 132 of the Income Tax Act in case of Element Jewelers, a gold jewelry retail chain, on 28th Feb 2024. As a part of post-search inquiries, billing software was analyzed and On the basis of analysis of the data, it was found that company was involved in violation of 40A3 in major way in tune of 20 crore of the purchase of the old gold. What the question is? This is a Element Jewelers now. Element Jewelers was under search. During search, computer records were found, and during computer records, it was found that this jeweler was used to buy the old gold. Some customers used to come up with their old gold, and this jeweler used to buy the old gold in cash. See, ultimately, you can buy anything, but payment has to be done in cash via banking channel. 40A3 clearly states that exceeding 10,000 you cannot pay to anybody. But provision says during the search it was found that 20 crore rupees payment have been made in cash. 20 crore payment, 20 crore payment. What was auditor doing? What was auditor doing? Let's see. In order to verify the foundings in the digital data, some of the customers whose whereabouts were available to the records were contacted and their statements were recorded under oath. These customers admitted under the oath that they had sold some old gold and received the amount exceeding 10,000 rupees. The fact which emerged from the inquiries is that Element Jewelers Private Limited old gold was made. See, ultimately it was identified. Customers were called, customers admitted on the oath that they were paid more than 10,000 in cash. That means this Element Jewelers has defaulted. It has defaulted. But the issue here is, what was auditor doing? What was auditor doing? Why didn't he report in tax audit report that payments in cash were made? Now, when being asked, understand, huh? However, the tax auditor had mentioned, yes, that means all the payments have been made by account paycheck. Auditor has submitted a statement that every payment has been done in account paycheck in compliance with 40A3. Wow. Tax auditor also said that standing instructions were given by the management to the of the entity to the employees to make. See, tax auditor said that I have seen the instructions. Management had given instructions to the employees. The payment exceeding 10,000 has to be done in bank channel only. Now, what auditor is saying? Auditor is saying, I have seen the instructions. Auditor has seen the instructions. Are you getting the point what auditor is saying? Management has just given the instructions. This is what auditor has seen. He has not verified the transaction. He has just seen the instructions. Now, what other point is saying? Understand? Huh? He has seen the instructions. Now, perfect. He further submitted that he has also received the representation. Or Baba, never be this kind of auditor. Never be this kind of auditor. He has also taken the representation from the management. Are Baba, you are asking chore whether he has done chori or not. Now he has taken representation from the management. Why management in ever sense would say that they have done the violation? In addition to that, he says that he has done some test check. Are Baba, 20 crore violation has taken place, and you are saying that you didn't find any of the violation in 20 crore test check basis. He It is absolutely correct. Auditor has done something wrong. It is absolutely correct that auditor is wrong here. First of all, he cannot rely on just instructions. He cannot rely on management representation letter. He cannot even rely on test check basis because this is the higher risk of material misstatement now. But issue arises, how do we write this answer in exam? We know auditor is wrong. We know auditor is guilty, but how do we write that answer in exam? That is the important thing now. So for that matter, we have to check the answer now. First of all, first paragraph would always include the section which auditor has done something wrong, where assessee has done something wrong. Now, first of all, section is 48.3, where any payment has to be done by account paycheck demand of electronic clearing system. Done, sir. Second paragraph will talk about tax audit report. Okay, tax audit report. Now, in the tax audit report laws number 21, chartered accountant is required to report any of the transaction that have taken in cash exceeding 10,000 rupees. Even ICAI's guidance on tax audit report mentions this thing clearly that any transaction has to be reported. This has to be told. Now, here you have to tell the opinion of the auditor and the nature of business. Now, since it is a risky business, where auditor has to take more diligence now. This is the high risk of material misstatement where auditor cannot rely on just a representation letter, where auditor cannot have just a test check basis. This is a risky business. In addition to that, auditor should have taken more test check basis. He should have taken more samples to take out the uniformity. He cannot just see the instructions. He can apply alternate audit procedure and multiple things. That means with respect to case, with respect to relating, with respect to understanding the provision, you have to write the third paragraph. Last paragraph will be based on auditor has failed to exercise the due diligence. Now, In this case, auditor is guilty. We have only two clauses. That means clause 7 and clause 8 in code of ethics. We have only two laws, two clauses. Clause 7 normally talks about your due diligence. If you do not apply due diligence, you are grossly negligent. Now you are guilty of that. But clause 8 is applicable where you did not get the sufficient and appropriate audit evidences. You did not get that. Now we are dicey which section to apply, whether section 7 would clause 7 would apply or clause 8 would apply. It is always advisable to mention both of them. In this answer also they have mentioned both of them because it appears from reading the question that both the clauses are applicable. If you don't know the answer, then do not mention any clause, it is better. If you think that both might apply, write both of them, but do not write the wrong clause number. It is always advisable, do not write the wrong clause number. Why? Because wrong clause number is not appreciated by ICAI. In this case, since he had not taken sufficient appropriate audit evidences, he just did work on the test check basis, very less sample taken. In addition to that, he has done something extra wrong things he has done. What extra wrong things he has done? He has relied on management instructions. That is not. Therefore, in this case, he has done violation. He shall be guilty under CA Act. Now, what are the consequences that you will see in the audit chapter, audit syllabus? I am not supposed to tell that. I am just there to tell you what the ethical compliances are with respect to tax audit. Come on to tax audit question. Very beautiful question. Double star rated question. Once you should hear it very carefully. Very good question it is. Now, what the question is? See, question appears to be very small, but answer related to it is very good. Okay. Understand this. XY and Z. XYZ in company is a partnership firm consisting three working partners A, B, and C. The answer. And one non-working partner D. Perfect. Engage in the business of manufacturing and selling electric kettle. See, whenever you hear manufacturing now, you should think of additional depreciation. Always this should come to your brain. Now, total turnover is 2.8 crore rupees. Consideration for transfer of new plot. That means a new plot has been sold at 57 lakh rupees. Profit on sale is credited to P&L. Okay. Sale took place on 1st Jan 2025. So this is the sale value. Cost value we would get to know later on. Cash receipts out of the first. That means out of turnover, cash receipts are 10.5 lakh rupees. Cash receipts via bearer check, cross check is 2 lakh rupees. Out of this 2.8 lakh, cash is 10 and bearer check and cross check is nothing but 2 lakh rupees. Answer. Amount of sales consideration for the plot received in cash. Oh, that means out of this 57 lakh rupees, cash receipt is 16.8 lakh. Oh, cash receipt for the plot. Total payments is 1.95 crore. Out of that, 4.5 lakh is in cash. Done, sir. Now, while making the cash payment, now one clerk was paid 12,000 rupees per month. 12,000 per month was paid. So that means 1 crore 144 lakh has been paid in cash. This has to be disallowed now. Net profit of the partnership firm is this and this. Why? What do we need to answer? Let's see. What do we need to answer? This year, firm does not want to maintain books of accounts and audit advice whether what it can do. What will be the total income if it does not want to maintain books of accounts? If it does not want to maintain books of accounts and get audited. See, whenever a firm doesn't want to maintain books of accounts and audit, then they can get their return filed under 44AD. Now, 44AD is normally available to those entities who have turnover up to 2 crore. Now, in this case, how much turnover they have? They have turnover of 2.8 crore rupees. Whether they are applicable for 44AD, sir, we have a provision that if 95% of the turnover is received via banking channel, then they get 44AD benefit. Now, 5% in cash is allowed. What is the 5%? Out of 2.8 crore, 5% is 14 lakh rupees. 14 lakh in cash would be applicable, would be allowed. Now, 14 lakh in cash would be applicable. Perfect, sir. How much they have taken in cash? 12.5. That means 12.5 they have taken in cash. 12.5 lakh they have taken in cash. Now, how much it turns out to be? 5 less than 5%. That means for them they can claim 44AD as well. How much would be their profit? See, 2.8 crore rupees. Out of that, 12.5 lakh is in cash. 2 crore 80 lakh minus 12 lakh 50,000. That means 267.5 lakh would be via banking channel. On cash, we have to offer 8%. On banking channel, we have to offer 6%. Let's into 6% M plus 12 lakh 50,000 into 8% M plus. It turns out to be 17 17.05 lakh is the income on this business as per 4480. Let's see now. See, interest and remuneration is not allowed to partnership firm whenever they opt for 4480. Done, sir. Additional information, firm has brought forward business loss. See, if partnership firm has brought forward business loss, then this can be set off. Yes, this can be set off. Business loss, brought forward business loss can be set off from this partnership business. Okay. Firm acquired a plot in 2019 for 12 lakh rupees. CIA is given now since 57 lakh is the sale value. Firm had acquired this plot for 12 lakh rupees. That means 45 lakh is the gain amount now. And this will be this will be capital gain. So total income would turn out to be 61.3 lakh would be total income as per 4480. This is my humble submission. This is my humble submission. This is the total income as per 4480. Let's see. Oh my god! Oh my god! Absolutely correct. Absolutely correct. Why are you shouting? We got now. We know that you will get correct answer only. Hey, I always get excited when I get the right answer. You know, I always get excited, and it's a proud fact. I always say. Now, what second part of the question says? Compute the total income of the firm, assuming that instead of 2 lakh, the firm received 4 lakh rupees via other than account paycheck. Now, this is cash receipts, and out of this 4 lakh rupees, 2 lakh rupees, they received 4 lakh rupees in cash. If you take 2.8 crore, we can take 5% in cash. That means 14 lakh we can take in cash. But now we have 14.5 lakh in cash. That means whether 4480 is available? No, sir. 4480 is not available. 4480 is not available. Now it has to get its books of accounts audited. It has to get its books of accounts audited. Yes, sir. It has to get its books of accounts audited for sure. Now for audit, turnover has to be more than 1 crore, if you remember. But there was a condition now. There was a condition that if there 95% of the cash receipts are in banking channel, but 95% of the payments are via banking channel, then they are not required to get audited up to 10 crore. We have to check this condition as well. We have to check this condition as well. Now, how do we check that? See, payments made are 1.95 crore. We would take 5% of that. 1 crore 95 lakh into 5%, which would mean 975. Whether payments are in compliance, yes, payments are in compliance. Payments are up to 5% only. Whether receipts are in compliance or not, see, we have total receipts of adding both of them would give us total receipts 2 crore 80 lakh plus 57 lakh. Total receipts are 337. Out of that, how much 5% is allowed to us in cash? That means 16.85 lakh is allowed to us in cash. But sir, 16.8 for the property we have taken in cash. That means more than 5% are in cash. Therefore, limit of 10 crore is not applicable to us. Limit for 4 crore would only apply to us. Okay, sir. Done, sir. Now we would have to get our books of accounts audited. For that, they have given us 8.65 lakh rupees of net profit. After debiting and crediting the following items. So 15% is the interest on capital on 10 lakh rupees that has been authorized. Oh my god. Now capital is 10 lakh rupees on which 15% has been allowed. How much it has been paid? 1,50,000 rupees has been paid. 150 has been paid and has been debited. Ideally, how much it should be? 120 should be only debited. Ideally, this is the case. 150 has been paid, but ideally 120 should be paid. So 30,000 has to be added back now. 30,000 of the interest has to be added back if I show you. Yes. Now, what else things have to be done? Understand there have to be certain adjustments to be done. Understand there has to be certain adjustments. What adjustments to be done? Understand this very carefully. Turnover, no adjustment. Lot sales, sir, these sales have been credited to P&L. Profits have been credited to P&L. 57 lakh is the sales value, 12 lakh is the cost value. That means 45 lakh have been the profits that have been credited to P&L. This has to be removed from here. Cash receipts, ignore. Receipts by the way of account paycheck has to be ignored. Plot sales, cash sales have to be removed. In addition to that, 140 is to be added now. 144 is to be added back because that is paid in cash. This would give us the profit for remuneration. How much it would be? 865 plus 30,000. minus 45 lakh minus 1440 37.49 lakh. Am I doing it correctly? Whether cost of acquisition was correct? Now cost of acquisition seems to correct. Answer theme seems correct. Seems correct. Let's see. Oh, we have also paid the remuneration as well, now. 60,000 per month has been remuneration. Each partner, that means 4 partners for 12 months. That means this is the remuneration now. Oh my god, sir, remuneration is to be added back because this is not allowed. We will allow remuneration as per our own limit. This is our life. 20, 865 plus 30,000 minus 45 lakh plus 144 plus 288,000. And 581 is the net loss. 581 is the loss. PGBP. Yeah, or I should say loss from business and profession. PGBP. It is a loss. On this, we would get deduction of remuneration also. Of course, remuneration paid is up to, in case of loss, 3 lakh remuneration is allowed. That means 881 is the amount of PGBP. It is the loss. It is loss in case of PGBP. We have a brought forward loss as well. Can this be carried forward? Yes. Can this be set off? No. Brought forward loss cannot be set off against any other head. Na? So we have loss here in this year as well. So what would happen? 881 would be carried forward. In addition to that, we have capital gain of 45 lakh, and this would set off from each other. Business loss can be set off. Current year business loss can be set off from this capital gain income. Let me see what the answer is, if it is correct. 881 is the current year loss. 45 lakh is the business income. If we set them off, how much our total income turns out to be? Income turns out to be 36 lakh 19,000. That is the answer. Oh my dear God. Oh my dear God. This was frightening question, and this was a frightening question. I mean, how much to write, what to write, it is always a question in these type of question. But of course, these type of question would yield you marks. These are important questions which would make your paper tough. Of course, practice requires for this question. Question number 87. ABC, an Indian company engaged in producing electrical equipments during financial year 24-25, paid interest of 95 lakh rupees to James, a non-resident associate enterprise, on borrowing or monies borrowed from it. Okay. On 1st April 2024, ABC Limited borrowed 5 crore rupees from George PLC and interest at the rate of 10%. George PLC is a foreign company in which ABC holds 20%. Oh, okay. Okay. James PTC deposit 2 crore to George. Since interest is paid to a non-resident associate enterprise, it does not exceed 1 crore rupees for financial 24-25. Provision of 94B are not applicable in the case. As per the opinion of the tax auditor, interest of 20 lakh rupees paid to George PLC shall be 94B would be applicable. Oh my God. What the cases? Let me tell you. Let me tell you the case. What the cases? Now, ABC is a company. And what are the transaction parties? We have with us James and George. James is an associate. They both are associates. Indian entity paid 95 lakh rupees interest to James. It had borrowed 5 crore rupees from George. On this 5 crore, 10% interest is paid to by ABC. That means 50 lakh interest has been paid by ABC. George and ABC has 20% shareholding in common. Now, what the case is, James has deposited 20 lakh 2 crore rupees to George, and out of this 2 crore rupees, 2 crore rupees has been distributed, and remaining 3 crore have been distributed out of the own pocket. That is how 5 crore has been arrived at. That means directly we are paying just 95 lakh rupees to James. But James has given 2 crore rupees to George. George took this 2 crore rupees, added 3 crore rupees, and gave this entire 5 crore to ABC. That means, can I say that out of the 5 crore payment, 2 crore interest has been applicable to James only? 2 crore amount has been to James only. And this is what auditor says. This is what auditor says, that ultimately 2 crore have been indirectly given to you by associate only. So whatever the interest that you are paying with respect to 2 crore rupees has to be added. Whatever interest you are paying on this 2 crore rupees is paid to associate enterprise. That means 20 lakh is to associate enterprise. That means interest paid to associate is 115. Therefore, 94B is applicable. This is what auditor said, but assessee says it is not applicable because ultimately it is not a corresponding amount. See, loan from a third party is considered as loan from associate only if as a third party, only if associate deposits the corresponding amount. Now, it is not corresponding. So assessee says it is not corresponding amount. 5 crore loan is given, and out of the 2 crore is given by associate. So it is not a corresponding amount. So assessee and auditor are in argument. The issue here is we don't have to answer the fact that assessee is correct or auditor is correct. We don't have to answer that. People tend to get confused whether assessee is correct or auditor is correct. We don't have to answer. We have to just tell the reporting requirements. Now, examine the reporting requirements if any in case of audit. Now, whenever there is a disagreement between auditor and assessee, what auditor has to do? See, for in the cases, we have to explain the provisions. We have to explain the provisions of 94B. We have to explain the provisions as per that 90 section 30, clause 30. We have to report these things. We have to explain the clauses as well. 94B clauses. In cases, we have to mention as well that auditor is required to report these things. Now, conclusion we don't have to give at all. We have to write down reporting requirements. Now, reporting requirements are such that auditor has to report both the opinions. In 3CD, he has to report both the opinions, whether what assessee says and what auditor says. He has to appropriately mention this difference of opinion in 3CB or 3CA, whatever the case is, he has to mention this difference. In case he has been restricted from getting the opinion, he shall qualify his report. These three things he should do. If he fails to do that, he shall be guilty under CA Act. So that is the case. This is the reporting requirement. He should appropriately tell both the viewpoints, and he shall clearly mention that there is difference of opinion. Therefore, he shall give both the opinions so that tax authorities can take a final judgment. Done, sir. Black money law. The black money law. Okay, no issue na. We'll solve every question na. Deepak, age 45, has been settled in California, USA since 2015. Prior to that, he has been in India. He has always acquired residential property. Oh, no. He has been in California in 2015. He has been always or been in India before that. He had acquired a property in California in 2009. That means when he was resident in India, he acquired a property for 20,000. That means can this be taxed in India? Yes, it will be taxed in India. Because either he should be resident of current year or he should be resident of the year in which he acquired the property, then property is covered under black money law. He kept a bank account deposit in New York since 2010. That means, see, property of 20,000 can be taxed and 10,000 rupees bank account can also be taxed. Both the things can be taxed. Now, a notice was issued under black money law on 20th September, 20th October 2024. Whenever notice is issued, now that year is considered year of taxes always. Whatever the date on which notice is issued, now you have to consider 1st April of that previous year. That means 1st April 2024 is the valuation date. That is the date on which valuation is to be done, and that is the date you have to use for conversion purposes as well. For conversion purposes also, that date is only used. Now, understand, huh? The fair market value of the residential value on 1st April was 25,000. See, we have to check 1st April 2024 only. 20,000 is valued at 25,000. On 1st April 2024 is only to be checked. Remaining figures 25 is not valued. Other dates are not valued. Bank deposits with interest accrued was 12,500 1st April. Other dates are not to be checked. That means this bank account is 12,500. Oh, done, sir. The currency exchange rate is given 1st April. Others are not relevant. So this 25,000 has to be converted with 71. This is converted. Done, sir. On this bank account, 10,000 is the bank balance and 2,500 is the interest portion. Both of them have to be converted with 71. But what it is asking, compute the value of undisclosed foreign assets chargeable to tax in India. Not the income, but the assets. So 2,500 is the interest accrued. So we would not charge taxes on that. 10,000 to 71. In 7 lakh 10,000, 75 is the right answer. This is what they have done. Ideally, it seems illogical, but that is what they have done. We also have to do. If they are asking total value of the total value on which black money law should be taxed or black money law should apply, then 12,500 would apply. But in this case, they have only asked the assets, so we would only charge taxes on assets only. Now, Mr. Rohit is an Indian citizen returned to India in March 2013 to assume the office of a CEO of ABC Private Limited, an Indian company. He served in the capacity from 1st April 2013 to 31st March 2020. Prior to this, from May 2020 to Feb 2023, he was working as renting in the USA. In April 2020, he went back to USA to rejoin the permanently. Now, what the case is, understand the timeline. In 2013, he came to India. April 2013, he came to India. Before that, he was in USA. He came to India till 31st March 2020, up to COVID year. He came to India. That means that was the red part. And beyond that, he went USA. That means that would be blue part. Now, somebody won't get offended. Why did I draw the red part when he was in India? Don't get offended on that. Huh? Again, he went back to USA. But yeah, let's stay away from the controversies. Let's mark it as black or Republic. Black will give me more, put me into more controversy. Orange, 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 orange. We Indians are orange ones. Orange army. I mean, I am very much afraid about the current going scenarios. Indian era is orange era. Orange era. I don't want to get into other details of that. Okay. Now, Rohit visits India every year. That means he is non-resident. If it was found that when he was CEO of India, he had accumulated. When he was CEO in India, he accumulated certain things. He accumulated multiple things. He accumulated multiple assets. Now, shares of listed company on 10th December 2012. Shares of company. Can this be taxed? Sir, in current year, is he resident? No, sir, he is non-resident. When he acquired the shares, was he resident? Sir, he was non-resident. Therefore, can this shares be taxed? No, sir, it cannot be taxed. Acquired apartment in London 2015. London apartment. Can this be taxed? Sir, when he acquired the asset, he was resident. Now, can this be taxed? Yes, it can be taxed. Establish a leather manufacturing unit in Malaysia. That means 15th April 2020. Malaysia for this year, for previous year 2021, whether he is resident, no sir, he is non-resident, therefore it cannot be taxed. He also earned income by the way of commission from various buyers between 13 to 20. Now, for this period, for this black period, 13 to 20, 13 to 20, when he was resident, he took some commissions as well. Can this be taxed? Can this be taxed? Sir, for that matter, when the notice was issued in April 2024. Now, whether can money be taxed? Sir, money can be only taxed when it is received after 1st April 2015. After 1st April 2015, only then only money can be taxed because that was the year in which black money law came into picture. Therefore, any money received prior to 1st April 2015 cannot be taxed. After that, any money can be taxed. That's the simple solution to the question. That is point number 89. Oh wow, sir. Oh wow. Answer. Let's solve non-resident taxation. Question number 90. Examine with reasons whether the following transactions attract income tax in India in the hands of the recipient under Section 9 of the Income Tax Act 1961 or not. A non-resident German company which did not have permanent establishment in India. A non-resident German company did not have permanent establishment in India. Entered into an agreement for execution of electrical works in India. Separate payments were made towards drawing and designs which were described as engineering fees. Assessee contended that this is the business profit and it is not taxable. It does not have any business connection. See, German company providing engineering services in India. German company is saying that it does not have any it does not have any permanent establishment in India. Therefore, it is no business connection would be established. No business connection, no income in India, no tax in India. Now, whether it is correct or not, it is absolutely incorrect. German company may or may not have any office in India. It is irrelevant. It may or may not have. It is kind of technical piece. It does not depend upon any physical barrier. It does not depend upon any permanent establishment. Whether a technical piece is paid, it is absolutely taxable. Always taxable. It is always Indian income as per Section 9, subsection 1, clause 7. Firm of solicitors in Mumbai engaged a barrister of UK for arguing a case in Supreme Court of India, paid £5,000 as per the terms of professional engagement. Now, what the case is? Now, since we have a Supreme Court, Supreme Court, Supreme Court. Now, in India, there is a law firm. It wanted to argue in Supreme Court, but for that matter, they require help of a US firm, US barrister. Now, US barrister argued via online mode, whatever the mode they wanted to argue, they argued on Supreme Court, and for that matter, this Indian company paid $5,000. Now, whether this should be treated as technical fees, ideally this should be treated as technical fees, now, but this is not the answer that they have given. They have given answer that it is a kind of professional engagement. Professional engagement, like we have business connection now. They said it is a kind of professional connection established. There is a professional connection established. Therefore, this would be taxed in India. Ideally, it is a technical fees that because of it should be taxed, but they say that it is a professional connection, the professional connection because of which it is taxable in India. So we would put a star mark to this and we would learn this point. Amount paid by government for the use of the patent developed by Mr. A, who is a non-resident. Whenever government pays any money for the patent purpose or for any royalty government pays, now it is always tax in India. Always tax in India, it is Indian income. Sai Limited, a non-resident manufacturing company, entered into collaboration agreement on 25th June 2024 with Indian government. And it was in receipt of 8% debentures of 20 lakh rupees issued by Indian company in consideration of providing know-how. Now what the case is, understand. Non-resident provided services. In relation to that, no money is paid, rather debentures are paid. 20 lakh debentures at the rate of 8% interest was paid. Now whatever the money that it is going to on account of debentures, whatever the debentures are issued, now that is a kind of professional fees only. Any repayment of debentures would be taxed in India because it is a kind of payment of professional fees only. And interest shall also be taxed in India only. Now, question number 91. Singtel Limited is an Indian company incorporated. It is a company incorporated in Singapore. 55% of the shares are held by Godavari Company, an Indian company, and it has presence in India as well. Singtel has the balance sheet as given below. Now what data is given below. Now what the case is? This is India. India has a Godavari, and Godavari holds 55% in Singtel. Now, if parent company is located in India, will it make this foreign company as resident? It will never make it as resident. Whenever a foreign company is outside India, whenever a foreign company is outside India, it would never make such company resident of India. See, just because subsidiary, it is our subsidiary, it does not mean it is resident. For that matter, we need to check the poem. We need to check the poem. Without poem, we cannot determine that just because being a subsidiary would not make poem India. Understand? Parent subsidiary relationship is good for decision making, but it is irrelevant for the purpose of poem. For poem, we need to check the assets, ABOI test we have to check, and the other thing we have to check is decision making. Now, in this case, we have to check ABOI test. Now, for that matter, Indian assets are given, Singapore assets are given. We have to check asset related tests, we have to check payroll related tests, we have to check employee related tests, we have to check the income related tests. Four things we have to check, and board of director meeting. 5 tests we have to see. Now, fixed assets given, Indian assets are 120, the Singapore assets are 20, intangible assets are 50 and 200, other assets are 40 and 120. If we check the total Indian assets, now it would turn out to be 210. If we check the total Singapore assets, it would turn out to be 400. That means total of 610, 210 assets are located in India. That means less than 50% are Indian only. Now, so asset test is met. Less than 50% assets should be located in India. It is met. Now, this is with respect to operations. We will see number of employees. 70 employees are Indian, 90 employees are Singaporean. That means out of 160, 70 are Indian. That means less than 50% of the employees are Indian. That means that is also met. Payroll expenditure, Indian payroll expenditure is 8 crore and other payroll expenditure is 12 crore. That means out of 20 crore, 8 crore is Indian. That means less than 50% in it is Indian. That means this is also met. Only condition left is income. We will see. Now, income from trading operations is 25 and 50. Income from transaction where purchases are from associate enterprise and sales to unrelated. Purchase from associate, sale to unrelated, it is not passive income. Purchase from a transaction where sales are to associate and purchases from unrelated, sale to associate, purchase from unrelated, is it passive? No, sir, it is also not passive. Transaction where both purchase and sale are to associate, it is passive? Yes, it is passive. Interest dividend, whether it is passive? Yes, it is passive. So what will be total income? Whatever I am highlighting in blue will be total income. Just do a total 25, 50, 25, 50, 20 and 15. This will give us total income. Do a total of it, 25 plus 50 plus 20 plus 15. Total income would turn out to be 110. Out of this, how much would be the Indian income? Sorry, how much it would be the passive income? This 5, 10, 15, 20. This will be our passive income. 5 plus 10 plus 50 plus 20. This means 50 is our passive income. Can I simply say up to 50% only is the passive income? Up to 50% only is the passive income. Can I say yes, sir? Absolutely, you can say. Therefore, passive income criteria is also met. Board of director. If we see the board of director, 8 board meetings have been held. Out of that, see, understand this, huh? Understand. 3 in India, 5 in Singapore. That means total 8. That means less than 50% of board meeting have been held in India. Therefore, board of director criteria is also filled. That means all the criteria are filled. That means this company doesn't have OM in India. It is a non-resident company. This Singtel Limited is absolutely non-resident company. Same thing that we have said now is discussed here. Clear to this point? Clear to this point. Come on to question number 92. What this question number 92 says. Acer's Bid2 Inc., a FII investor, has furnished you the following details for the financial year 24-25. So it is about FII taxation. Basic things clear. Now, short-term capital gain. Now, what short-term capital gain is? It says STD purchase, STD paid at the time of purchase and sale. That means short-term capital gain will be 111A. Sale proceeds on company A will be 1690, and cost of acquisition is 6 lakh. That means 10 lakh 90,000 is nothing but the profit. And since it is sold after 23rd July, that means it would be taxed at the rate of 20%. Done, sir. Then we have sale proceeds on sale of equity shares of company B. Okay, 1150. Cost of acquisition. Now see, sale is after 23rd July. Cost of acquisition is given to us. That is that means we have short-term capital gain, and that will be other STCC because we did not pay any STT on this now. Since we did not pay any STT, it would be taxed at 30% only. So whatever the gain is, 11,50,000 minus 565, 585 into 30%. Done, sir. Long-term capital gain, whether did it mention that it is STT paid or not, sir? It did not mention anything. It did not mention anything. Therefore, what would happen? We would not consider it as 112A. It is normal LTCG. Sold on 13th Jan 2025. See, whenever we have long-term LTCG, it would be taxed at 10%, even before budget also and even after budget also. This is the only section in income tax which had not undergone any changes. So, 55 lakh minus 26 lakh would amount to 26 lakh rupees. Into 10%, this would be our answer. Indexation irrelevant, completely irrelevant. Interest on securities, interest received on Indian companies' investment in RDBC. Things made very simple. Whatever interest FII receive will be taxed at 20%, irrespective of RDB, irrespective of the instrument. Whatever investment they do in India, they would be taxed at 20%. That's it. Only exception to that is infrastructure debt fund. If they receive infrastructure interest from infra debt fund, then only 5% tax rate is applicable. Otherwise, in every case, it will be 20%. Every case. Now, see, since word mentioned here is rupees, so 18,50,000 has to be grossed up, has to be divided by 79.2 because 20 plus 4% TDS would have been deducted on this. 18,50,000 divided by 79.2%, which would mean 2335858 into 20% would be tax rate. Dividend would be taxed at 20%, and other income would be taxed at 20%. If I may highlight it for you, then our total income would turn out to be this much. Then 90 into 20%, 30 into 585. Just give me a second. 10,90,000 into 20% M plus. Then 585 into 30% M plus. 26 lakh into 10% M plus. Oh my god. Calculation error. 26 lakh into 10% M plus. 2335858 plus 225 plus 8 lakh into 20% and plus double MRC. Did I do some mistake here? It feels like 2335858 plus 225 plus 8 lakh into 20% and plus. Then we have 26 lakh into 10%, 85. Tax amount turns out to be 13,25,671. Let's check it. 13,25,671. Answer is absolutely correct. Now, issue here is how much total income turns out to be. See, total income, if you all add now, it will be more than 50 lakh rupees. It will be more than 50 lakh rupees. Now, whether surcharge would be applicable or not, the fact is, ideally, surcharge should be applicable. It should be applicable. See, and FIIs are normally AOPs. FIIs are by default AOPs, but what exception they use? See, it is a foreign ink. Inks are company. It is a foreign company now, registered as foreign company in that country now. Therefore, it is considered as a foreign company. So both interpretation they assume. In some cases, they treat it as AOP and charge surcharge. In some cases, they don't assume it AOP. They would treat it as company and they would charge surcharge based on a foreign company. So what we have to do, see in this case they have given as AOP, but alternatively they have also given an answer as company. What you have to do is, if Inc mentioned is there, if it is mentioned it is foreign company, then use the surcharge of the company. If nothing is mentioned, then use AOP. See, understand this thing. Whatever you do, you just write down the note in the bottom. This will help you to get the answer. In this case, they have assumed, therefore they have added 10% surcharge. Done, sir. Come on to question number 93. XYZ, an Indian company, is engaged in the business of manufacturing and packaging of mineral water. Its manufacturing facilities in India. XYZ, okay, is the wholly owned subsidiary of Flix. Oh, okay. Mm-hmm. The company incorporated in country M. Oh. Hmm. Angelo and James, the citizen of country N, each of them hold 50-50% in the Flix. Okay. Angelo and James each had invested 100 crore in 2015. Oh my god, see what the cases understand. We have an Indian company called XYZ. This is 100% subsidiary of Flix. Now, Flix is held by two people, Angelo and James. 50% is being held by him, 50% is being held by them. Both of them invested 100 crore rupees. Now, what the provision says, on 1st June 2024, Angelo and James received an offer which they believe is fair and sold the entire stake of Flix to Ishan, the country resident of country N, at 350 crore each. The entire shares of 50% has been at sold 350, and entire shares have been sold at 350 only. Both the cases 350 is the value. The accounting period of Flix is January to December. Okay. The relevant extracts of the balance sheet has been given as on 31st March 2024, 1st June 2024, and 31st December 2024. First of all, after the transaction, a balance sheet is not relevant. What the cases understand? First of all, what the cases? We have a foreign company, we have a foreign seller, we have foreign buyers. Everything is outside India, sir. Therefore, nothing is in India. Only thing is to be taken care of is whether this foreign company derives its value from Indian assets or not. Only thing we need to see, that if this foreign company derives its value from Indian assets or not. That is the only thing we need to see. In that case, what would happen? Understand, in that case, how do we determine? First of all, we need to find out the valuation date. Valuation date is to be either of two: the last balance sheet date or the date of the transfer. Which date to choose? See, take all the book value of the assets on the last balance sheet date and compare it with the book value of the asset as on the date of the transfer. If increases by more than 15%, in that case, what would happen? Date of transfer would be taken as valuation date. Now, in this case, Flix book value of assets are 1000 as on the balance sheet date. But on the transfer, it turned out to be 1300. Therefore, increase is more than 15% now. Therefore, again, the date of transfer is relevant. Every valuation will be done on date of transfer. It is very important. If you miss out on the date of date of valuation, your answer would change substantially. Your answer would change at all. Therefore, it is very important for you calculate the date of transfer properly, date of valuation properly. Now, we have got this value, we have got the valuation date. Now, on valuation date, we have to check the FMV of Indian assets upon FMV of the total assets without liabilities reduction. So, total value is 1100. fair market value without reducing liability, and Indian assets are 600. That means Indian assets are 600 out of 1100 of total assets. That means 54.54% is, that means out of 1100 crore of assets, 600 crore are Indian. And can I say more than 50% are Indian assets? Yes. More than 10 crore of the 10 crore is the worth of Indian assets? Yes. Both the conditions are satisfied. Therefore, this mix is located in India, and whatever the capital gain this Angelo and James are having, that would be taxed in India. How much capital gain it is? They are having 350 crore minus 100 crore. That means 250 crore each capital gain is having, but not this entire capital gain would be taxed in India. Only 54.54% would be taxed in India. That is the only thing. Divided by 1100. Only 250 into 54. That means only 136.36 crore would be taxed in India, because only 54% are the assets located in India. Simple point? Yes, sir, simple point. If you really feel it was simple, do like the video now. Every solution to every point. If you like, if you felt it simple, like it, like the video. If you like my content, just subscribe to the channel. If you really like, if you really want me to support, share it with your friends now. Share it with your friends. Question number 94. Robert, a non-resident, provides a ship for carriage of goods, passengers, and livestock between Dubai, Mumbai, and Chennai. See, it is a kind of ship. Therefore, 44B would come into picture. Whenever we have a provision called 44B, we have to take care of two things. Goods that have taken out of India, freight collected anywhere in the world would be considered. Second thing, goods that have come to India and freight have been collected in India. So it has to be freight in India, or it has to be freight for the goods of India. It has to be either of will be added. Received in India, oh, received in India would be taken. Received in India, 50 lakh taken, add. Received in Dubai, Dubai. But for the goods of India, that means goods from Chennai to Dubai, therefore this has to be also added. Expenses incurred, sir. Expenses are not allowed under 44B. Gross winnings from horses is 25 lakh rupees. So what their sales are? 200 plus 50 plus 65. 315 is the sales value. On this, they have to offer 7.5% as their PGBP. That means 23.625 is the total income. This is the business income. This would be taxed at the rate of slab. 25 lakh, it would be taxed at the rate of 30%. Total income chargeable to tax in India. Also compute the tax liability. See, assume they shift out of default tax regime, so this would be taxed as per old regime. Answer is same, 23.625, 25 lakh. On this 23.625, now you would be charged to taxes at slab. And on remaining income, you would be charged 30%. Add education cess, and you would get the final liability. Question number 95. What question number 95 says? Mr. Bisht, not Bisht, Mr. Bisht, a dusht insan, like Bisht. Mr. Bisht is a non-resident individual who earned interest of 12 lakh rupees from an investment made in notified infra debt fund set up in India, eligible for exemption under section 1057. Now, what provision is? Mr. Bisht is somebody who is a non-resident. There is infra debt fund, and Mr. Bisht is somebody a non-resident, and he is earning interest from infra debt fund. Perfect, sir. Further, he incurred an expenditure of 15,000 for earning such interest income. So he earned 12 lakh rupees of interest and spent some expenditure. See, non-resident spending any money on the interest income is not allowed. Any income which is taxed at special rate, na, we do not allow any deduction on such incomes. Therefore, this is not allowed. Answer. Examine the tax treatment in the hands of the fund and the Mr. Bish. See, fund is required to deduct TDS at the rate of 5%, and same interest would be taxed in the hands of Mr. Bisht at the rate of 5%. Justify your conclusion with the relevant provisions of income tax in two scenarios. Mr. Bisht is a residing person of notified jurisdictional area. If Mr. Bisht stays in NJA, then it would be taxed at the rate of 5% only, but TDS would be deducted at 30%. It would be taxed at the rate of 5%, but TDS would be deducted at the rate of 30%. But if it is located in outside NJA, then 5% TDS rate, 5% tax rate would apply. Mr. Bish is stationed outside. Will there be any change in answer if income is earned because of technical services? Say if technical services is paid now, then 20% is the tax rate, 20% is the TDS rate. But if the SSC is located in NJA, then 30% is the TDS rate and 20% is the tax rate. Tax rate remains same for the purpose for the people in NJ. Only TDS rate changes to 30%. That's it. Come on to question number 96. A good question. Ioni is a company incorporated in Japan, is engaged in development of infrastructure and providing consultancy in the same field. During the year, its shareholders met in India for 3 times. The first 2 meetings were held to discuss the modification of the right attached to the various class of the shareholders. And third meeting was to discuss and decide about the sale of the company's assets situated in India. It provides additional information. Wow. See, understand. Vioni Inc. is a Japanese-based company, and this is India. Remember, shareholders have met. Board of directors didn't meet. Unless board of directors meet, we cannot decide the poem, irrespective of the fact. Shareholders are irrelevant for determining the poem. Now, dividend declared by Miyani, a Japanese-based company, 54,000. See, Vioni received a dividend from Miyani. Both are Japanese-based company. Miyani holds 70% of the total assets. Oh, this Miyani is located substantially. It derives substantial value from asset located in India. Derives substantial value from asset located in India. Oh, that is what the point is. Okay. See, whenever a foreign company's assets are being sold, whose value is derived from Indian assets, then transfer is located in India, transfer and tax in India. But if such foreign companies distributes any dividend, it is not taxed in India. Only capital gain is taxed in India. No dividend is taxed in India. Therefore, this is exempt. This is not taxable. Not taxable at all. Wow. Fees for technical services from the government in India. The government utilizes such services for development of project in Nepal. See, whenever government of India pays any FTS, it is irrelevant that for what purpose it is used. It is used in India or outside India. It is not relevant. Whenever any money is paid by the government, it is clear cut assumed. It is clear cut assumed that it is taxable in India. Therefore, this 454 would be simply taxed in India. What they are asking us just to compute the total income, not even tax, but just the total income they want us to compute. Now, interest received from Mr. O, a unit located in IFSC in respect of money is borrowed. See, whenever money have been lent to unit in IFSC, on or after 1st September 2019, it is always exempt. Interest on that is always exempt. Therefore, it would not be taxed, not taxable. Last thing, on 26th June 2024, Vioni sold 5,000 shares held in an Indian company. Sale value is 89. These shares were bought on 2011 at 64. That means cost of acquisition was 64. Sale value was 89. And average, fair market value as on 31st Jan was 70. So our cost would be 70, else 89 minus 70 into 5,000. That means 19 into 5,000. This would mean that 95,000 is the capital gain. So our answer would turn out to be 554. 554 plus 95 will be our total income. 554 plus 95 will be our total income, and this would give us the total income of the entire entity. Simple question, easy peasy. Simple question, easy peasy. Yes, sir, easy peasy. Come on to question number 97. What this question number 97 says, it is also a good question. See, whatever the questions we have in non-resident taxation, and these are good questions. By default, these are good questions. You should try them. Now, Trex Limited is a company incorporated in country T. We have with us country T, Trex. Now, compute the total income and tax liability of Trex for assessment year 2026, assuming it has its OM outside India. That means this is a non-resident company. Answer. Interest of 285 earned on debentures of 30 lakh rupees issued on 1st August 2024 in collaboration with providing technical know-how to MNO, an Indian company, for the purpose of business carried out in India. Understand this thing. Whenever foreign company brings any money to India and interest on such borrowing is paid, then it is taxed at 20% under 115A. We are aware of this fact. But in this case, whether any money flow is coming to India or not, no sir, money flow is not coming to India. In no case money flow is coming to India. So at what rate it would be taxed? It would be simply taxed at the rate of 35%. The interest of 285 would be simply taxed at the rate of 35%. Sir, done. In addition to that, sir, technical know-how would be taxed at 20% because ultimately it is a technical know-how. 115A would apply. Sir, whether it is government approved or not, I assume that it is government approved. Whatever you think, you can write it down in the notes. In exam, it would be mentioned to you that whether it is government approved or not. Logically, it is assumed that it is government approved. Now, dividend of 650 received on GDR, Global Depository Receipt. Understand, whenever you receive any dividend under GDR, GDR are taxed under 200 115 AC, and they are taxed at the rate of 10%. So this would be taxed at the rate of 10%. Done, sir. Dividend of 1550 earned on the equity shares. See, if any foreign company earns any dividend on the equity shares, it would be taxed at 20%. Income by the way of royalty of 12,56,000 net of TDS. Okay, net of TDS now. So 1256 470 divided by 79.2% into 100. 1256 470 divided by 79.2%. 1586 452 into 20%. Done, sir. Business receipt of 850. Whenever we have business receipt, it would be taxed at 35%. Long-term capital gain on transfer of unlisted shares of the Indian company computed with indexation. See, if any non-resident or foreign company invests into unlisted shares, they are not given benefit of indexation. First proviso even states that they don't have any benefit of indexation. In addition to that, they are taxed at 10% only. They are taxed at 10% before budget, 12.5% after budget. So what is the rate of transfer? It is rate of transfer. So it would be taxed at the rate of 10% only without indexation. On this 10% would be charged. Done, sir? Yes, sir. Let's solve it. Let's do the total. See, whatever figures I have mentioned, just multiply rates to those figures and you will get the answer. You just need to multiply the rates and you would get the answer. Just the figures that I have mentioned, you will get the answer. 285 into 35% and plus 30 lakh into 20%, 650 into 10% and plus 1586 452 into 20% and plus 1550 into 20% and plus 850 into 35% and plus and 232 into 10% and plus 1712 740. Let's see. Oh my god, sir, absolutely matching the answer. Of course, 4% education cess would be added. This would give us the proper answer. Correct. It's correct. Simple question and absolutely correct answer. Wow, sir. Wow. It's magic. It's magic. It's not a magic. It's just pure logic. See, sometimes now what would happen? Sometimes what would happen? See, in some cases now you would see in some of the authors' books or in some of the faculties' books, you might see that answer is differing. Answer difference would only come because some faculties assume that this is unregistered. This is not approved. This is not government approved now. It's not government approved, so therefore they charge 35%. In that case, your answer would differ. But believe me, in exam you will be given. You will be given, and even if you are not given a, just do whatever you feel like. Just give a note to it. If you think it is government approved, write it government approved. If you don't think that it is government approved, then don't write government approved. Normally, my personal thought has been that royalties are not government approved, but fees for technical services are by default approved. How can you provide a services without it is government approved? Now, the technical services happen day to day, and not every services are approved. But royalties are normally approved. So royalties and FTS go differently. Come on to question number 98. What the question number 98 says: the net results of the business carried on to a branch in US based foreign company in India for the year ended 31st March 2025 was a loss of 28 lakh after charging the following expenditure. Remember, it is talking about branch, it is talking about expenses. That means the question is of head office expenses. For head office expenses, we have two things to be considered. Whenever you calculate the head office expenses, now you require two things. You think you require total income plus you have to do five adjustments. You have to do five adjustments. What were the five adjustments? फैमिली प्लानिंग का डिडक्शन लेके हेड ऑफिस में बैठ के फैमिली प्लानिंग का डिडक्शन लेके बफेलो उड़ गई. दिस वाज द acronym we had understood. Head office expenses, if you have debited, you would add back. If any chapter 6 deduction you have taken, you would add back. If you would have added any brought forward losses, you would add back. If you have any unabsorbed depreciation, that would also have add back. If you have any family planning expenditure, capital ones, that would also be added back. These five things had to be added. But the issue here is we require correct total income. Correct total income in which these adjustments are to be carried out. We have been just given a net loss. That means we are not given correct total income. We need to find out the correct total income. Then we would do this adjustments. Answer. So 28 lakh is our, for the time being, 28 lakh is our the loss. This would give us the ATI. Of course, this would give us the ATI. Done, sir. Depreciation for the current year is 35 lakh. Do we need to do anything for depreciation? No, sir. Current year depreciation is nothing, treated like nothing. Unabsorbed depreciation for the financial year is this. Sir, do we need to adjust this? Do we need to adjust this, sir? While correcting this net profit, we do not adjust it. While correcting net profit, it is not adjusted, because in net profit, na, it is always it is to be reduced. Whenever you arrive at net profit, na, this unabsorbed depreciation is to be reduced. Therefore, it is done correctly here. But in ATI calculation, we would add it back. So we would add it back here. 18 lakh would be added here. Short-term capital loss on sale of the shares of the Indian company received in USA. Now listen to this point. This short-term capital loss is current year capital loss. How can a short-term capital loss be set off against the business income? It is incorrect statement. It is incorrect statement. So 1.5 lakh would be added back. Expenditure on payment of VRS scheme. Now expenditure on payment of VRS scheme. Now what this expenditure is all about, understand this. Expenditure on VRS. See, expenditure on VRS is allowed 1/5 as per 135 DDA. They had taken deduction of entire 12 lakh, so this would not be allowed. 1/5 will be only allowed. That means 2.4 lakh would be allowed. That means 9.6 lakh is to be added back. Done, sir. Speculative business loss brought forward. See, speculative business loss. Whether speculative business loss is set off against regular business, no, sir, it is wrong. Adjustment done. It will be added back. See, it has to be added back either here or either here. Brought forward losses. It has to be done at one place. We have done while correcting the total income. Deductions under chapter 6 is ideally should be deducted from this total income. So here we are taking here. Deductions 29 lakh. Head office expenses to be allowed. See, head office expenses are normally, whether are to be allowed or not, see, we can add it here. In any of the place we can add it. No issue whatsoever. Done, sir. Anything left out? Anything left out? No, sir. Nothing left out. Nothing left out. Just do the adjustments on this 28 lakh rupees. Do these adjustments and do these adjustments as well, and you will arrive at ATI. Do these adjustments and do these adjustments, you will arrive at ATI. 28 lakh minus plus 1.5 plus 9.6 plus 17 plus 165 plus 29 plus 18. That means our adjusted total income is 212.1. This is our adjusted total income. On this, 5% would be allowed to us. 5% of the expenditure would be allowed to us. Done, sir. 5% would be allowed to us. How much 5% would be? 10.605. If we reduce this losses now, like 28 minus plus 1.5 plus 9.6 plus 17 plus 165 minus 10.605. 154.495 is the allowed, is your profit, is your actual profit after those expenses. Let's see. 104.495. This is the amount. See, people misunderstand with one point. See, here we have taken VRS, here we have taken brought forward losses to correct the net profit. Whatever net profit has been given to us, it is useless to us. For calculating proper head office expenses, now you require total income, and here total income has not been given. To arrive at total income, we have done these adjustments. If they would have given us total income, then these adjustments were not required. In another question, I will refer the same thing to you. In that, what would happen? We have not been given with proper information. We have been properly given with total income. And here we are not given with total income. So to arrive at the total income, we have done these adjustments. Otherwise, these VRS expenditure was not required to be done. Joseph, a non-resident person of Indian origin. Non-resident person of Indian origin. That means he is an NRI. Done, sir. Furnish you the following information. Okay, sir. Sale proceeds of listed equity shares on 31st May. 31st May. That means he is selling before budget. That means he would be taxed at the rate of 10% over 1.25 lakh. Done, sir. The 6 lakh sales value is the 6 lakh. Done, sir. Cost of acquisition is 1.1 lakh. Done, sir. Expenditure wholly connected, that means 50,000 that we have to do. See, this should be done carefully. Minus transfer expenses. Okay. Net consideration is nothing but 5.5 lakh minus cost of acquisition 1.1. This would mean 4.4 lakh would be cap gain. Answer. Capital gain would be 4.4 lakh and this would be taxed at the rate of 10% over 1.25 lakh. Perfect. Interest from the government securities net of TDS 81,000. See, whenever any non-resident NRI earns any interest on government securities, it is a kind of forex asset. So it would be taxed at the rate of 20% plus 4%. So 79.2% to be used to gross up 81,000 divided by 79.2%. That means 102,272 into 20% is to be charged. Perfect. Interest on deposit with public companies. See, public companies deposits 325,123 into 20%. Whenever we have public interest on interest on whenever we have interest on deposits with public securities, these are forex assets only. So whatever interest you receive, that is nothing but a forex income only. That means 20% tax will be applicable. Interest were held with private companies. See, private companies, whenever you have any income with private companies, it is taxable at the rate of slab. So 555,123 would be taxed at the rate of slab. What's regime it is opting? We need to check it out. Fresh investments in the share of the public company 1111. See, we sold the shares on 31st May and we bought shares on 11th November. That means within 6 months we bought another forex asset. We sold forex asset, we bought forex asset. So there would be some exemption. 115F would apply. Now what 115F says? Your capital gain would be exempted. How much capital gain would be exempted? Multiplied by cost of new asset. Cost of new asset is 220, 2.2 lakh. Net consideration is 5.5 lakhs. So this much amount would be exempted. So 4.4 divided by 5.5 into 2.2. That means 1.76 lakh is to be reduced. Overall capital gain would turn out to be 4.4. That means 2.64 lakh is the amount of capital gain tax. On this 1.25 lakh, we would get exemption. And remaining would be taxed at the rate of 10% minus 1.25 into 10%. That means 39,000, 1,39,000 rupees. Sorry, 13,900 would be taxed on this. The remaining tax we have to calculate 1022 into 102272 into 20% and 55,000 with slab. Let me tell you. Let me show you this answer. Oh, sorry. One thing. Dear. One very important clarification. People also do mistake in this, and I have also done the same mistake. Whenever NRI opts for special provisions, and actually I have not done this mistake, but to be honest, just to make you aware, this was a prank. Whenever NRI opts for special provisions, he never gets benefit of 1.25 lakh. Even in listed securities, it did not get. Understand? Whether 1.25 lakh benefit is given to NRI, is not given to NRIs. If they opt for optional provisions for forex asset, now they are not given this 1.25 lakh benefit. So 1.25 lakh benefit would not be given. They would simply be taxed on 264 into 10%. This is the flat tax rate applicable to them. 264 into 10%. Investment income 102 plus 325 would be taxed at 20%, and remaining income would be taxed at the rate of slab. Whatever the slab is, they would be taxed 4% education cess, and this would give you answer. See, this is a clear-cut point that NRIs do not get any benefit of 1.25 lakh. If they opt for optional provisions, they won't get any benefit. If they don't opt for optional provisions, they will get the benefit. That's the bottom line. Sir, got this point. Now, question number 100. Finally, reaching to question number 100 feels like some satisfaction. Delta Global Inc. is a foreign company, operates a branch in India. Okay. For the financial year ended 31st March 2025, head office incurred certain administrative expenditure outside India and allocated 1 crore 85 lakh rupees to India. The adjusted total income is a loss. See, whenever you have adjusted total income as loss, now you are not allowed any head office expenses based on this adjusted total income. You have to find out the ATI of preceding 3 previous years, average them out, and on that ATI you are allowed 5%. Now, for that matter, we have been given information for 3 years, 22, 23, and 24. ATI given to us, okay, done. Assessable income, Current year depreciation is not adjusted, it is always to be ignored. Unabsorbed depreciation always to add up. Chapter 6 deduction always add up. Brought forward short term loss always add up. Long term loss, it is current year loss. The current year loss are never adjusted. Brought forward speculative loss will always add up. VRS expenditure is to be ignored. See, here we are ignoring VRS because we are already given total income. If we are not given total income, then we would have adjusted this. Head office expenses, we would simply add up. Whatever the figures we have done now, we will add up, divided by 3, multiplied by 5%, and we would arrive at the proper head office expenses. If you see the answer, entire figures have been calculated. Divide by 3, 24 lakh, 22 crore 48 lakh 33,333. On this 5%, we would take 24 to 4, 8, 1, 2, 3, 4, 5 into 5%. That means 12 lakh 41,667 is the amount of head office expenses that will be allowed to you. We have a portion 1.85 crore. Now we will allow only 12 lakh. This is what happens in India. Done, 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 done. Done, 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 done. Sir, absolutely clear. Absolutely clear. Coming on to question answers of double taxation avoidance agreement. Two bigger chapters. Just stay with me. I'll guarantee, even if you have not read this chapter in DTAA, you will be clear. Even if you have not read this chapter, everything will be clear to you. Just follow the steps that I'm asking you to follow. Come on to question number 101. We have only few questions from DTAA, only few questions from transfer pricing, and we are done with the entire syllabus. Remember, thank you so much for being till here. Even if you have not subscribed, even heartfelt thank you. Even if you have come this far. Mahesh, age 50, is the CEO of Silver India Limited since 1st April 2019. His income in India consists of salary before standard deduction. See, 23 lakh is the salary. Which regime is opting? It matters the most. Compute the total income. Net tax liability of Mahesh for assessment year 25-26. Assume Mahesh pays tax under 115 BAC. So under 115 BAC, he will get 75,000 deduction. So his income would be 22 lakh 25,000. This is his income. This is the amount of income that would be taxed in his hands. Done, sir. Interest in respect of self-occupied house property. See, whenever you have any self-occupied house property, you do not get any deduction. You do not get any deduction because in new tax regime, it is not allowed. Interest in bank, that means 1 lakh 60,000. This is his Indian income. Done, sir. He has the following income for the year ended 31st March 2025. Country A. Income from business in country A. So he is doing business in country A and he's earning in dollars. Whenever you have to convert this into rupee, whenever you have incomes in foreign currency and you have to convert this into rupee, what exchange rate you have to use? Understand. For business income, for house property income, and mostly for all the IFOS income, except for interest and dividend, you will use the year end rate. That means rate as on 31st March 2025 you are going to use. And for all other things, it may be interest, it may be dividend, it may be taxes, it may be anything, any other thing. What rate? For example, it may be capital gain, it may be salary. You are going to use the rate preceding month, whatever the month you receive it or it is accrued, last date of the preceding month you are going to use. I'll tell you how. Now, since business income, we are going to use 31st March's rate. What is the rate of on 31st March? 71. That means 17 lakh 75,000 would be used. Done, sir. Rent received is 45,000. Now, whatever rent that is received, we don't consider. We don't even consider that rent. We have to take the municipal taxes. We have to reduce the 30% standard deduction, and then what it turns out to be, we will take it. On 450 municipal taxes paid, there is 450, so minus 450. Whatever the figure we arrive at, we would take just 70% of that. And whatever the figure we arrive, or we will multiply 71 to that because 71 is the exchange rate as on the year end. House property is converted as on year end basis. So it turns out to be 201,285. This is the rental income. Dividend from the shares held in country A, where dividend was declared and paid in March 2025. See, if you are declared and paid in March, so dividend would be taxed based on preceding month's last date. That means 28 Feb would be used. 28 Feb is 70, so we would take 70. This implies 7 lakh is the amount of dividend taxable. Short-term capital gain of 5,000 US dollar on the sale of the shares of the company registered in country A and sales proceed was O. See, short-term capital gain took place on 28th March 2020. That means it would be converted based on 28th Feb's rate. That means 70 rupees would be exchange rate. This means 350 is the amount of short-term capital gain. Now, of course, this is not listed, so it would be taxed at slab only. What are the Indian incomes? These are two Indian incomes. And the things that I'm highlighting in blue are the foreign incomes. Whatever the income is, we would at least do the total of that. 22, 25 plus 160 plus 11, 1775 plus 201285 plus 7 lakh plus 350. Total income in India turns out to be 54 lakh 11,285. This is the total income in India. Taxes on that would be, see, minus 15 lakh multiplied by 30% plus 1.4 lakh into 1.04. This is into 1 point actually 1 because surcharge would be applicable into 1.04 would be. See, this is a calculator trick I'm telling you. You can even use this in exam as well. Minus 15 lakh into 30% plus 1 lakh 40,000 into 1.1 into 1.04. That means taxes in India are 15 lakh 2,513. This is the amount of taxes in India. Let's check. Fingers crossed. 15 lakh 2,513. Oh wow. Oh wow. Finally. Now, what is the average rate of tax? The average rate of tax has to be calculated always. Divided by 5411285. 27.7663% in India. Now, how do we calculate relief in this section 90? Taxes paid in that country versus taxes paid on such income in our country. That's the only thing you have to do. Taxes paid in that country versus taxes paid on such income in our country. And yes, sir. Whatever the things that I've highlighted in blue, just add them for a second. 1775 plus 201285 plus 7 lakh plus 350. That means whatever income it is he is earning in that country, it becomes taxable in India only to the extent of 30 lakh 26,285. And on this, India is charging taxes at the rate of 27.7663 percentage. 27.7663%. So in India, we are charging taxes of 842.87. This is the amount of taxes on such income in India. How much this Mahesh has paid taxes in that country, that is important. Understand? Mahesh has business income of, I'm highlighting in red. Now now I am highlighting with this orange color. He has income of $25,000 there. He has municipal taxes, and remember, municipal he has rent received on which municipal deduction are not allowed. So 450 is not allowed there. He received a dividend of 10,000 rupees and short-term capital gain of 5,000. So if I do the total of all the orange portions, how much amount it turns out to be? 44,500 is the amount of the total dollar income that he has earned in that country. Now, India has DTAA with country and he has paid taxes and he is eligible for the credit fiscal year. Tax rate is same in the both the countries. The rate of 20% is applicable. So their tax rate is 20%. That means he has paid taxes of 8,900 US dollar. He has paid 8,900 of US dollar in that country. Remember. Now this taxes have to be converted into India. What is the conversion rate of the taxes? I have told you everything has to be converted based on the last month's last date, preceding month's last date. Now, the only point is when did he pay the taxes? When did assessee pay the taxes? If you see carefully, he paid taxes on 25th May. That means taxes have to be converted based on 30th April's date. 30th April's date is nothing but 72, and 72 we would consider for conversion. That means 648.80 is the amount of taxes paid in that country. And how much relief we would get? This only 648.80 is the amount of relief that we would get. If you check the answer, 648.80 is the actual amount of relief that we would get. Done, sir. Done, sir. Done, sir. Yes, sir. Absolutely. Come on to question number 102, and it is a very good question. Triple star rated question. Now, what the question is all about, understand. Ram Prakash is a resident Indian, age 58. He has business interests in India and in some foreign nations as well. He has derived income from two other nations, X and Y, with which India does not have DTAA, and particulars of income earned in both the nations have been given to you. Answer. Simple question. It is not difficult at all. It has to be handled with care. To be honest, it has to be handled with care. Otherwise, there would be something wrong in this answer. Understand this. Gross rental received from the commercial properties. In country X, we received rent. In country Y, we received rent. In both the cases, only 70% would be tax. So what 70% would turn out to be? It is 175, 175. That means 3,50,000 would be rent. 175 would be from country X and 175 would be from country Y. That means 350 would be total rent. Then fair income from partnership firm loss and partnership deed is not evidenced by instrument in writing. Understand this point very carefully. Now, we received loss from partnership firm. Normally, losses are not allowed to us. But if partnership deed is not evidenced by instrument in writing, that means entire losses would come to us. Entire losses would come to us. That means we will be allowed losses. So I am highlighting things in blue which we have to add up, and I'm highlighting things in red that we have to reduce. Done, sir. We have business income. We would add business income entirely from all the countries. We have short-term capital gain from vacant land. See, if you have short-term capital gain on land, it would be taxed at slab only. Therefore, 1080 would be taxed as it is. Long-term capital gain in India. This has to be worked out because this will be either taxed at 20% or 12.5% as the case may be. Since property is sold before budget, that means 15th March 2024. Okay. Gain is given to us, sir. Gain is given to us. That means it would be taxed at 20% only. Done, sir. Agriculture income from country X is to be added, country Y is to be added, but India is not to be added because agriculture income is exempt in India. Purchase price of the residential house in Delhi, see, in the joint name of the spouse. See, he sold the house and then bought the house. That means he would not be taxed on 37 lakh, rather he would be taxed on only 12 lakh rupees because for 25 lakh is the amount of exemption, so only 12 lakh would be taxed at 20%. So we would add this as well. Now, contribution to PPF, we need to check which regime is opting. Compute the net tax liability. Assume he is paying taxes under default regime. So default regime, in that case, this would not be allowed to us. Things seem simple. Things seem simple. Let's add the things in blue and reduce the things in red. 350 minus 120 minus 130 plus 280 plus 340 plus 180 plus 1080 plus 12 lakh plus 340 plus 180. Our total income turns out to be 37 lakh. How much taxes would be calculated? See, we have agriculture income as well. Now, how taxes would be calculated? Taxes are calculated in 3 steps. Step 1, total income plus agri income. Taxes on that. Now, what is total income? 37 lakh and agri income is 5.2 lakh. Total income is 37 lakh and agri income is 5.2 lakh. That means taxes on 42.2 lakh rupees. We need to calculate. Now, on this 42.2 lakh rupees, we won't directly charge tax slab. On this, we have two portions. One of them is long-term capital gain of 12 lakh rupees, that would be taxed at 20%, and remaining 30.2 lakh would be taxed at the rate of slab. And this would give us the final tax liability. This is not simple. This is not simple. The way you are thinking, it's not that simple. 30 lakh 20,000 minus 15 lakh into 30% plus 140. That means 596 and 240 plus 240. This would give us, see, do not add education cess, never add education cess. Education cess is always added at last. 836 is the tax on agriculture income and total income. Step 2 help us tax on agri income plus basic exemption limit. Now, agri income is nothing but 5.2 lakh and basic exemption limit is 3 lakh. So we have to calculate taxes on 8.2 lakh rupees. Up to 3 lakh, we don't have any taxes. 3 lakh to 7 lakh, we have 5%, that means 20,000 taxes. 7 lakh to 8.2, that means on 120, on 1,20,000, we have taxes of 10%, that means 12,000. So 32,000 is the amount of tax. 32,000 is the amount of tax. How much actual tax we have to pay? 80 4, 1, 2, 3. This is the amount of taxes we would charge 4% education cess. 836, 160. This is the amount of taxes we have to pay. This is the taxes amount that we have to pay. On this, we would get rebate. But for that matter, we need to calculate average rate of tax in India, and that would be calculated based on this tax liability. The average rate of tax in India is 22.5989%. 89%. This is the amount of average rate of tax in India. Let's check this figure. Fingers crossed. 2037 lakh is correct. 836 160 is also correct. 836 160 is correct. That means first step we have done correct. Now what we want? We need to calculate relief. Relief in country X. How it will be calculated? Doubly tax income into average rate of tax, that is 22.5989, or foreign tax rate. Similarly, we need relief for country Y. Doubly tax income into average rate of tax, that is 22.5989, or foreign tax rate. Lower of 2, lower of 2. Only things we need to do this. In country X, what is the doubly tax income? Let's find out. What is the doubly tax income? Looking at the figures of country X, I am just removing the highlight portion. What is the doubly tax income? Understand. Rental income is taxed at the rate of 250 there, but in India it would be only taxed at 1750, so it would be doubly tax income. Deduction for loss is allowed in that country. Deduction for loss is allowed in that country, so it is not relevant. Deduction for loss is given in that country or not, it is not relevant. If India gives the deduction of that losses, now it would be always reduced from doubly tax income. Always. Why? Because in India we are reducing the income now. So whenever it is we are reducing, of course our income would be always lesser. Our income would always be lesser. Therefore, we get deduction of losses. Always we allow deduction of losses in doubly tax income calculation. Business income is taxed as it is. Short-term capital gain would be taxed as it is. The fact is, agriculture income we need to see. We need to see the agriculture income. No statutory deduction in respect of house property is given in country X. Okay. Loss from firm can be set off against the other businesses in country Y only, not in country X. Oh, in that country losses is not given, so we don't care. In India we are given, so doubly tax income we get deduction. Agriculture income is exempt in country X only. That means in country X we did not pay taxes on agriculture. In country X we did not, but in India we are paying taxes. Therefore, it is not doubly tax income. Understand, doubly tax income is that income which is taxed in both the countries. 340 is only tax in India, so it is not doubly tax income. So whatever we have highlighted in blue and red, blue has to be added, red has to be reduced. 175 plus 280 plus 1080 minus 120. That means 14,50,000 is doubly tax income. Now we need to calculate foreign tax rate. How foreign tax rate would be arrived? Foreign tax rate would be arrived with a different manner. Now understand. We need to compute income there. What is their income? In that country, house property is taxed at 250 only. House property is taxed, no deduction is allowed in country X. Okay. Loss can be set off. Loss cannot be set off in country X. Therefore, if loss cannot be set off, so we have to ignore these losses. We would tax 280, we would tax short-term capital gain. Agriculture income is exempt there. So in that country, how much total income would turn out to be? 250 plus 280 plus 1080. This is the income in that country. This is the income in that country, huh? Country X. And in country X, tax rate given is this. Up to 3 lakh, no tax. 3 lakh to 6 lakh, we have 15%. So 3 lakh income into 15%, which would mean 45,000. Above 6 lakh, up to 16 lakh 10,000. That means on 10 lakh 10,000 income, we would be charged 22%. Double two double zero plus 45,000, and this would be taxed at 267,200. So if income there is 16 1 1 2 3 4 and taxes there are 267,200, Average rate of tax in that country is 616,596, 16.5963%. So okay. 16.5936, 16.59, no, 16.5963. This is the foreign tax rate. Now, how much relief you would get? You would get relief on this 14,15,000 into 16.5965. So, how much relief? 1415. Relief would be 234,837. This is the relief in country X. Not simple, but still, it is good. It is a very good question to practice. Country Y, we need to calculate the foreign tax rate. Oh my God, sir. How better things can be. Foreign tax rate has already been given. We only need to calculate doubly tax income in country Y and we'll get the answer. What is doubly tax income in country Y? Understand. Whatever the rental income is in India, we are charging less. So Indian income would be doubly tax income only. That means 175 would be doubly tax income. In India, we always give deduction of losses. So we would have to reduce this losses as well. Anyway, we have to reduce this losses. Business income would be added. Agriculture income, we need to see what the agriculture income scenario is. Agriculture income is not exempt in country wise, so agriculture income is also doubly tax income. So things in blue to be added and red to be reduced in case of country Y. 175 plus 340 plus 180 minus 130. That means 565 is the doubly tax income. 565 into 22.5989. That means 127,683 is the amount of relief in country Y. Add relief of both of them plus 234,837. How much relief you would get? 362,520. 362,520. Fingers crossed. 362,520. I can't have better satisfaction than getting this answer correct. Every time when I solve this question, I'm always worried whether I'll be getting correct answer or not. But of course, mostly or always I get the correct answer. But still, this is the type of question now which always puts a pressure on you that whether you will arrive at correct answer or not. But normally we arrive at correct answer only. Okay, sir. How many questions are there? Yeah, there are too many questions in DTAA. Honestly, there are too many questions, but no issue. These are for practice only. Our practice only. Question number 103. Now, Mrs. Sudha Sharma, age 61, is married and settled in Calcutta. Now, she is a Hindustani classical singer composer who performs in concerts in India and Country M. Okay. She visits Country M every year during the music season in October to participate in the mega music concert held there. For the rest of the year, she performs concert in India. Okay, she performs in Country M, Country N, and she comes to India. Now, whenever we calculate relief, we need to follow 5 steps. First of all, Indian income, then taxes in India, then average of tax, then foreign tax income, then double tax income. Now, concerts in India, 10 lakh we have to add. Country M, whether India has country M with DTAA with country M. India has no double taxation avoidance with country M, but has DTAA with country N. This is the line given to us. Since India does not have DTAA with country M, what we have to do, see, we don't have to consider that thing as of now. Right now, we don't have to consider. Right now, we just only need to consider the Indian income. For Indian income, we need to convert this, and business income is always converted based on the year-end rate. Country M year-end rate is 780. So on with 80, we will convert this 12245 into 80. That means 979,600 will be business income in country M. Done, sir. Tax deducted in country M in respect of the income earned is 250. I don't care as of now. He earns 10,000 CND by the way of royalty. In the composition, see, royalty is the business income. So 10,000, country N, 10,000, and it would again be converted with the year end rate. That means into 79. That means 790 is the country N's income. 790 is the country N's income. Done, sir. The royalty is paid to her every year on 25th March after deduction of taxes at the rate of 10%. Done, sir. In India, she has interest income of 4 lakh. So this 4 lakh will also be added. The name. Okay. 25,000 from the savings bank account. This would also be included. Now she has a medical insurance of 27,000. So 27,000 medical insurance is normally not allowed, but only 25,000 insurance is allowed. So we would reduce this. and 30,000 to ensure her husband age 64. Oh, whenever either you, oh, so she is all 61. That means she won't get 50,000 now. In her and her husband, clubbing both of them, she would get 50,000. Clubbing both of them, she would get deduction of 50,000 and 50,000 would be reduced from her total income. Okay. She deposited 1.5 lakh in PPF, so she would get 1.5 lakh as PPF. 3 lakh in 5 year saving deposit, that is irrelevant. No. Whatever the thing is, we need to calculate the total income, assuming that she has opted out of default tax regime. That means old tax regime is to be considered. Done, sir. We'll do that. We'll do that. We'll do that. Peacefully, we'll do that. Things in blue has to be added. Things in red have to be reduced. Now, 10 lakh plus 979,600 plus 7 lakh 90,000 plus 4 lakh plus 25,000 minus 2 lakh. Her income turns out to be 29,94,600. And taxes in India turn out to be minus 10 lakh into 30% plus 1,10,000 into 1.04. Remember, she is a senior citizen, so for her up to 3 lakh no taxes would be charged. 736,715. This is the amount of taxes. 736,715. Let's check. Did I miss out on something? 29,94,600. Oh, she got deduction also now. She got deduction of FD interest also now. So yes, 50,000 will additionally be reduced. 80 TTB. So 49, 29, 44, 29, 44, 600 minus 10 lakh into 30% plus 1,10,000 into 1.04. 721115. This is the amount of taxes she would be charged. 721115. This is the amount of taxes she would be charged. So average rate of tax would turn out to be divided by 29, 44, 600. 24.4894%. This is the amount of average rate of tax she is charged in India. Done, sir. Now, we need to calculate relief in country X as well, country Y as well. What the provision is, we don't have DTAA with country M. So how we would calculate with country M? Country M, we would calculate doubly tax income multiplied by average rate of tax or foreign tax rate, whichever is lower. Average rate of tax we are given with. In country M, foreign tax rate is also given. Country M, 2,500 is the earning, where 12245 is the income. 2,500 divided by 12245. So in country M, 20.4165 is the tax rate. 20.4165 is the tax rate. 2,500 divided by 12245. Yes, sir. This is the amount of tax rate in country M. So 20.4165 is the tax rate. What is the doubly tax income? Of course, whatever the income is entirely doubly tax income. So it is 979,600. 979,600 would be considered. 979,600 would be considered. 979,600 into 20.4165 percentage. That means 2 lakh is the amount of relief we would get. 2 lakh is the amount of relief we would get in that country. Answer. Country Y, country N, taxes paid in that country versus taxes paid in India. On such income, we have to check. Now, 790 is income in India. And in India, we pay taxes at the rate of 24.4894%. How much it turns out to be? 79 lakh, 7 lakh 19 to 24.4894%. In India, we charge taxes of 193,466. 193,466. But in that country, we are paying how much taxes? Understand this thing, huh? 10% taxes. That means 10,000 Canadian dollar. That means 1,000 CND we are paying taxes when we are paying on 25th March. 25th March we are paying. That means 28th February we will use. 28th February we will use. That means into 78 we would multiply. That means 78,000 is the relief that we would get. 78,000 is the relief in country N we would get. 20 lakh, 2 lakh is the relief in country M we would get. That means 278 is the total relief that we would actually get. 2,78,000 is the actual relief. And that is the answer which is suggested here. Absolutely same answer suggested in this point as well. Done, sir. Come on to question number 104. A beautiful question. Beautiful. Mr. Ashok, aged 66 now. Whenever a person is 60 years, 6 years of age, one thing to be taken care of. One thing to be really taken care of is the slab rate. Up to 2.5 lakh, up to 3 lakh, he will not be charged to taxes. A resident individual furnishes you the following particulars of income earned by him in India and country N for the assessment year 2026. Now, I am just highlighting things in blue to be added for the purpose of Indian income. Taxable income from the sole proprietorship, add it. Income from country N, business income, add. Gift in foreign currency, of course, greater than 50,000 rupees, it would be taxed in India. Dividend, always add. Brought forward business loss, it would be allowed in India. Of course, business loss is always allowed in India. Done, sir. Country and taxes dividend, we would take care later on. Deposited 1.5 lakh paid to NPS. Assume the income tax, net tax liability, assuming that Ashok pays under default tax regime now. So this LIC point is irrelevant. Just add the blue ones and reduce the red ones. 8 lakh plus 950 plus 65,000 plus 140 minus 50,000. This would give us the total income. Total income would be 1905. Taxes would be as per default tax regime, so minus 15 lakh into 30% plus 1 lakh 40,000 into 1.04 to 71,960. How relief would be calculated? W tax income into average rate of tax or foreign tax rate. How much average rate of tax would be? 14.2761%. It is the average rate of tax. Now, what is the foreign tax rate and W tax income we have to calculate? Understand this point very carefully. Country and taxes the dividend at the rate of 10% and all other incomes are taxed at 20%. So business income is taxed at 20%. This is also taxed at 20%, but dividend is taxed at 10%, and brought forward losses of assessment year is 50,000 rupees. Domestic tax laws do not permit the set off against the other income, so losses are paid losses in that country. We would arrive at the taxes by multiplying the related figures. Relative figures, we would arrive at the figure answer 950 at 20 into 20, 65,000 into 20%, and 140 into 10%. 2,17,000 of taxes on the total income of 65,000 plus 140, 1155. So 2,17,000 divided by 1155. This would mean they are required to pay 18.7878%. Of course, average of tax in India would prevail. Now, what is W tax income? Of course, this business income is W tax income. Gift income is W tax income. Dividend income is W tax income. But we would also reduce this amount of losses because in India we get deduction of losses now. So 950 plus 65,000 plus 140 minus 50,000. That means 11 lakh 5,000 would be W tax income. On that, 14.2761% would be given to us. That means relief would be 157750. This is the amount of relief that we would get. 157750 would be the amount of relief. Oh wow, sir. Oh wow. Absolutely correct answer. Absolutely correct answer. And why would it be wrong? Of course, why would it be wrong? Come on to question number 105. Now, Miss Meera, age 28, a senior resident, provides the management consultancy services to small and medium corporations in India and abroad. She regularly travels to country A for K for providing the consultancy services to her clients. It provides the following information in respect of income for financial year 24-20. Amount received from consultancy in India 37 lakh 50,000 and in country A 12,000. So always add back. Okay, wait a second. Amount spent for earning this income in India is 960 and in country K is 250. That means business income in India is 3570 minus 960 now. 35 lakh 70,000 minus 960 after deduction of expenditure. That means 26 lakh 10,000. And business income and country K would be 12 lakh minus 250. That means 950. This is the business income. Rent received in India is 55,000, so it would be multiplied by 12, of course. And in India, we got 30% deduction, so 70% is only taxable. So rental is 462,123. Remember, in this case, no, expenses are not allowed in India. Expenses are not allowed in India. If this would have been municipal taxes, then answer might have been different, but these are normal expenses. That means 4022123 is the total income. Taxes on such income would be minus. So which regime she is opting? She does not have DTAA. Your calculation up to 2 decimal places. Okay, you are required to compute the total income, assuming she opts to pay default tax regime. So default tax regime is important. Huh? Almost 15 lakh into 30% plus 1,40,000 into 1.04. 1981616. Now, average rate of tax for her would be average rate of tax. Did I do some mistake? 4022 minus 15 lakh into 30% plus 140 into 1.04. Now, taxes turn out to be a different one. 932,464. This is the amount of taxes. The average rate of tax would be 23.1841%. 23.1841% is the average rate of tax in India. We need to calculate foreign tax rate and doubly tax income. Two things we require. Let's calculate the foreign tax rate. Foreign tax rate first, then we would arrive at doubly tax income. Country K provides two options to the SSC as far as taxation of management consultancy is concerned. 20% without deduction, 30% with deduction of expenses. 12 lakh is the income, either 20% or 12 lakh minus 2.5 lakh, 3 point lakh, what was the 2.5 lakh into 37%. Of course, the 37% would be higher, so we would be paying taxes there only. 12 lakh into 20% would mean 2 lakh 40,000 of taxes there. Country K taxes rental income as flat 27% after giving standard deduction of 20% on regular expenses. No other expenses allowed. So there 55,000 is the rental multiplied by 12 months. That means 660 is the rental. There they get 20% of deduction. That means 660 minus 20%. That means in that country 5,28,000 are being taxed at the rate of 27%. Understand this thing. Huh? 27% would mean, so how much taxes are being charged, that is important. 12 lakh into 20% first thing, 12 lakh into 20% M plus first thing, and 528 into 27% second thing. Taxes charged in that country are 382,560. And income being taxed there is 17 lakh 28,000. This would give us the taxes in that country, which would arrive at 22.14. Of course, at 2 digit they are asking us to calculate, so we'll calculate up to 2 digit only. Now we need to calculate the doubly tax income. Important. Understand this point carefully. India charges tax on 950. That country is charging tax on 12 lakh rupees. So doubly tax income would be 9 lakh only. Second thing, India charges rental income of 462. That country is charging rental income of 527. So of course, doubly tax income would be Indian income only. So these two would be doubly tax income 950 plus 462. That means 14 lakh 12,000 is the doubly tax income. 14 lakh 12,000 is the doubly tax income multiplied by 22.14% and 3,12,617 is the amount of relief that you would get. 3,12,617. 3,12,617 is the amount of relief that you absolutely get if you do the things correctly. And even if you have not subscribed to the channel, what else I can ask? What else I can ask? I can just cry now. To this point, even if you have not subscribed, even if you have not liked my video, I can just cry. There is no other option left. Come on to last question of DTAA. Beautiful question in itself. Beautiful question to practice. I'll not help you out with the entire question, but one thing I want to help, want you to work out with. Miss Ritika is 30-year-old resident individual, started her business of printing mobile skins and covers in India and abroad. She frequently visits countries that to serve the overseas clients. The following are the particulars. Okay, done, sir. Receipts from cell phones and skin covers in India. Now, in India, she sells the skins of 12 crore 47 lakh 45 lakh 50,750. Expenses are 10.2 crore. So business income in India is 1245 57 80 minus 1245 5780 minus 1020. So 2 crore 25 lakh 50,780. 225 50 780. This is the business income in India. And countries at 1550 minus 9 lakh. This is easy now. Country X. In that country, no skin is popular. In India only we are crazy about mobile skins. 6 lakh 50,000. Done, sir. Simple point. Rent received from commercial property in that country is nothing but 65,000 into 12, of course, into 70%, because in India only 70% is taxed. 546. Done, sir. Done, 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 done. This would give you GTI. 237,46780. This would give you GTI. Yes, sir. This would give you GTI. Country Z, okay, foreign tax rate is given to you in this question. Foreign tax rate is 25%. Simple. After deduction of all the expenses. Now, for the expansion, Ritika opened a manufacturing plant in Pune. In addition to that, she hired new employees. 18 employed she hires at rupees 23,300. That means 18 employees into 11 months salary at rupees 20,300. 22 employees she hired on 1st June for 24,500. That means 22 employees into 10 months salary into 24,500. 15 employees she hired on November basis. Sir, if she hires on November, would she get deduction? Sir, she would not get deduction, because at least employees have to be employed for 240 days. If she hires in November, 240 days condition is not fulfilled, so she would not get deduction. On this salary expenditure, she would get 30% deduction. 18, 18 into 11 into 23,300. 22 into 10 into 24,500. 30%. 3001020. This will give you the total income. 23746,780. That means 207,45760. This is in itself is a tedious task. The figures are so confusing. 237, sorry, 207,45760. This is the correct figure. Our total income is correct now. 207,45760. We need to calculate the taxes. Just simply reducing 15 lakh, multiplying 30% plus 1.4 lakh into 1.15, actually, since it is exceeding 2 crore now. So 1.25 now, because it is exceeding 2 crore, so 25% surcharge will be applicable into 1.04. Wait a second, do not add education cess for a second. Do not add education cess for a second. Minus 15 lakh into 30% plus 1,40,000. 207,45760 minus 15 lakh into 30% plus 1,40,000 into 1.25. Taxes turn out to be 73,90,160. If you remember one provision, that if your income just exceeds the surcharge bracket, just above the surcharge bracket, then you have an option to surrender the income over and above. What I'm saying, just calculate taxes on 2 crore plus 745,760. Now, how would you calculate minus 15 lakh into 30% plus 1.4 lakh into 1.15? This is the amount how you would calculate. 2 crore minus 15 lakh into 30% plus 1,40,000 into 1.15 plus surrendering the above income 745,760. That means if the above method is used, 72,89,260 is arrived at. That means this assessee would get a marginal relief. If you do the hurry, you might forget this concept of marginal relief. Very basics class we are taught this concept. We get marginal relief when income is just above the surcharge bracket. How much marginal relief is arrived? 7392160. Okay, 7392160 minus 7289260. 102900 is the amount of marginal relief. But how much taxes would be charged? This plus 4%. That means 7289260 into 1.04. That means 758083 is 0 is the amount of taxes charged. 7580830 is the taxes charged. See, there is no difficulty in relief. There is no difficulty in relief. Average rate of tax we would arrive dividing this by total income. Total income is 20745,760. Average rate of tax in India would turn out to be nearly 36.54, which is irrelevant. Doubly tax income is simple. Doubly tax income is not an issue in itself because doubly tax income, business income would be that only. In addition to that, rental income would be same only. So there is no issue with respect to doubly tax income. Only thing difficult in this point was nothing but this tax calculation. If your tax calculation had gone wrong now, your answer would be absolutely wrong in every sense. Absolutely wrong. See, in the same case, they have also done the same thing now. How they have arrived at doubly tax income? 546 is the rental and 650 is the 546 is the rental income and 650 is this doubly tax income multiplied by 25%. They would get the relief. There is no difficulty. 650 in plus 546 into 25%. 2,99,000 is the relief amount. Both of them multiplied by 25%. So in this case, relief was not even a question. Question was with respect to surcharge, with respect to marginal relief. But it was covered in the format of DTAA. A good question in itself. Finally done with this question also. Finally done with these questions as well. Shall we start off with the next topic, the beautiful and the elegant and the most important of all, transfer pricing. You are bound to see a question from this. You are bound to see a question from this, and of course, a good question. I'm pretty sure that with these concepts, now you will be in a position answer things properly. Now, transfer pricing. Earth Private Limited Calcutta is engaged in trading of electronic goods. It purchased goods from its various associate enterprise Sun Pte. Singapore. It also purchased from unrelated party Oceania UK for financial 24-25. The gross profit margin was 15% on the sale of the goods of Sun Pte, whereas 20% in case of Oceania. Oh, just understand the diagram. Okay. Oceania and this is Earth PT. Now, Earth PT is buying goods from two people. First one is Sun PT and the other one is Oceania. These are the two people from which this assessee is buying the goods. Okay. Now, when this Earth is selling goods of this Sun, it is earning 15% margin, whereas when Earth is selling the goods of Oceania, it is charging 20%. Now, why there is 5% difference? Why there is 5% difference? Simple reason being you are buying things at a higher price. You are buying thing at a higher price. Of course, the Sun PT is the associate price. Therefore, you are charging, you are buying things at a higher price from associate. Therefore, transfer pricing provision would be applicable. Okay. Now, when it was asked why did it charge, why did it charge more, why did it buy at higher cost, the reason was given after sales warranty of 6 months was provided by Sun PT, whereas Oceania gave, oh my god, this is providing you 6 months warranty, whereas this is providing 1 year warranty. Despite of that, you are taking high, you are buying it at a higher price. The cost of warranty may be taken as 2% of sales price. Sun PT has a brand value. Okay, this is the brand value. Brand value you are giving. 1% of the sales value is the brand value. Okay, may be taken as 1%. During there, it goods sold of 20 crore rupees and Oceania 15 crore rupees. At regard to transportation cost, there was no difference. Compute the arm's length price. Now, what the cases understand? 20 crore goods have been sold. And on this, ideally 20% margin should have been charged. That means if I reduce 20% margin, so cost of acquisition should have been 16 crore. You are buying it from associate at a higher price. Ideally, you should have bought at 16. See, whatever you are buying at associate, it is maybe 15% reducing. That means 17 crore you should be buying. You are buying at 17 crore. But ideally, you should be buying at 16 crore only. You should be buying at 16 crore only. Ideal cases, you are buying at 17, but you should be buying at 16. But there are two functional differences. What are two functional differences? See, first of all, why I am paying extra? Why I am paying extra to my associate? First reason is because it is giving us brand value now. 1% brand value. 1% brand value. Now, of the sales of 20 crore, 1%, even if I add, so on the 16 crore, even if I add 20 lakh of brand value, I should be paying 16.2 only now. In addition to that, this associate is giving me only 6 months warranty, whereas this other related party is giving me 1 year warranty. And 1 year warranty is nothing but 2% of the sales value. So 2% of sales value is nothing but 40 lakh, and half 6 months extra warranty is given to us now. So it is a loss to us. 20 lakh will be reduced. That means ideal purchase price is 16 crore only. Arm's length price is 16 crore only. What did the warranty point was all about? I am repeating that. See, associate is giving me just 6 months warranty, whereas other party is giving us the 12-month warranty. Other party is giving us 12-month warranty. That means associate is giving us lesser benefits. Associate is giving us lesser benefits. Or I should say, we are already paying higher to associate for 6 months warranty. Ideally, we should pay lesser now. We should pay lesser to the unrelated party for 6 months warranty. Now, of course, we are not getting we are getting 1 year warranty. Ideally, we should be getting 6 months warranty from the unrelated party also. So we should be reducing the price now. So 20 lakh has been reduced. With that 16 crore is the ideal arm's length price. If you did not understand it, just listen to this point again, because this was a crucial point. 16 lakh is the arm's length price. Now, ABC Canada holds 35% shares in Element India, develop software for both on-site and off-site consulting services for customers. Okay, then. Element during the year built ABC. Okay, what the cases understand? Huh? ABC is a Canadian-based company. Element is Indian-based company, and it holds 35%, which means they are associates. It bills them also, and it bills the other parties also as well. For the financial year, Element billed for 120 man hours for 180. So 120 man hours into 1800 man hours. So how much billing they have done? 120 into 1800 would be 2,16,000. Okay, 2,16,000 is the amount of billing they have done. The direct cost is, oh my god. See, this is the issue now. Cost incurred is 2,25,000, and you are billing at 216. You are billing at a loss. You are billing at a loss. How can you transact at a loss? However, Element Limited billed XYZ at a rate of 28. Oh, XYZ. They have billed at 2,800 rupees for the similar level of manpower and earned 50% on cost. From unrelated party, you are charging 50%, but from related party, you cannot even charge anything. How can you charge 15% from 50% from unrelated, but not even single penny from the related party? How? There are certain differences. The transaction with Element and ABC, XYZ are comparable subject to following differences. Okay. While Element derives the technological support, see, from unrelated party, you are charging 50%. But from related party, you get na technological support, which may be 18% of GP. See, we are charging 50% to unrelated, but we cannot charge 50% from related now. Why we cannot charge? Because he is giving us warranty service, technological support, technological support. How much technological support he is giving? He is giving technological support of 18% of GP, 18% of 50%. That means 9% can be reduced. At least charge 41% from him. No? At least charge 41% from him. At least 41% you should be charging from him. Na? Got it, sir. Got it. Absolutely got that point. Second thing, ABC gives the business in large volumes, offers the quantity discount. See, we are charging 15% from the unrelated party, but we cannot charge 50% because he is buying in bulk. We cannot charge him. Reduce now. How much he is giving? 10% of the GP margin now. So 10% of 50%, that means 5%. Charge him 5% more or less. Charge him 36%. Question says, nah, 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 we cannot even charge that. In case of rendering services to ABC and Element, neither runs any risk or rewards nor any marketing cost. On the other hand, the cost of service was, oh, marketing may be considered as 12% of GP margin. See, we charge 50% from the unrelated, but we cannot charge 50% now. Because when I'm selling to somebody else, to an outsider, we run advertisement, we do marketing, therefore we charge more. But here we don't do anything now, so we cannot charge. Provision says just reduce that. Even 12% or 50% would be 6%. Reduce that. You should be charging 30%. 30% should be charged. LMN offers 1 month rate to ABC, whereas cost of providing may be taken as 2% of GP. See, you are charging 50% from third party or unrelated party. You are not giving him credit as well. But with related party, you are giving credit as well. That means whatever you are charging, you should charge more. That means 2% or 50% has to be added. That means 1% is to be added. That means 31% it turns out to be, I guess, 31% is the figure that is to be charged. 31% minimum should be charged. So cost is 225 plus 31%. That means 294,750 is to be charged. 294,750 is to be charged. What they are charging? 216. That means 78,750 is the addition or adjustment in arm's length. Adjustment that is to be done in arm's length price. We check the answer. This is the absolutely same answer that you would say. Absolutely same. So come on to question number 109. ABC Private Limited Bangalore is engaged in manufacturing of electronic goods and exporting it to various associated and other enterprises across Southeast India. The report with respect to international transaction with AE has been furnished for all the years. Company has applied APA in respect of transaction with AE. The application was filed on Feb 2024. Application filing for Feb 2024. That means APA will be applicable for 24-25, 25-26, 26-27, 27-28, and 28-29. These are the 5 years for which APA would be applicable. And 4 years for rollback, that means 23-24, 22-23, 21-22, and 20-21. Calling off the assessment year wise, 24-25 assessment year, AY 23-24, 22-23, and 21-22. These are the 4 assessment year for which APA would be given to us. Now, company had applied for the rollback benefit and it was signed in April. So April it was signed for perfect. The details have been given. Assessment year 1920, whether we will be given rollback for that year? No, sir, rollback would not be given to us. 2021 and 21-22, no disputes. That means rollback would be given. Absolutely, sir. Absolutely. 2021 rollback would be given to us. No issue. In assessment year 22-23, the assessment of 2023 was completed by making reference to TPO who enhanced the arm's length price to 500. Now, for 2023, assessment was referred to TPO who increased the arm's length price. For example, our income was 1,000 and he increased by 500. That means income turned out to be 1,500. If APA had been applied, the ALP determined for would be enhanced by 300 lakh as against 500 lakh. So, if rollback is applied, the additions would be only 300, not the 500. So, uh, can rollback decrease the amount of additions? Yes. Rollback can always reduce your assessed income. It can never reduce your filed income, but it can always reduce your assessed income. That means this 500 can be reduced to 300, but this 1,000 cannot be reduced in any of the sense. Therefore, rollback would be given for this year as well. That means previous year 21-22. For 23-24, arm's length price has been disputed before the tribunal and tribunal set aside and referred back to AO for fresh assessment. Now, whenever tribunals set aside and refer back to AO for fresh assessment, it never amounts to disposing of the application. If tribunal disposes of the application, then rollback is not allowed. But in this case, it has just set aside the assessment, so rollback would be given to you. For assessment 24-25, ITR was filed in December. That means late ITR was filed. So for this year, rollback would not be given. So yes, 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 and at last no, because late ROI. Done, sir. Simple question. Question number 110. Simple question it is. XC, an Indian company, in which Zilla, a US company, has 28% shareholding and voting power. Okay, sir. Done. XC sold 1 lakh t-shirts to t-shirts at $2 to Zilla. Identical t-shirts were sold to unrelated party named Kennedy. Oh. XC is an Indian company and Zilla is a US based company. Now, ultimately, it sold 1 lakh t-shirts at rupees 2 only. But ideally, this could have been sold to outsider for 3 rupees. That means $1 lakh is the less amount you are taking from the associate. 1 lakh less you are taking. Very bad. It borrowed 2 lakh from a foreign lender where guarantee was given by Zilla, where guarantee fees was 10,000 paid, whereas ideally it should have been just 7,000. You are paying 10,000 rupees as guarantee fees to Jilla. 10,000 as guarantee fees. Ideally, you should be paying just 7,000. So 3,000 extra you are paying that chats to be added to your income. XC paid 15,000 to Zilla for getting various potential customer details with to improve your improvement of the business. Oh, bhai sahab. It is paying 15,000 rupees to Zilla for getting customer, whereas ideally this could have been easily paid got for 10,000 rupees. So 5,000 is to be added back to your income. That means net addition would be 1,08,000. This is the net addition that is to be done. Now, what is the net addition? 1,08,000 into an exchange rate is given 64. Now just imagine 64 is the exchange rate when question was drafted. This question has been nearly 5 to 6 years old, it appears. Now 69 lakh 12,000 is the amount of addition to be done. Now our declared income is 12 lakh rupees and 69 lakh is to be addition. Now, entity is into special economic zones and it claims 10AA. Can 10AA be claimed on this increased portion? So it cannot be claimed. Once income is increased on account of adjustment, it can not claim 10AA on this increased portion of the income. XC cannot be claimed. 69.2 answer remains the same. This question you can skip out for some time. See, there was some mistake in this. See what it says. Let's solve it. There is an issue in this solution. Let me solve it for you so that if you are stuck somewhere, you will get proper direction. Alipay is an Indian company in which Andes Inc. A foreign country Z company holds 38%. So Alipay is an Indian company and Andes is a country Z based company. The 38% shareholding. Okay. During previous year 2023, Indian company supplied computers to country Z based 1100. Oh, now what it says, Indian company supplied computers to this at $1,100. Okay. Price of the supply to an unrated party is 1,400. Oh God. If you would have sold to an outsider, you would have easily got 1,400, but you are supplying it just at 1,100. Very bad person you are. During the course of the assessment proceedings, assessing officer carried out the adjustment of 168 lakh rupees, the difference between the actual price and the arm's length price on 700. So $300 into 700 pieces multiplied by exchange rate would be given to you that 80. So what into 80? This would give you the difference. $300 into 700 pieces into 80. This would mean 168 lakh would be the adjustment. 168 lakh, as it is saying, 168 lakh is the adjustment. It was duly accepted and assessing officer passed the order on 1st June 2024. Assessing officer passed the order for the adjustment on 1st June. Ideally, what should happen? Whenever order is passed, within 90 days, money should be repatriated back to India. If money is not repatriated back to India, ideally you should charge interest from the very next day. That means from 2nd June, interest should charge. From 2nd June, interest should charge. Now, X wants to know the effect of this transaction for assessment 25. It has declared income of 300 lakh rupees. Now, exchange rate is this, and 6-month labor rate is given to you. No issue whatsoever. Now, once it's 68 lakh, it is not repatriated back to India. So, assessee has two options. First of all, it can continue with the interest portion. It has to pay the interest portion at least for the year. How much interest would be applicable? See, 9.5% plus something. Whenever we have outstanding payment, whenever we have any money outstanding with somebody, and that too in rupee or that too in foreign currency. See, transaction is in foreign currency now. Transaction is in foreign currency. So in that case, we have to charge 3% in addition to this labor money. So 9.5 plus 3%, that means 12.5% is to be charged. And for how many days? It has to be charged from not from 1st June, but from 2nd June it should charge. Order was made on 1st June, so ideally it should be charging from 2nd June. 2nd June. So how many days it turns out to be? Ideally 365 days minus 30 days of April minus 31 days of May minus 1 day of June. So 365 minus 62, 303 days interest should be charged. Ideal case is this. 303 days out of 365. This is the first thing, interest it has to be offered. Second thing, SSC has an option to pay an additional tax. Now, how much additional tax? 18% additional tax plus 12% education surcharge plus 4% education cess can be paid by the SSC. This is a rescue option. If SSC opts to pay this much amount of taxes, then this is the final tax. Till this date, till the payment of taxes, assessee has to pay the interest. Beyond that, interest won't be applicable. If you see the answer, you will see the entire answer same, but only thing is by mistake, na interest has been calculated from 1st Feb only. This is the old answer. Ideally, ICI is corrected. Interest is calculated from the next day. In this case, na interest has been calculated on the basis of same day only, the same date of order. But ideally, it should not be done. It should be based on 303 days. So answer is a bit wrong. You can correct this answer. Whatever I have told you is the final thing. It can also pay the additional taxes. So additional taxes have been calculated in this sense. Now, 112 question, again some disputed question, not disputed actually, but question even that does not synchronizes with the logic. It is absolutely a correct question, but it presumes too many things. This question presumes too many things now, so it is difficult to digest. Let's try to solve it and then see how things go. Amar Private Limited Bangalore is engaged in IT enabled services. It is subsidiary of ABC USA. It provides similar services to SAC in Singapore and billing is given as below. Now understand this. What the case is? Now, Amar is an Indian company and it is a subsidiary of ABC. It provides services to ABC and to somebody else called SAC. ABC is associate and SAC is unrelated party. Billing is given to us ABC and SAC. We have been given billing of both of person. Both of them we have been given with billing. Now, ABC has provided loan of $1 lakh to Amar towards the purchase of the hardware. Executing the project rate of interest is 3% per annum. Done, sir. No issue. Direct and indirect costs are 100 rupees per dollar and 200 rupees per dollar respectively. Amar worked for 9 hours for 15 days for ABC and 8 hours for 15 days to SAC. Now, how much cost is incurred for SAC? Understand this, huh? And warranty for providing services to SAC is 2 years. Cost of warranty may be taken as 1% of the direct cost. And cost of warranty is neither included in the direct cost, not included in direct cost. Done, sir. Sorry. Arm's length price calculation based on cost plus method. Assume conversion rate is 64. Perfect. No issue whatsoever. Now, what things has to be done? Try understanding this carefully, very carefully. We provide services to ABC as well. We provide services to SAC as well. You manufacture and provide services to both. Whenever manufacturing is given, always use cost plus method. And in this question, it is already mentioned that cost plus method. Now, how much margin should be charged from associate? It depends upon how much we charge from unrelated party. We need to calculate how much we charge from unrelated party. For that matter, we have provided services of 8 hours into 15 days multiplied by 100 rupees for direct labor, direct cost, 8 hours into 15 days into 100 into 200 for indirect cost. This will give us the cost for the work. 18 into 15 into 300, of course. So, sir, 36,000 is the total cost involved for SAC. Total cost involved for SAC. Done, sir. Done. How much profit it is arrived at? Just understand the profit. How much profit? See, this is the cost. Profit turns out to be 34,000 divided by 70,000. 34,000 divided by actually 36,000. 36,000 is the what did I write? Profit is 34,000. So profit turns out to be 94.44. This is the amount of profit that assessee is getting. Assessee is getting from unrelated party. This is the amount of profit that assessee is getting. But remember, warranty was provided to SAC. Warranty was provided to SAC for 2 years. Cost of warranty is 1% of the direct cost. Understand this thing. This thing will change a lot. Understand. You are providing warranty to unrelated party, but you are not providing warranty to associate enterprise. Unrelated party, you are providing warranty, but you are not providing unrelated party warranty to associate. In that case, what you should do, ideally, what should be done? This has to be made comparable. This has to be made comparable. So warranty cost has to be reduced. Warranty cost has to be reduced. Therefore, profit margin has to be reduced. Now, cost profit margin should be reduced. Now, see, ultimately, what is happening? Try understanding. I am charging more from unrelated party because I am giving him warranty as well. I am charging him more on cost. I'm charging him 94% because I'm giving him warranty. If I would have not given him warranty, I would have charged him less. So profit margin would reduce. How much margin it would reduce? See, cost is 36,000. Amount of warranty turns out to be, just give me a second. Huh? Just give me a second. Just give me a second. Amount of warranty is nothing but 2% of direct cost. So 12,000 into 2% is nothing but 120. So cost turns out to be 36,120. Whereas billing remains the same, 70,000 rupees. So profit would change, 36,120 minus 70,000. 33,880 divided by 36,120. This would give us the proper profit. Divided by 36,120. 93.798 into 93.7984%. This is the amount of profit we should be charging from unassociate enterprise as well. Why this amount of profit we arrive at? Understand this thing very carefully. Why? Because 94% we can charge from unrelated party. We cannot charge the same amount from associate as well. We are charging 94% because we are even providing warranty. Associate, we cannot charge the same thing because we are not providing them the warranty. So this should reduce. Profit margin should reduce. This is how margin has been reduced. This is the amount of profit that we should charge. Simply 93.8% we can say. 93.8% we can charge. Now, how much cost is incurred? 9 hours into 15 days into 100 is the direct cost. 9 hours into 15 days into 200 is the indirect cost. How much cost is incurred? 9 into 15 into 300. This will be 40,500. In addition to that, there is some more cost involved. See, principal rate of interest. Now, how much how much interest is being charged? This is a careful point, critical point. $1 lakh is the loan amount. On that, 3% is the per annum. And how much time does it take to complete the work? It takes 15 days only. So ideally 15 days interest should be charged. But there they have assumed that interest is minimum for 1 month. So divided by 12 they do. So how much that 12 amounts to? 1 lakh into 3% divided by 12. That means 250 is the extra interest that they have charged. 4750 plus 93.8%. This would amount to 78,973. This will amount to 78,973.5. This is the billing that should have been done. We have done billing of 85,000. Of course, we have charged more, so no adjustment would take place. 78,974. We have taken more, so no billing, no adjustment would be done. Simple question it was. Another simple question. KVS and SSC had sold goods well located in NJA. Oh, see, KVS is an Indian entity. It had sold goods to L, who is located in NJA. Okay. And charge 11 point, Achha, for 10.5 crore. For 10.5 crore. Okay. During the financial year, KVS charged 11.5 crore from AJ. Achha, you are charging 11 from AJ, you are charging 11.5. And 12 crore from KP. From KP, you are charging 12 crore rupees. Oh, Baba. For the identical goods, both of them are, see, AJ is also not associate, KP is also not associate. Oh, bhai. But the issue here is they are on CIF basis, but when you are providing to associate, they are on FOB basis. Now, what is the difference? See, whenever you provide on FOB basis, cost is to be incurred by them only. In this case, cost is being incurred by this NJA only. This L only cost has to incur. Therefore, we are charging him less. But here we have to incur no cost, so we are charging more. So this is the basic difference. How much is the cost? How much is the difference? 20 lakhs to 20 lakh can be reduced. 20 lakh can be reduced to make them comparable. India has double taxation avoidance with India and UK. The SSC has a policy of providing after-sales support in tune of 14 lakh to all the customers except L to procure local. Oh, see, SSC provides warranty to everybody, but not to L. Therefore, it is not able to charge now. Now, what is the cost of warranty for others? Understand. SSC has a policy of providing 14 lakh to all the customers, which is procured locally. See, it procures a locally. Now, 14 lakh has to be reduced because 14 lakh warranty we are providing. This would give us the price that we should have charged from AJ. So, I mean, this is the price that we are actually charging from AJ, which is comparable to the person located in NJA. 11.5 minus 0.2 minus 0.14. This would mean 11.16 crore. 12 minus 0.2 minus 0.14. This would mean 11.66. Adding both of them, see, if we have two arm's length price, we would take average of two. So ideally, our transaction price would be 11. It should be 11.41. It should be 11.41. How much we are actually charging? 10.5 into 1 lakh, or I should say 1 crore. 91 lakh is the adjustment that should be done. 91 lakh is the adjustment to be done. Since figures are in crores, so 91 lakh is the amount of adjustment to be done. Done, sir. Question number 114. XYZ provides you profit and loss for the 2 years. Now let's see what the figure are. On 23rd July, X is an Indian company borrowed from LNTC. X is an Indian company. XYZ is an Indian company borrowed from LNT, country R-based company, and repayable over 5 years, guaranteed by SAM. Now, money has been guaranteed by the SAM incorporated in country. Acha, our associate has given guarantee to somebody and we are paying loan to that person. If our associate has given guarantee to somebody, then whenever we pay any money to such person, in that case 94B provisions would apply. That means in this case 94B provisions should apply. Calculate the amount of PGBP for the assessment here, assuming GP margin is okay. As per, okay, done, sir. No issue, no issue. Let's see. For financial year 2024 we'll do separately, and for 24-25 we'll do separately. We are given GP. Can we reduce employee benefit expenses? Yes, we can reduce. Do we need to reduce interest? No. Do we need to reduce depreciation? No. Do we need to reduce income tax? Do we need to reduce profits? No. We need to calculate EBITDA for the purpose of 94B. We need to calculate EBITDA for that matter. 2090 minus 390 we can do. That means 1640 is our EBITDA, and on this EBITDA 30% is allowed interest. Into 30% is the allowed interest. That means 492 is the allowed interest for 23-24. How much interest we have actually paid? We have actually paid 562. 492 is allowed. We have paid 562. That means 70 is disallowed. 70 is to be disallowed for last year. Remember, 70 is disallowed. Everything kept aside, nothing is relevant to us. Only thing relevant is 70 was disallowed in last year. Now current year. 1780 is the gross profit. Employee benefit expense minus 1780 minus 402. That means 1378. On this 30% would be allowed to us into 30%, which means 413.7, 413 actually 413.4. Now, how did we actually pay? How much we actually pay? We paid 130, we paid 389. We are paying less. Now remember, you are allowed to pay more interest, but you are paying lesser than interest. Then what would happen? Last year, which was disallowed, now you can claim the set off. You can say you can set that interest off. And how much you can set that off? You can set off up to 24.4. So current year deduction would be 389. Last year deduction would be 24.4, and therefore 413.4 would be disallowed. This has to be reduced. So this is GP. From this GP, you would reduce the employee benefit expenses. You would reduce the interest paid for current year, interest paid for last year. Depreciation you would also reduce. Income tax you don't have to reduce. Income tax has not to be reduced. We need to calculate the total income now. So 1780 minus 402 minus 389 minus 24.4 minus 254. That means 710. 710.6 is the total income. Oh wow, sir, how is it matching? Why will it not? Again, I'm asking the same thing. Why will it not match? It is bound to match now. It is always bound to match. Done, sir. Question number 115. Surya Limited is an Indian company engaged in manufacturing activities by importing raw materials from Sun Inc. UK. Okay. Surya is an Indian company. It borrows from Sun, UK based. Has total borrowing of 1 million pounds from XYZ. But out of that, Surya Limited has given guarantee of the 20% borrowing. Out of the total borrowing, 20% has been guaranteed by Surya. Done, sir. We are providing guarantee to our associate. Just listen. We are providing guarantee to somebody, that means that person is our associate. During financial year 24-25, Surya imported 60 crore goods. So Surya imported 60 crore worth of goods, okay, from Sun Inc. And it was acha. Sun Inc. supplied the similar raw materials to unrelated party at a markup of 20%, whereas for Surya it provided markup of 25%. We gave him 20% guarantee and he is charging us 25%, whereas for others he just charged 20% only. Understand? Huh? Now, Sun normally charges 20% from anybody, but it is charging cost plus 25% from Surya. And goods imported are 60 lakh rupees. 25% have been charged. Okay, 25% are being charged. Correct, got it, sir. Surya was allowed to use brand name without any payment. Okay. Unrelated party cannot use. See, acha, we are charging more because Sun is allowing us to use the brand name. Brand value is there. Okay, sir, done. No issue. Annual cost of the brand value is 100 lakh. Chalo, noted. Noted. Surya was allowed a credit of 2 months, whereas unrelated party. Okay, acha, brand value we are getting. 1 month credit we are getting. What is the value of 1 month credit? 12 month of the purchases through uniform throughout the year. Okay, assessing officer referred the case to TPO for the determination. You are required to compute the arm's length price. What is the due date for furnishing the audit report and what is the amount of penalty if report is not furnished? First of all, what is the actual purchase price? What is the actual purchase price? This has to be understood. Actual purchase price. Understand this. 60 lakh is the purchase price we are buying. We are buying 60 lakh of purchase price. Okay. This is inclusive of cost plus 25%. So this is equal to 1.25%. Ideally, we should have been buying for 1.2 only. 60 lakh divided by 1.25 into 1.2. So ideally, we should have been buying on 57.6 lakh only. We should be buying at 57.6 lakh only. This is our should be purchase price. If we would have bought it from somebody else, or if somebody else would have bought from Sun, then this would have been the purchase price. The unrelated party would have purchased at this price, but we are paying more. We are paying more. Why? Because there is warranty involved now. There is actually brand value also involved. So what is the brand value? Brand value is nothing but 12% per annum. 57.6 into 12%, or I should say 1%. 12% for 1 month, that means 1%. That means 0.576 lakh is the brand value. So we would pay extra for that. Even we would pay 100 lakh extra, 100 lakh extra. That means 1 crore extra for the purpose of the other things. Brand value. Brand value is 1%, 100 lakh extra, and credit extra given is 0.57 lakh. Okay. Even after that, plus 1% plus 1. Ideally, we should be paying 59.176 now, but we are paying 60. How much difference it is into 1 crore? 82 lakh 40,000 rupees we are paying extra, and this should be adjusted. This has to be adjusted, and this is the same thing given to us. See, this is the fun part of the answer. Surya Limited is also required to get its books of accounts audited by the chartered accountant up to 31st October. If it fails to get it done, 1 lakh penalty will be applicable. 92E, 30th October, at least 1 month prior to ROI, and if it fails, 1 lakh penalty would be applicable. Now, Diamond Lux. Now, what the case is? Diamond Lux BV is a foreign company incorporated in Belgium. It has diamond mining and trading in of raw diamonds. It sells raw diamonds globally. Previous year 24-25, it sold raw diamonds to Indian buyers in SEZ in Surat, Gujarat for 100 crore. An exhibition was taken in special notified zones in Surat, Gujarat for display of uncut unassorted diamonds and had income of 10 crore rupees from activity of uncut and unassorted diamond display. Diamond Lux also want to exercise the safe harbor rules. It want to declare 3 crore profit from trading of raw materials and 2 crore from the display income. Whether Diamond is eligible for safe harbor rules or can it declare 3 crore or 2 crore respectively as per safe harbor? Now what it is? Diamond Lux BV is a foreign company who came into special notified zones for, first of all, display of uncut unassorted diamonds and sale of uncut and unassorted diamonds. Earn 10 lakh rupees of display, the 10 crore of display income, on which it wants to declare 2 crore. It had earned income of sale of 100 crore, on which it want to declare 3 crore of income. What can they do? Understand this. Whenever any foreign company earns any income, in special notified zones on account of display of uncut unassorted diamonds. This is not taxable. Not even 2 crore is required to be to be offered. Not even 2 crore. Nothing is to be offered. But when company wants to offer the income as a sale of uncut unassorted diamond, it should offer minimum 4%. So minimum 4% is required. Lesser than that, safe harbor rule would not be given to you. It has to go under the process of assessment. It cannot declare lesser than that. For that matter, now we have to explain what are safe harbor rules, how CBDT has notified, what is the case of safe harbor rules in our case. In our case, what is the business connection, and in what cases it is not considered as business connection, and at last it can offer safe harbor or not. It cannot say opt for safe harbor rules if it is willing to opt for 3%. Another beautiful question, beautiful question. Now understand, this is also a good question to practice. Indiana Limited, an Indian company engaged in manufacturing and trading of electronic projectors. Now, Indiana has different entities. Indiana has three entities. It has 30% voting powers in Star GmbH. So, Star GmbH, 30% voting power. That means Star is the associate dancer. It can appoint 6 directors in Moon out of 15 directors. So, 6 out of 15 won't make it associate. So, Moon is also a transaction entity. Moon is not associate because less than 50% of the board of director can be appointed. It has guaranteed for a loan amounting to 12 million euros taken by the Asteroid Limited in UK. The value of the total borrowing is 150. So out of 150, only 12 million has been offered by us. That means less than 10% has been borrowed. So there is entity called Asteroid. On Asteroid as well, it is not associate. Indiana entered into different transaction with different entities. Now understand. Transaction with associate enterprise. Associate enterprise, it is entering into transaction, and what the transaction is. Indiana Limited bought 1,000 electronic projectors at rupees 15,000 for the purpose of resale in India. Now this is Indiana bought from Star. And what is the purchase price? 15,000. Done, sir. It sold the projectors without doing any modification. The gross profit margin on the sale is 20%. Now, margin on sale is 20%. Done, sir. Done, 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 done. Star GmbH provides after sales warranty of 1 year. Oh, this is providing 1 year warranty. Okay. Indiana bought 1,000 similar electronic projectors, same as a Star GmbH from Moon. It is also buying from Moon as well. Oh, but at 14,000. Ignore this 14,000. For the time being, ignore this 14,000. Okay. Per unit for the purpose of resale, it sold these projectors without doing any modification and earned 30%. Oh, 30% on sales price. Oh. First thing, you are purchasing from associate and earning just 20%, but you are purchasing from somebody else, you are earning 30% of the sales price. That means you are buying goods at a very high price, and it is clear cut case of resale price method. It is a clear cut case of resale price method. But the issue is Moon provides only 9 months warranty, so associate is providing 1 year. This might be one of the reason, but this cannot be only reason. Now understand. Asteroid we are not concerned with, because Asteroid is not even our associate, so we are not concerned now. Whether Star GmbH, Moon Associate, see, Star is associate, Moon is not, Asteroid is not. Calculate the arm's length price. We'll do that, of course. We are there to calculate. Now understand. Our cost price is 15,000 rupees. Our actual cost price is 15,000 rupees. What should be our used to be cost price? I mean, what should be the to be cost price? First of all, we need to have a sales price. 20% margin on sales. So 20% margin on sales, that means 25% on cost. So ideally 15,000 is the purchase price plus 25% margin if we charge on cost. So our sales price should turn out to be 18,750. This is the sales price that should turn out to be sales price. On this 30% has to be removed, minus 30%. So our purchase price should be 13,125. We should be ideally buying at 13,125. 13,125 is the ideal buying price. Now what this is, but there is a small difference of warranty. What warranty? The associate is providing 3 months extra warranty. Now what is the warranty? Cost of warranty is 3% of the sales price. Now cost of warranty is 3% of the sales price. 18,750 into 3%, And difference of warranty is only for 3 months out of 12 months. Now, what is the value of the warranty? Let's calculate 18,750 into 3% divided by 12 into 3. That means 140.625 is the warranty. Of course, we can pay this much extra now. This is the price that is charged from unrelated parties. If we would have bought from unrelated party, we would have got at 13,125. But we are buying from associates, so we are buying at a higher price. It is providing 12 months warranty. So we will get 12-month warranty now. We will get the 12-month warranty, but just with just an add-on of 140. So ideally, we should be only paying 13,125. 13,265.625 is the maximum amount that we should pay. It is a maximum amount we should pay, but we are paying 15,000. That means there should be difference. 13,265.625. 13,265.625 is the amount that we should pay maximum. Maximum, but we are paying how much? We are paying 15 crore. So the difference would be half the price adjustment. Question number 118. Examine whether the transactions and whether the transfer pricing are as valid as per safe harbor rules or not. First of all, Tech Mitra Solution is an Indian company, provides system support services to Blue Orbit, which holds 30% voting power in Tech Mitra. See, first of all, 30% voting power is being held. That means they are associated. Whenever you provide system support services, it is nothing but software development services. Whenever you provide software development services to associate, and transaction is up to 100 crore, then 17% of the profit you should be offering. And if transaction exceeds 100 crore up to 300 crore, then 18% you should offer. Transaction is 99 crore. How much you are offering? 8 out of 50. That means 16% you are offering. You are not allowed to offer. You are not allowed to opt for safe harbor rules. So 17% you should minimum offer. Now, Next Era Systems is an Indian company, provides data processing services. Okay, IT enabled services, it seems. Use of technology in IT enabled service to subsidiaries, not to subsidiaries. IT enabled services also we need to offer 17/18%. If transaction exceeds 100 up to 300, then 18% to be offered. How much it is offering? 45 out of 225. That means 20% is it is offering. Yes, safe harbor rule is valid in this case. Pragati and Company, a partnership firm registered in India as a Partnership Act, provides R&D services to an entity which holds 12%. See, for a partnership firm, we don't require 26% voting. We require only 10% of the interest. In this case, 12% is being held. Therefore, these are associate enterprises. Now, for research and development, we don't have 17% limit. We just have to check whether transaction up to 300 or not, and whether 24% has been offered or not. In case of research and development, we have 24%. So 50 upon 250, which will mean only 20%. Therefore, safe harbor rule is not allowed. In all the above cases, it is assumed that Indian entity which provide the services assumes the insignificant risk. Okay, it may be assumed that foreign entities referred above are non-resident. Would your answer change if it is NJA? If we are providing any services to person located in NJA, we are not allowed any safe harbor rules. No safe harbor rules are allowed to us. Come on to question answers from advanced ruling. Now we have only last some portion left. Examine the correctness or otherwise. Ricky is an individual aggrieved by the order passed by the Board of Advanced Ruling. Since the board is binding, he has no other option whether it is correct or not. It is absolutely incorrect. You can go to advanced ruling within 60 days to the High Court. If you are not satisfied with the order of the advanced ruling, you can go to High Court within 60 days from the date of the order. You can definitely go to High Court. See, remember, normally to go to High Court, you should go in within 120 days. But for advanced ruling, you should go in within 60 days. Mrs. Aritri is an Indian public sector company, wants to seek advanced ruling from the Board of Advanced Ruling in respect of matter of the computation with respect to question relating to computation. However, such matters already pending before ITAT as on the date of the application for advanced ruling. It cannot seek Board of Advanced Ruling as the case is already pending. Now, what the issue is? A case is already pending in ITT, but only for computation. Can it seek advanced ruling? It can seek. The statement is incorrect. It can seek. Now, when Indian company makes an application to Board of Advanced Ruling in relation to tax liability of Messer Pincers, a non-resident company arising of the transaction which is proposed to be undertaken, the value of the transaction is 250 crore. See, up to 100 crore, 2 lakh pieces required. 100 to 300 crore, 5 lakh pieces required. And more than 300 crore, 10 lakh pieces required. Now, Indian SSC wants to know the tax liability for the transaction on behalf of non-resident. Can it go for advanced ruling? Yes, it can go. What is the amount of fees to be accompanied with the application? Fees is to be 5 lakh. Application has to be submitted in 4 copies, but right now we submit online application, so copies are not required. What is the remedy available for the order of the advance ruling? If you are not satisfied, you have to go to High Court. Within 60 days, you have to go to High Court. Done. ABC Limited is an Indian company entered into agreement for providing technical know-how to PQR. Now, it is a good question. Understand? ABC is an Indian company. It provides technical know-how to PQR. It is country A based company. Country A. Okay. PQR is sister concern. PQR is sister concern named XYZ, which has obtained advance ruling on the identical matter with respect to MNC. See, MNC and XYZ have already undertaken some transaction and they have already took advance ruling on this case. Agreement is expected to be 500 and expected tax liability is 150 crore. ABC wants to make use of this advance ruling, so it applied to the board for the use of the same since it is identical matter. Now, ABC and PQR want to enter into transaction. They want to know the consequences of the transaction. PQR sister concern has already obtained the advance ruling on the similar concern. Can they directly use the same advance ruling? No, they cannot simply directly use the advance ruling. They shall go to advance ruling, tell the cases if advance ruling is satisfied based on the case that whether advance ruling is similar or not. Advance ruling will only give the judgment whether they can use it or not. Well, board will give the judgment whether they can use or not. To verify the transaction between the PQR, advance ruling, board compelled the production of books of accounts. Can ABC make an application to the advance ruling as per the act? Also examine whether can board ask the production of books of accounts on the similar, examine in context with the Income Tax Act. First of all, can SSC request to board for the application? Yes, SSC can request the board for using the same advance ruling. It can request. Of course, fees has to be paid. Same process would go, but board will tell whether they can use the same ruling or not. Board will tell. For that matter, board can request SSC to produce books of accounts, and it is the duty. Advance ruling has powers of a civil court, production of books of accounts, discovery and inspection, examining such person on oath, issuing summons, commissions. This can be done by advance ruling. Remember, in that case, one thing to be taken care of is board can request and SSC has to submit this thing, then only it is valid. Otherwise, legal proceeding can take place against SSC. Now we have some small last topics: base erosion, profit shifting, modern expenditure tax treaties. Only thing you need to hear. That's it. Now this point you can skip out. This is very technical. Now what it is MLI? Whether MLI will apply in the following scenarios or not. See, now what happens is MLI is nothing but a tool through which amendments and treaties can be made in a fast track manner. Now, understand, whenever MLI is being introduced, it has to be ratified in both the countries, ratified in country A and country B as well, and it has to be notified as well, notified as CTA in country A and country B as well. I mean, see, whenever any MLI is to be made in force, in that case, now both the countries to MLI should ratify them in their parliament. In addition to that, they should notify them as covered tax arrangement. And that means whatever arrangement is there, that should be mentioned. Notification should be done and ratification should be done. If any of the thing is mentioned, then MLI shall not apply. Now, country A and B have signatories to MLI. Both countries have ratified, but A has notified, but B has not notified, so MLI would not apply. Country A and B, DTAA cover tax agreement, both the MLIs are notified. A has ratified the MLI, but B has not ratified the MLI. So what would happen? It is invalid. It is again invalid. What do you understand by base erosion profit shifting? See, shifting of profit from high tax paying countries to low tax paying countries. That's the basic reason, basic meaning. Base erosion profit shifting means tax planning strategies that exploit the gaps and mismatches in tax tools to make profit disappear for tax purposes and shift it to the locations where there is no real profit but tax is low. So ultimately shifting from high tax paying countries to low tax paying countries by exploiting the gaps, exploiting the loopholes of the tax treatments in the different treaties. Now, what are the effects of BEPS? There are 4 consequences. First of all, there is underfunding of public enterprises. Second thing, tax integrity is hurt because individual face more burden. There is competition, more competition in case of local player because they are left with less income because of higher taxes. underfunding of public enterprises. Of course, government has to incur too much of administration cost for the revenue collection. So these are four consequences. Now, what were the significant OECD recommendation under Action Plan 1? See, OECD recommended three things. First of all, whatever the existing PE rules are there, that should be modified. Second thing, people should introduce virtual fixed place of business as PE as well. And third thing, countries should come up with some withholding taxes. Whenever somebody wants to remit money outside of their country, they should impose some withholding taxes. These are the three things. What actually did India did two things. First of all, it introduced equalization levy in 2016. In addition to that, India introduced significant economic presence under Section 9. These are the two things that India did. Now, what are the provisions incorporated in line with OECD Action Plan number 4? See, Action number Plan number 4. 4 is 94. 4 is 94. 94 implies what India has done, or what India has done in counter with Action Plan number 4 means how India has tackled the interest payment mechanism. See, what happens is big countries concentrate their money in India, concentrate their money in the countries where there is high tax. They concentrate their money in the form of debt, so too much of interest outflow takes place from that country. Therefore, less and less taxes, less and less profitability is left with high tax paying countries. So what India did, India has come up with 94B, where only 30% of the EBITDA can be only paid to associate. That is what India has done. Now, describe three-tier structure for BEPS documentation. See, three-tier structure is master file, where all the details related to place of incorporation, number of entities, business address, these are mentioned. Local file, all the transactions that are done exceeding 1 crore has to be entered into local file. And CBC reporting under 286, every parent entity has to report the every transaction of the every transaction related to profit, capital employed. These things have to be reported in CBC reporting. What is the nexus approach in Action Plan number 5 adopted in Income Tax Act? See, Action Plan number 5 can make you relate to 105 BBF. What does that mean? 105 BBF implies whenever somebody does any kind of patent work, patent work, such patent should be registered in India if expenditure of more than 75% is done in India only. Research work is done in India. Then such patent should be registered in India, and government should incentivize those with lesser tax rates. India has brought up 115 BBF, where any income from royalty on patents is taxed at the rate of 10% only. If more than 75% of the expenditure is done in India, then tax rate applicable is just 10%. Now, what is the hybrid mismatch arrangement? See, hybrid mismatch arrangement is nothing but in double non-taxation happening because of difference of treatment. Now, how it happens? Sometimes you take deduction of the single borrower. Sometimes you participate in exemption regime. Sometimes you misuse the foreign tax rate. Sometimes what happens is you take deduction without corresponding incomes. Action plan number 13, how standardized approach help? What are the advantages of three-tier structure? See, taxpayer will get more consistent transfer pricing positions. Tax administration would get useful information to access transfer pricing risk, and tax administration would be able to make determinations about their resources. See, these are the theoretical things. If you are able to do it, then do it. Otherwise, you can ignore this point as well. Application of tax treaties. What do you mean by double taxation, and what are the connecting factors that lead to double taxation? Now, what is double taxation? Taxing income twice. Now, what happens? Country charges taxes on two bases. First of all is source rule. The other one is residence rule. If somebody is a resident of some country and earns income from the other country, they are being taxed twice. Now, double taxation happens on the basis of two things. First of all, is because of jurisdiction, because of difference of source rule and residence rule. Second thing, double taxation happens because of economic nature. Because of nature of the treatment, because of the nature of transaction, it might be taxed twice. So economic double taxation is also one of the thing. For example, if you are remitting dividend from a country, in that country DDT is applicable, dividend distribution tax is applicable. So while remitting the dividend, you are paying taxes. But in India, you are receiving the money, you are again paying taxes. So in this case, you are paying double taxation because of the nature of the treatment, economic double taxation. Now, in addition to the taxing rights, double taxation avoidance agreement, there are some other considerations to receive whenever you enter any treaty. The basic reason for the treaty is elimination of double taxation and allocation of taxing right. This is the basic thing. What additional things? First of all, it helps the tax administration. I mean, it helps in easier collection of taxes. It helps in dispute resolution. It helps in equity and fairness. It helps in capital import export neutrality. It helps in promotion of public trade and investments. These are the things that help. These are the benefits of the treaty. What are the general rule of interpretation as per VCLT? You don't need to learn this one. This is very generic. First of all, you should read the subsequent agreements, subsequent practices, and relevant rules. In relation to a treaty, must be read in good faith. But that's it. That's it. That's it. You only need to read this. Only 4 or 5 points are sufficient. Not more than that. What are the extrinsic rates? See, whenever you want to read any treaty, what are the extrinsic aids? You should read the committee reports, protocols, preamble, some international court judgments, or multiple other things are there. For example, subsequent agreements, subsequent conducts of the parties. You can read them. This will help you understand. Other treaties can be read. Now, this is question number 134. Now, what this question is about? This is about MFN clause. For example, there are 5 countries: A, B, C, D, E. Now, these 5 countries are part of most favored nation clause. Now, for example, on 1st April 2022, we entered this MFN, group, most favored nation clause group. Now, later on, these countries have an agreement that everybody will charge interest at the rate of 10% only. Whenever interest is paid to each other, it will be taxed at the rate of 10% only. Later on, on 1st April 2020, we entered into agreement with USA to charge interest at the rate of 5%. Now, what are the things happening? Understand. What are the things happening? B is also a part of MFN, where it has agreed to be taxed at a certain price. Later on, B is entering into with some other party at which it is limiting its right to tax. In addition to that, it is notifying that so this 5% tax rate benefit has to be given to everybody. This is the issue. Whenever you become part of MFN and you give lower tax rate to somebody, and that lower tax rate benefit has to be transferred to every member of the MFN. Okay, sir. Overview of model tax conventions. Difference between UN model and OECD model. What is the basic difference? The UN model is followed between developing countries, or one of them is developed. OECD model is followed between developed countries. UN model forces more on source rule and resident rule, a compromise between them. OECD model follows the residence rule only. This is the basic difference. Tiebreaker rule. How tiebreaker rule shall be applicable? Understand. If a person becomes resident of both the countries, then tiebreaker rule shall apply. Now, how tiebreaker rule apply? First of all, you need to check where he is where he is permanent resident. Where is his permanent home? If he has permanent home in both the countries, you have to check where it is personal and economic relation more close. If he has personal economic relation close in both the countries, then we have to check habitual abode. If he has habitual abode in both the countries, then we will check his uh, nationality. If he is national of both the countries, then both the countries' economic competent authorities would come together and they would decide based on MAP. What is meant by interest and fees for technical services? The interest, first of all, like the video. Even if you have not liked the video, okay. What is interest now? Last 2 minutes only. Interest is nothing but income from debt claim of any kind. For example, if I give money to somebody, for example, 5 lakh I give him. Whatever additional money that I get over 5 lakh is interest. Whatever additional that I get is interest. Now, if I give loan, it can be secured, it can be unsecured, it can be participating, it can be non-participating, anything it can be. What is fees for technical services? Managerial, technical, and consultancy services, but it does not include mining, it does not include construction, salary. These things are not included. What are automated digital services, teaching services, cloud engine services, content creation services, advertisement services? Multiple similar services are considered. Now, what are the payments covered under royalty? See, whenever royalty is considered, now, see, under OECD model, one thing is said: right to use intangible asset is royalty. But under UN model, in addition to that, two things are mentioned. First of all, rentals of film tapes. Rental of film tapes used for radio and television broadcasting also includes royalty. And equipment rentals for industrial, commercial, and technical equipment is also royalty. Under UN model, we have two more extra things: rental for film tapes and equipment rentals are also royalty. OECD model, only intangible is considered as royalty. Exchange of information. What this says: exchange of information is very simple. two countries sitting together and deciding how they are going to share the information. Now, why it is important for tax administration purpose as well, for other informations as for other purposes as well. It facilitates exchange of information, curtails cross-border tax evasion, and particularly relevant for the perspective of the developing countries. Okay, what do you mean by globe rules? Now, what it says, if any of the company has turnover more than 750 million euros, then it should pay minimum of 15% of taxes. That's it. This is the globe rules. If company has turnover of more than 750 million euros, it should pay minimum 15% of the taxes total wise in every country. That is the entire point. I hope these question answers were helpful to you. If you liked the video, if you really liked the video, do share it with your friends. Do comment down how was your experience, and do tell what all videos you want for your attempt. Thank you so much. It real effort to come up with this video. Thank you so much for supporting. See you guys in some other video. Bye bye. Take care and enjoy studying.